compulsorily watch this my introduction part before you start watching the marathon session. Do not miss the very important information I'm going to share you regarding September exams, applicability of amendments, MTPs, RTPs, revision lectures from Sreshta. Fine. So we for every attempt, we have a practice of uploading all the subjects free revision classes on the YouTube, and P1 accounting, revision marathon is going to be handled by Karthik sir. By the way, all the revision classes which we are going to upload now are completely a re-upload of the May marathons itself. Many students are asking us, sir, May marathon can I watch for September? Absolutely, you can watch. But to avoid confusion, we are once again a fresh uploading whatever May marathon is it, that itself we are re-uploading once again. Right off that you are watching, no, that's nothing but a re-uploaded version of May marathon itself. Absolutely same. Not just for September, man. Even this marathon, whatever you are going to watch is useful even up to January 25 attempt. But for May 25 exams, we will give a separate new marathons for all the subjects. Up to January 25 exams, the same marathons can be used. September 24 and January 25. Sir, what about income tax and GST, sir, for January attempt? Some of you might have doubt. Same syllabus is applicable. Same. Whatever is applicable for September, same is applicable. Don't worry, subject wise, I'm giving you an introduction. So right now you may be watching accounts, law, tax, or maybe you're watching costing, whatever it is. So just watch this. So accounting marathon is being handled by Karthik sir. He's a renowned faculty like for accounting. So he's going to take up the class. And by the way, for all these marathon classes, we have used a material, like our own material is there, which is in PDF format, is free of cost available. So you open Sreshta for CACMA website, you open this. So here you will find PDF resources. Here you will find subject wise the breakup. So subject wise, you will find the materials, whatever that we actually used in our particular marathon. So law, this is being handled by our faculty, Subramaniam sir. Income tax, myself will handle. GST will be handled by myself. Ganesh sir will handle costing and financial management. Again, auditing, you know me. So I myself handle strategic management. Remember once again, this marathon is not separately done for September. It's not required. Institute itself has not given separate books for September. Institute has not given separate books for January attempt. For September, January, whatever May 24 books were there, the same books are applicable. Just to that, in taxation alone, we have one amendment in income tax, only one amendment related to PAN rules, permanent account number rules. GST, we have few amendments, all put together 30 to 40 minutes. That's the only amendment. If at all you are watching May 2024, if at all you already given attempt for May 2024, already you have all the resources for May 2024 exams. If at all you are spending this 40 minutes extra to May 2024 effort, enough. You are done for September 24. So I just want to give this introduction. And remember, we are going to give you revision marathon, RTP for September, MTP and MTP videos also we are going to. And if you open our YouTube channel, see a Ram Harsha. If you go to the playlist, you go to the playlist here. Here you will find a playlist name called September 24 Marathon RTP MTP. In this, you will be finding all the videos that we are uploading for September 2024 marathons, be it RTP, MTP1, MTP2. So why late? Continue watching the classes. Kindly watch the marathon at standard speed. Don't try to watch at 2x speed and try to finish as soon as possible. You are here to revise thoroughly, not to finish the class. Revise the class. You are watching this class for revision, not to finish it off. Believe in the process. Watch at standard speed. The way you experience the subject is going to be superb. And most of the students have given one feedback for all our marathons is greatest of all time. Greatest of all time. The kind of clarity that you get if you watch our marathons is higher than, I bet, I challenge, this clarity that you get through just our revision class is much more higher than the clarity that you already have on your regular class of some other institute, because you have never tasted Sreshta's standard. Now you will experience how our revision class on accounting, law, tax, GST, income tax, whatever subject you pick your choice, experience our standard, and it's altogether different. That's it. All the very best. Do well. Continue watching.
Hello students, welcome to Sreshta for CA and CMA. Myself DV Subramaniam, Chartered Accountant and faculty for Corporate and Other Laws paper at CA Interlevel. This video lecture is all about marathon of corporate laws. For other laws, I made separate video which is already available in YouTube, and that video lecture is sufficient for upcoming CA inter examinations. Under corporate laws, we are having 10 topics. From examination point of view, you can expect minimum 4 marks and maximum 8 marks from each and every topic. Particularly if you look at small chapters like preliminary, deposits, charges, dividends. 4 topics, roughly you will read some 20 sections. And in examination, you can expect 20 marks from these small topics. So don't ignore these small topics. Clear? And the first topic of our marathon lecture is preliminary. Under preliminary chapter, we are having 2 sections. Section 1 is all about applicability of Companies Act. Section 2 is all about definitions. So let's look into section 1, applicability of Companies Act. First of all, what is meant by company? Company means company incorporated under Companies Act 2013 or any previous company law. Under previous company law, you can observe Companies Act 1956, Companies Act 1913, Companies Act 1882 and Companies Act 1866. That means if your association, if it is incorporated under present Companies Act 2013 or incorporated under Companies Act 1956 or incorporated under Companies Act 1913 or 1882 or 1866, yes, our Companies Act 2013 is applicable to all these associations. It is immaterial whether you are incorporated under previous company law or present Companies Act. So simply Companies Act is applicable to all new companies which are incorporated under new act as well as old companies which are incorporated under previous company laws. And our provisions of Companies Act also applicable to banking companies, insurance companies, generation or supply of electricity companies. However, if there is any conflict between Banking Regulation Act and Companies Act, Insurance Regulatory Development Authority of India Act and Companies Act, Electricity Companies Act and Companies Act, in that case, you have to follow special provisions. Simply, you have to follow respective provisions of respective acts. Simple rule. Conflict between general rule and special rule. Always special rule overrides general rule. Yes or no? This point I explained in General Clauses Act also. Best example, Schedule 3 financial statements as well as accounting standards. Every company is required to prepare financial statements according to Schedule 3 as well as accounting standards. However, banking companies, insurance companies, generation or supply of electricity companies are not required to comply Schedule 3 as well as accounting standards. But still, those financial statements can express true and fair view. Next one, companies incorporated under separate statutes or special acts like Life Insurance Corporation, State Bank of India, and our Institute of Chartered Accountants of India. All these associations had special statutes. These associations came into picture because of those statutes. Now, whether Companies Act applicable to these statutory companies, which were incorporated under separate statutes, the answer is yes. Next one, notified body corporates. Notified body corporate. Example, foreign company. Foreign company comes under the definition of body corporate. Foreign company means what? Company incorporated outside India and having place of business in India, whether physically or electronically. Yes or no? Now, body corporate definition, if you look at body corporate definition, body corporate includes a company incorporated outside India. Under Companies Act 2013, there is a separate chapter, it starts from section 379 ends with section 393. So these sections are applicable to foreign company. Is it clear? So it is all about applicability of Companies Act 2013. Next one, yes, of course, area point of view, it is applicable to whole of India. Next, definitions. Definitions, important definition, private company and small company, subsidiary company. These 3 definitions are very, very important from examination point of view. Private company, small company, subsidiary company. So first, I'll start with private company. Come on, students, tell me, What is meant by private company? A company with minimum 2 members, and it should have minimum paid up share capital as may be prescribed. Till date, no order from Government of India with respect to paid up share capital. So minimum 2 members are required. Fine. Next, its articles of association should contain 3 clauses. First one restricts transfer of shares to protect privacy, to provide confidentiality of private matters. So there is a restriction on transfer of shares. Next, limits number of members to 200. Next one, prohibits public offer. Prohibits public offer. Many students, in examination, they're writing wrong points. They're writing like this: prohibits transfer of shares. Transfer of shares is permitted, but with some restrictions. It is not prohibited. Any member, if you want to transfer his share, yes, he can transfer subject to board approval. So first he need to write his willingness to transfer his shares. He need to share his idea of transfer with board of directors. Then board of directors will permit you to transfer shares to the existing members. If existing members are not willing to take your shares, then offer shall be made to the persons known to board of directors at a price fixed by the board of directors and certified by the company auditor. So following these restrictions, transfer of shares is permitted. It is not prohibited, it is permitted. Next, limits the number of members to 200. While counting 200, 2 conditions you need to satisfy. One is joint shareholding. If you observe joint shareholders, you should not count them, according to their number. You should count them as 1. Suppose 10 members holding 1 or more shares jointly under a single share certificate, then you should not count them as 10. You should treat them as 1. Next one, employees who became members during their employment, whether present employees or past employees. But if they become members during their employment, then you have to exclude them while counting for the purpose of 200. Next, private company. Name itself is telling private. So this association should not invite public to get share in the ownership of company. So it is prohibited from making public offers. Clear? Next one, coming to public company. Public company definition is very simple: a company which is not private company, and it should have a paid up share capital, minimum paid up share capital as may be prescribed. And very simple, here transfer of shares permitted freely. Members can transfer their shares freely without any restriction. And coming to the members, no limit on number of members, unlimited. It can have unlimited members. And coming to public offer, yes, permitted. So public company, transfer of shares permitted, public offer permitted, limit on number of members, there is no limit. And this is one part of definition of public company. There is another part of definition, that is any company, whether it is a public company or private company, if it is subsidiary to public company, then also it becomes a public company, deemed public company. Have you heard about it? Deemed public company. Deemed public company means what? Any private company or public company, if it is subsidiary to public company, then it is deemed to be a public company. It is immaterial whether its articles of association contain these 3 clauses. You are a subsidiary to public company, you will be a public company. Clear? Everyone. So with this private and public company definitions we completed. Next one, small company. 2 to 3 times this topic was tested in examination. Small company. On what basis, one can categorize a company as a small company? Very simple. See, first of all, it should satisfy 3 conditions. Condition number 1, not a public company. It should not be a public company. That means always a private company. Condition number 2. Paid up share capital shall not exceed 4 crores. Third condition. Turnover during preceding financial year. Preceding financial year, very, very important word. Remember, preceding financial year, the turnover of the company shall not exceed 40 crores. If all these three conditions are satisfied, then we can call a company as a small company. And we need to check these limits every year, every year. Suppose in the financial year 2022-23, the company paid up share capital is 1 crore and turnover is 10 crores. For example, 10 crores. Now coming to financial year 23-24, yes, this is a small company. This is a small company. And coming to financial year 2023-24, turnover increased to 50 crores. Turnover went up to 50 crores. Now for financial year 2024-25, it is not a small company. So for each and every year, you need to check the status of small company. How to check, sir? Go to preceding financial year financial statements. Preceding financial year financial statements. If turnover is less than or equal to 40 crores, if paid up share capital is less than or equal to 4 crores, then of course it should not be a public company. Then you can call it as a small company. Now coming to financial year 24-25, paid up share capital same, there is no change, 1 crore. Turnover fall into 10 crores, sir. Turnover fall into 10 crores. Now with respect to financial year 2025-26, whether the company is treated as a small company or not a small company. Come on, students, respond. Is it a small company or not a small company? The answer is yes, it is a small company. So don't come to a conclusion. Once lost, forever lost. Wrong. Generally, once small company status lost, always lost. It is a wrong statement. Every year, every preceding financial year, you have to check into the figures of turnover as well as paid up share capital. If they are within the limits, now coming to current year, it will be a small company, or else it is not a small company. Understood, everyone? Now, being a small company, it had many advantages. Coming to financial statements, no need to prepare cash flow statement. Cash flow statement is not required under financial statements. Next, rotation of auditors is also not applicable. That means a company can have a single person as an auditor for 10 years, 15 years, 20 years. There is no problem. And next one, annual returns. It is sufficient. A single director signing annual return. No need of company secretary signature. Annual returns. Next one, CARO not applicable. You all know CARO. Yes or no? So many privileges small company is having today. The only reason, reducing compliance cost, so that it encourages many associations to come and register under Companies Act 2013. Then Government of India definitely will have a control on these associations, or else many associations will do business under a partnership type of organization where registration is not mandatory, and then government can't have control on them. So in order to get control over such associations, this is like an encouragement provision. Understood, everyone? And one point I ignored, I missed, that is small company. Following companies are not treated as small companies. 5 companies we are having. Public company is not a small company. Holding company is not a small company. Subsidiary company is not a small company. Companies registered under section 8, company with charitable objects, not a small company. And companies registered under separate statutes, simply I call them as statutory companies. So these 5 entities are not treated as small companies, even though they satisfy paid up share capital limits and turnover limits. That's it, all about small company, everyone. Next, holding subsidiary associate companies. Holding subsidiary associate companies. Holding company definition, very, very easy. We can call a company as holding company if it had subsidiary companies. Any company having subsidiary or subsidiary companies, we can call that company as holding company. Now coming to subsidiary company. A company can be treated as subsidiary company if it satisfy either of these two conditions. Condition number 1, control over composition of board of directors. Control over composition of board of directors. So composition of board of directors means what? You all know maximum in a company 15 directors you can have. Maximum in any type of company, whether it is a private, one person or public company, maximum a company can have 15 directors. Of course, you can increase this limit by passing special resolution and by making a alteration to articles of association. Okay, so max to max it can have 15 directors. Now control over composition of board of directors means more than half of the directors. Now if you look at 15, more than half means 8 out of 15 directors. If another company is having a control means how, sir? Removal power, appointment power. If these powers are vested with another company, then another company is treated as holding company. Our entity is called a subsidiary company to that holding company. Are you all getting my point, students? So control over composition of directors. That means, if an entity is having, if a body corporate or if a company is having composition, if a body corporate or any other company is having control over composition of board of directors, then this entity is treated as subsidiary company. That company is treated as holding company. Next, condition number 2. Possess not less than or simply more than half of total voting power. Of course, voting power comes from equity share capital only. I agree with you. So if your entity, if your company possess more than or simply not less than half of the total voting power, then this entity will be subsidiary company and holding company, which hold more than half of the total voting power. This type of control, it can be exercised in 3 ways. One is direct, the other one is indirect, the next one combination. I'll tell you example. Just see, A Limited is having 60% of voting power in B Limited. Now B Limited is a subsidiary of A Limited. Direct subsidiary. Next, B Limited is holding 54% voting power of C Limited. Now C Limited is subsidiary to B Limited as well as C Limited is subsidiary to A Limited. Now C Limited is controlled by A. Indirectly, how? A is controlling B and B will control C. Finally, C is under control of A. Understood? The entity controlling other entity, we call it as holding company. And controlled company, we call it as subsidiary entity, subsidiary company. Understood? So total indirect. Next one, A Limited is holding 60% of voting power in B Limited and 40% in C Limited. This B Limited is holding another 25% of C Limited. Now if you observe, in C Limited general meeting, who can attend? A Limited representative as well as B Limited representative. B is already under the control of A Limited, yes or no? So now B will listen to A and B Limited will cast vote according to the will and wish of A Limited only. So now A Limited is having 40% control in C Limited, B Limited is having 25% control in C Limited, finally 65% control A Limited is having in C Limited. Now C Limited is also treated as subsidiary to A Limited. A Limited. Are you all getting my point, students? Everyone. So C Limited is a subsidiary to A Limited. This is, direct and indirect combination. And I forgot to tell you one point, Suppose me individual, holding 60% paid up share capital or 60% voting power in Reliance Industry Limited. Now, can you call Reliance Industry Limited as a subsidiary to V? The answer is no. Why? I'm an individual. I'm not a body corporate. So, holding company status will be given to company and company includes body corporate. So if an individual is holding more than 50% of voting power, you can't call individual as a holding company. Company means company incorporated under Companies Act 2013 or previous company law. I'm an individual, I'm a natural person, I'm not an artificial person. Are you getting my point? So here there arises no holding and subsidiary relationship. In order to call entity as a holding company, it should be either a company or body corporate. Understood? Next, associate company. Associate company, very simple ma. We can call one company as an associate to another company if that another company is having significant influence. What kind of influence? Significant influence. Sir, significant influence means how much, sir? At least 20% of voting power. If a company is having at least 20% of voting power in another company, then this company becomes associated company. Now, if you observe, sir, 60% is also more than 20%. No, sir. Yes, that means, if a company is holding 60% of voting power in our entity, then will it become associate company or subsidiary company? Subsidiary. So that clarification is provided, ma. All associate companies exclude subsidiary companies. All associate companies exclude associate companies. So simply just observe 20%, but less than or equal to 50%. 20% of total voting power. Total voting power. So 20% of voting power, 50% of voting power. So minimum 20, maximum 50. In that case, there arises associate company relationship. What relationship? Associate company relationship. Now 50 and above. So simply not, sorry, it's not 50 and above, more than 50%, and up to 99.999 percentage, there arises holding subsidiary relationship. If it is equal to 100%, then there arises wholly owned subsidiary. What kind of company? Wholly owned subsidiary. 100% owned by another entity. Clear? And one special point, associate company includes joint venture companies. Is it clear? Everyone? Okay, fine. So with these major important definitions we completed. So private company, public company, small company. Now very recently small company figures have been enhanced. So paid up share capital to 4 crores and turnover to 40 crores. Holding subsidiary and then associate company also we completed. And one special point how to remember. If a examiner want to twist a question, if you want to give tricky questions, then there is a chance of asking questions like this. So one such question I already explained. 1 year paid up share capital, turnover crossed 40 crores. The another period, another financial year, it is within the limit. So small company status will be lost forever, or once again a small company. Like that one topic I explained. Another one, fiduciary capacity. Other topic, fiduciary capacity. While determining holding subsidiary relationship, while determining associate company relationship, shares held by these entities in a fiduciary capacity. What capacity? Fiduciary capacity shall not be considered. Means what? Suppose A limited company is there, B limited company is there. A limited is holding 46% of voting power in B limited. Okay, sir. Managing director of A limited is personally holding some 10% voting power in B limited. Personal holding, it's not on behalf of A limited. It's not a representative relationship. It's a personal relationship. Managing director, out of his personal funds, he invested in B limited and it constitutes 10% voting power. So A Limited is holding 46% voting power. Managing Director is holding 10% voting power. Okay. One day he got heart attack and he's going to die. He called his lawyer, advocate, and he prepared a will. According to this will, his son, till he attains age of majority, 21 years, 18 years I know, but in some cases 21 years. Till his son attains 21 years of age, all my properties, all his properties will be under the control of A Limited. So simply A Limited is going to act as a legal representative of, yes, a guardian, a legal guardian. How long? Till son attains age of 21 years. Because of this will, now A Limited is holding 46% of voting power directly, as well as 10% voting power on behalf of managing director, deceased managing director, according to the will. Now, sir, can I add this to, can I write 56% voting power is having with A Limited? So A Limited is a holding company, B Limited is a subsidiary company. Is it correct? The answer is no. Shares held in a fiduciary capacity shall not be considered for the purpose of checking holding and subsidiary relationship. Are you all getting my point? And similar rule is also applicable here, company as well as associate company status. Everyone. Next up, and we had one more important definition, that is government company. Government company. So government company means what? No, it's a company in which central government alone, state government or state governments alone, or sometimes central government as well as state government as well as state governments put together hold at least 51% of paid up share capital, then this company becomes government company. This is one part of government company definition. The other part, if any company is a subsidiary to government company, then this company is also deemed to be government company. So two conditions, either of these conditions, if it is satisfied, then we call it as government company. First one, at least 51% of paid up share capital is held by central government alone, or state government companies alone, or combination of these all governments, then we call such entity as government company. And any company, if it is subsidiary to government company, then we call it as government company. Suppose central government is holding 56% of voting power in Indian Oil Corporation Limited. Now Indian Oil Corporation Limited is automatically a government company, and IOCL is holding, for example, 52% of voting power in A Limited. Now A Limited is also a government company. Understood? Everyone. Sir, how can we identify government companies? Very simple. If it is a central government company, in SIN, corporate identity number, you can observe GOI. In state government companies, you can see SGC, state government companies. In SIN, you can observe these three words. Looking at these three words, you can come to a conclusion whether it is a government company or not a government company. Clear? And next one, you can see, company limited by shares, company limited by guarantee, company unlimited companies. So what is the concept of these companies? Very simple. On the basis of liability, companies are classified into three types. Limited by shares. Here, each and every member is liable to the extent of unpaid value multiplied by number of shares held by the person. So how many shares I am holding? 20 shares. What is unpaid value? 2 rupees. 20 into 2 rupees, 40 rupees is my maximum liability. And suppose, my colleague, my neighbor is holding 2000 shares. 2000 shares into 2 rupees. 4000 is maximum liability. Understood? So in the event of liquidation, a deficit, simply if assets are not in a position to meet liabilities, so assets less than liabilities, there is a deficit, sir. Deficit amount or unpaid value, whichever is lower, is the maximum liability of members. Understood? And there is no concept of joint and several liability. Each and every member is liable for his own share, not for other shares. Under partnership firms, each and every partner is liable not only for his share but also for other partners also. Yes or no? So there is no concept of joint and several liability under company limited by shares as well as under company limited by guarantee. Unlimited companies, in the event of liquidation and if assets are not in a position to meet liabilities, now not only business assets but also personal assets are held liable to the business liabilities. So members' personal assets are also responsible to company liabilities. Clear? With this, I completed preliminary topic. Preliminary chapter completed. Next one. Incorporation of company and matters incidental thereto. 20 sections we are going to cover. Section 3 to section 22. Section 3 to section 22. Examination point of view, you can expect 6 marks. And very, very important from practice point of view. Those who choose practice as their career, this chapter is very important. You can earn minimum 15 to 20,000 for each and every company incorporation. Clear? So examination point of view important. From career point of view, very, 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 very important. The first topic is concept of promoter. Concept of promoter. Who is a promoter, ma? So we had a definition. Promoter. Promoter. The person who falls under this, any of these three categories. Any of these three categories, we call him as promoter. One is who has been named as promoter in the prospectus or annual return. So company, before making public offer, it is required to prepare a document called prospectus. In prospectus, company has to disclose the details of the promoters. If your name is mentioned as a promoter in that prospectus, you will be the promoter of company. And every company is required to file annual returns with ROC. In that annual returns, you can find the details of promoters. If your name is written as promoter in the annual returns, then you will be promoter of that company. Next one who has control over affairs of the company, either as a member or as a director or any other character, simply creditor, financer, banker, who is having control over entity according to an agreement executed between company and creditor. Suppose our association required funds and one person agreed to provide finance and he put one condition: any key decision in the company, before you implement the decision, you have to take my approval. So my prior approval is required to implement any new business policy. Now I'm not a member of the company, I'm not a director of the company, still I had control over affairs of the company, so I'll be treated as promoter. So promoter, by way of name, you'll be a promoter. By way of having control, you'll be the promoter. Next one, shadow promoter. Shadow. See, on whose advices, instructions, directions. On whose advices, instructions, directors, the board of directors are accustomed to act. Accustomed to act. In that case, that person is also treated as promoter. That person is also treated as promoter. However, under this third category, one person is excluded. That excluded person is professional. Professional. Sima, business people know how to do business. They don't know the provisions of Companies Act, Income Tax Act, etc., etc., etc. So every month he is asking me, sir, what to do this month? I told you, okay, this is the month of September. You need to conduct general meeting. You need to prepare financial statements, and those financial statements should get audited, and those financial statements should be approved in the general meeting. So according to my advisors, instructions, directions, the directors are following. The directors are implementing. Now, sir, can you call me as a promoter? No, I'm a professional. So any professional rendering services in professional capacity, as long as he render services in professional capacity, he is not rated as a promoter. As a professional, he is excluded from the definition of promoter. Of course, in additional to professional services, if I render any business services, If I render any management services to that person, sir, you should go to that place, you should get permissions like this, you have to dig this much quantity, you have to sell this much quantity to this supplier. That means, business advices, business strategies. If I'm rendering those services and advices, then I'll be treated as promoter. Very simple definition. Named as a promoter in prospectus or annual return. Control over affairs of the company as a member or director or otherwise, or on whose advices, instructions, directions the board of directors are accustomed to follow, then these persons shall be treated as promoters. Clear, everyone? Next one, section 3. Section 3. So section 3 is all about formation of company. So here we are having two topics, section 3 and 3a. Section 3, formation of company. So before you form company, a Companies Act is giving you three options. Which you have to select one option. OPC, private, public. Coming to OPC, members, minimum OPC 1 member, private company 2, public company 7. And maximum, it is not prescribed under section 3, it is prescribed under respective acts. Suppose if you look at section 3, OPC, maximum 1 person. Private company, section 2, clause 68 is clearly mentioning a point. Max to max, the number of members are limited to 200, and public company unlimited. Okay, sir, what about directors, sir? Directors, minimum 1 in OPC, 2 in case of private company, 3 in case of public company. Sir, maximum, yeah, maximum in all companies, 15 directors. They can have 15 directors. Okay, sir, a selected private company, sir. Okay, once again, 3 options will be enabled. Once again, sir, what are those 3 options? You have to choose whether you need company limited by shares, limited by guarantee. Okay, next, unlimited companies. So you have to select one option. Sir, I'll go with limited by shares. Okay. So this is all about section 3, formation of company. Yes, of course, OPC is there. I'll tell you. Now, section 3A, breach of condition of minimum number of members. So what I told you, public company, minimum it should have 7 members. So this condition I should satisfy not only at the time of incorporation, but also subsequent to incorporation. That means as long as I do business under company type of organization, I should have minimum 7 members. Suppose if number of members fallen below 7, then what is the consequence, sir? What is the consequence? Imagine 7 members are there. Imagine A, B, C, D, E, F, G or 7 members of public company. F, G working abroad. F is working in France, G is working in Germany. This company is incorporated some 5 years back. Now on 1st April 2020, COVID pandemic happened. Yes or no? COVID pandemic is there. Because of this pandemic, Mr. D and Mr. DE deceased, they expired. Now, as on 1st April 2020, how many members are there in company? 5 members are there. FG, they don't know about the death of D and E. They are innocent. They don't know the death of D and E. Only A, B, C, these people came to know that company is having a less number of members, less than 7 members. Okay. Now, lawmaker is giving you 6 months time, not 6 days, 6 months from the date of reduction of number of members. 6 months time we are giving you. So by 1st October 2020, this 5 should be increased to 7. If you do this, no problem. Sir, that association failed to increase number of members from 5 to 7, sir. Acha. From this point onwards, there is no concept of corporate will. Separate legal entity is ignored. As long as separate legal entity is there, company is liable for its acts. Members are not liable for company acts. Are you getting my point? So till this point, company is liable for any debts, any obligations up to this point, company is liable. Subsequent to this date, it's not company, members, not all members, only A, B, C, simply, members who are aware of the fact, who are having a knowledge, technical word cognizant of fact that company is doing business with reduced number of members. Only those people are held liable for the debts obligations subsequent to expiry of 6 months from date of reduction of number of members. Oh my god. Arre. Example, suppose up to this date company debts are 30 crores. During this 6 months, company incurred additional debt of 5 crores, and during this period company incurred additional debt of 6 crores. Now up to here total debt is 35 crores. For this 35 crores, company is personally liable, and subsequent to expiry of 6 months, whatever additional debts is there, 6 crores. For this 6 crores, company is not liable. Mr. A, Mr. B, Mr. C personally liable and jointly and severally liable. That means if C fails to pay this 6 amount, then A, B should pay 3 crores each. If C fails to pay his contribution, then A and B should contribute 3 crores each. Understood the punishment, ma? So debts incurred during 6 months after reduction of number of members. For this debt, members are not responsible, company is responsible. Remember this point. Subsequent to 6 months, subsequent to reduction of members, no liability on members. But after 6 months, remember, sorry, it's not, remember this point, ma? After 6 months, whatever additional debts, additional obligations incurred by that association, it's not company, members. Nature of liability, unlimited, joint and several. Clear? I repeat, it's not I remember, I repeat. Debts contracted during the 6 months, company is liable. Debts contracted after 6 months from the date of reduction of number of members. Now for those debts, members who are cognizant of the fact that company is doing a business with reduced number of members, only those people will be punished. Sir, how government knows this? Every year company is required to file annual returns, yes or no? In annual returns, you have to give the status of existing members. You have to give the status of existing members. So definitely ROC will come to know, yes, company is doing business with just 5 members only. Initially punishment will be on 5 members. However, F and G will prove like this. Sir, we are doing business in France and Germany. We don't know about the death of D and E. We didn't receive any communication. So we are innocent. In that case, F and G will be protected. A, B, C are held liable. Sir, why this much rigorous punishment? Very simple. I told you condition. 7 members. You ignored it. Now I'll ignore corporate will. Very simple, right? Okay. So with this section 3 also completed. Breach of minimum number of members. So after those 6 months is very important. After those 6 months. Next one. One person company. I'll discuss one person company and then we'll discuss incorporation procedure. Incorporation procedure. One person company. You'll find only one member in one person company. In addition to member, you can find a nominee. In the event of death of the member, nominee becomes member of OPC. Nominee becomes member of OPC. So, okay, let's see the conditions, restrictions on OPC. Conditions with respect to OPC. Conditions with respect to OPC. OPC can do any business. However, there is prohibition. Some prohibitions on OPC. OPC can't carry Section 8 activities. The main objective of OPC is to promote entrepreneurship. The main objective of entrepreneur is profits. It's not charity. So Section 8 company is disqualified. OPC is disqualified to carry Section 8 activities. Next, OPC is disqualified to carry investment in body corporate activities. Investment in body corporate activities. You do in your personal capacity. Why OPC? Next, OPC is prohibited from carrying NBFC activities. Clear? Next, conditions with respect to member as well as nominee. Conditions with respect to member as well as nominee. Max 1 OPC. They can become member or they can become nominee maximum in 1 OPC. And that member or nominee should be a natural person, must be citizen of India, may be resident of India. I'm using the word, shall and may. Shall compulsory. That person should be citizen of India. He must be citizen of India. But he may be a resident of India. However, his period of stay in India shall not be less than, simply greater than or equal to 120 days in preceding financial year. Right now we are in financial year 2023-24. So you have to check preceding financial year status 22-23. If his period of stay in India is 120 days or more, then he is eligible to incorporate OPC. He is eligible to act as nominee in one OPC. So what are those three conditions? Natural person, citizen of India, maybe resident of India. Sir, can Infosys company, can Infosys Limited incorporate OPC? No, it is a company. It is not a natural person. Sir, Mr. Glenn Maxwell, Australian cricketer. Glenn Maxwell, Australian cricketer. He wants to incorporate OPC in India. No, why? Because he is Australian citizen. Once he revoke Australian citizenship and once he get Indian citizenship, he is permitted. Next, resident of India. Very simple. Look at his passport. In passport, date of leaving country and date of entering into country. You can see these two dates. So the period between these two dates, ignore. Now count it. If 120 days concept is 120 days condition is satisfied, then he is eligible to incorporate OPC. And in one attempt, I think 2019 attempt, there is a tricky question on this topic. Actually, correct question only. But students didn't imagine that kind of question. What is that kind of question? Very simple. See, M Incorporated M OPC Private Limited Company. In this, M is member and is nominee. So this company is incorporated in the financial year 2021-22. Very good. On 1st July 2022, N married to X and N left India permanently. And left India permanent after marriage. When it happened? 1st July 2022. Now, if you observe for financial year 2022-23, repeat, for 22-23, if you observe, his period of stay in India is just 92 days, if I'm not wrong. April, May, June. So 91 days. 1st July, he left India. So next year, there is no nominee in the company. There arises a vacancy in nominee clause. So what is the consequence? Very simple. There is a vacancy in nominee clause. Member shall appoint a new person, say for suppose Y, new person as a nominee, and the same matter shall be communicated with ROC within 30 days of such vacancy. That means these three conditions, natural person, citizen of India, resident of India, you have to satisfy these three conditions not only at the time of incorporation of OPC, but also subsequent to incorporation. That means every year after incorporation, you have to check these three conditions. Sir, one condition failed, sir. There arises vacancy. Suppose, M cancelled his citizenship in India, sir. Nominee becomes member automatically. And after becoming a member, nominee has to nominate another person as a nominee. And the same shall be communicated with ROC. Suppose M got deceased, sir. M died. Then nominee shall become member of the company, and after becoming member, the new member shall nominate another person as nominee, and the same matter shall be communicated with ROC. Are you getting my point? Simple pointer, very very simple point, but students didn't imagine such kind of questions. And coming to the concept of nominee, before incorporating the company, member has to nominate one person as a nominee. For that, he need to take a written consent from nominee. and such written consent, and that written consent can be withdrawn at any point of time by simply giving a notice to company as well as sole member. Sir, I'm withdrawing my consent to act as nominee in your company. Now, what sole member and company should do? Within 15 days of such vacancy, shall appoint another person as a nominee, and within 30 days of vacancy, shall communicate the same matter with ROC. Change in nominee will not affect a memorandum of association. So, change in nominee will not lead to alteration of MOA. Are you all getting my point, students? Everyone. And this nominee can also be removed by member. Change of nominee. Change of nominee. One is withdrawal, simply like resignation. The other one is change of nominee. So change of nominee means what, sir? Change of nominee means what? Come on, students. Change of nominee means what? Member terminating existing nominee and member proposing new person. And one more time, there will be a vacancy nominee clause, that is, member deceased, member disqualified, then nominee becoming member. And one special point I have to tell to you. Special point, yeah. Sir, what is that special point, sir? Suppose, we had a rule that, one person can act as a member in only one OPC. We discussed it, right? Max to max, in how many OPCs you can act as a member? One OPC. Sir, we had two one-person companies, sir. One is, XOPC, YOPC. In XOPC, member is Mr. X and YOPC member is Y. And coming to nominee, in XOPC, Y is the nominee, X is the nominee in YOPC. Understood? Yes, X is acting as a member in one OPC and X is acting as nominee in one OPC, another OPC. Max only one. The limit is one, correct? Suppose if Y got deceased. Now, legally X can become a member of this YOPC, yes or no? In the event of death of the member, X can become, nominee will become member of the OPC. Now here if you observe, X is already a member of XOPC and now X is becoming a member of YOPC. So he is holding a membership in two OPCs simultaneously. Possible or not possible? Possible. Possible. Now in this case, lawmaker is giving a time of 180 days to X. Come on, X, you have to choose only one OPC. If you want to continue with XOPC, come on, close YOPC. If you want to continue with YOPC, come on, close XOPC. So 180 days discretionary time period is provided to X in order to reduce his membership to one OPC. Are you all getting my point, students? Everyone? Can I proceed? I'm asking you, can I proceed? Yes. So this is all about marathon. Once again, I'm telling you, this is all about marathon. It's not a detailed lecture. Clear? So next topic is incorporation, procedure for incorporation of company. Section 7 is all about procedure for incorporation of company. Section 7, subsection 1, filing of documents with ROC. Filing of documents with ROC. You all know promoters. So they will file documents and information with ROC. So what documents are, what information, sir? First and foremost important document, MOA and AOA, duly signed by all the subscribers of the association. Second one, address, temporary address for correspondence. Next, details of subscribers, details of first directors. Upon incorporation, who will become directors of the company? The people who become directors of the company, we call them as first directors. Along with the details of first directors, they need to give written consent in order to act as a director of the company. So no objection certificate, plus interest of directors in other body corporates, in other body corporates. So they have to disclose the details of the entities in which they are having interest. Okay. Along with these documents, they have to give two declarations, declaration. It's like a promise, a written promise. So one declaration is all about, compliance of Companies Act, compliance of Act and rules made thereunder. So whatever the company you are incorporating, the proposed company we are incorporating, it is according to the Companies Act 2013 and rules made thereunder. So this declaration shall be signed by a professional, practicing professional. He may be a CA in practice or CMA in practice, or I'm using word or, any person, or CS in practice or advocate in practice, any person. So must sign declaration. Along with the professional, one more person, either director or secretary or manager who is involved in the incorporation of company, who is participating in the incorporation of the company. So these people should certify or should declare that, proposed company incorporation is as per Companies Act 2013 and rules made thereunder. Second declaration. Now this declaration is all about, not convicted any offense, not convicted by any offense, no breach of trust, no breach of trust or misfeasance, or not held guilty for any frauds. Just observe the grounds, observe the grounds. I'm not convicted under any offense during the promotion, incorporation or management. Let me write complete words. Promotion, incorporation, management of any company. Now not been guilty for any fraud or not breach of any trust or misfeasance in any company during the last 5 years. During last 5 years. Once again, I'm explaining you. I'm repeating you. So I have not been convicted under any offense for the time being in force, not convicted under any offense during incorporation, promotion or management of any company during the last 5 years, or have not been not guilty of any fraud, no breach of trust or misfeasance in any company during the last 5 years. The next one, for proposed company, the documents and information we are filing with ROC is complete, correct and true. Complete, correct and true. So this declaration should be signed by two groups. 1, 2, 3. These 3 points. Yes, declaration should be given by two groups. Who are they? Subscribers of the company as well as first directors of the company. First directors as well as subscribers. Remember, how many declarations are there? Two declarations. One is given by professional as well as director or secretary or manager who participates in incorporation of the company. This declaration is all about compliance of Companies Act and rules made thereunder. Suppose if you take one person company, sir, one person company is prohibited from carrying NBFC activities, investment in body corporate activities, Section 8 activities. So we drafted MOA and AOA according to Section 3 of Companies Act. We followed entire Companies Act. We followed entire company rules for incorporating this company. And second one, the subscribers of the proposed company, the first directors of the proposed company should not convict any offense during promotion, incorporation or management of any company during the last 5 years. If they commit any offense, if they commit any fraud, 5 years prohibition period. They're banned from becoming subscriber of new companies, becoming first directors of the new companies. So this is the this is the documents and information promoters has to file with ROC. Next step. Registration of company. So what ROC will do? ROC shall issue certificate of incorporation, and that certificate of incorporation shall contain corporate identity number. It's a 21 digit number, 21 digit alphanumeric number, 21 digit number. You can see, it starts with L or U, listed or unlisted company. Next 5 digit is an industry code. Next one, you can see, state of incorporation, year of incorporation, private limited or public limited, and last 6 digits is the serial number of the company. Next one, maintenance of documents and information. So whatever document and whatever information you file with ROC, the documents and information you have to preserve at registered office till liquidation of company. Till liquidation of company. So all this information and documents you have to preserve at registered office till liquidation of the company. Understood? Everyone. Suppose, sir, for incorporating company, the promoters furnished false information, sir. The promoters suppressed material information, sir. Then what would be the consequence? Very simple, ma. See, in a company, there are 7 subscribers, ma. All these 7 subscribers, actually they are minors. But these promoters, what they did, they forged Aadhaar cards, PAN cards, they edited date of birth. And they projected all these minors as majors. So these people actually incapable to enter into the contract, but these promoters, they made minors as majors. They forged all material documents. So they furnished false information for incorporating the company. Or suppressing material information. Suppose last year I committed one fraud in one company. Now, according to Companies Act 2013, I am prohibited from incorporating a new company for a period of 5 years. However, I failed to disclose this information. And myself, a proposed director, I'm having interest in other body corporates. I'm not furnishing this information. So, suppressing material information. Any false information you file with ROC or suppressing material information. Sir, ROC came to know this matter during incorporation. So while verifying, ROC came to know that yes, company documents, proposed company information is false. Then, consequence, applicant shall be punished as per provisions of section 447. Repeat, applicant, the person who filed application with ROC, applicant is going to get punishment under section 447. Sir, ROC came to know about this matter after incorporation, sir. All these subscribers are minors. So ROC came to know about this matter after incorporation. Then, what would be the consequence? Here, applicant as well as professional, the persons who are associated with this incorporation are going to get punishment under section 447. In addition, company is also going to get punishment. So what is the punishment, sir? So ROC will file a petition with the National Company Law Tribunal. Now key is in the hands of tribunal. So tribunal will decide either to change MOA or AOA. It may pass order. Yes, come on, change MOA, AOA, change subscribers. Or it may convert members liability limited to unlimited. Or it may remove the name of the company. It may order for removal of name from register. Or it may order for winding up of company, liquidation, simply liquidation, or any other order as it thinks fit. But before passing any order, tribunal will give an opportunity of being heard to that association. Company, these are the allegations against you. Is there anything to tell? Come on. So it's nothing but opportunity of being heard. So yes, NCLT will give an opportunity of being heard to the company, and it will also consider the transactions entered by the company during the time period, after incorporation till the date of petition. So after considering these two aspects, NCLT will pass either of these orders. Very, very, very important. In one attempt, this particular concept came for 5 marks. So company was incorporated by furnishing false information, by suppressing material information. So state the powers of NCLT. What kind of orders NCLT can pass? Very simple. NCLT can order for change of MOA or AOA. NCLT can convert members liability limited to unlimited. NCLT may order for removal of name. NCLT may order for liquidation of the company, or NCLT may pass any other order as it thinks fit. But before passing any order, NCLT will give one opportunity of being heard to the company, and NCLT shall also consider the transactions entered into by the company during the time period of its existence. Completed. So section 7 we completed, Next one, section 9, effect of incorporation. So once promoters file information as well as documents with ROC, now ROC shall issue certificate of incorporation. The moment certificate of incorporation is issued, section 9 comes into the picture. All the subscribers to the memorandum of association shall become members of the company automatically. Once shares are allotted to the subscribers, they become shareholders. Next, company will get its characteristics, perpetual succession. Next, separate legal entity. Next, can sue or be sued. Next one. Next, common seal. Next, members limited liability. So can enter into the contracts, can acquire properties, can incur liabilities. All these characteristics, that body corporate will get upon incorporation. That is what section 9, effect of incorporation. Understood? Next one, we'll discuss section 8 company. Section 8 company. Basic conditions, section 8 company should satisfy. Basic conditions. 3 conditions are there. Object clause of MOA should contain the following objects. Object clause of MOA shall always contain these objects, any of these objects. Social welfare. Come on, tell me. Sports. Next, art, culture, environment protection, education, commerce, charity, etc. So objects clause of section 8 proposed section company should contain any of these objects: social welfare, sports, art, culture, environment protection, education, providing education, commerce, charity. Next one, surplus. I won't use word profit. Why? Because this is an association not meant for profits. This is an association not meant for profits but for charity. So coming to the surplus. So excess of income over expenditure. This surplus, you can't declare and pay dividends. Dividend is strictly prohibited. Then what I can do with this surplus? Invest surplus in promoting other objects. Invest in promoting objects of company. Objects of company. Many students got it out. Sir, why section 8 company, sir? We had a concept of trust, no, sir. Trust will take care of all these activities, no. Yes, correct. But coming to the differences between trust and section 8 company, section 8 company is having India-wide recognition, nationwide recognition. This association is getting certificate of incorporation. It will be issued under Ministry of Corporate Affairs stamp. So it will have a national recognition. Coming to the trust, its recognition is restricted to a state, particularly state. And coming to section 8 company, you will find better transparency. Why? Because every year company is required to prepare annual returns. Every year company is required to prepare financial statements, and these financial statements and annual returns company should file it with ROC. And for section 8 company, audit is mandatory. An independent person will come and he will verify the books of accounts and he will express opinion. So it enhances confidence among the users of the financial statements, readers of the financial statements. So you will find better transparency in section 8 company compared to trust and society. Section 8 company, it will have a global recognition, not only nationwide, global recognition. It can get donations from international sources as well. Are you getting my point? So compared to trust, section 8 company is better. It's not better, it's a best thing. And you had separate legal entity concept also. Being a company, it had separate legal entity status. So company is responsible for its own acts. Members are not responsible for company acts. Understood? So tell me, what are the basic conditions company should satisfy in order to become section 8 company? The basic conditions are object clause of MOA, and next, don't declare dividends out of surplus, invest surplus in promoting other objects of the company. Understood? Next one. So once these conditions are satisfied, then promoters has to file an application with central government. Of course, the power has already been granted, delegated to ROC. Okay, along with this application, they are required to prepare some more documents, additional documents they need to file with central government. So there should be a declaration from professional as well as directors about compliance of Companies Act. Next one, estimated income and expenditures for next 3 years. So they have to prepare these documents and they need to file it with central government. Upon verification, central government shall issue a license subject to additional conditions. Central government can grant license to this association. Immediately they have to register license with ROC as per Companies Act. But power already vests with ROC only. Now ROC shall register the same and will issue certificate of incorporation. Here you will find NPL, not for profits. So in SIN, you can identify Section 8 company, by looking at SIN. That SIN, corporate identity number, will have 3 letters, NPL, not for profits. And the liability of members is limited. Understood? Everyone. Next, so what benefits being a Section 8 company? Benefits, coming to benefits. Even a partnership firm can become member of Section 8 company. Firm which has no legal identity in the eyes of law, it can become member of Section 8 company. And notice calling for general meeting, 14 days is sufficient. Next one, no need to constitute various committees, nomination, remuneration committee, shareholder relationship committee. These committees are not at all required. Understood? And it can enjoy all other advantages being a company, limited liability, perpetual succession, all these advantages quite common. Clear? And moreover, these companies are not required to use words limited or private limited in its name clause. No restriction to use these words limited, private limited. Clear? So with this one part of Section 8 company we completed. Benefits, conditions, and obtaining license from government we discussed. Next one, important part, revocation of license. I can expect a question from this topic, revocation of license, very very important. Revocation, reasons as well as consequences. Reasons as well as consequences. Students, you have to remember this particular area. Basic conditions, benefits, procedure for obtaining license, very simple. But this particular area, somewhat, tricky as well as important. So I can expect a question from this particular concept, revocation of license. Reasons. Violation of Section 8 objects, violation of Section 8 provisions, violation of central government conditions. At the time of granting license, they will give you license with some additional conditions. If you violate those conditions, or if you violate provisions of Section 8 company, violate the provisions of Section 8 of Companies Act, simply, you are declaring surplus as a dividends. You are converting your objects into profitable objects. You are starting profitable business activities. Understood? And you are violating central government conditions, or activities carried by Section 8 company are prejudicial to public. Simply, it is having some negative impact on the public. You are dealing with some kind of activities which are opposed to public policy. For example, you told that we'll provide basic necessaries to the people. So our company is meant for necessaries to the people, and you are promoting, you are providing, brown sugar to the public. The people who need drugs, you are supplying to them. And you told that you are providing education, training to the people. In fact, you are providing, how to kill a person, how to rob. You are providing training. You are giving training to some students, but the training is with respect to, how to kill a person, how to rob something, stealing, theft. But all these will have a negative impact on public. These are the activities opposed to public policy. So if you do those kind of activities, then government, after giving opportunity of being heard to you, it will revoke license. Upon revocation, you have to add words limited or private limited in your name clause. Limited or private limited in your name clause. Next thing, fund left with company, Section 8 company, fund, whatever donations, contributions Section 8 company received so far, this amount shall be transferred to insolvency and bankruptcy fund maintained under insolvency and bankruptcy code, or a similar Section 8 company, company with similar Section 8 objects, similar Section 8 company, the company, the authority will order for either winding up of company, or amalgamation with similar Section 8 company. Amalgamation with similar Section 8 company. And whatever the fund left with this Section 8 company, that amount shall be transferred to IBF or similar Section 8 company. That means a Section 8 company with similar objects. This company is in sports association. You need to find another company with the same object of sports. You can transfer this fund to similar Section 8 company. And if authority came to know that a fraud was committed by in case of fraud committed by any person in Section 8 company, that person is going to get punishment under Section 447. And there is a general punishment under Section 8 for violation of Section 8 provisions. General punishment for violation of Section 8 provision, general punishment, that is company minimum 10 lakhs, maximum 1 crore. Penalty how much minimum 10 lakhs, maximum 1 crore. And officer who is in default, the person who is responsible for such defaults, he is going to get punishment minimum 25,000, maximum 25 lakhs, maximum 25 lakhs. And in case of proven frauds, that person is going to get punishment under Section 447. So this is all about Section 8 company. So far we covered Section 7, that is procedure for incorporation of company. You can look at this chart, determine the nature of company, reservation of name. So these points I covered. Next one. So we discussed Section. Okay. So some technical glitch is there. Okay. Just wait. So we discussed one person company. We discussed conditions of one person company. We discussed concept of nominee. And then formation of company with charitable objects. I covered all these points. Revocation of license, particularly revocation of license area is important. So company contravenes requirements or conditions subject to license is issued. Affairs of the company are conducted fraudulently. Violation of the objects of company are prejudicial to the public interest. Add limited or private limited against the company name, opportunity of being heard, winding up or amalgamation, and penalty. Yes, correct penalty only. 10 lakhs to 1 crore, 25,000 to 25 lakhs. Officer in default shall be liable for action under Section 447 in case affairs of the company were conducted fraudulently. Everyone. So far we completed Section 3, Section 7, Section 8, Section 9. Okay. The remaining provisions we'll discuss. So our next topic is Memorandum of Association. But before Section 4, let me discuss Section 10A. Section 10A, we are going in an order. Section 10A. This is all about commencement of business. Commencement of business. Sir, when a company can start business, sir? When a company can start business? A company can start business if two conditions are satisfied. Condition number one, company should file INC 22 with ROC within 30 days of incorporation. 30 days of incorporation. Sir, what is this INC 22? Verification of registered office. Generally, I don't tell form numbers. Why? Because frequently these forms will get updated. Frequently these form numbers will be changed. But some forms, they are, fixed. They're permanent. Almost 10 years completed, but still these forms remain unchanged. Only those form names I'll tell you. Understood? So condition number one, company should file a verification of registered office. INC 22 is all about registered office address. So verification of registered office address with ROC, and this form should be filed within 30 days of incorporation. And condition number two, company, on behalf of company, board of directors should file a declaration with ROC in form number INC 20A. And this INC 20A is all about a declaration. So declaration with respect to what? Sir, all subscribers who subscribed MOA had paid sufficient amounts, cash to the company. So whatever amounts they promised to contribute upon incorporation, they paid that amount to company, sir. Understood? So company should start business only with its own funds. Initially, it should start business with own funds. And this form should be filed within 180 days of incorporation. 180 days of incorporation. So these two conditions company should satisfy before it commences business, before it exercise borrowing powers. So two important conditions. One is verification of register office. The second one is declaration about subscription money. So subscribers had paid sufficient money and had paid promised money, contributed promised money to the company. So like that, board of directors should declare and they should file INC 20A within 180 days of incorporation with ROC. And this section is not applicable to all companies, ma. This section is applicable to only companies with the share capital. Company with share capital and incorporated on or after 2nd November 2018. Companies incorporated on or after 2nd November 2018 and company with share capital should comply these two conditions. Sir, consequences for default. Consequences. In case of default, what would be the consequence, sir? What would be the consequence? Company is going to get punishment, penalty of 50,000 rupees, and officers in default per day 1,000 rupees penalty, 1,000 per day, and max 1 lakh rupees. So how many days they will make delay? They're going to get this much punishment. Company flat 50,000 rupees, officer in default 1,000 per day, maximum 1 lakh rupee. These punishments will apply in case of delay filing. Delay. Sir, in case of non-filing, suppose company incorporated in the year 2019, till date they didn't file INC 22, till date they didn't file INC 20A. In that case, what would be the consequences? Non-filing. Very simple. ROC shall conduct an inquiry, shall verify whether company is carrying business operations or not. It will give notice to the address, temporary correspondence. I told you initially, at the time of incorporation, you need to give address for temporary address for correspondence. So it will send notices to that address. There is no reply. Then ROC had power to remove name from register, removal of name from register of companies. Register. ROC is having that power. So simply closure of company. So this is all about section 10A. Come on, tell me section 10A applicability. It is applicable to all companies which are incorporated on or after 2nd November with share capital. Simply company without share capital, this section will not apply. And what are the conditions under section 10A? So conditions, verification of register office and declaration with respect to subscription money. So after fulfilling these two conditions, the company is permitted to carry business operations. Company is entitled to exercise borrowing powers. Sir, before satisfying these two conditions, if company enter into any contract or company exercise any borrowing powers, all those acts become void ab initio acts, null and void. Company is not liable. Such acts are not enforceable against company. Are you all getting my point, students? Everyone? So this is all about section 10A. Next, I'll start section 4. Section 4 is nothing but memorandum of association. Section 5 is nothing but articles of association. Two constitutional documents of the companies. One is, what a company can do, what a company can't do. Memorandum of association, it defines the scope of company and it confines the scope of company. It restricts the scope of company. What to do, what not to do, MOA will tell you. It defines the scope as well as it restricts the scope. Infosys company, it can do any business connected with software. It can't do any business other than software. So positively defines the scope of company, negatively confines the scope of company. Articles of association, how to do. Company being an artificial person, it can't do activities on its own. It requires human agency, board of directors, management. Now powers of directors, powers of management, you can get under articles of association. Both are external documents and both documents, these documents act as a contract between company and members. Company and members. Company is bound to members because of MOA, AOA. Members are bound to company because of MOA and AOA. So this is a general concept, but if you look at the definition of MOA, MOA means MOA originally drafted at the time of incorporation, and it includes altered MOA. Such alteration might happen under old Companies Act or under new Companies Act. So MOA means memorandum originally drafted at the time of incorporation or altered from time to time in pursuance of previous company law or Companies Act 2013. Similar definition AOA. Articles means articles originally framed at the time of incorporation, and it includes the altered AOA, altered according to previous company law or present Companies Act 2013. So definition is very simple. Now we'll look into the clauses. First clause, name clause. So before selecting name, you have to satisfy few conditions. What are those conditions? Your name shall not be identical with or resemble to existing company registered trademark. Your name shall not be identical with or resemble to the name of existing company as well as existing registered trademark. And the name shall not be undesirable in the opinion of central government. Not undesirable, not identical with, not resemble to existing company, existing registered trademark. So simply unique. Next one. The name of a company shall always ends with private limited in case of private company, limited in case of public company. However, these rules are not applicable to Section 8 company as well as government company. Section 8 company is not required to use words private limited as well as limited. Government company, even though it's a private company, I repeat, government company, even though it's a private company, because of restricts, limits, prohibits in articles of association, still government company name shall always ends with limited only. Are you getting my point? For Section 8 company, private limited words are not applicable. For government company, only word limited is used, even though it is a private company. Understood? Next one. Next. So after satisfying these conditions, what promoters will do? Promoters will file an application for reserving unique name, reservation of unique name with ROC. And if ROC thinks correct, if ROC thinks that okay, this name is not identical with or not resemble to the name of existing company or existing registered trademark, if ROC is of that opinion, ROC shall reserve the name. Sir, how long this name shall be reserved, sir? If it is a newly incorporating company, proposed company, if it is getting incorporated, newly incorporating company, then name shall be reserved for a period up to 20 days. How many days? Up to 20 days. Sir, existing company wants to change its name, sir. No, change of name, sir. Change of name. Existing company, change of name. In that case, the name shall be reserved for a period of 60 days from the date of approval. 20 days, 60 days is from the date of approval. So 20 days, 60 days. During this time period, even Pradhan Mantri ji, Modi ji, or corporate affairs ministers, Nirmala Sitharaman madam, even if these persons file an application for same name, ROC shall not permit them. So the name shall be reserved for 20 days in case of newly incorporating company, for 60 days in case of existing company. During these 20 days, promoters will prepare MOA, AOA, details of subscribers, details of directors, declaration by professional, declaration by first directors, declaration from first subscribers. Everything promoters shall prepare, and they will file this information with ROC for incorporation. Suppose filing this information, filing this document, ROC came to know that this information, the document contained false info, or some material information got suppressed. False information. There is a false information. Example, if you want to copy the name of existing company, if you want existing company name, then you should get a permission from existing company directors. You have to obtain no objection certificate from existing company directors in order to copy their name. Or if you want to register company with a trademark, registered trademark, then you need to get permission from registered trademark holder. Sir, I need to use your name. Please grant permission. Now, if they grant permission, you can use that name. Now, promoters, they forged documents. Actually, they didn't get any objection, no objection from, they didn't get any permission from existing company or existing trademark holder. But still, they forged documents and they filed application with ROC. ROC came to know that yes, this application was filed by furnishing false information. Now, ROC will verify whether company incorporated or company not incorporated. Suppose company not yet incorporated, sir. Company not yet incorporated, sir. Acha? Okay. Company not yet incorporated, right? Applicant, my dear applicant, come pay penalty up to 1 lakh rupee. Sir, company incorporated, sir. ROC by mistake issued a certificate of incorporation. Now, ROC shall give you 3 months time period. 3 months. Why? To change your name. Change name. Or ROC may remove name of company from register. Removal of name. Or ROC shall file petition with tribunal. Now tribunal will take care of this company. Tribunal will take care of this company. Come on. Winding up of the company. What tribunal will do? Winding up of the company. Understood? So this is all about name clause in memorandum of association. Next clause is situation clause. Under situation clause, you can see the name of the name of the state in which company is getting incorporated. Name of the state in which company is getting incorporated. Every point, each and every material point I discussed with you. Italic content, you just give one time reading. You'll get to know everything. So reservation of name. Okay. Next one, reserving name. How long? 20 days, 60 days. If you want more time period, you can extend it by paying, prescribed fees. By paying 1000 rupees, you'll be given extra 20 days time period. And punishment for furnishing false information for reserving the name. Not incorporated, incorporated. Not incorporated, you can observe, name will be cancelled and penalty up to 1 lakh rupee. Up to, which may extend to 1 lakh means nothing but up to 1 lakh. Incorporated, change the name within period of 3 months, strike up the name of the company, petition for winding up of the company. Understood? Next, the situation clause. It will contain the name of state in which the company is getting incorporated. Understood? Everyone. The power fluctuations are there, ma. Power fluctuations is there. So don't worry. The video lecture will. I'll give you 100% clarity. So sometimes if fluctuation is there, just ignore that 5 to 10 seconds. Is it clear? Okay, fine. I didn't give a brief discussion about MOA in this lecture. Why? Because you all know this is a marathon and you know about MOA. Purpose of MOA. It defines the scope of the company, confines the scope of the company. It's a public document. Every person before entering into contract with company should have a knowledge of MOA, OA. All these points you already read at your CA foundation level as well as at CA inter level. So some basic points which are not important from examination point of view, I'm not discussing in this lecture. Why? Because this is a marathon lecture. In reality, entire company law I'll teach for 150 hours. I'll teach 150 hours. But this marathon lecture is, around, 10 to 12 hours, right? So basic discussions I'm not going to provide in this marathon lecture. Once again, I'm telling you, once again, I'm repeating the point. So situation clause, you will find only the name of state. So you can't find complete address in situation clause. You'll find only name of state. Only name of state. Complete address, company will file INC 22 with ROC within 30 days of incorporation. And registered office clause is very important from 3 aspects point of view. CJI, Chief Justice of India, right? CJI, all communications with company shall be addressed to registered office. And any complaint, any legal action if you want to take against company, the jurisdiction is subject to registered office jurisdiction. And if anyone want to carry inspection activities, investigation activities, straight away they will come to registered office. That's what you have to maintain all statutory records, books of accounts, documents and information you file with ROC for getting certificate of incorporation. Everything you need to preserve at registered office. So communication, jurisdiction, inspection, subject to registered office jurisdiction. Understood, everyone? So now company upon incorporation within 30 days it has to file information with ROC about its registered office. Next one, object clause in memorandum of association. Now these objects are of two types. One is main object, the other one is incidental or ancillary objects. Main objects defines the scope of company, for what purpose company came into existence. Stressed for CA and CMA, it came into existence for providing commerce courses education. Understood? Commerce courses, main object. Incidental, for providing educational services, for providing a commerce courses. Yes, we need staff, recruitment of staff. We need infrastructure, laptops, computers, ACs, lights, furniture, etc. We need infrastructure. And next, we need a building. We need office premises. So now we can purchase or we can construct or we can hire any building for providing these services. Now, purchase of infrastructure, purchase of a building, all these are incidental activities we are taking only in order to promote our main object. See, you can't carry incidental objects as main objects. Remember this point. You can carry incidental objects only for the purpose of attaining main object. Only for the purpose of attaining main object, you should carry incidental objects. If you want to carry incidental objects as a main objects, you need to alter memorandum of association. You need to pass special resolution. You need to get approval from members. Next, you need to file this information with ROC. ROC shall issue a certificate, fresh certificate. Then you can change your objects. You can invest money in new objects. The main objects, what purpose company came into incorporation. Incidental objects, in order to attain main objects, you have to carry one or more incidental objects. Understood? Understood, everyone? Everyone. Next one, next paragraph. Sorry, next matter. Doctrine of ultra-vires. So what is meant by doctrine of ultra-vires? Come on, tell me, my dear students, what is meant by doctrine of ultra-vires? The doctrine of ultra-vires, this ultra-vires is of three types. Ultra-vires as to Companies Act, ultra-vires as to MOA, ultra-vires as to AOA. So ultra-vires, ultra means beyond, vires means powers of the company. If company does any activity which is beyond the powers of Companies Act, beyond the provisions of MOA, beyond the provisions of AOA, we call it as ultra-vires. Ultra-vires as to Companies Act is illegal and void. Suppose if you take 1% company, investment in body corporate, section 8 activities, they are not illegal. Actually, they are not illegal. They are legal only. Whereas for 1% company, these activities are covered under prohibited activities list. Company can't carry these activities. Even though they are legal, but OPC is prohibited from carrying these activities. Now, if OPC perform any activity like investment in a body corporate, now it becomes ultra-vires as to Companies Act. It is illegal and punishable offense. So member will get punishment. Member will get punishment. Understood? Next one, ultra-vires as to MOA. So beyond the powers of MOA. Initially, I told you object clause of MOA defines the scope of the company. So if you do any activity which is beyond the object clause of MOA, it comes under ultra-vires as to MOA. So we had a decided case law, Ashbury Railway Carriage and Iron Company Limited versus Ritchie. Now their finance transaction is there. Actually, company had no power to enter into finance agreement. Now, what is the effect, sir? Ultra-vires as to MOA is void ab initio. If something is void ab initio, it can't be ratified subsequently. Even whole body of members can't ratify ultra-vires acts. Company is not liable for any responsibility or any obligation that arises from ultra-vires acts. Board of directors are personally liable for ultra-vires acts. Next one, ultra-vires as to AOA. It is valid provided members approve ultra vires acts as to AOA. So sometimes board of directors perform any activity which is beyond their powers. However, within the powers of member. However, within the powers of members. Then if member approves such activity, ultra vires as to AOA, it will be valid and enforceable. Understood? So it is the duty of each and every person to have knowledge of MOA and AOA before they enter into contract with company. So that is all about ultra vires. Void, can't ratify, can ratify when we can ratify it when it is ultra vires to AOA. Can't ratify when it is ultra vires to Companies Act or ultra vires to MOA. Next one, protection to the stakeholders. Because of ultra vires today, company is not responsible to the outsiders. Company is not liable for any ultra vires acts. In this manner, members' funds will be protected. Members' funds can be utilized only for the purpose of achieving main objects. Other than that, not. Next, we had liability clause. Liability clause determines the liability of members of the company. So liability of members of the company is decided by this clause. Next, capital clause. Capital clause. Share capital clause. Here three amounts you should furnish. One is total authorized share capital. Second, number of shares divided into number of shares and nominal value or face value. Three amounts you have to mention under share capital clause. Next, under liability clause, we had one point, many of the students, don't know, they don't have clarity with respect to this point. So what is this point, sir? Summary of this point is two members, one is present member and the other one is past member. We call them as list B contributories. If you had knowledge of liquidation of companies in accounts, liquidation of companies chapter, you can understand this point very well. All present members as well as past members whose membership got terminated within 1 year before winding up. 1 year before winding up. See, 1 year. Why 1 year word is used? The reason is going concern concept. If you look at going concern assumption, the company can do business for the next upcoming 1 year. If company is able to do business for the next 1 year, going concern assumption is appropriate. Sir, no sir, company can't do business for the upcoming 1 year, sir. Then going concern assumption is inappropriate. Going concern assumption is inappropriate. Are you all getting my point, students? So going concern assumption appropriate means for the next 1 year, company is able to do business. Company can do business. It is then you can call that going concern is appropriate. Okay. So here the point is these two people are liable for deficit amount. Deficit means assets less than liabilities. The difference between assets and liabilities. If assets are not in a position, company assets are not in a position to clear their liabilities, to discharge their liabilities, we call the difference as deficit. Deficit along with expenses of liquidation. Next one, adjustment among contributories. Adjustment among contributories. So these three amounts, these two people are liable. These three amounts, these two people are liable. I'll tell you when past members will be liable. First of all, present members are liable, to what extent? To the extent of unpaid value or to the extent of guarantee amount. If present member fails to pay, fails to discharge that unpaid value or guarantee amount, then we'll look into the past member. See, present member from which person he got the shares. Identify that person. When this transfer happened, sir, within 1 year before liquidation, sir, within 1 year before company winding up date, sir. In that case, bring that person also. Bring that person. Suppose we had 7 people, 7 people, A, B, C, D, E, F, G. Okay, 7 people are there. These 7 people started company in the year 2020. And in the year 2021, exactly date 1st April 2021, Mr. G transferred his share to H. Mr. G transferred his share to H. And on 31st December 2021, company went into liquidation. Liquidation proceedings started. So at this point of time, we observed a deficit amount is some 6 crores. Expenses of liquidation is some 1 crore. So total 7 crores amount is required for liquidating this company. Each and every member, they agreed to contribute 1 crore in the event of liquidation. 1 crore. 1 crore each. They promised, yes, we'll contribute 1 crore in the event of liquidation to cover deficit amount. Like that, they gave guarantee. How much? Each person 1 crore. G transferred his share to H on 1st April 2021. And from the date of transfer, within 1 year, company went into liquidation. Liquidator came to each and every person, A, B, C, D, E, F, H, come on, pay. H, he's financially not sound. He's not having that much amount. H failed to pay 1 crore rupees. Now what liquidator will do? From which person H got these shares? From G. And when this transfer happened? Sir, this transfer happened on 1st April 2021. Okay, past member, you also come into the picture. Sir, suppose if this transfer happened on 1st April 2020, from date of transfer to date of liquidation, there is a period of more than 1 year. So G is not liable. G is not liable. Are you all getting my point, students? G is not liable. But transfer happened within 1 year before winding up date. So now bring past member. Now these people are liable for this 7 crores. Suppose if B paid 2 crores money, 1 crore B money and 1 crore A money. Now, liquidator will ask A to pay 1 crore to B. This is nothing but adjustment among contributories. So 2 persons, present members, past members, liable for 3 amounts. One is deficit amount, next expenses of liquidation, next one adjustment among contributories. Okay. So next we saw capital clause also. Next, subscription clause, you can see subscribers of memorandum of association and articles of association. Next, articles, I told you, articles of association of a company as originally framed or altered from time to time are applied in pursuance of any previous company law or of this act. So articles of association contains internal rules and regulations of the company. Okay, next one. So it contains regulations that are necessary for whom? That are necessary for internal management, internal governance. Okay, so very important point, that is entrenchment of AOA. Generally, to alter articles of association, to modify articles of association, special resolution is required. Any clause you take in articles of association, you'll have some 100 clauses or 200 clauses. Any clause if you want to modify, general rule, special resolution is required. Now, in the place of special resolution, if you write something, which is more powerful than special resolution. Suppose special resolution means what? Votes in favor not less than 3 times of votes against. Simply 75% of votes should be in favor. 75% of votes should be in favor. Then we can call it as a special resolution. Now, if you write like this, 90% voting power is required to amend a particular clause. In that case, we call it as entrenchment. Generally, entrenchment provisions are meant for protecting minority interest. For example, today I want to start a company with the name V Industries Limited. And in this company, in articles of association, clearly I mentioned a point that Mr. V will be managing director of the company, and he will be terminated only in the case of proven misconduct. Mr. V will be the managing director of the company and he will be terminated only in case of proven misconduct. Where you found this clause? Where this clause is there? In articles of association, this clause is there. Are you all getting my point? In articles of association, I mentioned this clause. Mr. V is the managing director of the company and he will be terminated only in case of proven misconduct. So today I incorporated company, 100% of capital left with, 100% of capital, me and my family is holding. But tomorrow, there is a chance I may go for public offer. Public may become members of our company. Okay. As a result, my and my family members holding, my family members and my personal holding may fall to 20%, 10%, 15%. Possible. Yes, possible. Today we started company with 10 lakhs, and then the entire 10 lakhs, me and my family members contributed. Tomorrow I'm making public offer of 90 lakhs. So public contributed 90 lakhs. So total 1 crore. In this 1 crore, my worth of capital is just 10%. My worth, my portion is just 10%. Now definitely I'll think that, if these people, who contributed 90 lakhs, they may come to general meeting. By passing special resolution, they may amend AOA removing this clause. And very next minute, they may terminate me from the position of managing director. You all getting my point? Possible or not possible? So simply by passing special resolution, first they will delete clause in AOA, and the very next minute they may remove me from the position of managing director. My job is at risk. So to protect my interest, to protect myself, what I'm doing? The time of incorporation only, I'm writing a point that in order to amend AOA with respect to removal of managing director, removal of this clause, 92% voting power is required. So definitely without my consent, this clause can't be terminated. This clause can't be deleted. And I'll be continued as a managing director as long as, I commit a default. So till I commit a default, I can be the managing director of the company. So simply to protect my interest in the company, I can entrench my articles of association. Entrenchment is nothing but, making a simple procedure complicated. Making simple thing as a complicated thing, it is nothing but entrenchment. So general rule for amendment of AOA is special resolution. But if you write anything, this particular clause can be amended by passing a resolution with 92% in favor, then we call it as entrenchment. So you can have entrenchment provisions at the time of incorporation. Sir, at the time of incorporation, I forgot to entrench my AOA, sir. Then after coming into existence, you can insert entrenchment provisions. For inserting entrenchment provisions, if you are a private company, all members' approval is required. All members' approval required. In case of public companies, special resolution is sufficient. So at the time of formation, you can have entrenchment provisions. Sir, I forgot, sir. Okay, after incorporation, you can have entrenchment provisions. But if you are a private company, you need approval from all the members. If you are a public company, simply by passing special resolution, you can insert entrenchment provisions. Clear? Clear? Okay. Next one, doctrine of indoor management. Doctrine of indoor management. So I told you, doctrine of ultra virus. If company enters into any act beyond the powers of MOA, we call it as ultra virus. Effect of ultra virus, company is not liable. Company is not responsible. Board of directors are personally liable. Continuation to this doctrine of ultra virus, we had doctrine of constructive notice. Sir, constructive notice means what? Notice is of two types, Notice is of two types. One is actual notice, the other one is constructive notice. Actual, constructive. Actual means, giving notice personally, communicating the matter personally, loudly, or through notice form. Constructive notice means, deemed. Here we are not giving actual notice, Here we are not at all giving any actual notice, but, we assume that notice has been given. Suppose if you look at ICA examinations, ICA won't call student personally. My dear student, November 1st onwards, we are going to conduct examination and you are required to attend examinations. ICA is not giving any personal intimation. ICA is not communicating with each and every student. There is no actual notice concept. No, the moment ICA hosts examination schedule in the website, and it posts that matter in the website, that's it. ICA assumes that we have given notice to all the students. We have given notice to all the students. That's it. So here you can't find actual notice, but it is deemed to be a notice. Deemed to be a notice. So accordingly, every person before dealing with company, they should have a knowledge of MOA and they should have knowledge of AOA. Ignoring MOA and AOA, if you enter into any agreement with company, and if company had no power to sign that agreement, then company is not personally liable to you. Understood? So that is what constructive notice means. And to this constructive notice, we had one exception. That exception is doctrine of indoor management. Name itself is telling indoor management. Indoor, with respect to internal matters, with respect to internal policies, outsider can make a presumption. Outsider can make a presumption. Outsider can straight away presume that all the board of directors, all the management personnel will have a powers to enter into contract on behalf of the company. They can make that presumption. Now, according to doctrine of indoor management, company is liable to outsiders. Outsiders shall be protected. Outsiders shall be protected. Company is held liable. Understood. And to this doctrine of indoor management, we had exceptions. Suppose in case of forgery, this doctrine is not applicable. In case of negligence, suppose there is a scope for inquiry. There is a scope for inquiry, but still outsider, they are blindly thinking that yes, company had power. Company directors are having power. Company directors are having a power. Like that, they're making, they're acting negligently. They're acting negligently. In that case also, doctrine of indoor management is not applicable. Understood, ma? So doctrine of indoor management, the main theme is protect public interest, protect public from company malpractices. Is it clear? So stakeholders need not inquire whether the necessary meeting was convened and held properly or whether a necessary resolution was passed properly. They're entitled to take it for granted and company had gone through all the proceedings in a legal manner. Next one. So next, Act overrides MOA and AOA, section 6. Section 6. Very simple, just remember. One side Companies Act 2013. Other side MOA, AOA, members resolution. Next, board resolution. Next, agreements executed by the company. So other side. If there is any conflict between Companies Act and these documents, remember always Companies Act shall prevail. Companies Act shall override provisions of MOA, AOA, members resolution, board resolution, and agreements executed by the company. Suppose one person company is prohibited from carrying investment in body corporate activities. And this one person company, they inserted this point in MOA. By making alteration to MOA, they inserted investment in body corporate activities in their MOA. Now there is a conflict between Companies Act and MOA. Now which one shall prevail, sir? Companies Act shall prevail. Next one, inconsistency between Companies Act and AOA. Suppose underwriting commission. Company wrote this point, company can pay underwriting commission 10%. But maximum 5% in case of shares, 2.5% in case of debentures, you all know. Now there is inconsistency between Companies Act and AOA. Companies Act shall prevail. Similarly, Companies Act and members resolution. Suppose doctrine of ultra virus. Members can't ratify ultra virus acts. However, members passed resolution to approve ultra virus acts. Now there is inconsistency between Companies Act and members resolution. Which one will prevail? Companies Act shall prevail. So inconsistent provisions, ignore MOA, AOA, members approval, board approval, company agreements. You just follow Companies Act. Consistent provisions, there is no problem. I'm talking about inconsistency provisions. Next one, effect of MOA and AOA. See, the moment company gets incorporated, MOA, AOA become contractual documents between company and members. So now members are bound to company is bound to members. Company can't utilize member funds for some other activities. And members, whenever company make calls on shares, member is liable to contribute call money to company. Member is liable to pay call money to company. If company violates any provisions, doctrine of ultra virus. If members violate call monies, if member fails to pay call money, then company will forfeit member shares. Company can reissue forfeited shares to other members. Understood? It's like a normal contract. Under normal contract, you can observe if any party commits breach, the aggrieved party can take action against party who is guilty. Yes or no? Similar concept applies here also. So company liable to members liable to company, and members are not liable to each other. Next one, company is not responsible to outsiders. Outsiders are not responsible to company because of MOA, AOA. The reason is MOA and AOA are contractual documents between company and members, but not company and outsiders. Is it clear? Everyone. Next one. The last topic of incorporation of company and matters incidental to thereto is alterations. Alteration as to MOA and alteration as to AOA. So alteration is nothing but modification, any addition or deletion. Any addition of new clauses or deletion of existing clauses, we call it as alteration. Previously, many times I told you, MOA and AOA are the contractual documents between company and members. It's like a contract. It's like a contract. Sorry, it's not like a contract. It's a contract between company and members. You all know under Indian Contract Act 1872, if you want to modify the terms of contract, consent of both the parties is required. And we call it as novation. Do you remember? Novation. So here also, modification of MOA, modification of AOA requires approval of members. Now, on behalf of company, board of directors will request. So we want to modify these clauses, MOA, AOA. We need your approval, and members has to approve it. General rule for modifying MOA and AOA, special resolution is required. I told you special resolution means 3/4 majority. Simply, 3 times majority. 3 times majority is required. Votes in favor shall not be less than 3 times of votes against. And this MOA, this is altered because of name change, capital change, next one, object change, and next one, situation change. And there are 2 more clauses. One is, association clause will never get changed. Association clause. At the time of incorporation, who are the subscribers? So, during the lifetime of company, association clause will never be changed except in case of order by the tribunal. Under section 7, we discussed. So, in all cases, association clause remains unchanged. Next, liability clause. Yes, you can change with the approval of members. Special resolution is required. But this is not there in our syllabus right now. Alteration of capital clause will discuss under share capital chapter. Section 61, I'll discuss with you. So in this particular chapter, we'll discuss name change, object change, and situation change. So by discussing these 3 points, we can complete this chapter marathon. So almost 1.5 hours for the past 1.5 hours, I'm discussing with you second chapter. I covered almost all the provisions. Now it's time to discuss alteration of MOA. So name change. You need to check it whether it is voluntarily or compulsorily. Voluntary or compulsory. So compulsory change is nothing but rectification of name, and this is covered under section 16. Voluntary change of name, you need to read section 13. Voluntarily, suppose due to change in management, due to change in ownership, due to change in object of the company, company decided to change the name of the company. Satyam Computers, Mahindra Satyam, now it is Tech Mahindra. So Satyam to Mahindra Satyam, you observed name change. Next, Idea Cellular Limited Company, now we are having Vodafone Idea Cellular Limited Company, name change. So voluntary change of name. What is the procedure, sir? Procedure is very simple. You had certificate of incorporation. According to certificate of incorporation, your name is Idea Cellular Limited. Now you want to modify it as Vodafone Idea. That means you need fresh certificate of incorporation. Fresh certificate of incorporation, ROC will issue only upon submission of documents with ROC. That means you need to file documents and information with ROC for change of name. Sir, what documents, what information we need to submit to ROC, sir? We need to submit to ROC. Very simple. Altered MOA, altered AOA. You need to submit to ROC for getting new name. And this alteration of MOA, alteration of AOA requires member approval. What kind of approval? Special resolution. Where we can take special resolution? In general meeting. So call for a general meeting, obtain members approval, special resolution. Now amend MOA, AOA, file all these documents and information with ROC. ROC shall issue fresh certificate of incorporation. Upon issuing fresh certificate of incorporation, your name will be changed. Understood? The point is, your proposed name shall not be identical with or resemble to the name of existing company. For that, you have to take prior approval of ROC, whether the proposed name is available or not. If available, ROC shall reserve that name for a period of for a period of 60 days. So within 60 days, you have to take special resolution from members. You have to alter MOA, AOA. You have to file these documents and information with ROC, and ROC shall issue certificate of incorporation. See, I wrote procedure in a reverse manner. Now, this is the first point, second point, third point, like that. Understood? I told in a reverse manner in order to understand the procedure. Looking at certificate, we'll get to know the company name. This certificate should be modified. Who is having power to modify this certificate? ROC. Upon filing of documents and information with ROC, ROC shall change the name. What kind of information and documents? Altered MOA, altered AOA, and copy of special resolution. So for getting approval of members, I need to call for general meeting. But before that, I need to reserve name. Whether the name is available or not, I need to reserve it. Are you all getting my point? So that is voluntary change of name. And two important points you have to remember. Two important points. 2 years from date of change, you have to disclose common name. Common name is old name. You have to disclose old name for a period of 2 years after change of name. Next one, this benefit of changing name is available only to the companies who are regular in filing annual returns under section 92, who are regular in filing financial statements under section 137 with ROC. So a company which is regular in filing annual returns and the financial statements with ROC, as well as the company has not committed any default in payment of debentures, deposits, interest thereon. So a company which is regular in payment of interest on deposits, interest on debentures, debentures redemption, deposits repayment, and which is regular in filing annual returns with ROC, regular in filing financial statements with ROC, only those companies are permitted to change its name. Understood? So voluntary change of name completed. Voluntary change of name completed. Special resolution. Next, name change. Next one, change in constitution, not a name change. That is, if you want to convert private limited to public company, public limited to private company, then what is the procedure? I'll discuss that procedure under section 18. Next one, prohibition of change of name. I told you, right? Non-filer not allowed. And next one, deposits, debentures, interest. In payments, if you had any defaults, you are not permitted. So if you had any kind of these defaults, first rectify those defaults, and then you are permitted to change the name. Next one, entry in register. On any change in the name of a company, registrar shall enter new name in the register of companies in place of old name and issue fresh certificate of incorporation with a new name, and change in name shall be complete and effective only after issuing a certificate. Next one, rectification of name by central government. That's what, compulsory change of name. See, we add word rectification only when there is a mistake. When there is a mistake, we'll use the word rectification. This mistake is of two types. One is name of a company similar to name of existing company, or name of a company is similar to name of registered trademark. Registered trademark. Name similar to name of existing company. You see, nowadays, we had the technology, we had information technology. So everything online form only. Today you can observe, when the moment you file document with ROC, it gets updated. But past 1950s, 1970s, there is no such advancement in technology. So manual forms filing is there. Understood? Now, one association, they registered their association under Karnataka ROC with the name ABC Limited. 2 days later, another association from Jammu and Kashmir, they registered their association with the ABC Limited name only. Lack of information between these two ROCs, what happened? Each ROC issued a certificate of incorporation with the same name. Later, central government came to know that two companies were incorporated with the same name. Now, what central government will do? Central government, power already delegated to ROC. Power already delegated to ROC. Okay, as per the act, central government will give a notice to company to change its name within 3 months. Come on, rectify your name within 3 months. And second case, if a registered trademark is infringed, infringement of trademark, without permission, trademark name is used. We used trademark name without permission of trademark holder. Now trademark holder owner can go to central government, can file an application. Sir, my trademark name is copied without my permission. So this application should be filed within 3 years of incorporation of company. Now here also central government will give notice to the company, come on, your name is similar to the name of existing trademark, come on, change your name. And the time period given is 3 months. So within 3 months you have to change the name. So in 2 cases central government will grant 3 months time period to change the name. Now what company will do? So company will call for a general meeting, and here ordinary resolution is sufficient, not special resolution. Remember this point. By passing ordinary resolution, yes, company is permitted to rectify its name. So once you get ordinary resolution, alter MOA as well as AOA, no, name change, and file these documents with ROC. ROC shall register the same and will issue certificate of incorporation. This entire procedure should be completed within 3 months time period. Of course, whether the proposed name is available or not, for that company has to file a special RUN form with ROC. If name is available, it shall be reserved for a period of 60 days. Existing company, if it want to modify the name, it will be given a time of 60 days for rectification. Understood? So yes, 3 months. Just remember the cases, identical with or resembles to the name of existing company, or the trademark name got infringed, then owner of registered trademark has to file application within 3 years of incorporation of the company. There is a practical question on this concept. Owner of registered trademark filed application with central government after 5 years of incorporation. 5 years after incorporation of company. Now can central government take any action? Can company is there any obligation on company to rectify its name? The answer is no. Central government will react only if application is filed within 3 years of incorporation. 3 years is for infringement of trademark cases, and for point A there is no such time limit. And rectification will take place by passing ordinary resolution. While all these documents with ROC shall issue fresh certificate of incorporation. Understood? In case of default, if section 13 is violated, then 1,000 per day is a penalty. 1,000 per day is a penalty, and officer who is in default, minimum 5,000, maximum 1 lakh rupees. This is the punishment for default. Understood? Only 2 branches we saw under name clause. One is voluntary change of name, the next one is compulsory change of name. Next one, registered office address change of registered office. So this is possible in 3 ways. One is change within city or town or village. Next one, change in city or town or village. Next one, change in state. And the second branch is again of 2 types. One is without change in ROC jurisdiction. Second one, change in ROC. First, understand these branches. So registered office change is possible in how many ways? 4 ways. First one, no change in city, town, village. Second one, change in city, town, village, but no change in ROC. Change in city, town, village, yes, there is change in ROC. And last one, simply change in state. Within this city, suppose if you take Hyderabad, from area A to area B, Amirpet to Begumpet, that is within the Hyderabad only. So in this case, the procedure you need to follow is board resolution approving the shifting of registered office plus ROC filing, that is INC 22. Within 30 days of shifting, you need to file INC 22 with ROC. By following this procedure, you can shift your register office from one premises to another premises where there is no change in city, no change in town, no change in village. So procedure very simple, board resolution and ROC filing. Now come on, next one, change in city, but within same ROC jurisdiction, within same state. Suppose if you take Andhra Pradesh, Amaravati to Visakhapatnam, no change in ROC, sir. Both Amaravati and Visakhapatnam are under ROC Andhra Pradesh, ROC Vijayawada only. Then what is the procedure? First, board resolution calling for general meeting. In general meeting, obtain special resolution. Next, ROC filing. Communicate the same with ROC. Communicate same with ROC. This is also very simple procedure. Now next one, change in ROC jurisdiction. There is change in jurisdiction, and this particular case 3 is applicable only to 2 states. One is Tamil Nadu, the other one is Maharashtra. And that too, in Tamil Nadu there are 2 ROCs. One is Chennai, the other one is Coimbatore. In Maharashtra we had one ROC in Mumbai, the other one is in Pune. So if your company wants to shift register office from Chennai to Coimbatore, or Coimbatore to Chennai jurisdiction, or Mumbai to Pune jurisdiction, or Pune to Mumbai jurisdiction, then only this case 3 is applicable. So under case 3 we had 2 registrar of companies before change and after change. That's the reason here we are not going to ROC directly. Here we are going directly to regional director. First you should know the hierarchy. Ministry of Corporate Affairs representing central government. Under Ministry of Corporate Affairs you can find a regional director, 7 in number total. Under regional director you can observe ROC. So case 1 and case 2 ROC is sufficient, but case 3 you are shifting from Chennai to Coimbatore. So before change you are with Chennai, after change you are with Coimbatore. So which ROC I should go, sir? Go with regional director, a level above ROC. A level above ROC. So here you know what board of directors are required to do. First, by passing board resolution they should call for general meeting. By passing special resolution they should take approval from members, and they should file application with regional director. Copy of board resolution, copy of special resolution. Along with that they should give a declaration. Sir, all workman dues discharged, completely discharged. We are not pending with any workman dues, sir. Another declaration is all about no change in jurisdiction for pending prosecutions. Right now there are 10 civil cases against our company, and all these 10 civil cases were in so and so court. Even after shifting, there will be no change in jurisdiction for pending cases. For pending cases, whenever court calls us, we will attend those cases. So there will be no change in jurisdiction for pending prosecutions. And acknowledged copy of Chief Secretary of the state. So yes, they need to file an application with Chief Secretary of the state. They need to get acknowledgement from Chief Secretary. So this copy is all about, due to proposed shifting, from Chennai to Coimbatore or Mumbai to Pune, there will be no adverse impact on workman. There will be no negative impact on workman. Suppose here, some 5,000 people are losing job, okay. But after shifting to new premises, we can create 10,000 job opportunities. Understood? So all these documents, board of directors has to file it with the regional director. Regional directors had a 30 days time limit, whether to approve it or to reject it. Seema, the board of directors simply representing company. They will file application with the regional director. A regional director has to dispose the order within 30 days of application. Now company, once it gets clearance, it has to file documents with ROC. So within 60 days, company has to file documents with ROC along with copy of regional director approval. And ROC within 30 days shall register the same and issue certificate with respect to the same. Issue certificate within 30 days to company. So simply here the approvals, if you look at equation format, board resolution, special resolution, RD approval plus ROC filing. Each and every case, one approval is getting added. One approval is getting added. Understood? Next, case 4, change in state. Change in state. Here company will go with the central government of India. Of course, power delegated to regional director. Okay. So here company has to file application with regional director. So what are the documents, sir? Copy of board resolution, copy of special resolution, and copy of altered MOA. Sir, why? In MOA, you will find only situation clause. You will find only name of the state. You can find only name of the state in MOA. Now, under case 1, case 2, case 3, there is no change in name of state. Under case 4, there is change in name of state. So, you need to alter MOA. Along with this, you need to give copy of creditors, list of creditors list, and you have to furnish advertisement copy. This should not be older than 30 days mark. This should not be older than 30 days. 30 days before you file application with central government, you have to advertise the matter in 2 newspapers. One is in vernacular newspaper, the other one is English newspaper, about shifting of registered office from one state to another state. And all other declarations quite common. Now, the moment central government receives the application, it will inquire whether creditor's consent is there or not. Creditor approval is there or not. Sir, creditor approval is there. Adequate security has been provided to the creditor, sir. Adequate. Sir, total loan amount is 10 crores and we provided 20 crores security, sir. Finally, creditor's consent is there. Now, after looking at creditors, after looking at debenture holders, central government shall approve the shifting of registered office from one state to another state, and for passing the order, for passing any order, approving or rejecting, central government is having a time limit of 60 days. 60 days of application, yes, central government shall dispose that order. Now, company has to file this information with 2 ROCs. ROC old, ROC new. So this filing should be done within 30 days of order. Now, old ROC shall register the same and issue certificate within 30 days of filing. Within 30 days of filing with ROC, yes, old ROC shall issue a fresh certificate to company, and new ROC, that means we want to shift to state of Karnataka. So Karnataka ROC shall issue certificate of incorporation. New ROC shall issue certificate of incorporation to the company. Understood? See, lengthy procedure, but I am giving you main points. I'm highlighting main points. So here, shifting of registered office from one state to another state, the approvals, if you look at the approvals, first board resolution, next members approval, next creditor's consent, and finally central government approval, of course, power delegated to regional director, next ROC filing. So simply, if you look at 4 cases, first case 1, board resolution plus ROC filing. Case 2, board resolution plus special resolution plus ROC. Case 3, board resolution plus special resolution plus RD approval. So regional director approval, it should be given within 30 days of application plus ROC filing. And case 4, change in name of the state. Change in state. It's not change in name of the state, change in state. I told you, board resolution, special resolution, altered MOA, copy of creditors, advertisement. Along with this, copy of minutes prepared in the general meeting. How to provide this information. Now, central government will take 60 days time to dispose the order. So, board resolution plus special resolution plus creditors approval plus CG approval, and finally ROC filing. Is it clear? So you can see each and every point, within a city, board resolution, special resolution, permission from regional director, special resolution, approval of central government, and you can see same time limits, 30, 60, 30, 60, 30, 60, 60, 30, 30, 60, 30, 30. So same time limits I mentioned in lecture also. Just give one time reading, ma. Just give one time reading. Sufficient. All these points I covered. Place of register office from one state to another state. Copy of MOA with alterations. Minutes of general meeting. Next, board resolution. List of creditors. Acknowledgement copy, service copy, applicant with complete annexes to ROC, Chief Secretary of the State, Union Territory, where register office is situated at the time of filing of application. Next, advertisement in newspapers, not more than 30 days. That means it should not be older than 30 days. Central government is having a time of 60 days to dispose the order. Sir, here the word regional director is there. No confusion. Act central government. However, as per rules, central government delegated power to regional director. And before passing of order, central government may satisfy itself. Consent of the creditors, provisions and security, filing with ROC. Finally, issue of fresh certificate of incorporation. Next one, alteration of MOA with respect to alteration of object clause. Alteration of MOA with respect to alteration of object clause. For this, same kind of approval. What kind of approval? Same approval. That is, special resolution is required. What kind of approval is required? Special resolution. But for getting this special resolution, members has to send notice calling for general meeting. See, company is planning to conduct meeting on so and so day, so and so place, so and so time. When you yes or no, so to tell date, time, place, agenda of general meeting, yes, it is the duty of company to send notice to all its members. Along with the notice, company is required to dispatch, company is required to prepare explanatory statement. In this explanatory statement, company should clearly tell the members, sir, we had this much amount, we received this much amount, total money received, received money from public. In this, we utilized some portion for existing objects and we are left with this much amount, unutilized money. And we are planning to start a new business. So objects of new business, simply new objects. A risk and rewards associated with new objects. Amount required for pursuing new objects. Profits that company will get after implementing new objects. Everything, a detailed explanation company has to provide to the existing members. And the same thing should be published in newspapers also. So after giving notice and explanatory statement to the members, members will come to the meeting. And in general meeting, definitely, voting will be conducted. In general meeting, voting will be conducted. So some votes may be in favor, some votes may be against. For alteration of object clause, once again I'm telling you, for alteration of object clause, special resolution is required. Imagine we had total 100 shares. Persons holding 90 shares gave approval, favor, and persons with holding 10 shares are against to the alteration Are you getting my point? Now the persons who are against to the alteration, we call them as dissenting shareholders. Now the point is, promoters of the company or controlling shareholders has to give exit offer to the dissenting shareholders. See, we want to change our objects. But you are not giving approval, right? Okay, please surrender your shares. We'll pay you money. So that's what, exit offer means. Who will give exit offer? Company or promoters? Answer is promoters. Don't write company. Why? Because if company is giving exit offer, it is nothing but buyback. Again, section 68 to section 70 provision shall apply. Again, section 68 to section 70 provision shall apply. So company won't give any exit offer. Exit offer shall be given by promoters or controlling shareholders only. So once everything is completed, come on, company, file information with ROC. ROC shall register the same. Company has to file this information within 30 days of special resolution. ROC shall change the same and ROC shall register the same and issue the fresh certificate within same time period of 30 days of filing. 30 days of filing. One blind concept you have to remember. Blind concept is MOA, AOA or contractual documents between company and members. Company and members. Any modification to these documents requires approval from members. General rule, special resolution. However, in case of rectification of name, ordinary resolution is sufficient. Whenever these documents got modified, all these documents, company has to file it with ROC. That's it. If you remember this topic, blindly finished. Next one. And one more point, in case company is having more than 200 members, in all the above cases, if company is having more than 200 members, then, voting shall be conducted through postal ballot. Remember this point. So that means, members having a company up to 200 members, postal ballot is not required. So after alteration, each and every copy of MOA and AOA should have a note point that, this is an altered MOA, this is an altered AOA. You make any default, 1000 rupees is the penalty. 1000 rupees is the penalty. Next one. Alteration of articles of association. Very simple, here also you need to get special resolution. And this alteration includes conversion of companies. You all know how can we differentiate private company and public company. In private company, in articles of association, you can see restricts transfer of shares, limits number of members to 200, prohibits invitation to public offer. Yes or no? If these points are there, then it is a private company. Now, if a private company wants to convert into public company, simply delete these provisions. Or if a public company wants to convert into private company, simply insert these provisions. One case you are deleting, the other case you are making insertion, addition. So delete or insert, it comes under what? It comes under alteration. So alteration of AOA, it requires approval from members, that is special resolution. So just look at the one note, private company to public company. In private company, in original AOA, you can have these points, restricts, limits, prohibits. If you delete these points, it leads to altered AOA, alteration of AOA. So for doing this, you need to get special resolution from members. Now file altered AOA and copy of special resolution with ROC. ROC shall register the same and shall issue fresh certificate of incorporation. Very simple. Now, if a public company wants to convert into private company, public to private, in that case, what is the procedure? You need to add restricts transfer of shares, limits number of members to 200, prohibits a public offer. And moreover, the existing members should come to 200 and existing public deposits, existing public money should be repaid immediately. So whether it happened or not, so central government will come and central government will check. So central government approval is compulsory for converting public company into private company. Are you all getting my point, students? Of course, power granted to ROC, that is under rules. Per act, I am telling you. So from public to private conversion requires alteration of AOA and it requires copy of members approval, copy of special resolution. Along with that, you need to get central government approval also. Is it clear? Next one, see, a private company into a public company into a private company, even where a private company altered its articles in such a manner that no longer include, see, this paragraph is telling that private to public conversion. Provide further that any alteration having the effect of conversion of a public company into private company shall not be valid unless it is approved by an order of central government and on an application made within 60 days from the date of passing of special resolution filed with RD in form number RD1 along with the fees. Now, once required approvals, you got it. File it with ROC. So file it with ROC within 15 days of alteration to AOA. And alteration shall be valid only if it is registered with ROC. If it is not registered with ROC, then alteration is not valid. And alteration will have original effect. Same like, if for original articles, what is the effect we are having? Altered AOA will also have same effect. And this is common point. Disclosure of alteration on each and every copy. Disclosure of alteration on each and every copy. If there is no such disclosure, then penalty of 1000 rupees. Next one. Section 17 is a general section, distribution of MOA and AOA. See, under Companies Act 1956, or way back 2000, before 2006, we had no rich technology. You can call it as, we had no separate public domain where you can download documents just by paying 100 rupees. Right now, mca.gov.in, here you can view public documents, you can download public documents at just 100 rupees per company. So previously, this much facilities are not there. So any member, if you want to go through MOA, AOA, copy of board resolution, copy of members resolution or agreements executed by the company, what members used to do? Members used to request the company in writing. In writing, they used to request company. So we need a copy of MOA, we need copy of AOA, or we need a agreement, or we need resolutions referred under section 117. So along with the request, these members are required to pay sufficient fees. For fees for taking printouts, fees for dispatch of documents to the members. When these two conditions are satisfied, company is bound to submit these documents to members within 7 days. Within 7 days. So very simple. Any member can request for copy of MOA, copy of AOA, resolutions mentioned under section 117, that is some board resolutions, some member resolutions, and agreements executed by company. So any member can request for copies. So this request should be done in writing. Along with the written request, there should be some fees. You need to pay some fees. So once these two conditions are satisfied, company is bound to submit documents within 7 days of written request and receipt of fees. Failure, then company is liable for a penalty. How much, sir? 1000 rupees for each day during such default continues. Maximum 1 lakh rupees. Next, section 10A, I discussed with you. Section 10A already completed, Conversion of companies, I told you. Right now, under articles of association alteration, I told you. So even after conversion, private to public, public to private, just constitution of companies getting changed, private to public, public to private. So there will be no impact on existing debts, existing obligations, existing liabilities. They will continue. There is no change. Next point. Subsidiary company is prohibited to hold shares in its holding company. What is this point? We discussed holding company, subsidiary company. So a company will become subsidiary to another company if holding company is having more than half of total voting power, or holding company is having control over composition of directors. Yes or no? Board of directors. Now once a company becomes subsidiary to one entity, now from that minute onwards, subsidiary company should not acquire shares of holding company. Holding company shall not allot any fresh shares to subsidiary company, including rights issue. Including rights. Bonus is different. Holding company can give bonus shares to subsidiary company. So the rule is very simple, ma. On the basis of control, we are classifying companies into two types. One is controlling company, and the other one is controlled company. One is controlling, the other one is controlled company. Yes or no? Again, if you permit subsidiary to acquire shares of holding company, now there is a clumsiness. There will be clumsiness. You can't observe you can't find out which company is controlling another company, which company is controlling which company. Suppose H is having 60% voting power in yes. Yes is also having 60% voting power in H. Now tell me which entity is controlling which entity. Sir, H controls yes, sir. Acha, even S is also controlling H. So which entity is controlling which entity? No clarity. So that's the reason subsidiary company, after becoming subsidiary, it should not acquire shares of holding company. Holding company should not allot shares to the subsidiary company. But to this general rule, we had three exceptions. One is before becoming subsidiary. Before becoming subsidiary, A Limited, B Limited, two companies are there, ma. B Limited acquired 10% share capital of A Limited. B Limited is having 10% share capital of A Limited. It happened in the year 2022. Now there is no relationship between A and B. A is neither holding nor subsidiary. B is neither holding nor subsidiary. And there is no relationship between A and B. Subsequently, in the year 2023, A Limited acquired 60% share capital of B Limited. Now, because of this, B Limited becomes subsidiary to A Limited. B Limited became subsidiary to A Limited. Now, from date of becoming subsidiary, B Limited should not acquire new shares of A Limited. Up to the date of subsidiary, up to the date of becoming subsidiary, whatever shares held by subsidiary company, it can continue to hold such shares. There is no problem with anyone. There is no issue at all. So till the date of becoming subsidiary, any shares held by subsidiary company, it can continue to hold such shares. No need to surrender. In the year 2014, this question came for 5 marks. How you know, sir? I'm the student of 2014 attempt. I'm the student of 2014 attempt and I wrote wrong answer. That's why I still remember this question. So until the date of becoming subsidiary, if subsidiary holds any shares, no need to surrender. It can continue to hold such shares. The point is no voting power. No voting power. In such cases, there will be no voting power with respect to subsidiary company. That means in A Limited general meeting, B Limited can't participate with voting power. B Limited can't exercise any vote. This is first exception. Second exception, as a legal representative. Third exception, as a trustee. As a legal representative, as a trustee, subsidiary can hold shares of holding company. Subsidiary can hold shares of holding company. Suppose company A Limited, B Limited. B Limited is already subsidiary of A Limited. B Limited is already subsidiary of A Limited. One of the director of B Limited, out of his personal funds, bought A Limited shares. Some 2% paid up share capital, director is holding. One day, director got heart stroke and he prepared a will. According to the will, B Limited will be the legal guardian, legal representative of son. Accordingly, B Limited is holding shares of A Limited. Now, B Limited is not holding shares for its personal purpose. It is holding shares as the legal representative, representing son of the director. It is holding shares of A Limited. So this is also permitted. As a legal representative, as a trustee, subsidiary can hold shares of holding company. In these two cases, voting power is permitted. Why? Because subsidiary is not holding these shares for itself. Subsidiary is holding shares on behalf of some persons. So voting power is permitted. In case 1, voting power is prohibited. In case 1, voting power is prohibited. No company, either by itself or through its nominees, hold any shares in holding company, and no holding company shall allot or transfer its shares to any of its subsidiary companies. Any such allotment or transfer of shares to subsidiary company shall be void. I told 2 points. Subsidiary shall not acquire shares of holding company. Holding company shall not allot its shares to subsidiary company. What are the 3 exceptions? One is as a legal representative, the other one is as a trustee. In both the cases, participation in voting rights, voting power is there. Voting power is there. Next one, before it becomes subsidiary, it can hold shares, existing shares, but it can't increase it. It can't increase it. In one attempt, there is a question. Sir, holding company issued bonus shares, sir. Is this issue valid or invalid? Answer is valid. Why? Because allotment of bonus shares is at free of cost, and because of bonus shares there is no change in percentage of holding. There will be no change in percentage of holding. Even before it is holding 10%, after issue of bonus shares also same 10%. There is no change in voting percentage. There is no change in holding pattern. Bonus shares permitted. Rights, fresh issue, transfer, all these are prohibited. Understood? And you have to remember this point, ma. In one examination attempt, they asked voting rights, exclusively they asked for voting rights. So voting rights are available in case of trustee as well as legal representative. But voting rights are not available if subsidiary company is holding shares for itself. Next, signing of documents, self-study. You can read it on own, ma. Next, last concept, ma. Authentication of documents, proceedings and contracts. Sir, generally company will enter into contract. Yes or no? Yes. Company is entering into contract with one of the supplier, ma. One of the supplier of goods. Now this contract document, who will sign this contract document, sir? Who will sign this contract document? So the answer is KMP, key managerial person, or any officer or employee duly authorized by the board. If these people are signing this contract, that means company is bound by the provisions of that contract. Company is bound by the terms of the contract. So the document should be signed either by KMP or an officer or employee of the company authorized by the board. So if you look at the definition of KMP, CEO, MD, manager, CS, whole-time director, CFO, and any officer below the directors, a level below the directors, who should be in full-time employment and who has been designated as KMP. Precondition C, any officer, a level below directors. It's not, 2 levels, 3 levels below the directors, a level in a hierarchy, a level below directors who must be in full-time employment and who is designated as KMP. If these 3 conditions are satisfied, then that person is also a KMP. And such other officer as may be prescribed. In future, government may prescribe any person as KMP. So these people will come under the definition of KMP. Next one, authentication of hundis, bills, promissory notes and other documents. So on behalf of company, who can authenticate these documents? Very simple. If company is having common seal, first fix common seal. Sir, company is not having any common seal, sir. Then ignore common seal. That letter, that letter of authorization for delegating power, that letter should be signed by 2 directors. Two directors. In case company is having secretary, then 1 director and 1 secretary should sign it. Suppose Reliance Industry Limited is having a branch office in Guntur, in Guntur, Andhra Pradesh. One area, Guntur, Andhra Pradesh, one area. So with respect to Guntur, Andhra Pradesh, I'm the branch in charge. With respect to Reliance company, you can see Mukesh Dhirubhai Ambani, Nita Ambani, madam, all these are directors. And they're having, more than 30,000 branches. For all these branches, they need to pay rents. They need to pay salaries. Yes or no? For each and every payment, you just imagine directors signing the checks. That means, every day, every minute, they need to sign checks. No, directors, busy in signing the checks. Every month they should sign, every day they should sign for making payments. We had one clause in Income Tax Act. Any expenditure in excess of 10,000, if you make payment in cash or bearer check, that expenditure will be disallowed. Remember? So now, for making payments of rent, salaries, they can delegate the authority to staff. For such delegation, they need to sign an authorization letter. That authorization letter should contain common seal plus two directors signature. Sir, common seal is not there, sir. Then two director signature is sufficient. Suppose, sir, company secretary is there, sir. In that case, common seal plus one director plus one company secretary signature is required. Sir, common seal not there, sir. Then one director plus one company secretary signature is sufficient. That means that authorization letter, if it is signed by two directors or one director and secretary, company authority can be delegated to that in charge. Now after getting this letter, I can sign checks with respect to payment of rents, with respect to payment of salaries. So how authority is getting delegated, that is all about this point. Are you all getting my point, students? So with this chapter number 2, incorporation of company and matters incidental thereto, we completed. Our next topic, share capital and debentures. As you all know, company can raise money through various sources. Broadly, I can classify these sources of finance into two types. One is share capital and second one, debt capital. Under share capital, you can observe equity share capital and preference share capital. Under debt capital, you can observe borrowings from banks, financial institutions, debentures, acceptance of deposits. Provisions related to equity share capital, preference share capital, debentures are covered under chapter 4, share capital and debentures, and provisions related to deposits are covered under chapter 5, acceptance of deposits. So we'll start with share capital and debentures. Section 43 to section 72. On an average, you can expect 8 marks from this topic, including multiple choice questions. Okay. So first of all, share capital. What is meant by share, ma? The definition of share is, share means share in the share capital of the company, and it includes stock. That means the provisions of Companies Act 2013 that are applicable to share are equally applicable to stock. So wherever you read word stock, the provisions applicable to share are equally applicable to stock. Share is the smallest component of share capital, a portion of share capital, and stock means bundle of shares. Bundle of shares. So you can call like this, 10 shares, 15 shares, 20 shares. But coming to the stock, it is expressed in number, monetary number, 2 lakh stock, 3 lakh rupee worth stock, 4 lakh rupee worth stock, like that. Stock is expressed in rupees, share is expressed in number, 10 shares, 15 shares, 20 shares. Bundle of shares. If you surrender to company will issue stock after taking back shares. Okay. Share, you can't divide it into fractions, like, half share, 3/4 share, 1/5 share. It is not possible. But coming to stock, you can transfer even in fractions also. 20% stock, 10% stock, 5% stock, you can transfer it. Understood? So share means share in the share capital of the company and includes the stock. Next one, the nature. If you look at the nature of share, it is a movable property. It is transferable, subject to AOA. Why? Because if you are a public company, shares are freely transferable. If you are a private company, shares are transferable with some restrictions. Restricts transfer of shares. Do you remember? Next one. Each and every share should be distinctively numbered. So distinctively numbered. These two conditions, this condition, the share should satisfy. So next one, section 43, kinds of share capital. Kinds of share capital. I'm not talking types of share capital. I'm talking about kinds of share capital. We had two kinds of share capital. One is equity share capital. The other one is preference share capital. Sir, what is equity share capital, sir? Any share capital that is not preference share capital, we call it as equity share capital. Then what is preference share capital, sir? any share capital carrying two preferential rights. Two preferential rights. One is with respect to payment of dividend. The other one is with respect to repayment of capital. In the event of liquidation, yes, equity shareholders are there, preference shareholders are there. To whom you give priority? Sir, I'll give priority to preference shareholders. So in terms of payment of dividend, in terms of repayment of capital, I'll give priority to preference shareholders. So preference share capital carry two preferential rights. And there is one more type of preference share capital, that is, participative preferential right. Participative preferential right. Sir, even these two conditions are not satisfied. Dividend condition, repayment of capital, preferential rights are not there. But at the time of liquidation, along with equity shareholders, suppose assets total 100 crores, liabilities 60 crores. Now there is a surplus of 40 crores at the time of liquidation. In this surplus, along with equity share capital holders, if preference share capital holders are given a right, then those shares we call it as preference shares. Those shares we call it as preferential shares. So first part of preference share capital definition is capital which is having two priorities when compared to equity share capital. So those two priorities are, one is payment of dividend, the other one is repayment of capital. And there is another part of preference share capital definition, that is, a share capital which is having participative rights, in the surplus arising out of winding up proceedings or arising during liquidation proceedings. So that portion of capital we call it as preference share capital. Issue and redemption of preference share capital we will discuss under section 55. Now coming to equity share capital, again this is of two types. One is normal rights, equity shares with normal rights. The other one is equity shares with differential rights. As you all know, holding equity share will give you many rights. Popular two rights. One is right in the share of profits. I call it as dividend. The other one is voting rights. Whenever a company calls for general meeting, in that general meeting, equity shareholders are entitled to cast vote. Now these two are very popular rights. One is dividend, the other one is voting power. Now under normal rights, each and every share is entitled to equal dividend and equal voting rights. But coming to differential rights, here dividend may be high or may be low. Next one, voting rights may be high or may be low. Example, if you look at Tata Motors, two types of shares they are having, normal rights as well as differential rights. Under differential rights, 10 shares, holding 10 shares, you'll get only one vote. General rule, one share equal to one vote, ma. One share equal to one vote. If they are fully paid up, each share is entitled to one vote. Whereas Tata Motors differential rights, 10 shares constitute one vote. And to satisfy public, you are getting less voting power, right? So for you, the normal dividend plus 5% extra, you are going to get 5% extra dividend. Suppose if normal dividend is 12%, you will get 17% dividend. Sir, why differential rights will be given, sir? Why company will prefer differential rights? Only one thing, ma. See, we can categorize members into two types. One is promoter group. The other one is public group. Promoter group, public group. Promoter group always focus on control over company. So they don't focus on, dividends. Why? Because company belongs to them. Yes or no? Major portion of capital lies with them. Promoter definition, one who controls the affairs of the company as a member or a director or otherwise. Do you remember? So they don't focus on dividend. They focus on control. So for them, normal rights is okay. For them, normal rights. If they hold normal rights, no problem. So each share will give one vote. Now coming to the public, they will hold shares only for one purpose. That is, income, revenue. Every year, how much revenue will you pay to me? How much income will you pay to me? So there is nothing but dividends. I need more dividends, sir. Voting power, no problem, sir. No problem. See, we won't come to the general meeting. We won't participate in voting rights. Okay, chalo. Even if you give voting power, even if you give less voting power, there is no problem. And from promoters' point of view, if they prefer differential rights, if they look into differential rights, only less control is getting diluted to the public. Suppose promoter is holding one share, he will get only one vote. Now, if you want to give one share to same share to the public will also get one vote. Now, dilution of control is happening. Now, promoter's point of view, issuing, differential rights with less voting power, promoter interest is getting protected. There is no much dilution of control. Understood? So Tata Motors issued differential rights with high dividends and less voting. This is all about background of differential rights, ma. But for issue of differential rights, so what are the conditions we need to satisfy? Issue of equity shares with the differential rights. So what are the conditions we need to satisfy, sir? Very simple. First, AOA authorization compulsory. Articles of association authorization is compulsory. Suppose if AOA is silent, then do one thing. Implement section 14. Pass special resolution. Alter AOA. File documents with ROC within 15 days and obtain certificate from ROC. Now AOA authorization is permitted. Next one, ordinary resolution from members. If you are a listed company, then such ordinary resolution should be passed through postal ballot. Postal ballot kind of voting you have to conduct. Unlisted companies, you can call for a general meeting. In general meeting, obtain ordinary resolution from members. Understood? Next one, limit. So to what extent I can offer differential rights, sir? Very simple. Voting power from differential rights shall not exceed 74% of total voting power. Total voting power is nothing but voting power from differential rights plus voting power from normal rights. So these two put together 74%, out of total 74%, voting power from differential rights limit. So maximum voting power from differential rights shall not exceed 74% of total voting power post issue of equity shares with differential rights. And then next one, defaults. So the company should not have following defaults. Sir, what are those defaults, sir? Very, very important, ma. Very important. So what are those defaults? I classify these defaults into, two types. For easy remembering. I classify these defaults into two types. One is, time defaults. One is time defaults. Just 1 second, ma. So one is 3 years defaults and the other one is 5 years defaults. The next one, no subsisting default. For remembering only, I'm giving this chart. Just observe. The last 3 years, company should not default in following aspects. One is ROC filing. Every year company is required to file, annual returns under section 92, financial statements under section 137. So there should be no default in the last 3 financial years. Suppose, sir, I committed default in the year 2022, sir. I didn't file annual return. I didn't file financial statements in the year 2022, sir. Okay, from then 3 years, you are prohibited from issuing equity shares with the differential rights. After 3 years, you are eligible to issue differential rights. Understood? Next one, not penalized. Last 3 years, you should not be penalized under, sectorial regulators like RBI, SEBI, SCRA, FEMA, any other sectorial regulators. So last 3 years, you should not be penalized under these sectorial regulators. Next one, coming to the subsisting default. Subsisting default means what, sir? At the time of issue of equity shares with the differential rights, you should not possess these defaults. Sir, what are those defaults, sir? Debentures, repayment of debentures, interest on debentures, deposits repayment, interest on deposits, preference share capital, and dividend on preference share capital. Next one. So yes, so these 3 defaults you should not possess at the time of issue of equity shares with the differential rights. Everyone. Next, 5 years defaults means what? 5 years defaults. Just remember, just listen carefully and remember this point, tricky point. 3 years means, last 3 years you should not commit these defaults. 5 years means upon rectification of these defaults, upon rectification of default, there is a ban of 5 years on you. 5 years. So it's not from default date, it's from rectification of default year onwards. 5 years there is a prohibition on you, there is a ban on you. Sir, what are those defaults, sir? Very simple. Term loan, interest on term loan. If you commit any default in repayment of debentures, interest on debentures, deposits, repayment of deposits and payment of interest on deposits, preference share capital and dividends. Understood? Next one, term loan, interest on term loan. Next one, preference dividend. Preference dividend. Yes, it is repeated twice, ma. In Bear Act also I observed, preference dividend repeated twice. Here there is a point, here also there is a point. It is a mistake. It is a mistake, but you have to read it. Next one, IEPF, transfer of amounts to IEPF. Next one, employee statutory dues. Employee statutory dues like, PF, ESI, TDS. So if you commit any of these defaults, first rectify them. Upon rectification, prohibition of 5 years will be imposed on you. That means, suppose, sir, I committed default in the year 2023, sir. The default is non-payment of interest on term loan, sir. I failed to pay interest on term loan, sir. Acha, when you rectified it, sir, I rectified this default in the year 2025, sir. Now add 5 years. So from 2030 onwards, you are eligible to issue equity shares with differential rights. Observe the difference between 3 years defaults and 5 years defaults. Under 3 years defaults, last 3 years, you should not have these defaults. Last 3 years, you should not have these defaults. Subsisting default means at the time of issue of equity shares with the differential rights, you should not possess these defaults. 5 years defaults means, yes, default happened, sir. Failed to pay term loan, sir. Failed to pay preference dividend, sir. Failed to transfer amounts to IEPF amounts, sir. Failed to transfer dues, sir. Employee statutory dues to the government authority, sir. In that case, first rectify them and wait for 5 years. After completion of 5 years, you are eligible to issue equity shares with differential rights. Understood? So this is all about defaults. Lengthy points, but you have to remember. Next one. So proper disclosures. Disclosures in register of members, disclosures in board report. Regarding what? Number of shares offered, type of differential rights, terms and conditions, amount raised, and to whom shares were offered. So separate disclosure is required. And next one, conversion is not possible, ma. Conversion, that means normal rights to differential rights to normal rights. It is not possible. It is not permissible. So if you want, you can issue differential rights. If you want, you can issue normal rights. Next, coming to the rights. Except voting and dividend. Equity shares with normal rights and equity shares with differential rights will enjoy same privileges. Yes, normal rights people are entitled to attend general meeting. Differential rights holders are also entitled to attend general meeting. Normal right holders will get notice calling for general meeting. Differential right holders, they will also get notice calling for general meeting. Each and everything is same except voting and dividend. Even when you offer bonus shares, you can offer bonus shares separately to normal rights as per same terms, and same terms, you can offer differential rights bonus shares to the differential rights holders. That means when you offer bonus shares or rights issue, you can offer same class of shares to the respective class of shareholders. Suppose if I am holding normal right shares, I'll be given bonus share with normal right only. If I'm holding a share with the differential rights, I'll get bonus share with a differential right only. Are you all getting my point, students? So this is all about conditions for issue of equity shares with differential rights. You can see AOA condition, unlisted company ordinary resolution, listed company postal ballot. Next, max 74% of total voting power. Next, regular filing with ROC. Next, no default. Declared dividend to its shareholders. Dividend, deposits, preference capital, debentures, interest, dividend, term loan, employee statutory dues, IEPF dues. With respect to these points, upon rectification, after completion of 5 years, you can issue equity shares with differential rates and not penalized under sectorial regulators. So these 4 points I covered. Next, conversion is not possible and same privileges they are also entitled to. Next, register of members separate disclosure, board report separate disclosure. Next one, non-applicability. IFSC public companies, private companies. If their MOA and AOA prescribe that section 43 is not applicable, then section 43 is not applicable to them. However, they should be regular in filing annual returns under section 92 and financial statements under section 137 with ROC. Is it clear, ma? Everyone? So section 43 completed. Next, section 46. Section 46, very simple section. Section 46 speaks about share certificate. Section 46 covers not only original share certificate, it also covers duplicate share certificate. So original share certificate, it should be issued in form number SH1. Format is SH1. Next, rule of estoppel is applicable with respect to title of share certificate. So share certificate, 3 components are very, very important. Name of the owners of the shareholders, number of shares held by the persons, and next one, face value and paid up value. So name, who is the owner, number of shares, how many shares he is holding, face value and paid up value. So tomorrow, what would be his liability, maximum unpaid value. Maximum liability is unpaid value. Yes or no? So with respect to these 3 components, share certificate will act as a prima facie evidence. Understood? Next one, signing. Share certificate is valid only if this condition is satisfied. That condition is, if company is having common seal, fix the common seal. Sir, no common seal, sir. And company is having company secretary, then one director and one company secretary has to sign the share certificate, or else share certificate is invalid. Sir, company is not having a secretary, sir. In that case, 2 directors has to sign share certificate. Understood? If common seal is there, fix the common seal and get signature of director and secretary, or get the signature of 2 directors. Common seal not there, sir. In that case, secretary is there. 1 director plus 1 secretary. Sir, no secretary, sir. Then 2 directors. 2 directors should sign share certificate. And sir, what is the time limit for issue of share certificate, sir? What is the time limit for issue of share certificate? At the time of incorporation or at the time of allotment, within 2 months of incorporation date or within 2 months of allotment date, share certificate shall be issued in the name of allottee or subscriber. So the time limit is 2 months. Understood? Next one, coming to the duplicate. Sir, when duplicate share certificate will be issued, sir? Now, when original share certificate is lost or destroyed. This is case 1. And case 2, share certificate is defaced, sir, or turn into 2 pieces or 5 pieces, 10 pieces. So if you observe, we had 2 cases. One is lost, destroyed. There is no share certificate at all. Original share certificate I lost. Sir, share certificate is there, sir, but it is in 2 pieces, sir. Or some letters on the share certificate got erased, sir. Defaced, turn. Now under case 1, the applicant for a duplicate share certificate should submit documents to the board of directors. First one, an application. Along with application, you need to submit, proof, evidence. Sir, I lost share certificate and I am the member of the company, sir. Proof, evidence. Next, indemnity bond. Sir, really I lost share certificate, sir. Tomorrow, because of this share certificate, if you incur any loss, if you suffer any loss, I'll compensate you. Sometimes what happen, I'll have share certificate, I'll give it to my friend or I'll give it to banker for the purpose of obtaining loan. I'll give that document to my friend or banker. Now innocently, I'll come to bank and I'll say, sir, I lost share certificate. Please give me duplicate share certificate. Now what happened tomorrow if I don't pay the amount? Either my friend or banker will come to the company and they will claim, original share certificate in their name. Yes or no? They will they will obtain share certificate in their name. In that case, for company it is a loss. Giving share certificate to me and giving same share certificate to banker or to my friend from whom I obtained money. So in such cases, company will be at loss. Company will be at loss. So that's what I'm telling to company. Because of my application, tomorrow if you suffer any loss, I'll compensate you, indemnity bond. And then fees, maximum 50 rupees maximum 50 rupees. So upon submission of these documents, board of directors after giving approval, so they shall issue duplicate share certificate in the name of member. In case of defaced or turn, the document list is very simple. You have to submit original share certificate. Next one, fees not exceeding 50 rupees. Now, subject to board approval, company will issue duplicate share certificate in the name of applicant. Now here, disclosure is very important, disclosure. On the duplicate share certificate, there is you should mention a point. Duplicate share certificate issued in lieu of original share certificate number, like that. You have to make a disclosure, and you have to maintain a register separately for duplicate share certificate. And next one, sir, is there any time limit for issue of duplicate share certificate? Yes, there is a time limit for issue of duplicate share certificate. So time limit. So here companies are classified into two types: a listed company, unlisted company. Listed company, you have to issue duplicate share certificate within 45 days. Unlisted company, just double 45 days into 2 times. How much? 90. So write it in months, 3 months. So within 3 months of application, unlisted company, within 45 days of application, a listed company shall issue duplicate share certificate in the name of applicant, and that duplicate share certificate shall contain a point that duplicate share certificate issued in lieu of original share certificate number, and separate register has to be maintained. Is it clear up to here? Is it clear? Next, sir, if these duplicate share certificates are issued, duplication is genuine, no problem. Any fraud, sir, duplicate shares issued with fraudulent intention, in that case, officer in default, come, punishment 447. What is the punishment? Section 447. Next one, company, you are also having a penalty. How much? Minimum 5 times of face value of the security is duplicated. 5 times. Maximum, there are 2 limits, you have to remember 2 limits. Option A is 10 times of face value of share certificates duplicated. Option B, 10 crores, whichever is higher. What is the penalty on the company, minimum 5 times of face value, maximum 2 limits. Out of 2 limits, whichever is higher, you have to consider. One is 10 times of the face value, the other one is 10 crores. One is the 10 times of the face value, the other one is 10 crores. Understood? So with this, section 46 we completed. So yes, distinctively numbered, to be issued under common seal, signed by 2 directors. Everything I covered. Duplicate share certificate, loss, defaced, mutilated turn, fees not exceeding 50 rupees. Disclosure, duplicate issued in lieu of share certificate number. So time limit, 3 months for unlisted company. 15 days already, amendment came up. 45 days. 45 days from the date of submission of complete documents with the company separately. Next one, separate record you have to maintain. But all these provisions are not applicable to demat shares. Shares, demat form means, shares in electronic form. Only one difference, that is, having 2000 rupees in your pocket, it's a physical money. It's like a share certificate. Now, same 2000 rupee money, if it is there in a bank account, it's nothing but money in bank. Can you show it to me? No. Can you tell me the denomination? How many 500 rupee notes? How many 100 rupee notes? 50 rupee notes? Can you tell me? No. And you can transfer that money online also. You can withdraw it, or you can transfer money online also. So now if money is in bank, can you tell me the serial number of the currency? Serial number. So each and every note will have a serial number. Can you tell that serial number if money is with bank? No, sir. Understood? So distinctive numbering. These provisions are not applicable to the shares which are in demat form. Next one, manner of issue of certificates, duplicate certificates. I told you, prerequisites, everything I told you. Records of particulars, maintenance of share certificate, all these points are covered. Next one, punishment for defraud. So what is the punishment? I told you, right? Company, minimum 5 times, maximum 10 times or 10 crores, whichever is higher. Every officer of the company who is in default are liable for action under section 447. Next, section 47. So next concept, section 47. Voting rights. Very simple topic only. Very simple topic. 47. Voting rights. Here, I classify this section into two types. One is equity share capital, a preference share capital. In every general meeting, equity share capital holders are entitled to vote. They are entitled to vote on every resolution placed in front of them in the general meeting. However, these voting rights are subject to three conditions. One is no voting rights with respect to calls in advance. Calls in advance means any amount you paid extra, extra, whatever amount called by the company. If you are paying any extra amount, that extra amount I call it as calls in advance. For calls in advance, no voting rights. And your voting rights are subject to differential rights. I told you under Tata Motors, in Tata Motors company, if you hold 10 shares of differential rights, you will get one vote. Next one, a related party transaction. A related party transaction. So in any resolution, if you have any interest, if you or your relative is having any interest, then you are not entitled to vote. You are not entitled to vote. Understood? So except these three conditions, on each and in front of you in the general meeting, on every resolution, you are having a power to cast vote. Under show of hands, you are entitled to one vote. One vote, one person, one shareholder. One vote, one shareholder. Whereas in case of poll, votes depends upon number of shares held by you. So proportion to the paid up share capital. So what is the total paid up share capital? In the total paid up share capital, how much portion you are holding? To that much, for that much portion, you are entitled to voting power. However, in case of Nidhi company, there is a note point. The note point is member exceeding 5% of paid up share capital, holding 5% of paid up share capital, he is entitled to vote only up to 5%. 5% voting power only he will have. He will not have, if he is holding 10% paid up share capital, 10% voting power, 20% paid up share capital, 20% voting power. Like that, in Nidhi company, that clause is not there. That privilege is not there. That privilege is not there. Any portion in excess of 5% of paid up share capital, for that portion, you are not entitled to voting. Up to 5% voting is allowed. Clear? Next one, sir, preference shareholders. So will they get voting power? Generally, no. However, matters affecting their rights. Suppose, you promised at the time of issue 10% dividend every year. Now, company is not performing well. You want to reduce it to 8%. So yes, this is a matter affecting their rights. So you need to call for a meeting. You need to call them for a meeting, class meeting. In that class meeting, you have to take approval from them. After getting approval, you can reduce 10% to 8%. Next one, in the event of capital reduction, during capital reduction event. So section 66, I think I'll discuss under section 66. Don't worry. So reduction of capital. Next, during liquidation of company, winding up, they will get voting rights. So matters affecting their rights, capital reduction, liquidation or winding up of the company. Apart from these three conditions, apart from these three cases, when preference dividend remains unpaid consecutively for a period of 2 years or more, if preference dividend remains unpaid, then they will get voting rights similar to equity shareholders. Suppose last 2 years you didn't pay dividend to preference shareholders. Equity share capital, suppose 10 crores rupees is there, Preference share capital also 10 crore rupees is there. Now, last 2 years you didn't paid any dividend to preference shareholders. Now, the next general meeting, upcoming general meeting, both equity shareholders and preference shareholders are entitled to attend general meeting and entitled to cast vote in the general meeting. So, equity shareholders will have 50% voting power, preference shareholders will have 50% voting power. Why? Because, total 20 crores, right? Out of 20 crores, equity share capital is 10 crores, preference share capital is 10 crores. So, equity shareholders are 50% voting power, preference shareholders 50% voting power. Once you pay dividends to them, then they will lose their voting rights. Understood, everyone? So you can see here, Paul shall be in proportion to his share in the paid up equity share capital of the company. Total paid up share capital of the company 100 crores, and you are holding 10 crores. So 10 out of 100 means 10%. Now you are having 10% voting power. Coming to Nidhi companies, your voting is restricted to 5% of voting power. Understood? Next one. Voting right of member holding preference share capital. I told you, right? Matters affecting their rights. Winding up of the company. Reduction of equity share capital or preference share capital. Next, poll. So proportion to his share in the paid up preference share capital of the company. And this point also I discussed with you. Just give one time reading, you'll get to know. Next one, yes, special benefits to private company. Private company which is regular in filing returns with ROC, and in articles of association of that company, if they write that section 47 shall not apply, then section 47 is not applicable to private companies. So simply section 47 is not applicable to private companies which satisfy two conditions. One is AOA should specifically exclude section 47. Second one, they are regular in filing annual returns and financial statements with ROC. Understood, everyone? Next one, specified IFSC companies, common point. Just go through this chart, you'll get clarity. Next one, section 48. Section 48. So variation of rights. Section 48 is simply variation of rights. 5 minutes back I told one example. 10% preference share capital redeemable after 10 years. Now reading this statement, you can get this point. Preference shareholders are having two rights. One is every year 10% dividends, and after 10 years, complete redemption. Yes or no? So if you are holding this share, you are entitled to two rights. One is dividend 10%. Second one is after 10 years, 100% redemption. Right now, company is in bad position. Company is not performing well. Company is not in a position to pay 10% dividend. Company want to reduce it to 8%. Now, whose right is getting affected? Your right is getting affected. Yes or no? And company is seeking modification in the terms of the contract. So, terms of the contract, if you want to modify, mutual consent is required. So, preference shareholders consent is required. Yes or no? That means you need to get approval from them. So condition number 1, check your MOA and AOA. AOA authorization is there or not? Sir, no sir, authorization is not there. Then check issue terms. When you are offering shares, when you offered preference shares, so you might have mentioned some terms and conditions. So look at those issue terms. So issue terms should not have prohibition. On variation. You need to check it. Sir, there is no prohibition on variation, sir. Then you can proceed with variation. Suppose, sir, MOA authorization is not there, and in issue terms there is a prohibition on variation, sir. Now you can't change rights of the members. Condition number 2. Sir, condition 1 satisfied. Next, condition 2. And before that, one small point. 48 is applicable. 48 is applicable only if company had different classes of shares. different classes of shares. Equity shares with normal rights, equity shares with the differential rights, equity shares, preferentials, like that. Company must have more than one class of shares. And then condition number 1, MOA authorization. If no authorization, then check issue terms. Sir, condition 1 satisfied. No, condition 2. If you are able to call for a class meeting, then obtain special resolution from them. No, sir, I'm not calling for any meeting, sir. In writing, I want to get approval, sir. In that case, 3/4 of capital, 3/4 of that class capital. Simply, suppose preference share capital is suppose suppose 60 crores. 60 crores. Now 60 crores rupees into 3/4 means how much? 45 crore rupees holders. Preference shareholders. I'm not talking about count of preference shareholders. I'm telling that 45 crores worth holders must give approval in writing. If you are able to call for a meeting, then obtain special resolution. No, sir, we are taking approval in writing, sir. Like postal ballot. Then 3/4 of class capital should give approval. And here there is one more point, ma. That is variation of one class affects the other class members. Variation of one class members is affecting other class members. Then you have to take approval from other class members also. You have to take approval from other class members also. Example, you want example, right? See, ma, normal rights, equity share with normal rights, 1 share equal to 1 vote, ma. Differential rights, 10 shares equal to 1 vote. Okay. In a company, imagine in a company, total there are 90 shares normal rights. Differential rights also 90 shares are there. 90 shares are there. Now voting power, if you observe, into 1, 90 into 1 by 10, 9. So total 99, ma. Total how many? 99. So out of 99, if you observe, these people are holding how much portion? Maybe 91% they are holding. This one, maybe 9%. 9 divided by 99. I'll calculate. 9 divided by 99. It's a 9.09. So out of total voting power, differential rights are holding 9.09%. And normal rights holders are holding 90.1% or 90.9%. 90.9%. You understood? You understood this example? Normal rights 90 shares will give 90 votes. Differential rights 90 shares will give you 9 votes. Now, company decided to change the terms. The terms is, 1/10 is there, no? For every 10 shares, they are entitled to 1 vote, right? Now we want to modify it as 1 share equal to 2 votes, sir. 1 share equal to 2 votes, sir. In that case, after variation, what happens? See, normal rights 90 into 1, differential rights 90 into 2, total 90 plus 180, 270. Normal rights shareholders, actually they are holding 90.9% capital. However, now they are holding just 33.33% of total voting power. Differential rights, they are holding 66.67% of the voting power. So variation of one class is affecting variation of other class. Variation of one class is affecting other class rights. In that case, you need to get approval from other class also. What kind of approval, sir? 3/4 capital holders approval is required. 3/4 class capital, 3/4 capital of class holders approval is required. Understood? Everyone? Next one. Next point. So with these two conditions fulfilled. Next one. Once you get approval, variation is permitted. However, members holding not less than 10% of class capital, 10% of that class capital, who casted votes against to the variation. We don't want that variation, sir. We are opposing the variation. We call them as dissenting shareholders. Now these dissenting shareholders can file a petition with NCLT within 21 days. 21 days of variation. So who can file petition with NCLT? Dissenting shareholders not holding not less than 10% of capital. Not less than 10% of capital can file a petition. What is the time limit? 21 days of variation. Now NCLT will decide whether to permit the variation or eliminate the variation. So NCLT will pass the order, and company has to file that order with ROC within 30 days. So within 30 days of NCLT order, the same copy should be filed with ROC. That is all about section 48. One point you have to remember. One tricky point you have to remember. The tricky point is how much approval we need to take. If you are able to call for meeting, if you are able to conduct a meeting, then special resolution. Sir, in my company there are more than 200 members, sir. Compulsory postal ballot kind of voting you have to implement. Under postal ballot, capital value 3/4, 3/4 of issued shares of the class. That much capital holders must give approval in writing. Understood? And same points I already covered, So yes, dissenting shareholders can file a petition with NCLT, but they should hold at least 10% of the class capital. So time limit for application 21 days. Tribunal decision is binding. Next, file copy of order with ROC. So section 48 also we completed. Next, section 49, 50, very small points, that is calls on shares. One is calls on shares. So whenever company is making calls on shares, they should be on uniform basis. That means with respect to particular class, the call amount should be same for all members, and the time limit for making call payment, that should be also same. Suppose for one member, come on, pay half rupee, another member pay me 2 rupees, another member pay me 5 rupees. It is not permitted. Same on uniform basis. Understood? So there should be no differentiation in a given class of security holders. Next, section 50 is all about calls in advance. Calls in advance. Calls in advance, company can accept only if there is authorization from AOA. And with respect to calls in advance, there is no extra voting rights. There is no extra dividend rights also. No voting rights, no extra dividends, no extra voting. Suppose, face value 10 rupee. Called up as well as paid up value is 8 rupee. One member paid, entire 10 rupees to the company. So in this 8 rupee is paid up value, 2 rupee is calls in advance. Now with respect to 8 rupees only, he is entitled to vote. With respect to 2 rupees, he is not entitled to vote. Why? Because the 2 rupees is not a part of capital, it is a part of liability. For the 2 rupees, you are like a creditor. Creditor is not entitled to vote in the general meeting of company. Understood? Next one, section 51, dividend. The company may pay proportionate dividend on such paid up capital subject to AOA. Suppose, one class of shares, we had two types of clauses. For example, normal rights, differential rights. Tata Motors having face value 2 rupees each, paid up value, normal rights 2 rupees, differential rights only 1 rupees. Generally dividends are paid on face value. Actually, generally, on face value dividends will be paid. If AOA permits, AOA authorization is there, then on paid up value will pay dividends. On paid up value will pay dividends. Next one. So may pay proportionate dividend on paid up capital, including calls in advance, subject to AOA. Subject to AOA. They are using the word subject to AOA. If AOA permits, they will pay dividends proportion to paid up capital. That means on 2 rupees and on 1 rupee. Suppose 20% dividend. Now 20% on paid up value, 20% on 1 rupee paid up value. Nothing is mentioned. You can pay on face value. Your choice. Next. Preference shareholders, dividend is always a fixed rate. Normal point only. Next one, issue of shares at a premium. Very simple topic. Issue of shares at premium. Section 52. Securities premium. Under section 52, there is no condition to fix the securities premium. See, securities premium is nothing but issue price minus face value. There is no condition on there is no condition on calculation of securities premium. You can fix only 20% of face value, you can fix 100% of face value as security premium. There is no such condition. There is no condition on limit of share capital. There is a condition on utilization of securities premium. Utilization. So there are some restrictions on usage of security premium. So first of all, whatever excess amount you collect, in excess of face value, that amount shall be transferred to securities premium account. That amount shall be transferred to securities premium account, and that amount you can utilize for stated purposes only. So here companies are classified into two types. One is companies following accounting standards while preparing financial statements. Companies while preparing financial statements, following accounting standards as per section 133, and all other companies like banking company, insurance company, electricity company, like that. So companies preparing financial statements according to accounting standards, they can utilize securities premium for three purposes. One is buyback. The other one is expenses of expenses of issue related expenses. Next one, bonus issue. Now coming to all other companies, securities premium can be used for five purposes: buyback, bonus issue related expenses, Next, premium, redemption premium on redemption of preference shares, redemption premium, and to write off preliminary expenses. Preliminary expenses. Understood? So for all other companies, securities premium can be used for these five purposes. Whereas section 133 companies, that means companies following accounting standards in preparation of financial statements, they can utilize securities premium for three purposes only. Except the stated purposes, if you utilize securities premium, then instead of debiting securities premium, you have to debit share capital account. Generally, securities premium, it's a credit balance. You can utilize securities premium for stated purposes. Other than stated purposes, if you utilize securities premium, then you can't debit securities premium. Instead of debiting securities premium, you have to debit capital. That means section 66 reduction of share capital provisions shall apply. Understood? So AOA authorization is also not required. You can fix securities premium. It's your discretionary powers. But if you fix more amount, then Income Tax Act 1961 will apply. So they will compare issue price with the fair value of share. Fair value, not face value. Fair value. If issue price is more than fair value, then fair value, I'm calling once again fair value, the difference will be taxed under income from other sources. Income Tax Act subject is there. Income Tax Act, income from other sources, this provision is there. Under Companies Act, there is no restriction on fixation of securities premium. The restriction is only on usage of securities premium. Clear? Next one, issue of shares at a discount. Issue of shares at a discount. Sima, issue of shares at a discount is void. General rule is void. However, we had two exceptions. Exception 1, sweaty equity shares. Where is that point? See, except in case of issue of sweaty equity shares, this is exception 1. Exception 2, issue of shares to the creditors under statutory resolution plan or debt restructuring scheme. In past, I borrowed money from non-trade creditors. I obtained materials from trade creditors, but now I'm not in a position to repay them. I want to survive. I want to do business. However, I'm not having money to pay them. So now what I will do? I'll implement a plan, or I'll implement a scheme, debt restructuring scheme or statutory resolution plan. Under this scheme or plan, I'll invite creditors. Creditors, I'm liable to you, right? Come, just waive off my debt. I'll give you shares. Just cancel my debt. Equal amount, I'll give you shares. Sometime I'll give extra shares. Suppose debt amount is 80 crores. I'll give you 10 crore equity shares. Each face value 10 rupees. So I'll give you 100 crores face value of equity shares for waiving of 80 crores debt. Now, if you observe here, 20 crores is actually discount on issue of equity shares. Permitted, sir? General rule not permitted, but if it is as per statutory resolution plan or debt restructuring scheme, permitted. Okay. Except these two cases, if you offer equity shares, if you offer shares at a discount, then we call it as default. In case of default, the penalty as well as refund, two conditions will apply. Two things you have to follow. One is refund. Sir, you have to refund entire money. Along with that, you have to pay interest also, 12% per annum. So you need to refund money. In addition to refund, you have to pay 12% interest per annum from the date of accepting money, date of receipt of money to date of payment. And then penalty how much, sir? Option A, 5 lakh rupee. Option B, amount raised through issue of equity shares at a discount. I'm sorry, it's not equity shares, shares. Shares include equity as well as preference. Shares includes equity as well as preference. So penalty to both company and officer in default is rupees 5 lakhs or amount raised through issue of shares at a discount, whichever is less. Whichever is less. Remember these words, very, very important. Understood? Understood. So you can prepare chart on your own, ma. Very simple, issue of shares at a discount. Void. Exceptions. What are those exceptions, ma? One is sweat equity shares. Second one is, creditors, issue of shares to the creditors under statutory resolution plan or debt restructuring scheme. Violation. Suppose violation. Consequence. Refund. Along with refund, you have to pay 12% interest per annum. And then company as well as officer in default liable to pay penalty. How much, sir? Rupees 5 lakhs or amount raised through issue of shares at discount, whichever is less. Completed. Section 54 also we completed. Next one, sweaty equity shares. What is the next concept? Sweaty equity shares. Sweaty equity shares means equity shares. There are also equity shares. How to remember this word, ma? They are also equity shares. They are also equity shares issued by a company to its directors or employees at a discount or for consideration other than cash for providing their know-how or making available rights in the nature of intellectual property rights or value additions, whatever name you call. Today company can survive only with the efforts of employees, ma. Particularly if you look at service sector companies, telecom companies, Infosys, Wipro, Reliance, Jio, Infocom, employee contribution is compulsory. Without employee contribution, you can't run these companies in a long run. Infosys you take. One particular employee or one particular director, he really worked very hard and he got one new contact, a new customer, new client. So we can bill to that client, almost 1,000 crores every year. So that much, that much worth of revenue he contributed to the company. Now, what we are doing? We are offering shares to him, either at a discount. So generally, face value 10 rupee. But director, you worked a lot. Your efforts are really wonderful, awesome. You just pay me 2 rupees only. We'll give you 1 crore shares. 1 crore shares. Each share 10 rupee face value, but you just pay me 2 rupees. Now the difference 8 rupees is nothing but discount. This is discount. Next one, for consideration other than cash. Suppose in Dr. Reddy Laboratories, one employee is there. He worked very hard and he invented a medicine to cure COVID. So he developed a formula. He developed a medicine which can cure COVID. Now it comes under intellectual property rights. Intellectual property rights. The value of that intellectual property rights, for example, 10 crores. Now we are calling that employee, come my dear employee, because of your efforts, we got this intangible asset of 10 crores. We'll offer you shares, 1 crore into 10 rupee share. Don't pay me 1 rupee also. No need to pay 1 rupee. So here, for consideration other than cash, I'm getting consideration from you, but it is not in cash. It is in the form of intellectual property rights, know-how services, value addition, etc. So now what entry I'll record? Very simple. Intangible asset account debit to equity share capital. So simply 10 crores, 10 crores. If I'm getting asset, I'll capitalize it. If I'm not getting asset, what I'll do, I will charge that amount to profit and loss account under the heading of employee benefit expense. Employee benefit expense. Now, to which director or which employee a company can offer sweat equity shares? Do you think all directors and employees are eligible for sweat equity shares? No, no, no. Only directors, employees, working in our company or our holding company or subsidiary company, maybe in India or outside India, but they should be in permanent employment. They should be in permanent employment. You can see this condition. See here, definition of employee. Permanent employee, temporary employee disqualified from getting sweat equity shares. Only permanent employees. He may work in India or outside India. He may work for our company or for our subsidiary company or for our holding company, either in India or outside India. So coming to the director, either whole-time director or part-time director. No problem. These people are eligible to get sweat equity shares either at a discount price or for a consideration other than cash. Now, looking at the conditions, what are the conditions company should satisfy before issuing sweat equity shares? First one, special resolution. Obtain special resolution from members, and this special resolution is valid only for 12 months. After 12 months, special resolution is lapsed. Once again, you need to get special resolution. Then only you can offer sweat equity shares, or else you can't offer sweat equity shares. Next, for getting this resolution, you need to give notice calling for general meeting. Along with the notice, give them explanatory statement. In that explanatory statement, furnish the details, number of shares, what is the current market price, and what consideration you are getting, and to whom you are offering a sweat equity shares. If you are a listed company, in addition to Companies Act, you have to comply SEBI also. And coming to the sweat equity shareholders, these people will carry same rights similar to the existing equity shareholders. So same rights, limitations, restrictions, provisions that are applicable to equity shareholders, same rights, limitations, restrictions, provisions shall apply to sweat equity shareholders. There is a limit. There is a limit. The limit is at the time of issue, new, you can offer 15% or 5 crores, whichever is higher. 15% of existing paid up share capital in a year, or 5 crores rupees, whichever is higher, subject to a cumulative number, subject to a cumulative limit of 25% in the lifetime of the company. For understanding this point, definitely one example is necessary. A limited company is there. Paid up share capital is 200 crores. In the year 2019, they issued sweat equity shares of 10 crores. Now in the year 2023, they are planning for sweat equity shares. They are planning to issue sweat equity shares. How much, sir? 15% max. 15% max or 5 crores, whichever is higher. So 15% of 200 crores existing paid up share capital. So that is 30 crores. 30 or 5, whichever is higher, 30 is the highest amount. Already I issued 10 crores, right? Now cumulative effect, that is 25% max lifetime, 25%, right? So 200 crores into 25%, it will be 50 crores. So existing 10, proposed 30, total put together, they are within 50 crores only. So happily they can offer sweat equity shares of 230 crores. There is no issue, no problem. Next example. B limited company is there. Same paid up share capital excluding sweat equity shares is 200 crores. In the year 2018, they offered 30 crores sweat equity shares. In the year 2018, they offered 30 crores sweat equity shares. Now in the year 2023, they are planning to issue sweat equity shares of 25 crores. Possible or not possible, we need to check. Individually, for year 2023, you can offer 15% of 200 crores, so 30 crores. Now, during the lifetime of company, a company can offer sweat equity shares up to 25% of 200 crores paid up share capital, that is 50 crores. Already 30 crores issued. Now 30 plus 30 put together 60. It is violating second condition, that is 25% of 200 crores. So this time 30 is not permitted. Max 20 is only permitted. Why? Because existing already 30 you issued. Now new, existing plus new should be less than or equal to 25% of paid up equity share capital. Paid up equity share capital. So that means 30 plus x less than or equal to 50 crores. Now x should be less than or equal to 20 crores. So this time you can offer sweat equity shares up to 20 crores only. Coming to the startup company, up to 10 years of incorporation, the limit is 50%. It's not 25%, 50%. Startup companies generally grow based on employee contribution only. Employee will work hard only when they get better incentives. Next, lock-in period. This is applicable only for unlisted companies. Unlisted companies, lock-in period. So lock-in period means what? During this period, employee is not permitted to transfer these shares. Up to 3 years from the date of allotment, you are prohibited from transferring these shares. Lock-in period, compulsorily you have to hold. Next, valuation. Sir, share price, intellectual property rights, know-how, value addition. These two should be valued. Who can value, sir? A registered valuer. It should be carried out by a registered valuer. Just telling about myself. Apart from along with the CA qualification, I'm also holding this qualification. I'm holding qualification of registered valuer under security financial assets also. So my signature is compulsory. My calculation, it's not signature, my calculation, and I should value the share and intellectual property rights and know-how, value addition. So definitely company will prepare that value. I'll verify. So far, if you look into my practice, basically company will determine the values. I will also calculate values. If my calculation and their calculation is matching, then I will fix that price. If there is any difference, definitely I'll disclaim it, or I'll fix another value and I'll submit my report to the management. So far, I think I issued 8 to 10 reports, fixed a valuation of shares, 8 to 10 companies, not sure. Okay, so registered valuer is eligible person to value the share and value the intellectual property rights, know-how, as well as value addition. Next, board of directors report. Board of directors report for the year in which such shares are issued. Specify the details of issue of equity shares. Next, members register. Separate disclosure is required. Why? Because 3 years you impose lock-in period, right? So that the disclosure should be there. Yes or no? So disclose them separately in members register. Next one, treatment of non-cash consideration. I told you, if sufficient amount we are receiving a asset, the amount of equity shares you are offering, value of equity shares you are offering, if that much value, if you are getting asset, just capitalize it, or else expense, charge it to the profit and loss account. Next one, employee definition, value addition definition, already covered. Next one, write about provisions of Companies Act regarding issue of preference shares. Section 55 is having conditions with respect to issue as well as redemption of preference shares. Issue as well as redemption of preference shares. Issue related conditions, redemption related conditions, we are having at one place. That is section 55. Issue, simple conditions, AOA authorization. Next, special resolution from members is required. Why? Because preference shareholders carry two preferential rights. One is dividend, the other one is capital. So compared to equity, these people will get dividend first. These people will get capital first in the event of liquidation. So existing equity shareholders' right is getting affected. So you have to get approval from existing equity shareholders. The kind of approval is special resolution. Next, irredeemable preference shares. Can a company offer irredeemable preference shares? No. And maximum tenure is 20 years. In case of infra companies with infrastructure projects, 30 years is the maximum tenure. However, 21st year onwards, every year 10% redemption should happen. Every year, 21st year 10%, 22nd year 10%, 23rd year 10%, like that, 10 years Each year 10% redemption is must and should. Next one, no subsisting default. Important. At the time of offering preference shares, the company should not have following defaults. One is payment of preference dividend. The other one is repayment of preference share capital to preference shareholders. Logic very simple. If you are not able to satisfy existing preference shareholders, why new preference shareholders? If you are not able to satisfy existing preference shareholders, why new preference shareholders? First, satisfy existing preference shareholders. Pay them dividends regularly. Repay the capital whenever due occurs. So if you have these defaults, first rectify them and then you can offer preferences. So this is all about conditions with respect to issue. Very simple. Next, the redemption. AOA authorization not at all required. Suppose if there is no clause in AOA regarding redemption, can you say like this? My AOA didn't permit me to redeem preference share for capital, so I'm not redeeming preference share capital. Permitted? No. You have to repay irrespective of AOA authorization. Next one, the class of shares should be fully paid up. Preference shares should be fully paid up. Next one, sources. Very important, sources. Now here you need to classify the redemption amount into two parts. One is face value, the other one is premium on redemption. Suppose face value is 100 rupee and you promise that you will redeem it at 120 rupees. Redemption value 120. If you observe, 120 is of two components, 100 face value, 20 premium on redemption. Coming to face value, you have two sources. One is profits of the company, reserves. The second one is issue proceeds of fresh issue. Suppose if you select the profits of the company, then nominal value of shares for redeem, that amount you have to transfer to CRR account, capital redemption reserve account. Issue proceeds, there is no problem. Now coming to premium on redemption, you had two sources. One is profits of the company, the other one is securities premium. Section 133 companies. 133 means what? Companies preparing financial statements according to accounting standards. They can use only profits. Other companies, they can use profits or they can use securities premium for premium on redemption of preference shares. So this is about sources. Next one, once redemption happened, ROC filing within 30 days, file form with ROC along with MOA, Memorandum of Association. ROC filing is also compulsory. Next point, sir, failed to redeem, sir. We are not in a position to redeem. In that case, we call them as unredeemed preference shares. UPS. Such preference shares, we call them as unredeemed preference shares. In case of unredeemed preference shares, company will take back old shares and company will issue new shares to the preference shareholders. But this requires consent of preference shareholders, not less than 3/4 of capital value. Suppose 60 crores is the preference share capital, sir. In this 3/4 means how much? 45 crores. 45 crores worth of preference share capital holders must give consent. Next one, payoff to dissenting shareholders. Suppose, I got approval from 59 crores worth of preference share capital holders, sir. Remaining 1 crore, return their money. Finally, take NCLT approval. Approval from NCLT is also required. Now, these new shares, they can have, these new shares can cover two amounts. One is preference share capital, the other one is dividends that remain unpaid dividends. So yes, you can issue shares covering these two values. Sir, in that case, share capital may increase. No, sir. Now, increase of share capital provisions will apply. Not applicable. Even if you issue new shares, which is more than existing share capital, increment in share capital provisions will not at all apply. So with this, section 55 also we completed. Section 55 also completed. So redemption is must. Tenure is there. Redemption condition, out of profit, fresh proceeds. Redeem shares to be fully paid up. Out of profits, out of fresh issue. CRR condition, I told you. Sources for premium on redemption. If you are a company covered under section 133, you can use only profits. Other companies, they can use securities premium. Out of company's securities premium. Unable to redeem, we call them as unredeemed preference shares. Obtain resolution approval from them 3/4 in value. Approval of NCLT. Dissenting shareholders shall be paid off. No increase or reduction of capital provision shall apply. So with this, section 55 also I completed. Section 55 also I completed. Are you all getting my point, students? Everyone. The beginning of this chapter, I clearly told you shares nature is movable. They are movable in nature. They are transferable subject to AOA. In case of private company, on transfer there are some restrictions. In case of public company, the shares are freely transferable, right? Now, with respect to transfer, we had some provisions. Those provisions were listed under section 56. Now let's look into section 66. Conditions for transfer of shares. So what can be transferred first? If it is a company with share capital, transfer of securities. If it is a company without share capital, transfer of interest. Each and every member will have some interest in that company. So since there is no share capital, ownership will be measured in terms of interest, 10% interest, 20%, 25%, 30%. Now these two can be transferred. The following conditions shall be satisfied in order to register about transfer. What are those conditions? First, proper instrument SH4. It should be duly dated, signed, stamped. So it should be executed by both transferor and transferee. Understood? So here transferee has to specify the details, name, address, occupation. If you look at incorporation documents, initially subscribers will furnish their name, details, address, occupation, everything. At the time of allotment also, for getting shares, looking at public offer or private placement, the applicant should furnish name, address, occupation, everything. Now under transfer also, transferee should furnish complete details. So this transfer document, along with original share certificate, in case original share certificate is issued, original share certificate plus proper instrument. If share certificate is not yet issued, then letter of allotment plus instrument. Either transferor or transferee should submit these documents with company within 60 days of execution. Within 60 days of execution of instrument, transfer deed. And these rules are not applicable to bonds of government company and shares held in a demat form. So whatever we are discussing under section 56, these provisions are not applicable to bonds of government company as well as shares held in demat form. So 60 days time limit we are having. Instrument along with original share certificate, it should be submitted to company within 60 days from date of execution. If instrument is lost, then no problem. Submit indemnity bond. Submit indemnity bond. Under section 46, issue of duplicate share certificate, we discussed that point, right? Same point once again, I'm telling you. Indemnity bond. If instrument is lost or if share certificate is lost, submit indemnity bond. Next one, if shares are partly paid up, shares involved in the transfer is partly paid up, and if that application is executed by transfer alone. I repeat, two conditions. Condition 1, shares are partly paid up. Condition 2, application executed by transfer alone. Then company should not register. Company shall not register this transfer deed, shall not register this transfer until and unless it gives 2 weeks intimation to the transferee. Transferee, the shares involved in the transfer is partly paid up. Tomorrow if company calls on shares, if company makes calls on shares, you are liable to pay call amount. So you had 2 weeks time limit. Within 2 weeks, you have to give your opinion. If no reply from you, we assume that you approved this transfer and will register this transfer. Registration of transfer, the effect is transfer name will be removed from transfer register of members. Transfer or share certificate shall be cancelled. Transferee details are added to the register of member. New share certificate in the name of transferee, company will issue. And what is the time limit? 1 month is the time limit. Within 1 month of submission of these documents with company, company shall issue new share certificate in the name of transferee. Understood? So total 3 time limits we discussed under section 56. One is 60 days of execution. Transferor or transferee should submit these documents with company. And if shares are partly paid up, instrument is executed by transferor alone, then company should give notice to transferee, and transferee is having a 2 weeks time limit to reply to company. Next one, if everything is clear, company has to issue share certificate in the name of transferee within 1 month from the receipt of complete documents. Next one, transmission. These provisions are not applicable to transmission. What provisions? Execution of transfer deed, consideration, stamp duty value. All these conditions are not applicable in case of transmission. First of all, what is transmission, sir? Transmission is also like transfer, but it is not transfer. It is a purely under operation of law. Suppose one member got deceased. Now legal representative or nominee automatically becomes member of the company. Now shares in the name of this member are transmitted to legal representative or nominee. Suppose member became insolvent. Now through operation of law, all the properties held by Mr. M shall be transmitted to official assignee, who will sell all these assets in order to clear discharge liabilities. So this is also transmission case. So in case of transmission, transfer instrument, transfer deed, consideration, stamp duty value, 60 days time limit are not applicable, and company should register the documents in the name of nominee. So cases of transmission, death case, insolvency case, lunacy case. Time limit for issue of share certificates, issue of securities, sorry, not share certificates, securities. Why? Because here debenture point is also there. So what is the time limit of issue of securities? At the time of incorporation, within 2 months. At the time of allotment of shares, shares, 2 months from the date of allotment of shares. This is specific for shares only. In case of debentures, we are having time limit of 6 months. 6 months from date of allotment. Next one, in case of transfer or transmission, the time limit is 1 month from the date of receipt of instrument of transfer or intimation of transmission. And if it is IFSC company, for them double time limit, that is 60 days. 60 days after incorporation, allotment, transfer, transmission, everything 60 days, unique time limit, easy to remember. IFSC companies, easy to remember. 60 days after incorporation, 60 days transfer documents, transmission documents, 60 days from the date of allotment. Whereas for other companies, 2 months from incorporation, 2 months from allotment, 1 month from date of receipt of transfer deed or intimation of transmission, and in case of debentures, 6 months from date of allotment. Next one, very simple point. Now in case of death of a member, by way of transmission, legal representative will become member of the company. Now legal representative, he is having two options. Option A, register shares in his name, register shares in his name, in the name of legal representative, or transfer of shares to some third party. Transfer of shares to third party. Sir, I don't want shares, sir, I need money. I will transfer all these shares to the interested candidates. I'll transfer shares to the interested candidates. Now actually, who is the original member? Who is the original shareholder? M is the member of the company, M is the shareholder. So in the shares, you will find the name of M. However, particularly in this case, the transfer deed, M can't sign. Why? Because M already deceased. So legal representative signing on behalf of deceased member is sufficient. The transfer is valid. And the third party who gets shares from the legal representative of a deceased member, the transfer is also valid. So he can choose any option. Transmission he can choose, or directly he can transfer to third party. Next one, default, section 56 default. So company and officer in default, penalty 50,000 rupees. So depository, if shares are held in demat form, depository is responsible for those shares. If he commit any fraud, he will be punished under section 447 of Companies Act 2013. So with these provisions related to transfer completed, forged transfer. Somewhat tricky topic, tricky point. Just listen carefully. O is the original member, O is the original member. F obtained shares under forged transfer. Forgery, you all know the meaning of forgery. Forgery means imitating the signature of a person. Imitating signature of a person. So F executed a transfer deed, SH4. So transfer details, F signed. And F also signed O signature. It looks like a O signature only. Now F submitted all these documents with company. Company in good faith only registered this transfer. 1 year completed. During this year, F claimed bonus, F claimed dividends, F claimed right shares, etc. etc. Everything, F claimed. Bonus shares, F claimed. Dividends also F claimed. 1 year, O observed, I'm not getting any dividends, I'm not getting any intimation from company regarding general meetings. So O approached company and O came to know that this transfer deed was executed, fraudulently. This transfer deed, O signature got forged. Now O, the original member, is having a right to get back shares in his own name. We call it as restoration. So restoration of O's name in register of members, and O is entitled to get these shares. O is also entitled to claim dividends from the company. Company is liable to original member. Sir, if company started paying all these amounts to O, then company will be at loss. No, sir. No problem. Company can claim all these amounts from F. F is liable to compensate company. Any damages, company suffer. All damages, all amounts, F is liable to pay to company. Why? Because this is a forged transfer. Next one. Suppose, F transferred the shares to innocent buyer, IB. This person obtained shares in good faith. This person obtained shares in good faith. Now, after completion of this transfer, O approached company. Sir, I'm not getting any dividends. I'm not getting notice calling for general meeting. Show me your register. In the register, O's name was O name was removed. After observation, O came to know that, after analyzing what happened, O came to know that O shares got forged. O transfer deed got forged. And now the shares are in the hand of IB, insolvent buyer. Insolvent buyer. Now in this case also, under case 2 also, O has complete rights to claim his shares. O has right of restoration of his name in the register of members. Why? Because forged transfer and subsequent transfers are null and void. The title remains with O only. So company has to take back shares from insolvent buyer. Sorry, insolvent buyer not. Innocent buyer. Company has to take back shares from innocent buyer, and company has to return shares to O. Sir, in that case, innocent buyer will be at loss. No, sir. Yes, company has to indemnify innocent buyer. Why? Why? Because innocent buyer looking at share certificate in the name of F, innocent buyer paid amount to F on the belief that, company, you gave share certificate in the name of F. On that belief, I acquired shares. I paid money to F. Now I'm at loss. Correct only. So company should compensate a innocent buyer. Sir, now company finally at loss. No, sir. No problem. Company will claim that amount from F. Company is eligible. Company is entitled to claim all these amounts from F. Are you all getting my point, students? So that is what, complete question number 12. So in any case, original member is entitled to get back his shares. He is entitled to restore his name in the register of members. Any loss to the company, any loss to the innocent buyer, complete amounts, company can claim from the person who executed shares under forged transfer, who executed transfer deed under forged transfer. Understood? So, while restoring the name of original shareholder, the company may be asked to compensate a new genuine buyer, innocent buyer, I told you, right, who exercised good faith in purchasing the shares. Remedy to the company. As a remedy, company may get itself indemnified by the first transferee who used forged instrument of transfer to get shares transferred in his name. Dot. For demat shares, these concepts will not apply. For demat shares, forged transfer will not apply, right? Next one, punishment for personation of shareholder. Punishment for personation of shareholder. What is this concept? Right now, I told you one point, right? 1 second. Just now I told you point. Mr. F, he signed transfer deed pretending to be O. F intimated signature of O. Yes or no? Forged transfer, right? He imitated, it's not intimated. He imitated the signature of O. It is nothing but personation. Personation is nothing but acting like someone. Acting like someone. Now, F, he took transfer deed. As a transfer, he signed it. And as a O also, he is making a signature. That means, he is imitating another person. He is imitating someone. So, he is making personation. He is changing his identity and signing as if he is a O. So any person, if we make personation, in order to get shares, in order to get any benefits linked with the shares, now that person will get punishment. What is the punishment, sir? Imprisonment up to 1 year. Sorry, imprisonment shall not be less than 1 year. So minimum imprisonment 1 year, and a fine, end. See the point, imprisonment minimum 1 year. 1 year less than or equal to imprisonment less than or equal to 3 years, and fine. What is the fine amount, sir? 1 lakh to 5 lakh rupees, and fine, 1 lakh less than or equal to, fine less than or equal to 5 lakhs. Any person making personation, so acting like a original shareholder, in order to transfer shares, in order to claim any benefits associated with the securities, then that person will be punished. What is the punishment? Imprisonment minimum 1 year, maximum 3 years. And next, fine minimum 1 lakh rupee, maximum 5 lakh rupee. Section 58, a refusal to register transfer of shares. Refusal to register transfer of shares. Sima. So transfer or transferee, what they will do? They will execute transfer deed, form SH4. Is it right? Now along with SH4, they has to submit original share certificate with company. Now these two documents, either transferor or transferee should submit these documents to company. What is the time limit? Within 60 days of execution of transfer deed. Now, in front of company, two options are there. Two options. One is register transfer and issue share certificate within 1 month. Within 1 month of date of receipt of transfer deed. Date of receipt of transfer deed. The second option is reject. Reject. In that case, company has to give notice. Company has to give notice of refusal. So notice of refusal shall be given within 30 days of date of receipt of intimation of transfer. Now, the transfer agreed party, why? Because he already paid amount to transferor. So transfer is waiting for share certificate. However, transferee received notice of refusal. Now transferee is having an option to go to NCLT. Sir, I applied for a company share, sir, in secondary market. I paid sufficient consideration to transfer, and company refused my transfer, sir. Company refused my transfer. And that refusal is not on valid grounds, sir. Like that, transferee has to file an application with NCLT. Sir, is there any time limit? Is there any time limit for filing an application with NCLT? Yes, there is a time limit. Sir, what is the time limit? I'll tell you. The transferee or transferor filing an application with NCLT about refusal to register transfer. Refusal to register transfer. The time limit is whether you received notice of refusal or not. Sir, notice of refusal received. Notice of refusal not received, sir. Notice of refusal not received. So two branches, just observe carefully. And your company is private company or public company. Private company or public company. Two time limits are there. That's what I am telling you. The notice of refusal received. Okay. So within 30 days, if you are a private company, within 30 days of notice, file application with NCLT. If you are a public company, then within 60 days. Within 60 days of notice. Within 60 days of notice, file application with NCLT. Sir, notice of refusal not received, sir. Acha. Shares belong to private company, right? So within 60 days of within 60 days of submission of transfer deed with company. Public company, sir, within 90 days of submission of transfer deed, within 90 days of submission of transfer deed, submission of transfer deed with company. Very simple, ma. See, notice of refusal. What is the time limit for notice of refusal? 30 days, right? If you didn't receive notice of refusal to this 30 days, at this time limits, 30 plus 30, 60. 60 plus 30, 90. Very simple only. Very simple. You receive notice of refusal, right? From notice of refusal, within 30 days, file application with NCLT if your shares are belonging to private company. No, sir, shares of public company. Then within 60 days of notice of refusal, file a petition with NCLT. The notice of refusal not received, sir. Then when you submitted transfer deed with company, from that date onwards, in case of private company, 60 days. In case of public company, 90 days. Now NCLT will pass an order. Either it may dismiss the appeal. No, company is correct only, or valid grounds only. So no registration. Refusal is valid. Like that, dismiss the appeal. Or will order the company to register transfer. Along with that, compensate, reimburse, compensate, transferee. No, the expenses incurred for filing an appeal against you and everything. So whatever transfer incurred, whatever losses transfer incurred, yes, compensate transferee. Like that, NCLT will order company. Understood? So appeal to the tribunal. That's what I told you. 30 days. Within 30 days of date of receipt of refusal of notice, if you are a private company. For a public company, 60 days. So this is all about private company conditions, ma. Appeal to the tribunal. Now, if you look at the public company, 60 days of such refusal or 90 days of the delivery of the instrument of transfer. I told submission of transfer date. Okay, delivery of instrument of transfer or intimation of transfer, appeal to the tribunal. So now tribunal, it may direct, register the transfer, rectification of register, contravention of NCLT order, penalty, punishment. What is the punishment, sir? 1 year to 3 years and fine 1 lakh to 5 lakhs. Just 1 second, ma. One second. So next section is section 58. 57 we completed. 57 is all about refusal to register, transfer or transmission. The punishment is 1 year to 3 years and fine 1 lakh to 5 lakhs. Next one, rectification of register of members. This happens because of wrong inclusion of outsider as a member or exclusion of member details from register of members. Suppose I'm the member, but my name is wrongly removed from register. Next one, I'm not a member, but my name is recorded in register. Sir, happy? No. What happy? Tomorrow if company may call on shares, I'm liable to pay that call amount. Immediately I should I should remove my name from the register. So there is a mistake in the register, sir. Please rectify the register. Like that, you can file an application with company. If company rejects your application, go to tribunal. Now this time there is no time limit for filing an application with tribunal. Under section 58, there is a time limit, 30 days from notice of refusal or 60 days from notice of refusal. Next one, 60 days in case of submission of delivery of documents, 90 days from date of delivery of transfer deed with a public company. We saw the time limits. Those time limits are not applicable in case of rectification of register of members. Suppose, sir, I'm a foreigner, sir. I'm a resident of USA. I came to know that my name wrongly included in company register, sir. Now, can I come to, is there any obligation on me to come to India and to file application with NCLT? No. You can file application with competent court specified by central government, competent specified courts outside India, in case of foreign members. So simply rectification of register. Now, tribunal upon inquiry proceedings, upon verification, tribunal can dismiss the appeal or, it may direct the company to rectify the register within 10 days and also compensate, the applicant, compensate the petitioner, whatever losses or damages suffered, just compensate the petitioner, a party aggrieved. Understood, ma? So voting right. So during this time period, I'm the member, but my name was not included in the register. So during this process, during this time limit, if any general meeting is conducted, I'm entitled to voting unless my voting rights have been suspended by the order of tribunal. Understood? So suppose I'm the member and company is making delay to incorporate my details in the register of members. I filed a petition with NCLT. So that case is going on. Suddenly, a company conducted general meeting. Now I am entitled to voting rights in that general meeting. Generally, I'm entitled to voting rights. However, if my voting rights are suspended by the tribunal, then I'm not entitled to attend general meeting. I'm not entitled to vote at that general meeting. This is all about section 58. Section 58. Okay. Sir, this 30 days, 60 days, what is this time limit, sir? This is for section 58, refusal to transfer shares. Clear, ma? So with this, 2/3 of chapter 4 completed. And the balance portion, bonus issue, buyback, very, very important concepts. Majority of share capital and debentures chapter completed. I think within next half an hour, we are going to conclude. We are going to complete share capital and debentures. So next one is different ways of alteration of share capital. Sir, in how many ways we can alter share capital, sir? In how many ways we can alter share capital? No, in 5 ways, ma. Alteration to share capital. I'm talking about, this is related to capital clause of MOA. Capital clause of MOA. In incorporation chapter, I told you alteration of registered office clause, alteration of name clause, alteration of object clause. Share capital clause we didn't discuss. I told you we'll discuss it under section 61. So in 5 ways, we can alter share capital. One is increase authorized share capital. And the second one is diminution authorized share capital. Increase authorized share capital, diminution of authorized share capital. Right now, 10 crores, ma. I can increase it to 12 crores. I can reduce it to 8 crores. So unsubscribed shares, unissued shares, I can cancel. Diminution. This is different from capital reduction. Capital reduction I'll discuss with you under section 66. Don't worry. Next one, consolidate and divide. Next, split. Share split. Recently IRCTC, one share divided into 5 shares, ma. Originally face value 10 rupee. Now split happened. Now face value is 2 rupees only. Consolidate and divide means, suppose face value 10 rupees, ma. What we'll do, we'll consolidate all these shares and we'll divide into face value of 100 rupees, sir. We'll divide shares into face value of 100 rupees. Consolidation and divide. Last one, conversion of shares into stock. Conversion of shares to stock or reconversion of stock to shares. Once again, I'm repeating the point. Clearly told you in incorporation of company. In capital clause, you will find 3 components. One is authorized share capital. Next one, number of shares. And third one is face value. Any modification you make to any of these components, it comes under alteration to share capital. Suppose, face value you are increasing under consolidation, face value you are reducing under split. Alteration of capital clause. You are increasing authorized share capital, you are reducing authorized share capital. Alteration of share capital clause. Number of shares, when you increase authorized share capital, automatically number of shares will increase. When you reduce authorized share capital, automatically number of shares will fall. Alteration of share capital. Finally, consolidation of shares into stock and reconversion of stock into shares. However, 2 conditions you have to remember. Only fully paid up shares, ma. Only fully paid up shares can be converted into stock. I repeat, only fully paid up shares can be converted into stock. First point. Second point, direct issue of stock is prohibited. Direct issue prohibited. In one attempt under CA IPCC, this question was asked for 3 marks. Company is planning to issue stock directly without issuing shares. No, not permitted. Company can issue stock only upon surrender of original shares and that share should be fully paid up. Okay, so these are types of alteration of share capital. Then procedure for alteration of share capital. Sir, is there any procedure for alteration of share capital? Yes. Sir, what is the procedure, sir? First, check whether AOA permits whether AOA permits alteration of capital clause or not. AOA authorization must and should. Next, ordinary resolution is sufficient here. Next one, ROC filing. ROC filing. I forgot, after ordinary resolution, you need to alter MOA. Now you need to file it with ROC within 30 days of alteration, ordinary resolution. Understood? So this is all about section 61. Section 61 also completed. So increase authorized capital, consolidation and divide. Consolidation and divide. One tricky point is there, consolidation or division is resulting in change of voting powers of the shareholders. Then it shall be approved by the tribunal. So what is this? Sima, face value 10 rupee. Company decided to convert 100 shares into face value of 1000. In the original face value 10, revised face value 1000. Now you know, when you give 100 shares to company, they will give you 1 share in return. 100 shares of 10 each, 1 share of 1000 each, both are same, yes or no? I'm having 7000 shares, I'll get 70 shares. I'm having 700 shares, I'll get 7 shares. I'm having 70 shares only. Now how many shares I'll get? No. Sir, I'm having just 7 shares, sir. How many shares I'll get? No, you will get 0. Why? Because fractions, 70 divided by 100.7. 7 divided by 100.07. In that case, what we will do? We will try to acquire remaining shares in order to get 1 share. Or else we will surrender shares to the company directors. Company. In that case, public voting powers, voting power held by the public will come down. Promoters holding power will increase. Understood? See, if you are holding 7000 shares, you will get 70. If you are holding 700 shares, you will get 7. Suppose if you are holding 70 shares, how many shares you will get? Nothing. Company will ask you, acquire 30 shares so that we'll give 1 share. And you are not in a position to get 30 shares. Now you are surrendering 70 shares. As a result, what happened? Your voting power will become 0. Why? Because you are surrendering shares. You are surrendering shares to the company. Directors, suppose directors are taking those shares. Directors voting power, promoters voting power increasing. Now there is a change in voting power of promoters and public. So in this case, NCLT approval is must and should. After taking NCLT approval, you are permitted. You are permitted with respect to what? You are permitted to consolidate. Understood? Okay, next one. Conversion to stock, split, cancel of shares, diminution of share capital. Everything you have to intimate to ROC. Everything you have to give intimation to the ROC. Next one, section 62. Rights issue. Other name rights issue. Further issue of share capital. Why we are using word further issue? There is a reason. The reason is, at the time of incorporation, company will issue shares to whom? Subscribers. Company definitely within 2 months of incorporation, within 2 months after incorporation, company has to issue shares to the subscribers, and that issue we call it as initial issue, first issue. Subsequent to initial issue, all issues are classified as further issue only, further issue of share capital. Now first you need to give priority to the existing members. Preemptive rights. Existing members will get a right to subscribe additional shares whenever company offer shares. Why? Because they are owners of the company. They are not interested in losing ownership to someone else. And this is a non-dilutive pro rata way of raising the money. So first option you need to give to existing members. So rights issue offered to the existing members. So what are the conditions we need to satisfy, sir? You need to satisfy following conditions. First, you need to give letter of offer to the existing members, notice of offer or letter of offer. And you should give them a time limit. You should give at least 3 days. This notice shall be given at least 3 days before opening subscription. And that subscription period should not be less than 15 days and it should not exceed 30 days. See, subscription opening date, this point, for example, 1st April 2024. At least 3 days before, 27 March At least 3 days before opening subscription list, give letter of offer. And this though subscription period, it shall not be less than 15 days. Subscription closing date shall not be earlier than 15th April. It should not be later than 30th April. So subscription opening period minimum 15 days, maximum 30 days. And in case of private companies and IFSC public companies, this condition of 15 days can be reduced provided all the members, 90% of the members have given their consent in writing or electronic mode. So 3 days notice you can't reduce it. 3 days before opening of issue, this notice you can't reduce the time period. However, in case of private company, time period of 15 days, offer period, subscription period can be reduced with the consent of 90% of the members. And moreover, existing members, they had a right of renouncement. Of course, in private company, this right is not available. Private company, privacy is important, right? So, however, if AOE of a company prohibits renouncement, there is no renouncement option. Renouncement is nothing but giving right to some other person. In capital gains, you solve problems, right? Rights renouncement, capital gain 100% taxable. So, there is no cost at all. Capital gain equal to 100% of sale consideration. Next one, rights offer on expiry. Suppose, offer period completed, but still few people didn't file application for right shares. In that case, board of directors had discretionary powers to dispose them in such a manner which is not disadvantageous to the shareholders. Simply, there should be no loss at all, not disadvantages. Some students write advantages. No, this is not correct. We don't want losses. We don't want losses like that. We are not asking you profits, but we don't want any loss at all. We don't want losses means, do you think we need profits? 50% we need profits, 50% zero also sufficient, but no losses like that, not disadvantages to the shareholders and the company. Second option, offering ESOPs to the employees. First option, go to the members. No, lawmaker really talented person. Why? Because under section 62, further issue of shares, fish. First priority you should give to existing members. Why? Because these people are owners of the company. First ask them. How? By giving letter of offer at least 3 days before opening of offer period, and offer period should be minimum 15 days. Offer period should be minimum 15 days, maximum 30 days. These 15 days can, these 15 days can be reduced in case of private company, IFSC companies, provided 90% of the members should give consent. I told this point, right? Okay, if existing members are not having any money, or if existing members are not willing to subscribe right shares, then okay, company can go to employees under employee stock option plan. But for this, special resolution is compulsory. No, sir, we need more money, sir. In that case, chapter 3 will apply. Simply, others are outsiders. Others are outsiders. If you want to, if you are preferring private placement, section 42 shall apply. If you want to make public offer, then chapter 3 part 1, section 23 to section 41 provisions will apply. 41 is all about GDRs, right? 40 shall apply. So for this, first thing, you need to get special resolution from existing members. Next thing, valuation of share price. So report from registered valuer and such other terms and conditions as may be prescribed. But those terms and conditions are prescribed under chapter 3, prospectus and allotment of securities. So first priority. Second, to the employees. Why? Because they are internal to the organization. Third, you can go to others, outsiders. So employee stock option plan, to employees. Unlisted public company, special resolution. Listed company, SEBI regulations. Follow SEBI regulations. And private limited company, instead of special resolution, ordinary resolution is also sufficient. No need of special resolution. Ordinary resolution is sufficient, provided company is regular in filing annual returns with ROC. Company is regular in filing financial statements with ROC. And for specified IFSC public companies also, ordinary resolution is sufficient. Now other conditions, you need to get approval from members, right? Before offering shares, you need to get approval from members. For that, you will send notice calling for general meeting, right? Along with the notice, give explanatory statement also. So explanatory statement, make all adequate disclosures, why you are offering shares under employee stock option, how much consideration you are going to get, Hmm. and who are getting shares under employee stock option. So everything you discuss with members, under explanatory statement. Next one, freedom to determine exercise price. So what is the exercise price? You all know. So right now market value is 1000. Employee can become member at just 900 rupees only. Now this 900, company is having absolute freedom to fix this exercise price. 1 year time gap. So see, after giving these options to the employees, minimum 1 year time period should be given, between grant of options and vesting of the option. So employee, in order to exercise these options, he need to wait at least 1 year. Understood? In case of amalgamation demerger, the resulting company, the new company, has to offer shares under employee stock options to the employees. Lock-in period ma, company is having absolute freedom to fix lock-in period for employee stock options shares. Sweat equity 3 years. And until employee gets shares, no dividend will be paid on those shares. And these options are not transferable, not pledge hypothecation is also not possible. Once you exercise, once you get shares, then you can transfer those shares, then you can pledge those shares. Next one, employee is permitted to get shares under employee stock option plan. If employee got deceased, then legal heir can exercise those options and legal heirs can become member of the company. In case of permanent incapacity of the employee, then employee can exercise those options or employee can waive off those options. So all the options granted to him on the date of permanent incapacity shall vest in him on that day. So if he had money, he will pay them, he will pay money and he will exercise those options, or else options gets eliminated or wasted. A resignation. So the employees who got who leave the organization because of resignation, so automatically all these options get expired. These options get expired. Next one, employee definition under sweat equity, employee definition under ESOP, same permanent employee, whether working in India or outside India. Normal points only. Next one, sir, existing members rights issue completed, employees under ESOP completed. So suppose company is planning not to go to with existing members, not to go with employees, then they can go with other persons. But before going with other persons, first of all, company should get special resolution. Why? Because existing members ownership is getting diluted. Suppose company paid up share capital is 100 crores ma. It was held by some 10 people, 10 people holding 100 crores. Now these 10 people are having 100% control over the company, right? Now company is planning to raise another 100 crores money. Now this time company wants to offer these securities to public. Now if public subscribe these securities, they will become owners of the company. So total share capital of the company is 200 crores. Out of 200 crores, existing 10 people, their contribution will fall to 50%. And new people will get 50% ownership. So existing people ownership is getting diluted, yes or no? So existing people are at risk only, no? So that's what, existing members, you need to get approval from existing members first. Before you make allotment, you need to give offer to the existing members. If not, if they're not planning to subscribe, or the amount is very high, then obtain resolution from them, special resolution. After getting special resolution, go with how the outsiders. Again, here one more condition, that is obtain valuation report from a registered valuer. Compliance with applicable provisions of chapter 3. Chapter 3, I told you, prospectus and allotment of securities. If you are making private placement, section 42. If you want to make public offer, section 23 to section 40. These conditions you need to satisfy. Next one, non-applicability. Tricky point. Remember, this section shall not apply in case of increase of subscribed capital of a company caused by the exercise of an option where debentures or loans are converted into shares of the company. Oh my god, sir, section shall not apply in the following case means what, sir? Actually, what section 62 is telling, if you are offering shares to any person other than existing member, other than employees, first you need to get special resolution. Next, you need to get valuation report from registered valuer. These provisions are not applicable in case if you are offering shares to the debenture holders under conversion process. Preference shareholders under conversion process. Understood? So when you are converting debentures, debt capital into equity capital, no need of special resolution. That is the point. That is the meaning of this point. Sir, why, sir? Why? Because at the time of issue of convertible debentures, company is required to take special resolution as per section 70, I think 71 or 72. I'm not sure, 71 only. Debentures section. According to that section, if a company wants to attach convertibility option, then company can issue convertible debentures only after getting special resolution from members. Already at the time of issue, special resolution taken, no? So at the time of conversion, no need of special resolution. And next one, no need of special resolution in this in the following cases also. That is, company borrowed money from government. See. Company borrowed money from government. Company borrowed money from government, and the company is not in a position to pay money to the government. Now, government considering public interest. Oh my God, how many employees are working in this company and the products of this company? There are many customers. So considering public interest, considering financial condition of the company, considering terms and conditions of the loan, terms and conditions of the debentures, government shall pass an order asking company to convert these loans or debentures into equity share capital. Yes. So when you borrow money from government or when you issue debentures to the government and when you are not in a position to pay money, so government considering these factors, public interest, financial condition of the company, terms and conditions of the issue of debentures or terms and conditions of the loan, government will ask company to convert loans into the shares. If company converts, no problem. Suppose company is not interested, then company can go to NCLT. Sir, you don't want to follow government order, please eliminate this government order, please cancel the government order. So now ball is in the hands of NCLT. So NCLT will determine, okay, I'm canceling government order, or no, you have to follow government order. Accordingly, company has to take an action. Suppose if company is not preferring any appeal, then automatically the subscribed share capital, authorized share capital to this extent gets increased. Suppose authorized share capital, paid up share capital, both same 100 crores, 100 crores. Government loan some 60 crores is there. Now by way of government order, automatically this paid up share capital and authorized share capital gets increased to 160 cr. Automatic increase. So that's what deemed increase in authorized share capital. Getting my point? Next, so look at this chart once. Next one, write about issue of bonus shares. Important topic, very, very important topic. Now in 2 attempts, problematic question came. I'll discuss that problematic question with you in this marathon. Bonus shares are shares issued by a company to its current shareholders as fully paid shares at free of cost. So without collecting a single rupee from the existing members, company will offer shares. Such shares we call them as bonus shares. Important point: sources for issue of bonus shares: free reserves, securities premium, capital redemption reserve account. And revaluation reserve, you can't utilize. Revaluation reserve means, by revaluing the assets. Suppose, you purchased the asset at 10 crores. Today, the value of asset is 100 crores. Now, you revalued this asset to 200 crores. So, you are increasing asset balance, from 10 to 100. Corresponding credit, you can observe, corresponding balance in the liability side, you can see revaluation reserve 90 crores. Earlier, asset is 10 crores, right? Now, instead of 10 crores, you are recording 100 crores. The effect of revaluation, you'll put it on revaluation reserve side, liability side, revaluation reserve 90 crores. Now, you can't use this amount for issuing bonus shares. Next, procedural conditions for issue of bonus shares. First condition, AOA authorization. Articles authorization is required. Next, board of directors approval is required. So board shall recommend and board will call for a general meeting. In the general meeting, members has to approve by passing ordinary resolution. And bonus shares can be issued if company has not committed following defaults. One is deposits. Next one, debentures. With respect to deposits, principal component, interest component. With respect to debentures or bonds, interest component, principal component. Company should not commit these defaults. And company has not defaulted in respect of statutory dues of the employees, such as contribution to the provident fund, gratuity, and bonus. So these defaults company should not commit at the time of issue of bonus shares. Next one, partly paid up shares, if any, should be converted into fully paid up. So before you offer bonus shares, partly paid up shares should be converted into fully paid up. Simple, make calls on shares, convert them into fully paid up. And bonus shares shall not be issued in lieu of dividend. Suppose in a general meeting, company declared a dividend. Company declared dividend. On each share, we will pay 10% dividend. So within 30 days, dividend shall be paid in cash only. So on 30th day, company came forward and company is selling. Instead of dividends, we are giving you 1 share. For every 10 rupees, we will give 1 share. At free of cost. Permissible, not permissible. You can't issue bonus shares instead of paying dividends. Declared dividend shall always be paid in cash. Even dividend can't be paid in kind also. Dividend can't be paid in kind. Dividend shall always be paid in cash only. Next, so question got repeated. I'm sorry. This question got repeated twice. So ignore. Now I'll tell you that problem. I'll tell you that problem. Company A Limited is there. Paid up share capital 1 crore shares, 8 rupees each. Face value 10 rupee, paid up value is 8 rupee. So paid up share capital 8 crores. Okay. Next one, general reserves 50 lakhs. Next, profit and loss account surplus. Profit and loss account balance surplus in P&L 25 lakhs. Getting my point. Next, securities premium 25 lakhs. Capital reserves 25 lakhs. Next one, reserve capital. A certain portion of capital reserved and it will be called up only in the event of liquidation. Okay. Next one, revaluation reserve, another 25 lakhs. So these are under reserves and surplus. You can find general reserves 50 lakhs, profit and loss account surplus 25 lakhs, securities premium 25 lakhs, capital reserve 25 lakhs, revaluation reserve 25 lakhs. These amounts are there. Now company is planning to issue shares, bonus shares. So what are the conditions company should satisfy? AOA authorization, ordinary resolution. Okay, fine. Apart from this, these shares should be fully paid up. These shares must be converted into fully paid up. Now, company should make calls on shares. Calls on each share 2 rupees. The moment company receive 2 rupees, so this will be converted into 10 crore rupees. Now, company is planning to offer shares, in the ratio of 1:10, or company is planning to offer shares in the ratio of 1:5. Option A 1:10, option B 1:5. 1:10 means what? For every 10 shares, 1 share will be given as bonus share. 1:5 means what? For every 5 shares you held, will give 1 bonus share. Now, which option is permissible? You have to calculate. Today, paid up share capital of the company, fully paid up shares, all these shares are fully paid up. Fully paid up share capital is, paid up equity share capital is 10 crores. Now 10 crores into 1 divided by 10. For every 10 shares will give 1 share, right? For every 10 shares will give 1 share, right? So total number of shares is 1 crore shares, right? Yes or no? Total number of shares 1 crore shares. 1 crore shares, existing share capital 1 crore. 1 crore into 1 divided by 10 equal to 10 lakhs. And face value is 10 rupee. So 1 crore. So here I need sources up to 1 crore. I need sources for bonus issue is free reserves, securities premium, CRR. I forgot that point. I'll write here. CRR amount for the time being, it is 50 lakhs. 50 lakhs. Okay. Now, in case of 1:5 ratio, right now I'm having 1 crore shares into 1 divided by 5. So I need to offer 20 lakh shares. Each share face value is 10 rupee. So I need 2 crores rupees source. In option A, I need 1 crore rupees source. In option B, I need 2 crore rupees source. First of all, out of these reserves and surplus, which are eligible, you need to check. Which reserves are eligible, you need to check. General reserve eligible, profit and loss account eligible, free reserves only. These two comes under free reserves only. Security premium eligible, capital reserve not eligible, revaluation reserve not eligible. CRR eligible. So put together total how much? 50 lakhs plus 25 plus 25 plus 50. Put together 1.5 crore rupees we are having. So under option 1, we need just 1 crore only. We are having 1.5 crore. Okay, 1:10 permissible. 1:10 permissible. Now option B, we need 2 crore, sir. However, we are having only 1.5 crore, not permissible. Now this question came twice in examination. In previous examinations, this question was asked twice. 2 times this question came. Understood? Option A is permissible. Option B not permissible. Why? Because we are not having that much source. We are not having that much source. Understood? So with this bonus shares concept completed. Section 64 very simple ma. Whenever you alter share capital, whenever you redeem preference share capital, alteration of share capital, redemption of preference share capital. See, alteration of capital. Next one, redemption of preference shares. Next one, government order to convert loans, debentures into equity share capital. In these 3 cases, company has to file form number SH7 with ROC within 30 days. Within 30 days of the event, company has to file a separate notice with ROC, that is form number SH7. So in case of default, delay in filing, each day 500 rupees is the penalty, maximum 5 lakh rupees with respect to company. With respect to officer in default, minimum 500 rupees per day and maximum 1 lakh rupee. That means if 20 days delay happened, 20 days into 500, 10,000, no problem. 200 days delay happened, 200 days into 500, 1 lakh rupee, okay, applicable. Suppose 300 days delay happens, sir, 300 days into 500, 1,50,000. Officer in default is not liable for 1,50,000. Officer in default is liable for only 1 lakh rupees. Maximum penalty 1 lakh rupees given, no. So major 90% topics we completed. Sorry, 80% topics completed. We are left with only 3 concepts: reduction of share capital, buyback, debentures. Reduction of capital, buyback, debentures. This section 66, actually unimportant section. Many students thought this is an unimportant and they ignore this section. But one attempt, after introduction of companies at 2013, right from May 2014 onwards, sorry, November 2014 onwards till May 2023, almost 20 attempts ICA conducted examination. 20 almost. Out of 20 attempts, this question came only once. Remaining, bonus, buyback, equity shares with differential rights. You can't expect a paper without bonus or buyback concepts. Definitely bonus share or buyback question will come. But in one attempt, this question came. Somewhat tricky question, many students can't understand this section 66, reduction of capital. Many students will take choice with respect to this question, with respect to this concept. First of all, we'll discuss reduction of capital. A reduction of capital will happen in 3 ways, ma. Reduction of capital will happen in 3 ways. One is cancellation of unwanted capital. Oh my God, what is this word, sir? We didn't heard this. Unwanted capital. What is this? See, face value 10 rupees is there. Paid up value is 8 rupees. And we don't want this 2 rupees, sir. There is unpaid value of 2 rupees. We don't want this money, sir. We never need this money. Company is doing business profitably. Company is running in profits only. We will never call this money. Acha. So we want to cancel this money, sir. We want to reduce face value to 8. Acha. So after reduction of this face value, what will happen? Initially member liability is 10 minus 8, 2 rupees. But because of reducing this 10 to 8, there is extinguishment of member liability. Member liability will become 0. Suppose if you reduce it to 9, 9 minus 8, 1. Liability 2 is getting reduced to 1. Either extinguishment of liability, 0, or reduction of liability from 2 to 1. This is what case 1. Case 2. Return of excess capital. A return of excess capital. Here, face value 10 rupee, paid up value also 10 rupee. But we don't want 2 rupees, sir. We want to return it. And we don't want buyback, sir. Under buyback, we will take shares. No. We don't want to reduce shares, sir. We will keep number of shares constant and will reduce this paid up value by returning excess amount to the members. Members take this 2 rupees. So now paid up value will fall to 8 rupees. If you reduce face value also 8 rupees, now again extinguishment of member liability. Actually 10 minus 8 to 2 rupees, right? We are returning 2 rupees to the member. So future you can call 2 rupees, but you are reducing face value to 8 and paid up value is also 8. Extinguishment of members liability. That's what return of excess capital. And last one, cancellation of lost capital. Don't use these words in examination. For understanding sake, I'm using these words. Cancellation of lost capital. Under internal reconstruction, you did a problem. You solved problems under internal reconstruction. Suppose, paid up share capital is 10 crores. Face value 10, paid up value also 10. Next one, outside liabilities 10 crores. Fixed assets 5 crores. Current assets 10 crores. Current assets 10 crores. Profit and loss account debit balance 2 crores. Just wait. Fixed assets 7 crores. 8 crores. 8 crores. Now if you look at balance sheet tally, 20 crores, 20 crores. 20 crores, 20 crores. Balance sheet tallied or not? Yes. Now if you look at this balance sheet, one portion of asset is the P&L debit balance. That is accumulated losses. Can you sell this asset? No, sir. You can't sell this asset for 10 rupees also. And this much portion of capital I lost. Actually, if you reduce it, if you keep it on liability side, you need to reduce this 2 crores from capital. In sole proprietorship type of organization or partnership type of organization, we solved problems, right? We solved problems. Whenever loss comes, we'll reduce it from capital. Whenever profit comes, we'll add back to the profit. We'll add back it to the capital. Yes or no? So now, out of 10 crores, 2 crores worth asset is missing. 2 crores worth capital is missing. So now what I'll do? I'll cancel this much capital, sir. I'll do one thing. Face value 10 rupees. Paid up value, I'll reduce from 10 to 8, sir. I'll reduce it by 2 rupees. So it will come to 8. Now, revised balance sheet looks like this. Revised balance sheet, paid up share capital 8 crores. Outside liabilities 10 crores. Fixed assets 8 crores. Current assets 10 crores. So now also balance sheet tallied. But there is a difference between these two balance sheets. This balance sheet is telling that company is loss making company. This balance sheet, it is not telling like that. Yes or no? So now what I'm doing under case 3, I'm cancelling the lost capital. So in these 3 ways, reduction of capital will happen. One is cancellation of uncalled capital. And I don't want it, sir. I don't want it. Cancellation of uncalled capital. Second one is return of excess capital. And third one is cancellation of lost capital. In these 3 ways, reduction of capital will happen. Thema, not paid up, simply not called. Next, cancel any paid up share capital which is lost or unrepresented by available assets. Next one, pay off paid up share capital in excess of wants of the company. Are you all getting my point? So in these 3 ways, reduction of capital will take place. And the conditions for reduction of capital is, first you need to get approval from members. What kind of approval? Special resolution. Special resolution. Next, NCLT approval is must. So you need to file application with NCLT. Along with application, you need to give special resolution copy and you need to give creditors details. Creditors list. Why? Because reduction of capital should not affect creditors interest. Actually, it will affect creditors interest. How? When you are giving money to the existing members, what about creditors? Do you have sufficient funds to repay money to the creditors? Yes, sir. Acha. NCLT will come, NCLT will verify, and NCLT will give approval. Along with this creditor list, you need to give auditor certificate. Auditor certificate regarding accounting treatment. Regarding accounting treatment. Auditor certificate regarding accounting treatment. Understood? So examples you just give one time reading, you will understand. So prohibition on reduction of capital. Reduction of capital is prohibited in case deposits and interest on deposits. If there is any default with respect to deposits and interest on deposits, reduction of capital will not take place. Next one. Once company give intimation to the NCLT, immediately NCLT will forward this application to central government, ROC, if you are a listed company, SEBI, and creditors. And it will ask the people, come on, if you have any objections, file your objections within 3 months. If no objection is received within 3 months from the date of receipt of notice, then deemed approval from these agencies. Deemed approval from these agencies. Accordingly, NCLT shall give order to the company. Okay, you can proceed with reduction of capital. But before giving order, NCLT will observe whether creditors' interest is getting affected or not. Every creditor claim discharged. Have you paid? No, sir. What are the dues? At least, did you provide any security to them? Or these loans are secured or unsecured? Secured only, sir. Finally, whether you obtain consent from them? Yes, sir, we obtain consent from them, sir. This is the consent of the creditors, sir. Then it will order for confirming reduction of capital. And also, tribunal will verify the auditor certificate regarding accounting treatment, whether section 133 has been complied or not regarding accounting treatment for reduction of capital. Next one. Once NCLT issues order, this order shall be published in newspapers and this order should be filed with ROC also. And ROC shall register the copy of NCLT order and ROC shall issue certificate to the company. So now registration certificate, from that date onwards, reduction will come into picture. Reduction will conditions with respect to reduction, 100% satisfaction is happened. Seema, the moment ROC issues a certificate regarding registration of or tribunal order, that's it. It will act as a conclusive evidence. And at that point of time, what is the amount of share capital, number of shares in which share capital is divided into, and face value of each share, and paid up value of each share. All these will come into effective from the date of registration by ROC. Next one, what is the new liability of the member, sir? What is the new liability of the member? Upon reduction, what would be the liability of the member? That liability will prevail. Suppose 10 rupees is the face value, 8 rupees is the paid up value. Originally, member is liable for 2 rupees. Tribunal approved, you can reduce it to 8 rupees. Now 8 minus 8, 0. So what is the member's liability? Zero liability. What is the liability? Zero liability. So no liability arises to the member in future. Next one, up to here, no problem. This is a procedure. What is the detailed procedure? What is the procedure, ma? Can you tell me the detailed procedure? Special resolution, application with NCLT for getting NCLT approval. Along with application, you need to give creditors details. So NCLT shall forward the application to 4 people: central government, ROC, SEBI, and creditors. If there is no objection from these people within 3 months from the date of delivery of notice, NCLT, after verifying accounting treatment, verifying the accounting treatment with respect to which auditor will give certificate, right? So after verifying the certificate issued by the auditor and after going through the consent of creditors, going through the consent of the creditors, simply whether creditors consent is obtained or not, whether they have been properly discharged or not, whether they are properly secured or not. So after going through this process, tribunal will give order with respect to reduction of capital. Now company has to publish NCLT order in newspapers, and company has to register the same with ROC within 30 days of NCLT order. So from the date of registration of NCLT order, the new capital structure comes into the picture. Number of shares, face value, paid up value, everything comes into the picture. And member is not liable for any increased liabilities. Sorry, member's liability is restricted after reduction. Next one, suppose if creditor is entitled to object and failed, what it means? Total we are having 1,000 creditors, but in list we give only 100 creditors. 900 creditors names we made concealment. Next one, all these are unsecured debts, but we projected them as secured debts. Next, total liability is 100 crores, but we ignored 10 and we told only 10 crores. How NCLT comes to know, ma? NCLT is not doing business on behalf of company. How NCLT comes to know the list of creditors? How NCLT know the names, details of the creditors? It's the company. It is the company giving information to NCLT. Now that information is not complete. That information is incorrect. That information is incomplete. Out of 100 creditors, out of 1,000 creditors, company gave only 100 creditors list only. All these are unsecured debts, but company projected them as secured debts. Total loan amount is 100 crores, but company projected it as 10 crores only. The NCLT can go through the document submitted by company. NCLT will not have, that much sense, who will be the creditors of the company. Come on. NCLT will not have that powers. So NCLT gave order. Later, people came forward. Sir, my name is not there in the list, sir. Looking at the newspaper advertisement, looking at NCLT order, I came forward. My name is not there in the list. So my dues are pending, sir. Now what NCLT will do? It will remove the order which it issued previously. That means members' original liability will continue. Members' original liability before reduction, what would be the liability? That liability will continue. And coming to the officers, whoever commits this kind of frauds, they will be punished under section 447. Understood? Everyone. So in case of fraud, officers will get punishment under section 447, and members, the persons who are members at the time of reduction of share capital, those people will get original liability. That means the liability before reduction of capital. The liability before reduction of capital. What is the liability? That liability will prevail. Clear? Everyone. And we are left with only 2 topics under share capital. Debentures, deposits, separate topic. Debt capital, right? So under share capital, we are having only 2 topics. One is section 67. The other one is buyback. So section 67, company is restricted to purchase its own shares. Comment, correct. Exception, buyback. Exception, redemption of preference shares. No, company collected money through issue of shares. That money belongs to company. So company can't pay that money for getting its shares back. It's a fundamental rule. No company is permitted to purchase its own shares. Unless it is a case of buyback. Buyback, separate provisions will apply. Section 67 will not apply. However, we had 3 exceptions. This section is not applicable to private company, which satisfies 3 conditions. The 3 conditions are, if you look at members of private company, no member shall be a body corporate. No member of a private company shall be a body corporate. And private company total borrowings shall not exceed simply less than 2 times of paid up share capital or 50 crores, whichever is less. And company has not defaulted in repayment of such borrowings. If these conditions are satisfied, then for private company, section 67 is not applicable. Private company can purchase its own shares. Are you getting my point? What are those 3 conditions? Members of private company, there should be no body corporate, and total borrowings shall not exceed twice of its paid up share capital or rupees 50 crores, whichever is less, and there should be no default in repayment of such borrowings. Understood, everyone? And for Nidhi company, section 67 shall not apply. Why? Because in Nidhi company, member will go by transferring shares. In Nidhi company, when shares are purchased by the company from a member on ceasing to be a depositor or borrower, and should not be considered as reduction of share capital under 66 as well as 67. Are you getting my point, students? Everyone? Okay, fine. I hope each and every point is clear. Next one. Sir, direct purchase prohibited. Indirect purchase is also prohibited. Sir, indirect purchase means what? Financing someone. I'm financing my servant. Come, take company shares. I'll give you money. Direct finance, indirect finance, both are prohibited. Indirect finance means what? Servant, come to me. Go to SBI. I already gave guarantee to SBI. SBI will give you money. With that money, come and acquire company shares. So direct financial assistance, indirect financial assistance, both are prohibited. However, we had 3 exceptions, very simple exceptions. One is lending business. Suppose SBI is there, banking company. The main business operation of banking company is lending money. So daily, many people will come, many people will borrow money from SBI. And with the borrowed money, the people will do anything. Maybe, borrowers may purchase SBI shares. It is not possible for SBI to monitor each and every borrower. What is this fellow is doing? What is that fellow is doing? It is not possible, right? So if that lending happened at ordinary course of business, that's it. Borrower can purchase banking company shares. There is no problem allowed. Next one, lending money in a scheme. Suppose, company made an offer to the employees. Yes, you can also become members of the company. You can purchase shares. Employees said, we are not having that much finance. Acha, fine. Okay, we'll give you loan amount. So loan amount, it shall not exceed 6 months salary. Second condition, with this money, you should subscribe only fully paid up shares, not partly paid up. Only fully paid up shares you should subscribe. Third condition, employee excludes directors. And next one, special resolution compulsory. Special resolution, there is no doubt at all. When you are offering shares to the people other than members, special resolution is compulsory. So employee should not be a director. Second one, maximum 6 months salary. And third condition, only fully paid up shares he need to subscribe. If any condition violated, then section 67 shall apply. Exceptions will not apply. I'm sorry, I told third point here. See, employment not exceeding 6 months salary to purchase other than its director's KMP. This point I told this point. So yes, loan can be offered to the employees other than directors and KMP. Maximum salary, 6 months, maximum loan amount 6 months salary. And third condition, he should purchase fully paid up shares. He should subscribe fully paid up shares. This is all about the third exception. Second exception, here we are not offering shares to the employees directly. Here we are forming a trust, and we will appoint a trustee to manage this trust. Now company will finance this trust in order to purchase company shares, and this trust should be beneficial for employees. This trust should be for the benefit of employees. Next one, before lending money under this scheme, special resolution is compulsory. So 3 conditions to be satisfied. One is special resolution. Second one, trust should be for the benefit of Trust for the benefit of, trust should be for the benefit of employees. And third one, special resolution, I told you, right? And third one, with that money, they should subscribe or they should purchase only fully paid up shares. Understood? Lending business, exempted. Lending money in a scheme approved by members by way of special resolution, and trust for the benefit of employees, and then with the money advanced to the trust, that money should be utilized for subscribing fully paid up shares only. Next, third exception is employee loans. How much loan you can offer? Max 6 months loan. To whom you can offer? To the employees other than directors and KMP. And next one, with the borrowed money, he should subscribe fully paid up shares. We had practical questions with respect to these areas, ma. Suppose employee salary is 30,000, but company gave him 2 lakh rupee to subscribe shares. 30,000 into 6 months, 1.8 lakh. How company can give 2 lakhs? Violation. In case of violation, penalty. What is the penalty? 1 lakh rupee to 25 lakh rupee. Officer in default, imprisonment for a term which may extend up to 3 years, and penalty minimum 1 lakh, fine minimum 1 lakh, maximum 25 lakhs. Clear? Everyone. The last topic of share capital is buyback of shares. Very simple concept. Very simple concept. I'll give notes for this buyback. Listen carefully. Buyback. Section 68 to 70. So let's discuss section 68. First and foremost thing, you have to check AOA authorization. Next, approvals, approvals. Sometimes you need to get board resolution, sometimes you need to get special resolution. If it is within 10% of paid up share capital, paid up equity share capital and free reserves, I'll tell you, just wait. So 10% of paid up equity share capital plus free reserves. Here free reserves includes securities premium. If it is within this limit, board resolution is sufficient. Sir, more than 10%, sir. In that case, you can't cross 25%. 25% of paid up equity share capital plus free reserves plus securities premium. So 25%. 25% of paid up share capital plus free reserves plus securities premium, with the help of special resolution, you can make buyback. But at a time, limit, there is a limit. At a time, in a year, at a time, one time, the buyback shall not exceed, buyback shall not exceed simply less than or equal to 25% of paid up equity share capital. 25% of paid up equity share capital. Limits somewhat tricky. So in one case, if you observe, in one case, this paid up equity share capital. Maximum limit paid up share capital. One time buyback in terms of shares, 25% of paid up equity share capital. Here I am not adding free reserves. Here I am not adding securities premium. Try to understand. So AOA authorization. Next, approval. If it is within 10% limits, board approval is sufficient. Beyond this, special resolution. But it shall not exceed, in a year, shall not exceed 25% of paid up share capital plus free reserves plus securities premium. Sir, what is the difference between these two limits, sir? This is count on shares. And this is with respect to amount, finance amount. Understood? For better clarity, better download TCS buyback notice, you will get to know. Amount finance involved in the buyback, if it is within less than or equal to 10% of paid up equity share capital plus free reserves plus securities premium, board resolution is sufficient. Amount exceeding this limit, special resolution. At a time, you can make buyback of 25% of paid up equity share capital. This is all about limits, ma. Next one. Next one. Oh, problem with one more. Just wait. So next one, debt equity ratio. Post buyback. Post buyback, debt means both secured debt plus unsecured debt. Equity means you all know capital plus reserves and surplus. So post buyback, the ratio shall not exceed 2:1. Ratio shall not exceed 2:1. So debt equity ratio condition, ma. Next conditions. Next conditions. Time gap. Next condition, time gap between two buybacks should be 1 year. 1 year. One time a question came on this particular point. 1 year between two buybacks means what, sir? What is the exact time limit? Closure of earlier buyback. Closure of earlier buyback. Previous buyback, when it get completed, from that date onwards, wait for 1 year. After 1 year, you can start new buyback. Sir, actually, I'm permitted to buy back 25% of capital, sir. But previously, I bought only 5%. I will make 20% buyback right now, sir. Last month, I bought only 5%, sir. This month, I'll make 20% buyback offer, sir. No. Once buyback completed, you're prohibited from making buyback, a fresh buyback up to 1 year. Closure of buyback onwards, you need to count 1 year. You can make fresh buyback only after completion of 1 year from the closure of earlier buyback. Understood? Next one, listed companies, you need to follow SEBI guidelines. For listed companies, SEBI guidelines is compulsory. Next one, it's all about the declarations. Declaration to be prepared by directors, board of directors. At least two directors should sign this declaration. One among these two directors should be managing director. So this declaration is all about solvency declaration. That means after buyback, for the next 1 year, company will not wind up. Even if liquidation proceedings are initiated, company assets are in a position to meet liabilities. Simply, we are solvent. For the next 1 year, will be solvent only. Why 1 year? I told you in previous chapter also. 1 year assumption is under going concern. We are making 1 year assumption is because of going concern. So next 1 year, company will not liquidate. Even if it get into liquidation, company assets will be in a position to meet its liabilities. Understood? Everyone getting my point? Okay. So next one. So with this, buyback initiated. Next one, once buyback is completed, the shares which you bought back shall be cancelled, shall be extinguished. Buyback shall be, the securities which you bought back shall be cancelled. What is the time period, sir? Within 7 days, the bought back securities shall be cancelled. And that shares shall not be offered to anyone up to a period of 6 months. The shares involved in the buyback shall not be issued for a period of 6 months. However, in the following cases, you can offer those shares. One is, bonus shares. Next one, equity shares. You can offer. Next 3, you can observe easily. Conversion of warrants into shares. Next one, conversion of preference shares, conversion of debentures into equity shares. Here you can issue bought back securities. But the point, other than these exceptions, other than these cases, you can't offer bought back securities up to period of 6 months. And one important point I ignored. That important point is sources for making buyback. Sources for making buyback. Sources, one is free reserves, profits available for dividends, profits available for distribution in the form of dividends, securities premium account, and proceeds of fresh issue. Sir, which issue? Issue of any security other than bought back security, other than security involved in buyback. Suppose you want to buy back differential rights. Now you can issue normal rights shares. To finance buyback, you can issue normal rights shares. You can't issue differential rights in order to buy back differential rights. So shares involved in the buyback, shares involved in the issue should be of same kind or different kind? Different kind. So sources of funds, conditions of buyback, I told you AOA, special resolution, limits, post buyback conditions. No, only fully paid up shares. Buyback is permissible only for fully paid up shares. SEBI guidelines in case of listed company. Lock-in period, there is no such concept. But the point is, once buyback is completed, for the next 1 year, you are not eligible to make a fresh buyback. Clear? And procedure before buyback, you need to give explanatory statement to the members. For getting special resolution, you need to give notice calling for general meeting along with that explanatory statement. In that, you have to give disclosure of all material facts, reason of buyback, class of shares you involved in the buyback, and how much amount you are investing in buyback, and what is the time limit for completion of buyback. You have to disclose all these details. Next one. So from the date of special resolution or board resolution, buyback should be completed within 12 months. Suppose if 12 months completed, sir, but buyback still not initiated, then the special resolution or board resolution automatically gets lapsed. Once again, you need to take approval from members. Once again, you need to take approval from directors in respect to cases. Buyback from whom? You can make buyback from existing shareholders or from open market, in stock market, stock exchanges, or you can get securities from employees. Previously, you offered shares to the employees under ESOP or sweat equity. You can get those shares under buyback. So declaration of solvency, I already told you. Extinguishment of securities. Within 7 days of completion of buyback, you need to cancel the physical securities. And those securities, those class of capital, that class of capital, you shall not offer to anyone for a period up to 6 months. And we had 6 exceptions. Bonus shares 1, sweat equity shares 2, employee stock options shares 3. Okay, next conversion of warrants, conversion of debentures, conversion of preference shares. Here another 3. So in 6 cases, you can offer same class of shares which you bought back recently. And you need to maintain a separate register regarding buyback. Next, filing of these documents with ROC. And if you are a listed company, then you need to file document with SEBI also. Penalty for default. If you commit any default, penalty is very simple: 1 lakh to 3 lakhs. 1 lakh to 3 lakhs. Company 1 lakh to 3 lakhs. Officer in default 1 lakh to 3 lakhs. Minimum 1 lakh, maximum 3 lakhs. And if you select profits for a buyback source, profits, then nominal value of shares which you bought back, that amount you need to transfer to CRR. And CRR shall be used only in case of issuing fully paid up bonus shares. Sir, can I declare dividend out of CRR? No. You can utilize CRR only for one purpose, that is, the purpose is issuing fully paid up bonus shares. And in some cases, buyback is prohibited. In one attempt, I remember this question came for 5 marks. This question came for 5 marks. So list out the cases where buyback is prohibited. Buyback is prohibited when company makes a default. When company makes default in repayment of deposits, in payment of interest thereon, in redemption of debentures, in repayment of preference shares, payment of dividend, repayment of term loan, interest on term loan payments. However, if you rectify these defaults and after completion of 3 years, you are allowed to make buyback. So 3 years after completion of rectification of these defaults. What are those defaults? Deposits, interest, only debentures, no interest. Preference shares, dividends, term loan, interest on term loan. If you commit any default in payment of these amounts, then first you need to rectify them. After rectification, wait for 3 years. After 3 years, you are permitted. Permitted with for what, sir? Permitted for buyback. And at the time of buyback, you have to comply all these sections, That means there should be no subsisting default with respect to 92 annual reports, 123 dividends provisions, 127 punishment for failure to distribute dividends, 129 filing financial statements, preparation of financial statements. So company should comply all these provisions before it go with buyback. So this is section 70. That is section 70. Is it clear, everyone? With this, we completed provisions related to share capital. And it's time to start debt capital. Under debt capital, we'll discuss debentures and deposits. And the final part of chapter 4 is debentures. Section 71 covers provisions related to issue and redemption of debentures. Before we discuss section 71, let's discuss definition of debenture. So what is the debenture, sir? Debenture definition. Debenture includes debenture stock, bonds, any other instrument of a company evidencing a debt, whether constituting a charge on the assets of the company or not. So here we are not defining the word debenture. In fact, we are giving a list of instruments covered under debenture. So these instruments we can call them as debenture. Accordingly, section 71 provisions shall apply. Understood? So debenture covers not only debenture but also debenture stock, bonds, and any other instrument. You keep whatever name. But if it is an evidence, a debt to the company, if it is evidencing a debt to the company, then it becomes a debenture. And it is immaterial whether secured or unsecured. Constituting a charge on the assets means secured debentures. Understood? That means section 71 covers both secured debentures as well as unsecured debentures. Next one. The following instruments are not treated as debentures. In that first point, instruments referred to in chapter 3D of Reserve Bank of India Act 1934. So whatever instruments got notified in chapter 3D of Reserve Bank of India Act 1934, we can't call them as debentures even though they are evidencing a debt to the company. Understood? So they are outside the scope of section 71. Next one, such other instrument as may be prescribed by central government in consultation with Reserve Bank of India. So this point is giving power to central government. Power with respect to what? Yes, in future, central government can exclude any instrument from the scope of debenture. So central government will decide after consulting Reserve Bank of India. Next one, manner of issue and redemption of debentures. So section 71 is all about issue of debentures as well as redemption of debentures. Let's see the conditions with respect to issue of debentures. Section 71, issue of debentures. And second one, regarding redemption of debentures. Redemption of debentures. The first one, sir, can a company issue convertible debentures or only non-convertible debentures? Both. If company want to issue convertible debentures, it can issue convertible debentures. Sir, what is convertible debentures, sir? At the time of redemption, instead of paying cash, we will give them equity shares. We'll take debentures and we'll give them equity shares. So convertible debentures. If company decides to issue convertible debentures, then special resolution from members is required at the time of issue of convertible debentures. So company can issue convertible debentures. For that, special resolution. It has to take approval from the members, and that approval should be special resolution. Next one, with respect to non-convertible debentures. Non-convertible debentures. Generally, board resolution is sufficient when if existing debt, listen carefully existing debt plus proposed debt, that means new debt, existing debt as well as proposed debt put together, if they not exceed 100% of paid up share capital plus free reserves plus securities premium, then board resolution is sufficient. That means both old debt as well as proposed debt put together, if they are less than or equal to 100% of existing paid up share capital plus free reserves plus securities premium, then board resolution is sufficient. No sir, we are crossing the limit, sir. We are crossing the limit. Then one time special resolution is required with respect to non-convertible debentures. Next condition, sir, can a company issue irredeemable debentures? No, only redeemable debentures company has to issue. And what should be the tenure, sir? Maximum tenure 10 years. Maximum tenure 10 years for all companies. Whereas companies engaged in infrastructure projects, infrastructure debt finance companies, infrastructure finance companies, if they want to issue debentures, then they can issue debentures up to the tenure of 30 years. Logic is very simple. Infrastructure companies, they will have a long gestation period to complete the project. Suppose if you look into metro in Telangana state, almost 10 years completed. Still work is going on. Now, if you apply the same condition of 10 years, just I'm asking you, if you apply 10 years condition, come on, 10 years back, you got money by issue of debentures, right? Now redeem them. Sir, just now work completed, sir, and we are collecting revenue, we are collecting ticket fares, so we are getting revenue from now onwards. How can we redeem 100% as on today? Understood. So infrastructure projects, generally they will have a long gestation period. Gestation period means, the date of investment and the date of generation of revenue. The gap between date of investment and the date of generation of revenue is long for infrastructure projects. That's the reason for infrastructure companies, infrastructure debt fund financing companies, for them, the tenure of debentures is 30 years. Understood. Next one, in definition, I told you charge compulsory or not compulsory. Actually, not compulsory. You can issue unsecured debentures, but to attract more and more subscribers, definitely will provide security. In that case, you need to create charge on those assets, and this assets value, assets value shall not exceed. Sorry, assets value which you provide as a security to the debenture holders, this assets value should cover not only principal portion but also interest portion. Principal as well as interest, both components, yes, assets should cover. Understood. Next condition, before making a public offer or before making offer to the existing members, you have to appoint a debenture trustee. So debenture trustee is required when, sir, when you are making offer to members to subscribe debentures, and those members exceeding 500 in number, and next one, when you are making public offer of debentures, yes, debenture trustee is important. Appointment of debenture trustee is required. Without appointment of debenture trustee, you can't offer debentures to the public or to the members exceeding 500. Next one, you have to execute a trust deed, debenture trust deed within 60 days. Within 60 days, within 60 days of making receiving application money and allotment, you have to execute a trust deed. Next, you have to create debentures redemption reserve. This debentures redemption reserve shall be created out of profits available for distribution and payment of dividends. Understood. So conversion option we discussed, convertible debt, special resolution is essential. Next one, no voting rights. One more important condition, a company is prohibited to issue any debentures carrying any voting rights. As you all know, debenture holder is a creditor to the company. He is not an owner of the company, he is a creditor, outsider. So you can't give voting rights to them. If you issue any debenture with voting rights, then that issue is treated as void. Next, secured debentures. Secured debentures may be issued by a company subject to such terms and conditions as may be prescribed under rules. Next, 10 years. Maximum tenure, how much more? 10 years. However, for infrastructure companies, infrastructure projects, infrastructure finance companies, infrastructure debt fund, non-banking financial companies. Next one, companies which are permitted by Ministry or Department of Central Government or by Reserve Bank of India or by National Housing Bank can issue debentures for a period exceeding 10 years, but it shall not exceed 30 years, maximum 30 years. Next one, creation of charge. You offered secured debentures, you offered secured debentures, then you have to create charge on the properties or assets of the company or its subsidiary company, holding company, associate company. So if you want to create charge, this charge can be created on any of these four companies: our company, associate company, subsidiary company, holding company. And such assets and properties shall be of value which is sufficient for due repayment of the amount of debentures and interest thereon. I told you, not only principal amount but also interest amount it should cover. Next, security. The security for debentures by way of charge or mortgage shall be created in favor of debenture trustee. Generally, security will register in favor of money lender. Money lender. Here, who comes under money lender? Debenture holders. Debenture holders. If debenture holders count is 1, 2, 3, 4, 5, 6 up to 10, no problem. We can register security in favor of these people. But if you observe generally, these debenture holders, they are 100 in number, sometimes thousands in number, lakhs in number, and it is not possible to create charge in favor of all these people. That's what we'll appoint trustee, and in favor of trustee, we will register that security. Next one, appointment of trustee. As I told you, the company shall appoint a trustee before issue of prospectus. When you are making public offer, prospectus is compulsory, and letter of offer for subscription of its securities. Further, not later than 60 days after allotment of debentures, company has to execute a debenture trust deed. I told you, within 60 days of allotment, company has to execute debenture trust deed in order to protect the interest of debenture holders. And moreover, my dear students, debenture holders are prohibited from voting at general meeting. Yes or no? Why? They are not owners of the company. And moreover, if you look at them, they are investing money in the company. Same like owners, they are also making investment in the company. Owners, they are permitted to general meeting. Debenture holders are not permitted to general meeting. Now, debenture holders' interest is there in company, and they want to know what is happening to that interest. So that's what, on behalf of debenture holders, one person will be there. We call him as debenture trustee. Clear? Next one, limits on borrowings from the debentures. Convertible debentures, special resolution. Non-convertible debentures, borrowings by issuing debentures together with amount already borrowed exceed company's paid up share capital, free reserves and securities premium amount. 100% of paid up share capital, free reserves and securities premium. In that case, even if issue non-convertible debentures, special resolution is compulsory. Next one, only board resolution. In other words, if borrowings do not exceed as above, board resolution is sufficient. Next one, temporary loans obtained from company bankers in the ordinary course of business are not to be included in the borrowings. Short-term loans like overdraft facilities, cash credit facilities, if any company obtained from the bankers, don't consider them while counting, while checking the limit. I told you, right? Existing debt plus new debt put together shall not exceed these limits. So while calculating existing debt, don't consider temporary loans, short-term loans. Next one, debenture trustee. When required, when you make public offer, and second case, when you are offering, say, debentures to existing members exceeding 500. So don't read this condition as a whole. Debenture trustee is applicable in case of public offer, offering to the members exceeding 500. In these two cases, trustee is compulsory. And before you issue prospectus, the prospectus shall contain the details of trustee, or letter of offer shall contain the details of trustee. That's what, content letter. Disqualifications of debenture trustee. See, you can't appoint any person as a debenture trustee. In order to appoint someone as a debenture trustee, he should not be disqualified. Sir, what are the disqualifications, sir? He cannot hold shares beneficially in the company. Not, registered shareholder. I'm not talking about registered shareholder. I'm talking about beneficial shareholder. Suppose, my father is holding shares in one company on behalf of me. On those shares, all benefits, I'm entitled to all the benefits of the shares held by my father. Now I'm having beneficial interest. A company can't appoint me as a debenture trustee, even though I'm not having shares in my name. Why? Because I'm having beneficial interest in the company. Next one, promoter, director, key managerial person, any officer of 4 companies. Cash, I call it as cash. Company, associate company, subsidiary company, holding company. So who are them? Promoters. Shortcut, promoters, directors, KMP, officer. And you shall not fall under another heading. You shall not be relative of these above people. Shall not be relative of a promoter or any person who is in employment of the company as director or KMP. Next, and you should not be beneficially entitled to monies which are to be paid by the company. Simply, debenture holder is disqualified, creditor is also disqualified. You should not have any interest in the company, either as a creditor or as a debtor too. Suppose, if you look at 4th point, debtor is also disqualified. Why? Because it is all about independence. If you appoint these people as a debenture trustee, they won't make decisions in favor of debenture holders. They will make decisions in favor of themselves. Understood? So only independent person should be appointed as debenture trustee. So creditor disqualified, debenture holder disqualified, debtor disqualified. With coming to the debtor, any of these 4 entities, if he is a debtor to these 4 entities, any of these 4 entities, then he is disqualified to act as a debenture trustee in our company. has furnished any guarantee in respect of principal debt secured by the debentures or interest thereon. You all know guarantee concept, right? Contract of guarantee. So in contract of guarantee, you'll find three parties: principal debtor, creditor, surety. Principal debtor will borrow a loan, and surety will give guarantee. No, guarantee means in case if principal debtor makes default, I am personally liable to you and I'll pay money to you. That's what contract of guarantee means. Yes or no? Now imagine a company is there. Company borrowed money from debenture holders by issuing debentures. So now debenture holder stands in the position of creditor, and the company will stands in the position of principal debtor. To the same debentures, to the same loan amount, Mr. Yes is giving guarantee. Guarantee means what? Tomorrow, if company makes any default with respect to payment of payment of interest or repayment of principal, I'll pay you. I'm personally liable to you. So that's what yes is giving guarantee. And unfortunately, yes is also appointed as debenture trustee. Imagine debenture trustee. Now in company, company is making some policies which are against to debenture holders. If these policies are implemented, debenture holders' interest will be affected. So they're changing the assets of the company. Whatever surplus they're having, they're distributing entire surplus in the form of a dividends. So definitely company will face cash crunch tomorrow, and company may not pay interest or company may not redeem debentures. So that scenario is happening in the company. Now, as a debenture trustee, immediately he should go and he should communicate with the debenture holders. My dear debenture holders, your interest is getting affected. Company is making all wrong things. So definitely tomorrow company will file winding up proceedings. You will get nothing. Come on, take action immediately. Like that, trustee has to communicate that matter with debenture holders. Are you getting my point? Suppose if the same person is a surety also, in our example, surety is a trustee. Surety is a trustee. Now, surety went to debenture holders and told company tomorrow or day after tomorrow, they will close the business. Entire surplus, they are distributing in the form of dividends. Come on, go and take action. Initially, what debenture holders will do? They will ask the company, come on, pay us claims. Company made default. The moment the principal debtor makes default, creditor will cash whom? Surety. And who is surety? Trustee. So if trustee makes communication with debenture holders, go and collect money from company, and if company fails to pay the money, then debenture holders will ask whom? Debenture holders will claim money from whom? Surety only. Are you getting my point, students? Are you all getting my points? So just tell me, who will dig their own, ground, ma? Just I'm asking you. Suppose surety as a trustee, if he make communication with debenture holders, if company makes default, then who will be held liable to debenture holders? Surety. Surety only. That's what, in this situation, surety will not disclose any information with respect to company with debenture holders. He will keep silence. Why? Because if he reveal any information and if company makes default, obviously he will be held liable. Understood? So he won't make any independent decisions. His decisions will be subordinate to the company. That's what, surety is also disqualified. Guarantor is also disqualified from acting as a debenture trustee. Has any pecuniary relationship, financial relationship with the company amounting to 2% or more of its gross turnover or total income. So here the amount you have to decide, just having financial relationship is not a sufficient ground for attaching a disqualification. Suppose if you observe, me regularly I use, Jio SIM cards, regularly I'll pay Jio recharges. I'll do Jio recharges regularly. So I'm having, Jio setup box, Jio fiber net, and Jio SIM card. So every month I'm paying almost 1,000 rupees to Mukesh Ambani sir. So there is a financial relationship between me and Reliance Jio. Now, am I disqualified to act as a debenture trustee? No, sir. Why? It is not considering all financial relationships between company and the outsiders. It is talking about a significant material relationship. Sir, material relationship means how much? 2% or more of its gross turnover or total income. Suppose Jio is earning, for example, Jio is earning 2 crores rupees revenue. In that 2 crores, 40 lakh rupees I am contributing. Imagine, suppose 40 lakhs I am contributing. Now there is a pecuniary relationship between me and Reliance Jio Infocom Limited. Accordingly, I am disqualified to act as a trustee. So here you have to apply the limit. The limit is 2% or more of its gross turnover or total income, or rupees 50 lakhs or such higher amount as may be prescribed, whichever is lower. Right now, till today, central government didn't prescribe any higher amount. So just ignore this point. 50 lakhs is the ceiling limit. 2% of its turnover or total income or 50 lakhs, whichever is lower, you have to consider. And this relationship you have to check, last 2 preceding financial years. So right now we are in we are in the financial year of 2023-24. Last 2 years means what? 2022-23, 2021-22. And apart from these 2 years, and during the current financial year means 2023-24. So you have to check 3 years whether there is any pecuniary relationship between proposed candidate and company. If there is a pecuniary relationship, disqualified. No pecuniary relationship, not disqualified. Next one is a relative of any promoter or any person who is in employment of the company as director or KMP. Already told you. So remember these disqualifications. Same disqualifications are also applicable to depositor trustee. Deposit trustee. So next topic, deposits. No, in that we'll see the point. Same points apply in deposits also. Next one, filing of casual vacancy in the office or trustee. Now we appointed Mr. T as a debenture trustee. And after 6 months, there arises a vacancy. That vacancy is of 2 types. One is, casual vacancy. A reason, deceased, he died, or disqualified. Some of the above disqualifications got attracted. So this we call it as, casual vacancy, other than resignation. So any reason other than resignation, board is having authority to fill the casual vacancy. Understood? Board is having a power to appoint any person as a trustee in order to fill casual vacancy. But if it is a case of resignation, why this person is making resignation? Maybe he have observed some deficiencies in a company. He have observed some wrongful activities in a company. So tomorrow he may be liable if he can't report them to the debenture holders. Chance is there. So in that case, any person, yes, company can appoint as a debenture trustee. However, it should be ratified by simply, that vacancy, appointment of a person to fill that vacancy, it should be approved by the majority of debenture holders. Majority, more than half. In writing, they have to give consent for appointment of any person as a debenture trustee in order to fill vacancy arising due to resignation. Removal of trustee. Yes, debenture trustee can be removed by debenture holders. Suppose total debenture capital is 50 crores. Now, holders, people holding not less than 3/4 in value. So 3 by 4 into 50 crores. How much it is? 37.5 crores. So holders holding not less than 37.5 crores rupees, 37.5 crores rupees debentures can remove debenture trustee from the position. What is the role of debenture trustee, sir? He has to take all steps to protect the interests of the debenture holders. Initially, I told you, debenture holders are not owners of the company. They can't make any decisions. They can't participate in any decisions. However, their interest is there in the company. They also invested money in the company. So they want to know what is happening in the company. Understood? So debenture trustee will take care of all these things. Shall take all the steps to protect the interests of the debenture holders. Next meeting of the debenture holders. In order to protect the interests of debenture holders, yes, debenture trustee is having a power to call for a meeting. Accordingly, the meeting of all debenture holders shall be convened by debenture trustee on requisition in writing signed by debenture. So if any debenture holder holding not less than 1/10 of value, 1/10 in value of the debentures for the time being outstanding. So I told you 100 crores is right now debenture capital. Now person or persons holding not less than, so simply 10% of this 100 crores. So persons holding not less than 10 crores, they can file a requisition with trustee. Requisition with respect to what? Come on, call for a meeting. We have to take some important decisions. Or the happening of any event which constitutes a breach, default, or which in opinion of debenture trustee affects the interest of debenture holders. Suppose last 2 to 3 years company is not regular in paying interest on debentures. Understood. So immediately debenture trustee will get a power. Yes, call for a meeting and take any decision with respect to debenture holders, protection of their interest. Next one, liability of debenture trustee. So liability means what? If he fails to fulfill his obligations, then he will be held responsible to compensate the loss, suffered by the debenture holders, like that. So any terms in debenture trust deed are void. Terms in debenture trust avoid when if those terms are exempting the liability for breach of trust, even without exercising a degree of care and due diligence required from him as a trustee. Suppose company at the time of executing a trust deed, it mentioned a point: tomorrow if anything went wrong, and the trustee as a responsible person, he should communicate with debenture holders. However, there is no obligation on trustee to communicate with debenture holders with respect to deficiencies in the company. Even if debenture trustee fails to communicate with the debenture holders regarding deficiencies in the company, he is not at all liable. Like that, any clause you find in trust deed, those clauses shall become void. Understood? However, the liability of trustee can be exempted by passing a resolution by not less than 3/4 in total value of the debentures of such class. So tomorrow, suppose this debenture trustee is not regular in doing the works, is not taking steps in order to protect the interests of the debenture holders. So definitely he will be held liable, responsible to the debenture holders. However, 3/4 of the total value of debentures holders, if they give approval, okay, no problem, exempt debenture holder from the punishment, then he will not get any punishment. Next, to pay interest on redemption. So on what terms and conditions you received money through issue of debentures, fulfill all those terms and conditions. Next, petition before the tribunal by trustee. Suppose if a company is not in a position, or company financial resources are not sufficient, so tomorrow if due date comes, company can't redeem debentures. If trustee observed any situation like that, trustee is having a power to file an application with the tribunal, and trustee can demand a tribunal, trustee can request a tribunal, and tribunal will ask a company, don't incur any additional liabilities from here onwards. After clearing all dues to the debenture holders, you can incur new liabilities. Up to that point of time, don't incur any new liabilities, don't borrow funds. Failure to redeem or to pay interest. Ninth point, if you observe, today is not due date. Due date, after 1 year or 2 years. But when you analyze financial statements, you came to know that company will not be in a position to pay debts to the existing debenture holders. In that case, trustee can go to the tribunal, trustee can file a petition with the tribunal. Coming to the D point, it's a present tense. Today is the due date, but company is not in a position to pay interest, or company is not in a position to repay principal. Maturity date also came, but still company is not making any payments. In that case, either trustee or debenture holders, can file an application with the tribunal. Now, tribunal, upon verification of state of affairs of the company, it will pass such other order as it thinks fit. Next one, procedure to be prescribed by the central government. The manner for securing the issue of debentures, format of debenture trust deed, procedure for the debenture holders to inspect a trust deed, inspection of trust deed. So quantum of debenture redemption reserve. So how much debenture redemption reserve I have to maintain every year, and all other matters as may be prescribed. These points, these things, who is having power to fix? Central government is having a power to fix. The following things. Next one, coming to the debenture redemption reserve. Simple chart. All India financial institutions, they are not required to maintain debenture redemption reserve. Sir, how we create this reserve? Every year company will do business, yes or no? So in the profit and loss account, definitely there will be profits. Company will have some profits. In these profits, a certain portion you have to divert to debenture redemption reserve, and balance portion you can use it. For payment of dividends, for issue of shares, for balance profits. Yes, balance profits you can use for payment of dividends, or for issue of bonus shares. For issue of bonus shares also we saw free reserves, right? We also solved one problem. The remaining profits, it's your discretionary powers. But coming to the debenture redemption reserve, this reserve shall be used only for one purpose. That one purpose is redemption of debentures. And what is the quantum of debenture redemption reserve I have to maintain every year? Every year you have to maintain 10% of outstanding debentures maturing next year. So whatever debentures are getting matured, in the coming year, on that amount, apply 10%. That amount you have to maintain a reserve. So future is uncertain. So today you are having money and you invested money in a real estate sector. You had a hope that by month end you will get the funds. 2 months completed, you are not getting funds. Now debenture holders came to the company, sir, come on, pay our dues. Then how can you pay those dues? So some amount you have to maintain. You have to maintain a secrecy reserve. So how much, sir? With respect to all India financial institutions, zero. Private placement also zero. Financial institutions covered under Companies Act. Now limits will be specified by RBI. Now coming to the listed company, not applicable. Debenture redemption reserve not applicable. Coming to the unlisted companies, for NBFC not applicable. For others, 10% of the debentures, both under public issue as well as private placement. Next one, investment requirement. Whatever funds you kept as a reserve, that amount you have to invest in an asset which is having high liquidity character. How much? Minimum 15%. Actually, there is a mistake, ma. See, 10% I am making a reserve, and how government expect me to maintain 15% amounts in liquid assets? Government is asking me to keep aside a 10% of debentures maturing in the coming year, and it is asking me to maintain 15% liquid assets in order to meet this obligation. It should be either 15-15 or it should be either 10-10. So 10 keeping reserve and 15 you have to investment, means senseless provision. Next one, those amounts you have to maintain in the form of deposits with scheduled banks, securities in the central government of any state government, security bonds mentioned in section 20 clause A2 clause F of Indian Trust Act 1882. So like that we had a list. In these assets you can purchase any asset, ma. Above investments can't be charged for security, any loan, etc. Also, it should be only used for redemption of debentures. So, debenture redemption reserve shall be utilized for only one purpose. The one purpose is redemption of debentures. So, with this debentures topic, we completed. So, we discussed, issue related conditions and we discussed redemption related conditions. And our next topic is deposits. Are you ready? Very small chapter, ma. Very small and very simple chapter. Very simple chapter. Examination point of view, you can expect 6 marks from this topic. 6 marks you can expect from this topic. Acceptance of deposits, only 4 sections we have to discuss. Definition of the deposit. So the term deposit includes any receipt of money by way of deposit or loan or in any other form by a company, whether it is a private or public, but does not include such categories of amount as may be prescribed in consultation with Reserve Bank of India. So definition of deposit is also similar to definition of debenture. Debenture includes debenture stock, bonds, any other instrument of a company evidencing a debt. Yes or no? So here deposit means receipt of money, any receipt of money by way of deposit or loan or in any other form. See here, any other form means, don't think like this. Suppose, sir, we sold goods to one debtor for 1 month credit, sir. After 1 month, he paid money. Now, this is also receipt of money, no, sir. Can we call that receipt of money as a deposit? No, 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 no. Here, in any other form, is talking about loan. That means if you are receiving a money in the form of debt, loan, deposit, we call it as deposit. Broader definition. It covers all money receipts by way of deposit or loans or in any other form. However, it excludes some categories. Sir, what are those categories, sir? Let us discuss those categories. Very important, ma. Very, very important. Total we are having some 15 plus points, I think. So total we are having 18 points, ma. Out of these 18 points, 1 point can be asked for 2 to 3 marks. Any point can be asked for 2 to 3 marks, ma. So very, very important. Repeat, very, very important. Listen carefully. So we are talking about exclusions from deposits. Exclusions from deposits, certain categories are not categorized as deposits, or not considered as deposits, even though they looks like a loan, debt, a receipt of money. In that first one is amount received from government or guaranteed by government. So if you are receiving amounts from government sources, first point is all about government sources. Government sources cover, central government, state government, local authority, statutory authority. So if you receive loan or debt from government departments, governments, central government, state government, local authority, statutory authority, even though it looks like a loan, it is not a deposit. Sorry, even though it looks like a deposit, it is not deposit. That means chapter 5, acceptance of deposit rules will not apply. Next one, funds received from foreign sources. Second point is foreign sources. This money we have to return. After completion of purpose, we have to return this money. Understood? But these are not considered as deposits. In that first one, government source funds. Second one, foreign source funds. Foreign governments, international banks, multilateral financial institutions like World Bank, foreign governments owned developed financial institutions, export credit agencies, foreign collaborators, foreign bodies, corporate and foreign citizens, foreign authorities, or person resident outside India. Person resident outside India. So if you receive any money from these people in the form of loan or in the form of deposit, it is not treated as deposit. Very simple. Next one, loan facilities. Loans from any banking company, Axis, ICICI, State Bank of India, notified banking institution, corresponding new bank, and any cooperative banks. So all these, again, loans from public financial institutions like LIC, Life Insurance Corporation. So if you borrow any money from these institutions, they are not considered as deposits. Next one, commercial papers. Commercial papers, in order to finance short-term needs, commercial papers we can issue. We can issue commercial papers in order to finance short-term needs. So any amount received against issue of commercial papers or any other instruments issued in accordance with guidelines or notification issued by Reserve Bank of India, it is also not treated as a deposit. Now the doubt is whether debenture is a deposit or not. Whether debenture is a deposit or not. That point is also there under exclusions. Understood? We'll discuss. And students, you forgot to ask me one point. That is, sir, what is the difference between deposit and debenture, sir? Both are debt only, no? Yes, both are debt. But coming to the debentures shares, when you are making a public offer, you have to satisfy conditions specified under chapter 3, prospectus and allotment of securities. You have to get minimum subscription. You have to receive minimum application money. If you fail to achieve these two conditions, if you fail to fulfill these two conditions, minimum subscription and minimum application money, then you can't make allotment of securities. You have to return money to the applicants. But coming to the deposits, such conditions are not applicable. Such conditions are not at all applicable. And you'll just issue, a notice to the members or issue an advertisement to the public. So we are ready to accept deposits. Interested candidates can come to the company and fill deposit form, deposit your money. Sir, what is the benefit to the company, sir? See, whenever company need funds, first one they will go with existing members. Sir, I need funds only for short-term purposes, sir. Say for suppose, I need funds for only 1 year, sir. Or some 2 years, maximum 3 years, sir. Within 3 years, I'll definitely return the money. Acha, in that case, issuing equity shares, again making buyback, issuing debentures, and again redemption of debentures. For 3 years requirement, why unnecessary these things? Understood? Everyone. And moreover, sir, you can go to bank and you can borrow money from banks. No, sir. I agree. But the point is, banks will give me loans up to certain limit. Beyond that limit, banks will never show interest. And moreover, banker will charge, 11% interest on the loans I borrow from bank. At the same time, bankers will give only some 6% interest to the deposit holders. If you deposit money in SBI, for a long period, SBI will pay you just a 6% return. And same SBI, if they lend money to my company, they will charge 11%. Are you getting my point? So the difference 5% is a margin to the State Bank of India. Now what my company is doing, what my company is planning to do. So my company, instead of going to banks, my company is planning to accept deposits from public. So I'll issue an advertisement to the public. I'll give an advertisement to the public. Interested people will come to me and they will make deposit in my company. And I'll promise them, so I'll pay you 8% interest. Now from deposit holders point of view, if you see, so they are getting 8%. From banks, they will get only 6%. From my company, they are getting 8%. And from my entity point of view, it is sufficient to pay just 8%. No need to pay 11% to the banks. Yes or no? Are you getting? So both the parties are getting benefited. In this manner, you can differentiate, deposit from, bank loans and debentures. Are you all getting my point? So we completed definition of the deposit, and we are discussing the exclusions from the definition of deposits. So we completed 5 points. One is government sources, foreign sources, loan from banks, loan from financial institutions, commercial papers. Next one, intercompany loans. Intercompany loans. My holding company is giving loan to me, or I am giving loan to my subsidiary company, or I am giving loan to my holding company. Just telling you. So one company financing another company, it is also not covered under deposit. So any amount received by a company from other company, not a deposit. Share application money. Chance of getting practical question is very, very high. Very high. Under section 42, we had one point, whenever you receive application money, within 60 days of receipt of application money, make allotment of securities. Or else within 15 days after expiry of 60 days, refund that application money. Either make allotment within 60 days of receipt of money, or refund within 15 days after expiry of 60 days from the date of receipt of application money. Do either of these things. Sir, I didn't make allotment, I didn't make refund, sir. Then from the next date onwards, that share application money is no more called as application money. It will become a deposit. See, if the securities for which application money was received can't be allotted within 60 days from the date of receipt of application money, such application money or advance is not refunded to the subscribers within 15 days from the date of completion of 60 days. Such amount shall be treated as deposit under these rules. And accordingly, you have to pay interest. Refund, you have to refund. Suppose, company made an adjustment with respect to that money. One example, listen carefully. Suppose, company sold some goods to Mr. X. Goods worth 20 lakhs. Value of the goods is 20 lakhs. Next week, X came to company. X deposited some 50 lakh rupees as an application money. Company, you are making, you made private placement of securities, right? My name is also included in that list. So against that, I'm paying you 50 lakh rupees. So please allot securities in my name. And company didn't make any allotment. Now what company has to do? Company is required to refund application money within 15 days from the date of completion of 60 days. From the date of completion of 60 days, company has to refund application money to the subscribers within 15 days. Now what company did, Mr. X, we are not making any allotment. Last week you bought goods from us, worth 20 lakhs, right? So from this 50 lakhs, we will deduct to 20 lakhs and we will refund you 30 lakhs. Like that, company refunded 30 lakhs to Mr. X. 30 lakhs to Mr. X. Now, sir, is it a valid refund? First of all, is it a valid refund? The answer is no. With respect to 30 lakhs refund, okay. But with respect to 20 lakhs, I will not consider it as a refund and I'll consider this 20 lakhs as a deposit. Now onwards, acceptance of deposit rules will apply with respect to 20 lakhs. If I'm talking about refund, you have to refund that money. Adjustments not permitted. Repeat, adjustments not permitted. If you adjust against any other transaction, we won't consider them as a refund and we will treat the same amount as a deposit. Accordingly, you have to pay interest. Interest at the rate of 12% per annum. Next one, loan from directors. So here companies are classified into two types, private companies, private companies and public companies. Private company can get loan from directors as well as directors' relatives. Private company can get funds from directors as well as directors' relatives. Now coming to public company, it can borrow money only from directors. Now loan from director relatives in case of private company are not treated as deposit, provided one condition they have to fulfill. The condition is they have to submit a declaration. Declaration is with respect to, amount is not being given out of funds acquired by him by borrowings or accepting loans or deposits from others, and the company shall disclose the details of money so accepted in the board report. So I'm a director to my company. My company need funds. I'm contributing some funds to the company in the capacity of director. Along with the loan, I should furnish a declaration stating that this money is out of my savings, out of my pocket. This is my own saving amount. This is not from the borrowed sources. Like that, director or director relative has to furnish a declaration, and the same details shall be updated in the board report. Next one, bonds and debentures. Bonds and debentures. Another tricky point, ma. Another tricky point. Secured debentures, secured bonds, not a deposit. Not a deposit. But that security you have to provide only on tangible assets. Intangible assets are excluded. Intangible assets are excluded. So secured debentures, secured bonds, not a deposit. Next one, convertible debentures, sir. Convertible debentures. Compulsorily we'll convert them into equity shares within 10 years, sir. Then also it is not a deposit. Convertible debentures also not a deposit. Secured debentures, not a deposit. Convertible debentures, not a deposit. Next one, non-convertible securities. However, if they are listed on a recognized stock exchange, then also not a deposit. Then also not a deposit. Non-convertible securities which are listed on a recognized stock exchanges, then also not a deposit. So simply unsecured, non-convertible, unlisted debentures comes under, unsecured, non-convertible, unlisted debentures comes under the definition of deposit. Convertible debentures, conversion within 10 years, not a deposit. Secured debentures, not a deposit. Non-convertible securities, but they are listed on a recognized stock exchanges, sir, then also not a deposit. And secured debentures, you have to consider one point, that is value of security should cover principal as well as interest of the debenture, first thing. Second thing, if you provide security on intangible assets, such intangible assets shall be excluded. So you have to consider only tangible assets. Now tangible assets value, debentures value, just compare. Sir, equal, matching, sir, no problem. If it covers interest as well as principal amount, no problem. It is not a deposit, it is a debenture. Remember that point. Next one, security deposit from employees. Security deposit from employees is also not treated as deposit, provided two conditions company has to satisfy. One is maximum 12 months maximum 12 months salary company can accept a security deposit. And second condition, the deposit should be non-interest bearing deposits. Non-interest bearing deposits. These two conditions company should satisfy. Then only it is not treated as deposit. So what are those two conditions? Maximum 12 months salary. Second one, non-interest bearing deposit. Suppose my salary is 30,000 rupees. In a company, my salary is 30,000. Now company can take security deposit from me up to 3.6 lakh. Up to 3.6 lakh. Suppose if I'm making a deposit of 4 lakhs, if I'm depositing, if I'm making a security deposit of 4 lakhs, then it will be considered as a deposit. And second one, I made only 3 lakh security deposit and company is paying interest on it, sir. Then it will be treated as deposit. Accordingly, acceptance of deposits rule shall apply. Next, from trust, any non-interest bearing amount received or held in trust. Suppose company A Limited is there. Company A Limited is there. It has been appointed as a trustee for the benefits of one party or one group. Accordingly, it received some funds, some funds from any party, government or donors, anything. So A Limited received certain funds, some funds for the welfare of one group. Now this receipt of money, definitely company has to spend on that group for the welfare of the group. So as long as it spend that money, it looks like a loan, it looks like a deposit to the A Limited. However, acceptance of deposit rules shall not apply, provided company should not pay any interest on such amounts. Company should not pay any interest on such amounts. Next one, advances received for commercial transactions. Business advances, business advances. Suppose if you look into, Lalita Jewelry's gold schemes, every month you'll pay some amount, chit amount, right? So you'll pay some 5,000 rupees. So after payment of 12 months, you'll be given an ornament without making charges, etc., etc. Yes or no? So now Lalita Jewelers, it's a private limited company. Now Lalita Jewelers company is receiving money from its customers. Money from its customers. Now the point is that receipt of money comes under the definition of deposit? Answer is no, provided that advance shall be adjusted within 365 days from the date of acceptance of such advance. So within 365 days, yes, Lalita Jewelries Private Limited has to allot or simply has to sell a gold ornament to that customer. However, in case of any advance which is subject matter of any legal proceedings before any court of law, the said limit 365 days shall not apply. Under Negotiable Instruments Act also we discussed this point. Suppose have been given a check, my company received a check from another company and the check was dishonored due to insufficiency of funds. Immediately I filed complaint on that company under section 138 of Negotiable Instruments Act. Okay, so legal proceedings are going on. Meanwhile, court ordered Mr. Drawer, come on, pay him 20%. Deposit 20% amount with this company. If you won the case, if you won the case, payee will return money to you. If you lose the case, you need to pay balance amount. What is the point, man? See, I provided some services. My company, V Limited, provided some services to B Limited. B Limited issued check to me and the check was dishonored due to insufficiency of funds. Immediately, I'm payee. So I filed case in a court. Legal proceedings are happening. Legal, discussions are going on. Meanwhile, court ordered B, come on, deposit some 20% of the instrument amount, 20% of check amount with V Limited. So if you win the case, B Limited, if you win the case, V Limited will return that money along with interest. If you lose the case, you have to pay balance amount to V Limited. That is the, case happening between me and B Limited. Now, accordingly, I received some amount from B Limited. Now, in this case, the condition of 365 days shall not apply, ma. So you can keep that money, for 2 years, 3 years, 4 years until court gives a decision. You can keep that money. It is not at all a deposit. Next one, advance for immovable property. Under capital gains, you solved many problems with respect to sale of immovable property, transfer of immovable property, right? So if you receive any advance and finally, that proposed buyer is unable to pay remaining amount and you forfeited that advance amount, then that advance amount shall be reduced from cost of acquisition. Accordingly, you will calculate capital gains in subsequent sales. Remember that point. Okay, so any advance for immovable property, it is also not treated as deposit. Next, security deposit for goods or services. A security deposit for performance of a contract or for supply of the goods or provision of services, this is also not treated as deposit. And next one, advances for long-term projects. Next, advances for AMC contracts. Example, when you purchase a car or vehicle, two-wheeler vehicle or any item, so they will ask you, sir, we'll provide you extended warranty facilities if you deposit 1,000 rupees or 5,000 rupees or 10,000 rupees. General warranty 1 year, sir, but we provide you 5 years warranty. For 5 years, you need to pay some 1,000 rupees. Now you'll pay 1,000 rupees to the company. So this 1,000 rupees is revenue to them for a period of 5 years. After completion of 5 years only, they can book complete revenue. Each and every year they will apportion some portion. They will transfer some portion to the revenue. But balance amounts, even though they look like a loan or even though they look like a deposit, it is not treated as deposits. So advance for long-term projects, advance for AMC contracts. Next one, sectorial permitted advances. Sectorial permitted advances. So under prospectus and allotment of securities, we had a topic. So company, if it want to convert securities into demat form of securities, some companies, mandatory obligation on them to convert physical securities into demat form of securities. For that, company has to deposit 2 years fees with NSDL CDSL, National Security Depositories Limited, CDSL, Central Depository Services Limited. NSDL CDSL will provide demat form of security services. For that services, companies are required to deposit 2 years fees as an advance. This rule was imposed by SEBI. This rule, SEBI imposed this rule. According to this rule, if NSDL or CDSL is receiving advances from companies, then such advances are not treated as deposits. Next one, advances for subscriptions. Advance for subscription, today Amazon, Netflix, Geo. Some people, they will go with monthly subscription. Some people may go with 1 year subscription or 2 years or 5 year subscription. Now, advances against these subscriptions are also not treated as deposits. Next one, loan from the promoter. Loan from the promoter. Sir, loan from the promoter is also not treated as deposit, provided 3 conditions company has to satisfy. One is, this loan company is taking because of condition imposed by the lending institutions. And this loan is provided by the promoters to the company or promoter themselves or by their relatives or by both. And third one, it should be unsecured loan. Loan from promoter should be unsecured. And such exemption shall be available till the loans of financial institutions or bank are repaid and not thereafter. Suppose, company went to SBI. Sir, we want to start a new project. For that, total 200 crores we need, sir. SBI agreed to finance 200 crores to company on a condition that promoters of the company should contribute at least 50 crores. We will finance you, but at least 50 crores promoter has to contribute in the form of unsecured loan. In the form of unsecured loan, promoter should contribute. If promoters contribute 50 crores, we will contribute 200 crores to the company. Like that, they imposed a condition. Now, accordingly, promoters, they are giving a loan to the company amount 50 crores. So this loan should be, unsecured, first one, and next one, as long as this amount 200 crores returned to the SBI, simply company repay the entire amount to the SBI. Till that time, this 50 crores is not at all treated as deposit. Once this 200 crores become zero, from that point onwards, this 50 crores from the promoter will comes under the definition of deposit. Next one, Nidhi company. You all know Nidhi company. The main objective of Nidhi company is to cultivate habit of savings. So Nidhi company, any amount received from the members by the Nidhi company, if this chapter provisions will not apply. This chapter provisions will not apply for the deposits accepted by Nidhi company. Next one, chit fund companies. Amounts received by chit fund companies, even though they look like deposits, they will not come under deposits definition. Next, collective investment schemes, mutual funds. Mutual funds will receive amounts from its clients, and that amount they will invest in various securities, a basket of securities. So their main objective, a risk reduction. They will try to avoid risk. They will not invest money in a single entity, single company. So they will select some 10 to 15 companies, and they will subscribe securities of those companies using funds contributed by the clients of mutual fund companies. Now, any amount received by mutual fund companies under, collective investment schemes, it is also not treated as deposits. Next one, startup companies. We had startup companies. Startup companies, more than 25 lakhs. Under a single transaction, if a startup company received 25 lakhs or more in the form of debt only, and which will be repaid by issuing a convertible securities. So today you deposit 30 lakhs with me. We will execute a loan agreement with you. So after expiry of certain period, we will convert that loan into the equity shares. If this is the situation, then amount received by the startup companies are also not treated as deposits. And last one, amounts received by company from alternate investment funds, domestic venture capital funds, infrastructure investment trusts, real estate investment trust, and mutual funds registered with SEBI in accordance with regulations made by it. So those amounts are also not treated as deposits. Clear? Now out of 18, 3-4 points, they are asking repetitively. What are those points, sir? Share application money, promoter contribution to the company, debentures point. Very frequently these points are getting tested in the examination. No need to by heart all these 18 points, ma. Just understand the crux of the concept. That's it. Why? Because in examination they won't ask you what are the amounts excluded from the definition of the deposit. They won't ask you like that. They will give you a situation and they will ask whether it is covered under the deposit or not. Clear? Next one, meaning of depositor. Very simple, you can see. So in this entire chapter, two sections are very important: section 73 and section 76. Section 73 and section 76. 73, acceptance of deposits from members. Company accepting deposits from members. 76, acceptance of deposits from public. One is from members, the other section is from public. So not all companies can accept deposit from public, ma. Only eligible company can accept deposits from public. Only eligible company can accept deposits from public. So normal companies, other than eligible company, they can accept or renew deposits only from members. And next point, this chapter 5, acceptance of deposits, they are not applicable to some amounts which we discussed under question number 2. 18 amounts this chapter will not apply. And next one, few companies this chapter will not apply. So non-applicability of this chapter, one branch 18 points, 18 amounts, another branch companies. So this chapter will not apply to any banking company, will not apply to non-banking financial companies, will not apply to housing finance companies, will not apply to national housing banks, and will not apply to any other company as central government may specify after consultation with Reserve Bank of India. Clear, ma? Remember these 2 points. Next one, provisions relating to acceptance of deposits from members. Sir, what are the conditions we need to fulfill for accepting deposits from members? First condition, ordinary resolution. OR is sufficient. First, you need to take approval from the members. Next, you need to issue a letter called circular. You need to issue circular to the members. So, yes, company is accepting deposits. So, right now, what is the position, financial position of the company? Simply balance sheet. And what is the credit rating? Investing funds in my entity, is it risky or safe, will be decided under credit rating certificate. Next, till today, how many depositors we are having and how much amount we are due to them, and such other particulars as may be prescribed. So these matter, these particulars I need to furnish in a circular. And mode of sending this circular, sir, in which mode you need to send this circular to the members, sir? Any mode, ma. Either registered post with acknowledgement due, or by speed post, or by electronic mode, but it should be in form number DPT1. Publish in newspaper. Publish in newspaper. Generally, eligible companies can make publication in newspaper. Understood? So private companies, other than eligible companies, publication in newspaper is prohibited. The circular may be published in English language in an English newspaper and in vernacular language in a vernacular newspaper, having wide circulation in the state in which register office of the company is situated. The next one, CA certificate regarding non-defaulter. Important point. Any company which makes default with respect to interest on deposits as well as deposit is prohibited from accepting deposits for the next 5 years after rectification. After rectification, there is a prohibition period on you. There is a ban period on you. That ban period is 5 years. So until you complete 5 years from the year of rectification of the default, you are not permitted to accept deposits from members. Sir, no default, sir. Since incorporation, we never committed any default, sir. Acha, fine. Obtain the same on a certificate from statutory auditor of the company. Statutory auditor has to certify that company has not committed any default in repayment of the deposits or in payment of interest on such deposits. Even if committed default, 5 years had been lapsed since rectification of the default. Like that, statutory auditor has to give certificate. So in case of default, 5 years cooling period. Just now I told you. And authority. Such circular shall be issued on the authority and in the name of board of directors of the company. So who is having authority to issue circular? Board of directors. Sir, from whom? From board of directors will get authority from whom? No, board of directors will get that authority from members of the company. Now, members in general meeting, by passing ordinary resolution, they will authorize the board of directors to issue circular to accept deposits from members. And if you are making any advertisement, that advertisement is valid. That advertisement will have a validity period. That validity period is earliest of the 6 months from the closure of financial year. Suppose on 1st November 2023 I'm making this advertisement. When I'm making the advertisement, 1st November 2023. Now this advertisement is valid up to 6 months from the closure of financial year. That means closure of financial year is 31st March 2024 plus 6 months. So 30th September 2024, or date on which financial statements are laid before the company at the AGM or due date of AGM if no AGM is held. Or suppose my AGM date is 27th September 2024. And what is the due date of AGM? Generally AGM shall be conducted on or before 30th September 2024. So now you are having total 3 dates, Total you are having 3 dates. In these 3 dates, you have to consider earliest day. One is 6 months from the closure of financial year. Second one, date of AGM or due date of AGM, whichever is earliest. So out of these 3 dates, earliest date is 27th September 2024. Next one, fresh circular for each financial year. So every year you have to issue circular. So last year I issued circular. No. Current year, can I accept deposits without issuing circular? No. Filing of circular with ROC. ROC filing is compulsory. Next, deposit repayment reserve account. Similar to debenture redemption reserve. Every year company has to separate certain portion of profits and it has to reserve that amount under deposit repayment reserve account. Sir, what is the date? What is the due date for fulfilling this condition? The due date is 30th April of every year. 30th April of every year. Right now we are in the financial year 23-24, right? So with respect to this financial year, 30th April 2023 is the last date for maintaining deposit repayment reserve. At least 20% of the amount of deposits maturing during the following financial year. It's not current financial year, it's a following financial year. Following financial year means what? Upcoming year, not current year, the next year. So with respect to financial year 24-25 repayment of deposits, you have to maintain reserve on or before 30th April 2023. Suppose for the 24-25, we are in a we should return deposits to the volume of 50 crores. 50 crores we have to return during financial year 24-25. Now by 30th April 2023, you have to create deposit repayment reserve not less than 10 crore rupees. Further, such a amount shall not at any time fall below 20% of the amount of deposits maturing during the financial year. You can use this reserve only for repayment of deposits. Upon repayment, if this amount falls, immediately you have to increase the reserve. Immediately you have to transfer certain portion of profits and certain cash balances or bank balances to deposit repayment reserve as well as liquid assets. Certification as to no default in repayment. Yes, this point I already told you. You have to obtain a certificate from statutory auditor. Next, provision of security. You can accept secured deposits or you can accept unsecured deposits. But if you promise them will provide security, then you need to provide security only tangible assets. First thing we discussed earlier, right? And the charge value should cover not only principal amount but also interest amount. So company may provide security, if any, for due repayment of the amount of deposits or the interest thereon. Further, if security is provided, the company shall take steps for creation of charge on the property or assets of the company. If you are accepting unsecured deposits, separate disclosure you have to make in the circular. If no disclosure is there, general presumption they are security deposits. Next, relaxation for private companies. Here, companies classified into 3 types. One is startup private company. Second one, private company accepting deposits up to 100% of paid up share capital and free reserves. Limit. It is accepting deposits, maximum existing plus new deposits not exceeding 100% of paid up share capital and free reserves. And third one, private company which is satisfying two conditions. First, which is neither an associate nor subsidiary to other company, and total borrowings from banks, financial institutions, or other body corporate is less than twice of its paid up share capital or 50 crores, whichever is less, and no default with respect to repayment of those borrowings which we discussed in the above point. So private company satisfying these three conditions. One is neither an associate nor subsidiary. Next, loans not exceeding twice of its paid up share capital or 50 crores, whichever is less. Third one, not defaulted in repayment of aforementioned loans. In that case, these three companies are exempted from fulfilling certain obligations. One is no need of preparing circular, no need to issue circular, no need of filing a circular with ROC, no need of these reserve accounts, and no need of any certificate from statutory auditor regarding default, no default certificate. So these conditions, these obligations are not applicable to these three private companies. One is company which is accepting deposits to the extent of 100% of paid up capital plus free reserves. The other one is startup company, and the last one is company which is neither associate nor subsidiary, and its borrowings not exceeding twice of its share capital or 50 crores, whichever is less. Sorry, it's not exceeding, it is less than. It is not exceeding, less than. So loans, borrowings from three parties, banks, financial institutions, other body corporates, is less than twice of its paid up share capital or 50 crores, whichever is less, and no default with respect to repayment of such borrowings. Clear? And every company, after accepting deposits, it has to file certain forms with ROC. Clear? Next one, repayment of deposit. Once tenure is completed, you have to return deposit amount to the deposit holders. If you fail to repay, then aggrieved party can file an application with NCLT. Aggrieved party can file an application with NCLT. Now NCLT will decide the matter using the amount of DRRA. Come on, tell me, my dear students. Deposit repayment reserve account can be utilized for only one purpose. That one purpose is repayment of deposits. You can't declare dividends out of DRRA. Understood? Next one, you can't issue bonus shares from DRRA. You can't write off preliminary expenses using deposit repayment reserve account. Deposits repayment reserve account shall be utilized only for one purpose, that is repayment of deposits. Next one, tenure for deposits. So tenure, important point ma. MCQ point of view also important. Minimum, a company can accept deposits of 6 months, maximum 36 months. Minimum 6 months, maximum 36 months. However, a company can accept deposits for a period not less than 3 months also. General tenure is 6 months to 36 months ma. Beyond 36 months not permitted, less than 6 months not permitted. But in some cases, in order to finance very short term needs, 3 months condition is there. 3 months to tenure deposits is also there. But less than 3 months not permitted. And for 3 months also, you can't accept deposits limits. Sorry, you can't accept as much as deposits for a 3 months tenure. There is a limit on 3 months deposits also. Maximum 10% of paid up share capital plus free reserves plus securities premium. See, for the purpose of meeting any of its short term requirements of the funds, a company may accept or renew deposits for repayment earlier than 6 months, subject to following conditions. Max to max 10% of aggregate paid up share capital, free reserves, and securities premium, and minimum 3 months tenure. Minimum 3 months tenure. And next one, maximum amounts of deposits from the members. So this is a condition with respect to limit on deposits. See, if this condition is not there, then every person, what they will do, see, companies are paying more interest, right? So instead of depositing money with banks, they will deposit money with company. Now you'll find all money with companies only. You'll find nothing in banks. The liquidity crunch will happen. That's what this condition is there. So maximum a private company, ineligible public company can accept 35% deposit from its members. 35% on what? 35% on paid up share capital plus reserves and surplus and securities premium. Understood? So from this limit point of view, that those 18 exclusions are very important. Suppose you received a employee security deposit. If it is within the limit, 12 months salary, non-interest bearing security deposit, then that amount I won't consider it as a deposit. Accordingly, that space is available to you. You can accept that amount from members. Understood? My paid up share capital 1 crore ma. Reserves and surplus securities premium total 1 crore. Now total how much? 2 crores. 2 crores into 35% means how much? 70 lakhs. Existing deposits plus new deposits I can accept up to 70 lakhs. Suppose above 18 exclusions are there. In that one amount comes under the deposit. For example, employee security deposit. You received a 24 months salary as a security deposit. Total 8 lakhs you received from employee as a security deposit. Understood? So conditions violated, so we will call it as a deposit. How much amount? 8 lakhs. Now exclude 8 lakhs, so balance 62 lakhs you can accept the deposits from members. Understood? So existing plus proposed deposits shall not exceed 35% of paid up share capital plus reserves and surplus plus securities premium. And to this we had some exceptions. Exception to rule 35% means what? You can go beyond 35% also. You can accept deposits beyond 35%. Sir, what cases, sir? Specified IFSC public companies and private companies can accept deposits not exceeding 100% of aggregate paid up share capital, free reserves and securities premium account. General rule 35% ma. Once again I'm telling you, general rule 35%. Coming to specified IFSC public companies and private companies, they can accept deposits up to 100% of aggregate of paid up share capital plus free reserves plus securities premium. And next one, no limit for some entities. Here 35% limit not applicable, 100% limit not applicable. You can go up to 5,000 percentage, 10,000 percentage, 1 lakh percentage also. Sir, which companies, sir? Few private companies which falls under this category. One is startup companies up to 5 years from the date of incorporation. Second one, any private company which fulfill the following conditions. Just now we discussed these conditions. Neither an associate nor subsidiary to other entity, and the borrowings not exceeding. Sorry, it's not exceeding. No, I'm wrong. Borrowings, total borrowings less than twice of its paid up share capital or 50 crores, whichever is less, and company has not defaulted in repayment of such borrowings. So with respect to private company which falls under these two categories, they can accept deposit more than 35%, more than 100%, more than 1000%, no limit. And you remember again, these companies only, these three companies, these two companies and this private company accepting deposits from its members not exceeding 100%. So these three companies, condition of no default certificate, circular, filing of circular with ROC, these conditions are also not applicable. Privileges, simply privileges. Next one, appointment of trustee for depositor. Same concept ma. Under debenture trustee we discussed, no, same concept shall apply, nothing new. Even disqualifications also same to same. Powers, role of trustees same to same. Next one, ceiling on rate of interest and brokerage payable on deposits. Central government is having power to fix maximum rate of interest a company can pay to the deposit holders. Brokerage, maximum brokerage amount it can pay to the deposit holders. So there is a ceiling on it. Central government is having power to prescribe that rates. Next one, filing of application by the depositor. So intending depositor shall submit an application in order for a company to accept or renew a deposit. The application shall be in the form prescribed by the company. So without application, a member can't deposit money with company, and company is not allowed to accept that deposit. Along with the application form only, company can accept deposits. Sir, can I make deposit in joint names, sir? Yes, but maximum 3 joint deposit holders. So not exceeding 3. Company can issue deposit certificate. It shall not exceed. It can have a names of deposit holders not exceeding 3. Single person making deposit, I'll get a certificate in my name. 2 or more persons, if they deposit a single amount with the company, then company can issue deposit certificate, but that certificate will contain owner's names not exceeding 3. Next, nomination as usual, deposit receipt. deposit receipt. So within a period of 21 days from the date of receipt of money or realization of check or date of renewal, the company is required to furnish a deposit receipt to the depositor or his agent. So what is the time limit for issuing deposit receipt? 21 days. Do you remember time limit for issue of a share certificate? At the time of incorporation, 2 months. At the time of allotment of securities, 2 months. In case of transfer or transmission, in case of transfer or transmission, what is the time limit? The time limit is 1 month. Allotment of debentures, 6 months. Deposit receipt, come on, tell me, deposit receipt, the time limit is 21 days from the date of receipt of money or realization of check or date of renewal. Next, the receipt will be valid only if it is signed by duly authorized officer. That receipt shall have these following particulars. One is date of deposit, name and address of depositor, amount of deposit, rate of interest, and maturity dates. Clear? Every company accepting deposits has to maintain register of deposits. Another important point for multiple choice question, that is premature repayment of deposits. Premature repayment means, before due date, if company is making payment, we call it as premature repayment. Sir, why company will make premature repayment, sir? Reason, applicant, deposit holder came to company and is asking, sir, I need money. Suppose he made a deposit for 1 year, so for 9 months completed, and he came to company and is asking, sir, please return my deposit amount. Please return deposit amount. In this case, company is liable to pay interest. However, company can deduct 1% from interest rate as a penalty. Suppose, company agreed to pay 8% interest, 8% interest for 1 year. And this fellow, before completion of 1 year, came to company in order to get money. Now, company is liable to pay interest minimum 7%. Now, company is liable to pay interest at the rate of 7%. 7% for 9 months. So, amount is, for example, 1 lakh rupee. 1 lakh into 8 minus 1. 1 is, penalty. Okay. Into 9 months divided by 12 months. For 9 months only, company is having that money. So 7,000 into, so 1 lakh into 7% means 7,000. 7,000 into 9 divided by 12. So he's entitled to interest of just 5,250. Now this 1% reduction is just, discouraging factor. So to discourage early repayments, this 1% reduction privilege is available to the company. Next, next one, filing of return of deposits with the registrar. No right to alter the terms. Once you accepted deposits, you had no right to alter terms and conditions. You can't change interest. You can't convert the secured deposits to unsecured deposits. Next, final disclosures in the financial statements. And if company makes any delay in returning deposit amounts, then 18% penal rate of interest is applicable. 18% for overdue period, company is liable to pay 18% penal rate of interest to the deposit holders. And in this under this chapter, if company makes any default with respect to complaints of section 73, then the punishment. So fine extendable to 5,000 rupees, and in case of contravention is continuing one with a further fine of 500 for every day failing to send the deposit receipts within 21 days. For example, if you fail to send deposit receipt within 21 days, then this punishment is applicable. And there is a separate punishment for violation of section 73 and section 76. Separate punishment is there. So this question also covered in previous question. Exceptions, separate question we made. We already discussed this question. Next one, last part of this deposits chapter is eligible public companies. Who are permitted to accept deposits from public, sir? Only eligible public companies are permitted from accepting deposits from public. And what comes under eligible public company category, sir? First of all, it should be a public company, compulsory public company. And next condition, net worth not less than 100 crores. So calculation of net worth, paid up share capital plus free reserves plus securities premium. Next one, it excludes, P&L debit balance, accumulated losses. It excludes miscellaneous assets not written off. Miscellaneous assets which doesn't have any value, not written off. So this is the formula for calculating net worth. Revaluation reserve, everything is excluded, So simply paid up share capital plus free reserves plus securities premium minus losses, accumulated losses minus miscellaneous assets not written off. You will get net worth. Net worth not less than 100 crores. So greater than or equal to 100 crores. Turnover not less than 500 crores. Either of these two conditions should satisfy. Either of these two conditions should be satisfied. One is, one category public company with turnover 500 crores or more, or public company with a net worth 100 crores or more. Such companies we call them as eligible companies, and eligible companies can accept deposits from both members as well as non-members. However, special resolution is required. You are going outside, right? You can accept deposits from non-members. Yes or no? So special resolution is compulsory, and this special resolution you need to file it with the ROC. However, if the proposed deposits and existing debts are within the limits of section 180 subsection 1 clause C, section 180 is all about powers of the directors. Powers of the directors. Directors can borrow money on behalf of company. To what extent they can borrow, sir? Without members approval, they can borrow money. Up to what limits? Existing debt plus new debt. Existing plus new debt. Put together, not exceeding 100% of paid up share capital plus free reserves plus securities premium. If this is the case, under new debt, proposed deposits is there, proposed deposits is there. So after accepting these proposed deposits, total debt, if it is within the limit, then ordinary resolution is sufficient, or else special resolution is required. Next one, eligible companies for accepting deposits, conditions. As usual, section 73 subsection 2 conditions, but extra conditions, it is required to obtain credit rating every year, and the same shall be furnished in a circular letter as well as advertisement. Next one, charge creation. Yes, if you accept deposits by creating charge on any assets, then such charge shall be filed with ROC. Such charge shall be made only with respect to tangible assets, and market value of these assets shall cover not only deposits principal amount but also deposits interest amount too. Total value of security should not be less than amount of the deposits accepted and interest payable thereon. Next one, market value of assets subject to charge shall be assessed by a registered valuer. Whether assets value is covering deposits total amount or not. Registered valuer will make assessment of it. And security, same under debentures, we register security in favor of debenture trustee. Here also will provide security in favor of depositor trustee. Tenure for deposits already discussed. Minimum 6 months, maximum 36 months. You can accept deposits for a period not less than 3 months, provided that amount shall not exceed 10% of paid up share capital plus free reserves plus securities premium. My advice, when you find such equations, try to write in an equation format. Don't read like this blindly. So you just write like this 10% of paid up share capital plus free reserves plus securities premium, so that you can revise it more and more number of times. Appointment of trustee similar to debenture trustee, and these points already we discussed. Now coming to the maximum amount of deposits, this is the extra point we need to discuss. So from its members, eligible company can accept deposits maximum 10% of from aggregate of its paid up share capital, free reserves and securities premium account, and from persons other than its members maximum 25%. Sir, can I interchange these limits, sir? For example, I'll accept 15% from members, 20% from non-members. No, wrong. It is wrong. It is not permitted. So here 10 and here it is 25. And whereas for government companies, there is no limit at all. Government companies, 35% it can go with public, 35% it can go with members. There is no such problem. Just with respect to amounts point of view, limit on deposits. I'll give you one chart. Limit on deposits. Eligible company. From members, it can accept deposits up to 10% of paid up share capital plus free reserves plus securities premium. Non-members, non-members 25% of paid up share capital plus free reserves plus securities premium. However, these terms and conditions are not applicable to government company. Government company not applicable. Once again, I'm telling you, once again, I'm repeating you. This 10%, 25%, it's not about, proposed deposit. It also covers existing deposits too. Suppose already there is existing deposit, sir. Now, existing plus proposed deposit from members shall not exceed 10% of these limits. Same with respect to non-members also. Existing deposit plus proposed deposit. Total put together shall not exceed 25% of paid up share capital plus free reserves plus securities premium. So total, if you ask me, eligible company can accept deposits up to 35% of paid up share capital plus free reserves plus securities premium. And the same rule is also applicable to other companies. Here other companies are of two types. One is ineligible public company. Ineligible public company. Public company with turnover less than 500 crores and private company with paid net worth less than 100 crores. If it is the case, ineligible public company, we call it as ineligible public company. Next one, private companies. Ineligible public company, maximum it can accept deposits, up to 35% of paid up share capital plus free reserves plus securities premium. From whom they can accept deposits? From members they can accept deposits. And coming to the private company, it can also accept, it will also accept deposit from members only. It will also accept a deposit from members only. But the limit 35% is not applicable to them. Some private companies, they can make deposits up to, they can accept deposits. They can accept deposits up to 100% of paid up share capital plus free reserves plus securities premium. And coming to the startup companies, no limit at all. Startup companies, there is no limit at all. And next one, companies satisfying three conditions. What are those three conditions? In which, the company which is neither associate nor subsidiary to another body corporate. Total loans from banks, financial institutions, and other body corporates less than twice of its paid up share capital or 250 crores, whichever is less. And no default with respect to existing loans. Such companies can also accept deposits exceeding 35%, exceeding 100%. There is no problem at all. So this is, total summary about limits on deposits. And all these amounts, you can accept minimum tenure, minimum tenure that is of 6 months. Maximum tenure 36 months. The 6 months can be reduced to 3 months. However, you can accept deposits for a period of 3 months. There is a limit. The limit is 10% of paid up share capital plus free reserves plus securities premium. That's it. So this is all about deposits. This is all about deposits. Every point I covered. Next one, penalty. If company violates provisions with respect to non-repayment of, with respect to payment of deposits, with respect to repayment of deposits, then what is the punishment? Company minimum fine 1 crore, maximum 10 crores. This is the only section with a minimum fine crores rupees. Generally punishment, 1 lakh, 3 lakhs, 5 lakhs. So far we discussed, many penalties. 5 lakhs. This is the section, where minimum fine itself is 1 crore. Even under section 8 company, minimum fine is 10 lakhs, maximum 1 crore. But coming to the deposits, company minimum 1 crore, maximum 10 crores. Officer in default, both imprisonment as well as fine. Fine minimum 25 lakhs, maximum 2 crores. Sometimes, imprisonment, sometimes both. Imprisonment or fine or both. Clear? Section 76A. 76A is punishment for contravention of provisions of 73 to 76. So this punishment is applicable when you fail to repay, when you fail to return deposits. When you fail to return deposits, this condition is applicable. When you violate section 73 to 76, then this punishment is applicable. Suppose you are a private company, you can't accept deposit from public. Still you accept a deposit from public. and you are an eligible company, you can accept maximum 25% from non-members, 10% from members, 10% from members, and you crossed these limits. From members you accepted 20% deposits, from non-members you accepted 30% deposits. In that case, this section will apply. According to this section, the punishment is same, 1 crore minimum 1 crore or twice the amount of the acceptance of deposits. 2 times of deposits accepted against to the Companies Act, whichever is less. Under minimum we had two amounts. Out of these two amounts, whichever is less, you have to consider. Maximum 10 crores. Maximum punishment 10 crores. Sorry, maximum fine 10 crores. Minimum how much ma? 1 crore. Maximum 10 crores. You should not write like that. You should not write like that. Minimum 1 crore or twice the amount of deposits accepted, whichever is less. Maximum 10 crores. Coming to the officer in default, 25 lakh rupees to 2 crores and imprisonment up to 7 years. Imprisonment up to 7 years. And in case of, a fraud, section 447 is applicable. Punishment under section 447 is applicable. Clear? I'll give you one example with respect to fraud. With respect to tax authorities. Just see. Actually, my sale income is 100 crores. All my expenses, including purchase, it is 80 crores. Now net profit, how much 20 crores. On this, I need to pay tax 25% is the rate of taxation. If your turnover is less than 400 crores, 25% is the rate of taxation. So 20 crores into 25%. How much is the taxation? Come on, tax amount is how much? 5 crores, right? Yeah. Tax amount is 5 crores. The company has to pay tax of how much? 5 crores. Now, what company did you know? It reduced sales to 80 crores. 80 crores, yes, it reduced sales to 80 crores. And profit to 0 rupees. Now, tax amount how much? 25% on 0. Reduction of sales happened. What about collection from debtors? Suppose sales means the entry would be bank account debit 100 crores to sales account 100 crores. If it is a cash sales, I'm talking about cash sales. If it is a cash sale, the entry would be like this: bank account debit to sales. Yes or no? Credit sales, initially debtors account debit to sales. Next, cash account debit, cash or bank account debit to debtors account. Yes or no? So sales, they reduce it to 80 crores. Then what about this point? What about bank account balance? Bank account balance is there? No. 20 crores excess amount is there in bank account. How it is possible? Is it possible? Not possible. So that's why what company is doing. It is making an entry like this. Bank account to debit 80 crores. Bank account to debit 80 crores to debtors account. Sorry, not debtors. I'm writing consolidated entry, right? So to sales account 80 crores. For 20 crores, it is a writing entry like this: bank account to debit 20 crores to deposit holders. Like that, it is creating a liability 20 crores. Now bank balance tallied. Everything is perfect. So if you look at the balance sheet, what happened? We created a deposit liability of 20 crores. Is it a real deposit, sir? Is it a real deposit? No. You created this deposit in order to reduce your sales, in order to reduce taxes. So during investigation, if this matter comes into the picture, that means you committed a willful fraud. You committed this act willfully with the intention to deceive tax authorities. Now what tax authorities will do? They will definitely file a petition against the company, and company will get punishment as discussed like this. Company will get punishment minimum 1 crore or twice the amount of the deposit, whichever is lower, maximum 10 crores. Officer in default will get this punishment. And person responsible for this fraud, person behind this fraud will get punishment under section 447. Is it clear? Everyone. So with this deposits also we completed. Our next topic is registration of charges, section 77 to 87. Very small chapter, and examination point of view you can expect 4 to 6 marks. As you all know, loans are of two types: secured loans, unsecured loans. Without providing any asset as a security, if you obtain loan amount, we call it as unsecured loans. By providing asset as a security, if you obtain loan amount, we call it as secured loans. So providing security means what? Tomorrow if you fails to pay interest amount, or if you fails to repay principal amount, then the money lender will get complete rights over the property. He will sell the property, he will occupy the property in order to get his due amount. Yes or no? And these loans actually three types. One is pledge, second one hypothecation, third one mortgage. If you provide movable property as a security, and if you are transferring possession of movable property to the money lender, we call it as pledge. Example, gold loans. You transfer movable property to the banker. You'll also transfer possession of gold to the banker, and you will obtain loan amount. Yes or no? Upon payment of interest and repayment of principal amount, you will get your gold back. This comes under pledge. And if you provide movable property as a security and possession of the property remains with you only, the possession of movable property remains with the borrower, such kind of loans, it comes under hypothecation. Example, vehicle loans. Possession lies with borrower. Yes or no? C-book, particularly, C-book. On C-book, you will find the name of banker, financer. It comes under hypothecation. And third one, mortgage. If you provide any immovable property as a security, it comes under mortgage. Here you won't transfer possession of the property to the banker or money lender. You will transfer property documents, sir, and you will execute a mortgage deed in favor of a money lender. Is it clear? So all these three loans, if you observe in all these three loans, if borrower commits any default in payment of interest or repayment of principal portion, definitely the money lender, simply banker, will have complete rights over the property, will have complete rights to sell that property in order to clear their dues. Are you getting my point? Now, charge means what, sir? Charge is nothing but an interest or lien created on the property or assets. Both are same, no difference. Property or assets of a company or any of its undertakings. Undertakings, group of assets meant for a single purpose, meant for a purpose. Suppose if you look at ITC company, they had different wings. Suppose ITC hotels are there, ITC tobacco manufacturing unit is there, ITC FMCG manufacturing unit is there. Now each and every unit, I call it as undertaking. In each and every undertaking, you will find group of assets. So for the purpose of obtaining loan, if you create any interest or lien on any property or assets of the company or any of its undertakings or both, we call it as charge. We call it as charge. Simply here company what it will do, so it will provide a few assets as a security in favor of banker who lends money. So tomorrow if company fails to pay any interest amount or fails to repay principal portion, banker will get right over this property. Banker is free to deal with this property. Banker can sell this property. Are you getting my point? So technically speaking, charge, and charge includes mortgage. Charge includes mortgage. Our chapter name is not charge, our chapter name is registration of charges. So creation of charge is alone not sufficient. You should register that charge with a ROC. Sir, what is the background? What is the logic? Why we need to register charge with ROC? A very simple point, See, today company is having one immovable property. Immovable property. So definitely it will have a title deed, document showing title of the owner. Yes or no? Document showing title of the owner. So title deed. So today, company is going to Axis Bank. Sir, I'm having this immovable property. I want some 20 lakhs loan amount, sir. So please take these property documents and please give me 20 lakhs loan amount. Company filed an application with Axis Bank. Axis Bank keeping this title documents, yes, granted 20 lakhs loan to company. The very next week, company went to registrar office. Sir, I lost property documents, sir. Please issue me duplicate set, sir. Yes, upon filing an application with registrar, definitely they will issue duplicate documents, ma. After 1 month, company went to State Bank of India. Sir, I'm having one immovable property. I'm the owner of this immovable property. You can check in government records also. I'm the sole owner of this property. The value of property is 50 lakhs. Please grant me a loan of 20 lakhs. SBI also granted 20 lakhs loan to company. Again, after 1 month, company went to registrar office. Again, told same story. Managed the registrar and got duplicate documents. Now company is going to Punjab National Bank. File an application with Punjab National Bank. Punjab National Bank, my property value is 50 lakhs. Give me loan of 20 lakhs. Punjab National Bank also granted loan of 20 lakhs. So now company total, 20 plus 20 plus 20, it obtained 60 lakhs in the form of loans, providing a same property as a security. Finally, company defaulted in payment of interest, repayment of principal. Now all these banks came forward in order to sell that property in auction. And all these banks came to know that a single property was provided as security to all these three banks. Now whose interest is getting affected? Outsiders. Public interest is getting affected. To avoid this, yes, government came up with a concept called registration of charges. Company, whenever you create an interest or lien on any of your assets or properties or any of your undertakings in favor of some third party or in favor of a money lender, creation of charge alone is not sufficient. You should register the charge with ROC. Compulsory registration. Sir, company defaulted in registering charge with ROC, sir. Then what is the consequence? Very simple. Government will not consider that charge as a valid charge. Government will consider it as unsecured loan. So tomorrow if company went into liquidation, all these money lenders who granted loan against this security, they will not be termed as secured creditors, they will be termed as the unsecured creditors, and settlement will be done in that order only. You all know, during liquidation proceedings, first priority will be given to creditors with fixed charge. Secured creditors, to avoid confusion, secured creditors. Next, unsecured creditors. So if you want to stand in a queue under a secured creditor section, yes, creation of charge alone is not sufficient. Charge should be registered with the ROC. Next one, this charge can be created on any type of property, whether it is tangible or intangible, no problem. You can create charge on any asset, tangible or intangible. And the property may be located within India or outside India. The location of property, it is immaterial whether it is in India or outside India. Whenever company creates a charge, the charge shall be registered with ROC. And this charge is of two types, fixed charge, floating charge. Fixed charge, floating charge. In a company balance sheet, you can observe, fixed assets, current assets. What is the difference between fixed assets and current assets? Fixed assets, fixed in nature. Fixed in nature. Changes in these fixed assets you won't observe frequently. Suppose if you purchase land and building, land and machinery, this remains constant over a period of time. Fixed assets. Current assets, sundry debtors, inventory, they are not fixed in nature. They are not fixed in nature. Suppose today I am having 10 debtors. Do you think after 1 year will this same 10 debtors will continue? Do you think same balances will continue till the year end? No. So debtors and inventory, do you think, today I produced some 10,000 units of goods. Do you think after 1 year also can you observe only these goods are lying in the stock? No. The amounts in the sundry debtors, amounts in the inventory keep on floating or fluctuating in nature. Over a period of time, they are fluctuating in nature. So if charge is created on current assets like, sundry debtors, inventories, we call such charge as floating charge. Charge created on assets which are fluctuating in nature, floating charge. Fixed assets, sir. Identified assets, sir. Specific assets, sir. Present assets, sir. We call it as fixed charge. Under fixed charge, a company can't sell such properties without prior approval of a banker or money lender. But coming to the current assets, floating charge, company is free to deal with those assets. Company can sell the inventory. Company can realize money from the debtors. So with the realized money, they can purchase, they can procure raw materials, and they can process raw materials into finished goods, and those finished goods can also be sold to new customers. So company is having complete freedom to deal with assets which are under floating charge, but company has no freedom to use, to dispose the assets which are covered under fixed charge. Understood? Next one. Crystallization. Crystallization means what? Sometimes floating charge will be converted into fixed charge. Such process we call it as crystallization. Sir, when? Suppose, when a company violates terms and conditions of the loan agreement, immediately floating charge will be converted into fixed charge. So until crystallization happens, company is free to deal with the products, free to deal with the assets which are covered under floating charge. But once crystallization happened, a company can't sell them without prior approval of the money lender. So here, under charge, you'll find two parties. One is company, borrower. The other party is charge holder, in favor of whom you are creating charge. You call him as charge holder. So two parties, remember. So money lender comes under charge holder point, and the company comes under borrower position. Clear? So registration of charges. Whose duty to register charges? It is the duty of company. So it is the duty of company to register the charges. I told you, charge can be created on either tangible assets or intangible assets. The property may be situated whether in India or outside India. It is the duty of company to register charge with the ROC. If company fails to register charge, then charge holder can also apply registration. Can also file an application with ROC for registration of the charge. No problem. Next one, registration by the purchaser. Suppose company C Limited, it provided one immovable property as a security to State Bank of India, and this charge was registered with ROC. Now, who is having a duty? Who is having a duty to register charge with ROC? Initially, C Limited is having a duty to register charge with ROC. If C Limited fails to register charge, then charge holder can file application with ROC in order to procure his, in order to protect his interest. In order to protect his interest, he can file an application for registration of the charge. Next step, suppose, C Limited registered charge with ROC. Everything is fine. C Limited financial position is becoming, very, very bad, and C Limited want to sell this property to D Limited. So with the consent of charge holder only, C Limited sold this property to D Limited. Now D Limited obtained charged property. So now borrower changed. Initially borrower is C Limited. Now the asset is transferred to D Limited. D Limited is having two options: repay money to SBI completely, or register charge. This time, borrower. Who is the borrower? D Limited. So that's what registration by the purchaser. D Limited acquired charged asset from C Limited, and it is still under charge. Now it is the duty of D Limited to register charge with ROC. So three parties. One is by company, by the charge holder, by the purchaser. How to register charge, sir? Simple. File CHG1 form with ROC. Is there any time limit for filing a CHG1 form with ROC, sir? Yes, there is a time limit of 30 days of creation of charge. Within 30 days of creation of charge, it is the duty of company to register charge with ROC. So verification of instrument of charge. Verification is nothing but authentication, signing. Each and every electronic form you file with ROC, initially it should be signed by the authorized person. If property is situated outside India, generally the charge documents, forms will have a common seal. In case common seal, if there is no common seal, then any director or company secretary representing company will sign that charge document, or else under the hand of some person other than company who is interested in the mortgage or charge. Suppose director of the company on behalf of company providing asset as a security. Yeah, possible Director can give loans to the company, or director can give guarantee for the purpose of getting loans in favor of company. So director wants to provide his personal property as a security in favor of SBI in order to get loan to the company, in order to get loan for the company. Now, interested person, director, the person who is having interest in that mortgage, he will sign the charge documents. Suppose if it is a property situated in India, obviously first 2 points common ma. Company secretary or any authorized person on behalf of the company will sign these forms. Next one, normal time limit, general time limit is 30 days. What is the time limit for registration of charge? 30 days. 30 days. Sir, 30 days completed, sir. Now, can I register charge after completion of 30 days? Yes. Yes. Is there any additional time limit? Yes, there is additional time limit. Sir, what is that additional time limit, sir? So here charges are classified into two types. One is created before 2nd November 2018. The other one is charges created after on or after 2nd November 2018. Why? Because company amendment ordinance came in the year 2018, and it came into effect. It came into force with effect from 2nd November 2018. So charges created before 2nd November 2018, old provisions will apply. So according to old provisions, the normal time limit is 30 days of creation. Within 30 days of creation, you have to register charge with ROC, or else you'll be given 270 days additional time limit. 270 days additional time limit. So 30 plus 270 equal to 300 days. 300 days of creation on payment of additional fees. If not registered in 300 days, then register within 6 months from 2nd November 2018. You're given a extra time limit. Say by 2nd November 300 days also completed, sir. Or no, don't worry, we are giving you 6 months additional time. Within additional time of 6 months, you just register charges with ROC. So for old charges, the time limit for registration, normal time limit 30 days, additional time limit 270 days. So total 300 days. Sir, 30 and 300 both completed, sir. Don't worry, from 2nd November 2018 onwards, you have been given 6 months time period. So within 6 months, register charge with ROC. Now, new charges created on or after 2nd November 2018. Here the normal time limit is 30 days. Normal time 30 days. Government observed why we should give 270 additional days. What is the sense of giving additional 270 days? So they reduced 270 days time limit ma. Normal time 30 days. If you file forms with ROC within 30 days, only normal fees will be levied. Normal fees, 600 rupees, 500 rupees, 400 rupees, depending on authorized share capital, normal fees will be levied. If not registered within 30 days, you will be given additional 30 days time limit. So up to here 30 plus 30 60 days time limit. But here you have to file forms along with additional fees. You have to pay additional fees. Sir, 30 and 30, 60 days completed, didn't register charge with ROC, sir. Now ROC approval, along with ROC approval, you need to pay ad valorem fees. Ad valorem fees means proportionate to the document value ma. Proportionate, you all know customs duty, ad valorem taxes. So proportionate stamp duty you have to pay. Proportionate fees. Say for suppose loan amount 1 crore, no, straight away pay 1% as a late fees. Understood? So for that, additional 60 days time limit is given. So total, if you observe, 3 time limits are there: 30, additional 30, and final additional limit is 60. So total 30 plus 30 plus 60, 120 days time is there for filing forms with ROC. Sir, 120 days also completed, sir. File application with the government, file application with ROC, and along with application, file a declaration with ROC. So in the declaration, mention it, the reasons for delay, and due to this delay, creditors interest is not getting affected, sir. Company position is good only, company is in solvency position only, so none of the creditors will have a negative impact due to delay in registration of charges. So convince the government, convince the ROC. If they say okay, then registration is permitted. Understood? So same matter it is there in flowcharts, and the same matter you can observe in material also. So come on, tell me the time limits ma. Old charges 30 days, additional 270 days, so total 300 days, and another time limit 6 months from 2nd November 2018. Now coming to the new charges, 30 days normal fees. 30 days normal fees. Additional 30 days with ROC approval and on payment of additional fees. See, on an application by the company, allow such registration. ROC may allow such registration to be taken within a period of 60 days of such creation. Another 30. Sir, 30 plus 30, both completed, sir. Then within 60 days, here ad valorem basis. Next, I told you, right? Procedure for extension of time limit, it should be supported by a declaration from the company signed by secretary or a director that belated filing, late filing shall not adversely affect the rights of any other intervening creditors of the company. Next, issue of certificate of registration. The moment you file documents with ROC for registration, ROC shall register the charge and issue certificate of registration of charge in form number CHG2. And this certificate will act as a conclusive evidence. Yes, you have complied all the provisions of Companies Act and rules made thereunder. Understood? So this will act as a conclusive evidence. Now, the moment the charge is registered, it becomes a public information. It will be available on public domain, mca.gov.in website. So now second person, with whom company is filing application for loan. Now the second person, it is his duty to go through public domain, to go through the charge documents and to get a conclusion whether the property is charged property or freehold property. Then only he should lend money to the company. Suppose second person ignoring charge documents, ignoring public information, if he lend money against same property, then will he get any privileges over the property? The answer is no. The answer is no. It is his duty to go through the public information that is available in MCA. So without going through that information, if you lend money, doctrine of constructive notice shall apply. Accordingly, you won't get any privileges over secured property. Next one, subsequent registration not to prejudice rights of the charge holder. Even if you make any delay in filing, charge documents with ROC, it will not have any negative impact on charge holder. Consequence of non-registration, I told you. Even though it is a charged property, even though under various other acts and as per mortgage deed norms, mortgage deed terms and conditions, the charge holder may have a right over the property. But according to the Companies Act, that the charge is null and void and charge holder will have zero rights over the property. Simply if company, without repayment of loan, if company went into liquidation, that the lender will not get any control over the property, will not get priority with respect to repayment of debts. Next point, section 77 shall not apply to the certain charges. Futuristic point, government is having power to exclude some charges from chapter 6 scope. Okay, under deposits also we had same point. So this is a futuristic point. Government is having power to exclude certain charges from this chapter purview. Next one, application for registration of charge by a charge holder. I told you, it is a duty of company to register charge within 30 days of creation of the charge. If company fails to file application with ROC for registration of charge, then charge holder will get a right. Sir, why charge holder will file form with ROC? Why? Because if charge is not registered, then the charge becomes null and void. Charge holder rights over the charged property will become null and void. Will be null and void. So he will not get any control over the assets. He can't sell the asset according to the Companies Act 2013 provisions. I am telling you. Maybe under Transfer of Property Act, he had control over the property. However, if conflict arises between Transfer of Property Act and the Companies Act, you remember special provisions always override general provisions. As per Transfer of Property Act, if you execute mortgage deed, you are bound by the mortgage deed. You are liable to pay money to the banker, or else banker can take over that property. Coming to the Companies Act, creation of mortgage deed alone is not sufficient. You need to register that mortgage deed. You need to register that charge with ROC, or else charge holder rights will be zero. So generally, charge holder will file application in case company makes default. In practice, it is entirely different. In practice, banker will ask company, first file charge documents with ROC. Show me the proof. Then only I'll disburse you the loan amount. Until then, I'll hold the loan amount. I won't release a single rupees. First, you file these forms with ROC. Practice different, book different. So practice, bankers will always do the things, will do anything to protect their interest. Understood? Okay. Next one. On receipt of application from the charge holder, the registrar shall give a notice to the company. And if no objection is received, allow such registration within a period of 14 days after giving notice to the company on payment of prescribed fees. So immediately when if charge holder files an application with ROC, don't think that ROC will register the charge. First, ROC will give an opportunity of being heard to the company. Is it true, company? Is it true? Did you created any charge? That fellow came to me. Come on, give me reply. And that notice is valid for 14 days. That means company has to respond within 14 days. If company give positive consent or if there is no reply from company, then ROC shall register the charge and issue registration certificate in favor of company as well as charge holder. If company give negative consent, no sir, we entered into the agreement but we didn't borrowed any money. We had our opinion is sorry, we didn't give any consent to the banker, sir. We didn't agree to terms and conditions imposed by the banker, so we declined the loan proposal, sir. So like that, if company gives any negative consent, then ROC will reject the registration of charge. Clear? Now under this section 78, who is filing application with ROC for registration of charge? Charge holder is filing a charge form with ROC. Yes or no? Now who will file fees? Who will pay fees to the ROC? A normal fees or additional fees, who will pay? Charge holder will pay. Actually, whose duty to register charge with ROC? Company. Whose duty to pay money to the ROC? Whose duty to pay fees to the ROC? Company. So company. But who is paying the fees? Charge holder. So whatever amount paid by the charge holder is entitled to recover that amount from company, and company is liable to reimburse the expenses incurred by charge holder in registration of charge. Next, section 79. Company acquiring property already subject to charge. Already subject to charge. That means D Limited created charge on one asset in favor of State Bank of India. Now D Limited is acquiring that asset. Now it is the duty of D Limited to file charge document with ROC. This time borrower, it's not C Limited, D Limited. It shall be the duty of company acquiring it to get the charge registered in accordance with section 77. Next, write about modification of charges under section 79. See, modification of charges. Modification. Originally, you obtained 6 crores loan amount at rate of interest 9% per annum with tenure 30 months or 36 months, 3 years. By providing immovable property located at Mumbai from SBI, from State Bank of India. These are the terms and conditions. Loan amount 6 crores, rate of interest 9%, tenure 36 months, property situated at Mumbai, and the money lender is SBI. Now change of any of these terms and conditions is nothing but modification. Suppose loan enhancement happened 6 to 7 crores. Rate of interest reduced or increased, suppose 10 or 8%. Tenure increased to 60 months. Property changed. So yes, we don't want Mumbai property, we'll provide Delhi property. Or this charged property, another company acquired this charged property from company. Or loan takeover happened. Suppose SBI services, for example, C Limited thought that SBI services there is some delay. So we'll go with ICICI Bank. So what they did, so they transferred the loan from SBI to ICICI. All these are modification. Change in parties, change in terms and condition comes under modification. So now under modification, you need to register the modified terms and conditions document with ROC. Simply at the time of creation of charge, what procedure you followed, what is your duty, same procedure you have to apply under modification also. Understood? However, if modification happened because of operation of law, in that case, no need to register charge, no need to register that modification with ROC. For example, rate of interest, fixed 9%. Some cases, floating rate of interest, whatever RBI prescribes, so that interest will apply. So according to the terms and conditions, when you look into the terms and conditions, RBI rate of interest they mention. At the time of taking loan, it is 7%. After 2 years, it went up to 9.5%. So loan rate of interest increased, no sir. Can we call it as a modification? Yes. Is there any obligation to file modification of charge with ROC? No. Why? Because this modification didn't happen through the consent of the parties. Through the consent of parties, this modification didn't happen. This modification happened through operation of law. Next, so if modification happened through the consent of the parties, that modified charge should be filed with ROC. And what is the time limit, sir? Same time limit mentioned under section 77. Now 30 days within 30 days from the date of modification. The 30 days completed, sir. Additional 30 days. Sir, additional 30 days also completed, sir. Then additional 60 days on payment of ad valorem fees after getting ROC approval can get can register charge with ROC. Understood. Next one, demood notice of charge under section 80. Demood notice, simply doctrine of constructive notice. We assume that buyer is aware of the charges. So buyer once acquired charged property, if he acquired charged property, he is responsible to pay loan amount, principal amount, interest amount. He can't argue that, sir, I don't know about the charges, sir. I don't know the charges created by the company. So don't ask me money. So yes, buyer can't claim like that. A rule of estoppel. So simply doctrine of constructive notice will apply to all charged properties. It is the duty of buyer to go through the charge documents, to go through the public information that is available in available on MCA websites. Then he should take a decision. The transaction without knowledge of charge, buyer is still liable to the charge holder. Next one, write about reporting of satisfaction of charges. Satisfaction of charge. Now, for what purpose you created charge? Loan. You repaid entire loan amount. Now the purpose got fulfilled. When the purpose got fulfilled, technically speaking, we call it as satisfaction of charge. The moment charge is satisfied, you need to register satisfaction of charge with ROC. Sir, what is the time limit? 30 days. Sir, 30 days completed, sir. Don't worry, additional 270 days. So total 30 plus 270, 300 days. So within 300 days, they can file satisfaction of charge with ROC. And for additional 270 days, you need to pay additional fees. Okay. So this notice can be given by the company or charge holder or buyer of the property, buyer of the charged property. Any person can file an application with ROC for getting a certificate of registration of satisfaction of charge. Suppose if company gives intimation to the ROC, yes, we paid all the amounts to charge holder. Immediately ROC should not register the satisfaction of charge. It has to give notice to charge holder. So charge holder, come on, respond within 14 days from the date of this notice. Just respond within 14 days. If you had any objection with respect to satisfaction of charge, file your objections. If there is no objection, or charge holder give positive consent, yes sir, all charges cleared, sir. Now ROC will register the satisfaction of charge and will issue certificate of registration of satisfaction of charge. Memorandum of satisfaction. Call it as entering of a memorandum of satisfaction in the register of charges kept by ROC, and accordingly he shall inform the company of having done so. So in this entire section, important point is satisfaction of charge should be filed with ROC within 30 days of satisfaction. Extension time limit is 300 days of satisfaction. Next one, registers charges maintained by the company and ROC. Very simple concept, registers, records, simply records. So company will maintain record with respect to its charges. Whereas coming to the ROC is required to maintain registers with respect to all company charges. Company particularly itself, charges created by it, fixed charge, floating charge. So separate register company has to maintain. But coming to the ROC, it has to maintain register covering all companies and all types of charges. And this information is available to public at a large. Simply mca.gov.in. Go into the website mca.gov.in. View public documents. In that, select charge documents. Select company. On payment of 100 rupees nominal fees, you can download all this information. And coming to the company registers, yes, you can go to register office. These registers will be maintained at register office. You can go to register office and you can verify these records. Inspection is also permitted. Inspection is also permitted, okay, on payment of prescribed fees. Next one, the preservation of register. This document shall be preserved for a period of 8 years from the date of satisfaction of charge. It's not creation of charge. So when you satisfied charge, from that date onwards, you have to maintain these registers for a period of 8 years. Next one, write about power of registrar to make entries of satisfaction and release in absence of intimation from company. Generally, whenever company repay the loan amount, company is having a duty to file satisfaction of charge with ROC. Suppose company failed, ROC can still register satisfaction of charge. Sir, how ROC will know, sir, about satisfaction of charge? Very simple. Company, it created charge for 7 years, ma. The loan tenure is 7 years. 10 years completed, but still there is no reply from company. Now ROC will make some inquiry proceedings. ROC may call company or ROC may call the charge holder whether any dues to you. No dues, sir. No, ROC shall enter a satisfaction of charge in his register, and accordingly ROC will issue certificate of satisfaction of certificate of registration of satisfaction of charge. Understood? So ROC is having suo motu power. On its own motion, it can register satisfaction of charges. So before doing that, definitely ROC will give information to the affected parties, and finally ROC will issue certificate. Next one, write about intimation of appointment of receiver or manager. Company is having one immovable property, a 5-floor building, and from these 5 floors, company is getting a rent amount. Imagine 2 lakhs rent amount. So showing this property, company obtained some 2 crores loan amount from State Bank of India. So every month company has to pay 1.6 lakh rupees installment to State Bank of India. And State Bank of India imposed one condition. If company fails to pay installment for a period of 3 months consecutively, then I will appoint my person as in charge to this charged property. I will appoint one manager to this property. Now what this manager will do? This manager will come and he will collect all these rental incomes, 2 lakhs. Out of 2 lakhs, manager first, he will credit that amount to SBI. So 1.6 lakh he will credit to SBI. Balance, if any, that manager will return to the company. So simply he will manage charged property. Understood? So 2 years completed, company made default with respect to payment of installment. Now charge holder will get a power to appoint manager. So whenever charge holder appoints any person as a receiver or manager, charge holder should give an intimation to ROC as well as company within 30 days of appointment. So it is the duty of charge holder to give intimation to the company and ROC. So what is the time limit, sir? 30 days. And company came into the good condition and company started paying installments to the banks regularly. Now what a bank will do? Bank will cancel the appointment of a manager, or bank may remove the manager. So upon termination of that role, again company, again charge holder has to give intimation to both company as well as ROC. Simple point. It is the power as well as duty. Power to appoint a receiver or manager to manage charged property. Duty to intimate the same to ROC as well as company. Time limit 30 days. Next one, punishment for contravention of section 86. This entire chapter, only one punishment. If you violate any provisions of registration of charges, the punishment is company 5 lakh rupee, officer in default penalty of rupees 50,000. In case of fraud, punishment will be under section 447. Remember this punishment, Next, section 87 is all about central government powers. If company makes any mistake in charge documents filed with ROC, or if there is any delay in filing these forms with ROC, or any mistake in the registers, so to rectify these documents, charge documents, to rectify these registers, and moreover, in case of delay filings, in order to permit company to register the documents with ROC, yes, it is the duty of company to get permission from central government. So section 87 is all about permission of central government. in rectifying the documents filed with ROC. Understood? So no intimation or omission of any particulars in any filing previously made to the ROC. So if you want to rectify them, prior approval of central government is required. Then you can make changes to the documents you file with ROC. So this is all about registration of charges. My very small chapter. I told you, right? Very small chapter. Next one, management and administration. One point before I start management and administration, one point. I'm not going to discuss complete provisions of management and administration. I'll discuss only the provisions which have been asking very frequently, which have been tested very frequently. So very important provisions I'll discuss with you. Clear? I'm not going to cover all the provisions of management and administration. Very important provisions from examination point of view. I'm going to revise them only. Clear? Then only we can manage time resource. So section 88, I'll discuss section 88. Multiple choice questions point of view, important. Section 88, register of members. Register of members. I'll give you a crux of section 88, important topic points. So it is the duty of every company to maintain register of members, whether it is a private company or public company, listed company or unlisted company, government company, non-government company, small company or other than small company. Every company is required to maintain a register of members. So company here includes private as well as public. Duty to maintain a register of members separately for each and every class of security. Separate for each class of security. For equity shares with normal rights, one register. Equity shares with differential rights, one register. Preference shares, one register. So equity shares, one register. Preference shares, another register. So this register of members format is MGT1 in case of shares. MGT2 in case of other than shares. So other securities. For shares, MGT1 form. For other securities, MGT2 form. And these documents shall be maintained at registered office of the company. So maintenance, maintain place where we can keep all these registers, sir. First priority, registered office. Sir, other than registered office, can I keep these books, sir? Can I maintain register of members other than registered office, at a place other than registered office? Yes. For that, special resolution is compulsory. With approval of members, special resolution, you can maintain registers at any place in city, town, village where registered office is situated. Suppose company register office is in Jubilee Hills. Now you can maintain these registers at any place in Hyderabad. Next one, or you can maintain these registers at any place in India. Where not less than 1/10 of total members reside. 1/10 of members whose names are mentioned in the register, reside. Suppose company is having total 1000 members. Out of 1000, 100 members are residing in Delhi. Company register office is in Hyderabad. However, 100 members, 100 out of 1000, 1/10 of the members reside in Delhi. Now you can maintain this register office, you can maintain this register of members in Delhi after getting approval of members, special resolution. Understood? Next one, updation. Sir, is there any time limit to update these register of members? Yes, ma. Within 7 days of board approval, board or committee approval. Once allotment is completed, within 7 days register shall be updated. Transfer or transmission approved, within 7 days register of members shall be updated. Upon incorporation, upon allotment of shares, within 7 days register of members shall be updated. So updation should happen within 7 days. And who will sign these registers, sir? Simply authentication of registers. Authentication. Who will authenticate these registers? First option, company secretary. If there is no company secretary, then any person authorized by board of directors. Any person authorized by board on this behalf, board of directors, can authenticate these registers. And sir, how long I should maintain these registers, sir? Is there any time limit for maintenance of these registers? Yes, ma. In case of equity shares, till liquidation, till liquidation. In case of other registers, preference shares, debentures, in those cases, up to 8 years, sorry, up to 8 years. All right, up to 8 years from redemption onwards, from redemption date onwards, up to 8 years, you have to maintain these registers. So this is the time limit. Next one more important point, that is index. Index, starting page, you can observe index. So index is not mandatory for all companies. It is mandatory for the companies having a 50 or more members. If company is having 50 or more members, then index is mandatory. Remaining cases, if company is having 49 members only, sir, then index is just optional. Is it clear? So violation of section 88 provisions will attract penal provisions, will attract penalty. So this is the crux of section 88, ma. Section 88 crux. Question is lengthy. You can see, all these points I covered. Question is lengthy. Why? Because, particulars in the register, name of the member, date of becoming member, date of secession, amount of guarantee in case of company without share capital, any other interest, instructions, if any, given by the member regarding sending of notices. So these contents are there. And I'm telling you, the crux is very small topic. The crux of this section is very, very small. All these points I covered, ma. Next, foreign register. Yes, if company is having members from abroad, members from foreign, if company is having members in foreign countries, they can open foreign register in form MGT3, MGT1 for shares, MGT2 for other securities, MGT3 foreign register format, MGT3. Next one, whenever you open foreign register, the details has to be updated with ROC within 30 days from the date of opening of foreign register. And exact duplicate copy of foreign register company has to maintain at registered office also. So original register, in foreign we call it as foreign register. Apart from foreign register, in India you are required to maintain main register. We call it as principal register. And exact duplicate copy of foreign register we have to maintain in India. So total you will find 3 registers. One is principal register, other than foreign register, and the contents of foreign register again you have to copy in separate register. We call it as duplicate register. So total you have to maintain 3 registers. And company can close foreign register, but the moment if you want to close foreign register, all the particulars in foreign register shall be updated to another foreign register in another country, or shall be updated in principal register maintained by company at registered office. Authentication, time period, everything is same. Next, penalty. If you violate section 88 provisions, then company 3 lakh rupee penalty, officer in default 50,000 rupees penalty. Clear? The authentication of entries also I discussed with you. So remaining sections not that much important, ma. In previous examinations, if you go through previous examination papers, remaining sections are not that much important. So those sections I'm ignoring. You all know management and administration is not a small topic. Compared to share capital and debentures, this is somewhat lengthy, very big topic. And considering time constraint, I'm discussing only important provisions. Next one, closure of register of members. Power to close register of members. You all know, company will conduct general meeting. To the general meeting, who will attend, ma? Members of the company. Yes, members of the company. But section 56, transfer of shares. Company shares are freely transferable. Yes or no? Yes, sir. Company shares are freely transferable. So today I may be member. Tomorrow I may not be a member. Why? Because today evening itself, I'll transfer shares to another person. Now, which person, sir? We should give notice to whom, sir? We should give notice to whom? Who are entitled to attend general meeting? Who are entitled to vote at general meeting? Who are entitled to bonus shares? Who are entitled to right shares? Who are entitled to do dividends? So for that, we'll freeze registers, sir. Freeze. Freeze means no updation will happen. Simply speaking, closure of register. Closure of register means don't think that registers will be closed. No. Closure of registers means details updation will be kept hold. So during the time period, any transfer or any transmission happen, those details will not be incorporated, will not be updated in the register. So why we are closing the registers? Only to decide the members. to decide the members entitled to vote at general meeting, entitled to bonus shares, entitled to right shares, entitled to dividends. So for closing of register of members or other security registers, company has to follow a procedure. The procedure is, first it has to give notice, intimation to the members, intimation to the persons whose names mentioned in the registers. So 7 days prior notice is compulsory. If you are a public company, along with intimation, you have to give an advertisement in the newspaper, 2 newspapers, vernacular newspaper and English newspaper. So finally, that information, you have to share with members. Sir, how long I can close registers, sir? How long I can close registers? At a time you can close register for 30 days, ma. At one time you can close registers for 30 days. Understood? And during the year, the register, you can close the register for 45 days. Suppose I told you 4 instances: entitled to vote, entitled to dividends, right shares, bonus shares. So 4 situations I told you. In each and every situation, you can close register for 30 days. But cumulative, all these situations, it shall not exceed 45 days in a year. One time 30 days, throughout the year 45 days. If you close register more than this period, then penalty, 5,000 per day. 5,000 per day, subject to maximum of 1 lakh rupee penalty is applicable. So this is all about provisions related to closure of registers. Next one, annual return. Contents of annual return is not important. Contents of annual return is not important. But the time limit, signing of annual returns is important. Sir, who will sign the annual return, sir? Who will sign the annual return? First of all, these annual returns, you need to file in form number MGT 7. All companies. Coming to OPC and small companies. Small companies definition, you remember OPC and small companies. MGT 7A is applicable. Abridged form of original MGT 7. Abridged form. So this form should be signed by director of the company and company secretary. Coming to OPC, small companies, company secretary is not mandatory, right? Company secretary provisions will not apply. So if there is no company secretary, by a company secretary in practice, this provision is for all companies. Coming to OPC and small company, if there is no company secretary, then one director signature is sufficient. Sir, what is the difference between company secretary and company secretary in practice? In your company, if you had company secretary as an employee, he has to sign this annual return. Sir, there is no company secretary in our payroll records, sir. In our employee records, there is no company secretary. Then go to practicing professional company secretary. Get signature from that person. Understood? Get signature from that person. But one person company and small company, if there is no company secretary, no need to go to independent, practicing professional. Just director signature alone sufficient. Next one, certification. Along with MGT 7, another form MGT 8 is there, ma. This certification is not applicable for all companies. It is applicable only to the listed companies and company having paid up share capital of 10 crores or more, or company's turnover 50 crores or more. Only to these companies, certification is required. And who can certify, sir? Only company secretary in practice, not in employment. Independent practicing professional can certify MGT 8. MGT 8 is all about, compliance certificate. So during the year, yes, company has complied all the applicable rules and regulations like that. Compliance certificate. Next one, due date for filing annual return is important. So what is the time limit for filing annual return, sir? 60 days from the date of AGM. If AGM is held. If AGM is not conducted, then within 60 days from the due date of conducting AGM. So what is the due date of AGM? Within 6 months, every company, within 6 months from closure of financial year, company is required to conduct AGM. So majority of cases, 30th September is the due date for conducting AGM. So from this date onwards, add 60 days, I think November 29 or 28. So October you will have 31 days, November, so 28th most probably. By November 28th, you have to file annual returns. Sir, AGM conducted, sir. On 1st September, AGM conducted, sir. Add 60 days, 30th October. By 30th October, file these forms with ROC. This is the time limit. Penalty for contravention, rupees 10,000. In case of continuing one, 100 per day, maximum 2 lakh rupees. Clear? For company and officer in default, same punishment. And if company secretary, if he is giving MGT8 in a wrong manner, suppose not in accordance with this section 92, then he shall be liable to penalty of 2 lakh rupees. Is it clear? So in the entire section 92, you have to remember signing of annual returns. Who can sign annual returns? Director and company secretary. No company secretary, then director plus company secretary in practice. For OPC and small companies, if there is no company secretary, then director signing annual return alone is sufficient. Next one, what is the time limit for filing annual returns? Within 60 days of AGM. In examination, they can ask you question like this. Company failed to file annual returns with respect to financial year 2023-24. On inquiry, board of director contended that company has not conducted AGM so far. So that's the reason they didn't file annual return. Do you agree with the director's contention? No. So the time limit for filing annual return is within 60 days from the date of AGM, actual date of AGM. If AGM is not conducted, then 60 days from the due date of AGM, company is required to file annual returns with the ROC. Understood? Next one, maintenance of registers. All these points I covered. The next important topic is meetings, general meetings. Meetings. Meetings gained importance because of one reason, that is, separate legal entity. You all know, company is separated from its owners. Owners will contribute their money whenever company need funds, and company will do business with the funds belonging to the owner. On behalf of company, board of directors will do the business. Yes or no? Now, each and every member, definitely he has some interest in the company and he want to know something about the company results, company performance. So everyone will have an interest. Yes or no? Suppose if you invest 1,000 rupees in one company share, every day regularly you will check the share price. You will monitor the share price. Yes or no? Whether it is increasing or not. Now, owners invested money in the company. Definitely they want details of, they want updates of the company. For that, government came up with a topic with a concept called meetings. So every year company is required to conduct one general meeting, and that general meeting is nothing but annual general meeting. Annual general meeting. Any general meeting other than annual general meeting, we call it as extraordinary general meeting. General meeting between two AGMs, we call it as EGM. To discuss emergency matters, urgency matters, sir, we can't wait till AGM, sir, then you can call for extraordinary general meetings. And there is one more meeting called class meeting. Under section 48, we discussed variation of rights of the members. Variation of rights of the members, we discussed that point. Yes or no? So call for a class meeting. If class meeting is permissible, obtain special resolution from that class. Where members exceeding 200 are there, then you have to take approval under postal ballot type of voting. In that case, meeting is not required. Okay, see, every general meeting or every meeting is valid only if it satisfy three conditions. One is properly called. Next, properly constituted. Next, properly conducted. Understood? So properly called. So before meeting, you need to satisfy two conditions. One is notice calling for meeting. The second one is explanatory statement. And properly constituted, properly conducted. Here we'll see quorum, chairman, proxy, votings, resolutions. And last one, after conclusion of the meeting, properly concluded. Simply, minutes of the meeting, maintenance of minutes of the meeting. So we'll discuss these points, So I'll discuss with you section 101, 102, 103, and then 105. Clear? Next one, 118. So very frequently we are getting questions from these areas only. Apart from these 5 sections, we'll also discuss section 97 to 100, 96 to 100. Time limit for calling AGM. Provisions related to EGM. Okay. The first one, notice calling for general meeting. Notice calling for general meeting. Notice is nothing but intimation, Notice is nothing but intimation. So and so day, so and so time, so and so place, on so and so day, at so and so time, at so and so place, we are conducting general meeting. And in that general meeting, we'll discuss the following points. Simply agenda of meeting. So company will give intimation to the members in the form of a notice. That notice if you look at the contents of the notice, if you look at the contents of the notice, day of general meeting, date of general meeting, time of general meeting, place of general meeting or venue, place or venue, and then statement of business to be transacted at general meeting. I call it as agenda. Technically speaking, statement of business to be transacted at general meeting. Sir, who is having authority to issue notice calling for general meeting? One is board of directors. Normal cases, board of directors. Sometimes, requisitionist, members may ask a company to call for extraordinary general meeting. If company fails to call extraordinary general meeting, then members themselves can call for extraordinary general meeting. Such members, we call them as requisitionist. And sometimes National Company Law Tribunal is also having a power. If company fails to conduct AGM, then any member can file a petition can file an application with NCLT for calling general meeting. Now NCLT is having a power to call for annual general meeting. In that case, who will give notice calling for general meeting? NCLT. So finally, who is having authority to issue notice calling for general meeting, sir? Board of directors, requisitionist, NCLT. And next one, sir, to whom the notice we have to provide? To whom we have to give notice, sir? Every member of the company. In case of death of the member, to its legal representative. In case of insolvent member, to the official assignee. Understood? Next one, every auditor of the company, internal auditor, external auditor, both. Next one, every director of the company. Clear? So board of directors, by passing board resolution, they will fix a day, time, place and agenda of the general meeting, and that notice shall be given to all the members of the company, auditors of the company, as well as directors. Sir, directors only passing the resolution? No, sir. No, there is no condition that all directors should present to that board meeting in order to pass board resolution for approving day, time, place and agenda. Maybe some directors absent. You can observe absence of directors to that meeting, independent directors, etc. Next, apart from these people, debenture trustee, depositor trustee are also there. Person interested persons, debenture trustee is also entitled to receive notice. Next one, sir, is there any time limit for dispatch of these notices? Yes, there is a time limit for Section 8 companies. Come on, tell me, what is the time limit for Section 8 companies? 14 clear days. It's not normal days, 14 clear days. Sir, what is the essence of clear? I'll tell you. And other companies, 21 clear days. 21 clear days. This clear indicates you have to exclude date of notice, date of dispatch of notice, date of dispatch of notice and date of meeting. Excluding these two dates, there should be 21 days time period. Excluding these two dates, there should be 21 days time period. And next one, if you are sending notice through post or if you are sending notice through electronic mode, if you are sending notice through post, then you have to exclude 48 hours time period for putting the same into the transmission. For putting the letter into the transmission, generally some time is required. 48 hours you have to exclude. That means 21 days exclude 48 hours. So total, if you are sending notice through post, 21 days normal time period plus date of meeting plus date of notice plus 48 hours you need to add. Whereas coming to electronic mode, no need to of considering 48 hours, simply 21 plus 1 plus 1. So total 23 days, considering date of notice and considering date of meeting. Whereas under post, 25 days. Are you getting my point? Sir, can I give notice for a shorter period, sir? Simply, shorter notice. Can I give notice for 18 days? Can I give notice for 12 days? No, question comes from this area only. Shorter notice. Sir, shorter notice, is it valid or invalid? Valid if it get approval from the authority members. So valid when in case of AGM, shorter notice is valid only if 95% of members entitled to vote, 95% of members should approve the shorter notice. Such approval can be given a day before general meeting or at the time of beginning of general meeting. So 95% members should approve. In case of EGM, Companies are classified into two types. One is company with share capital, the other one is company without share capital. One is company with share capital, the other one is company without share capital. In case of company with share capital, two conditions you need to satisfy. One is majority of members, sir. Majority of members, more than half of the members, holding not less than 95% of paid up share capital. So two conditions, ma. Two conditions. Majority alone is not sufficient. 95% of paid up share capital alone not sufficient. Suppose, in a company, you and me, you people, you are 99 in number and I am 1 in number. I am holding 95% paid up share capital and you all holding 5% paid up share capital. Now this company want to call for an EGM with shorter notice. In this case, me alone giving approval is not sufficient, or you 99 people giving approval is not sufficient. Here two conditions, more than 50% members should approve. At the same time, the people approving shorter notice shall possess at least 95% of paid up share capital. And coming to the company without share capital, here only one condition: members having 95% of voting power. Members having 95% of voting power shall approve the shorter notice, or else shorter notice is invalid. Are you getting my point? Or else shorter notice is invalid. Suppose, sir, you said that notice shall be given to all the members, right? In case of omission, sir, I forgot to give notice calling for general meeting. Now, burden of proof lies on the company, ma. Company has to prove whether that omission is accidental or not. If it is accidental omission, sir, purely accidental, sir, it is accidentally we omitted. In that case, proceedings at general meeting, all the proceedings at general meeting are valid. In case of intentional omission, willful omission, in that case, proceedings at general meeting stands invalid. General meeting stands invalid. All the decisions taken at the general meeting stands invalid. Understood? So with this, section 101 completed. Section 101 completed. So 21 clear days, accidental omission. So meetings held at shorter notice. Contents of the notice. Persons entitled to the notice calling for notice. Authority to call a notice. Board. Next, mode of sending the notice. So each and every point we discussed under section 101. Next, section 102. Section 102. It is all about explanatory statement, ma. So it will contain the details, it will contain the information why members should approve the resolution. So it will contain, detailed disclosures of a proposal. Explanatory statement is not mandatory in all cases, ma. I'll tell you. So for section 102 point of view, a business means not buying and selling of goods and buying and selling of goods. So under Companies Act, business is nothing but decision making. This business is of two types. Decisions are of two types. One is ordinary business, the other one is special business. 4 items comes under ordinary business. Very regularly all these 4 items will happen. Sir, what are those items, sir? What are those decisions, sir? Adoption of financial statements, audit report and board report. Next one, appointment of auditors. Next one, declaration of dividends. And next one, reappointment of retired directors. Reappointment of persons in the place of a retiring one. So all these 4 items regular in nature. These 4 items comes under ordinary course of business. Others, removal of auditor, appointment of managing director, appointment of cost auditor, I'm telling you. Next, alteration of name, issue of bonus shares, buyback of securities, issue of preference shares, issue of sweat equity shares, issue of debentures, everything apart from these 4 items, all items comes under special business. With respect to special business, along with the notice calling for general meeting, you have to give explanatory statement. Mandatory. In the explanatory statement, you can observe following contents. Contents of explanatory statement. All material facts with respect to the proposal. You have to disclose all material facts with respect to proposal. And then you have to disclose interest of directors KMP in the proposal. If director or KMP is having any interest, if their personal interest is there in the proposals, you have to disclose that information also. and all relevant information apart from statutory information. So what statute is asking, any relevant information you have to provide. And finally, you have to provide date and place for verifying related records. So with respect to any agreement, in which, director or KMP or relative of the director or relative of the KMP is having interest. So date of verification of those records, place of verification of those records, you have to mention in this explanatory statement. Violation are not complete, sir. In that case, any benefit received by the promoter, director or KMP or relatives, their relatives, they can't enjoy with the benefits. That benefit shall be returned to the company. Benefit shall be returned to the company. Along with this, penalty, punishment. Sir, what is the punishment, sir? Liable to fine maximum, maximum punishment prescribed. Option A, 50,000 rupees. Option B, 5 times of amount benefit involved. 5 times of the benefit involved. So without proper disclosures, if you give explanatories, if you give notice calling for general meeting, just wait. So without mentioning, without disclosing the complete information, if you obtain any approval and if you obtain any benefit, that benefit shall be returned to the company. Along with that, fine. How much, sir? Maximum 50,000 or 5 times of the benefit received by these people, whichever is higher. Remember these words, whichever is higher. So this is all about section 102, ma. This is all about section 102. All these points I discussed with you. So 50,000 or 5 times the amount of benefit accruing to the promoter, director, manager or their relatives, whichever is higher. Clear? Next important section is quorum. Next important topic is quorum. So this is all about, constitution of the meeting. Quorum. Quorum means what, sir? Minimum number of members to be present at that meeting. In order to constitute a valid meeting, how many members are required, sir? So quorum, limits. It is different for private company. It is different for public company. For private company, two members personally present. For public company, as per register of members, if it is up to 1000, then applicable quorum is 5 members personally present. Sir, register of members, 1001 to 5000, sir. 1000, as per register of members, total there are 1001 or up to 5000. In that case, 15 members personally present should attend the general meeting. Above 5000, sir, simply, 5001 or above. In that case, 30 members personally present. These limits are the limits mentioned in AOA, whichever is higher you have to consider. Suppose myself, public company, having 10,000 members. In my AOA, nothing is prescribed. Then 30 members personally present shall apply. Suppose in my AOA, I clearly told 500 members should present at general meeting. In that case, 500 members is the applicable quorum. So first as per statute, next as per AOA, whichever is higher, you have to follow. Understood? So this is the limit. Sir, who will check, sir? Who will check this quorum is? Who will check whether quorum is present or not? Chairman appointed or chairman of the meeting as per section 104. Chairman will check the presence of quorum. And time limit, sir. What is the time limit to check the quorum, sir? Within 30 minutes from the scheduled time of meeting. Within 30 minutes of scheduled time. Suppose, 10 o'clock, morning 10 o'clock is the meeting time. So by 10:30, chairman has to check whether quorum is present or not. Sir, absence of quorum, sir. In case of absence of quorum, if there is no quorum, then, here meetings are classified into 2 types. AGM called because of requisitionist and all other meetings. In the absence of quorum, if it is EGM called because of requisitionist, then meeting stands cancelled. In all other cases, meeting stands adjourned. Sir, adjourned to which date, sir? If nothing is specified, then adjourned to same day, same time, same place, But next week, if anything is prescribed, sir, then decided a date, decided a time, decided place. Either of the cases, it is the duty of company to send a notice calling for adjourned meeting. So what is the time period for sending this notice, sir? 3 days, ma. General meetings, 21 days. For adjourned meeting, 3 days. So 3 days, you have to give notice to all the members individually. Sir, not possible, sir. 3 days before meeting, you have to give notice. Sir, not possible, sir. In that case, by way of advertisement, you have to give notice. By way of advertisement, you have to give notice. While counting quorum, I clearly told you 5 members personally present. So members personally present, it excludes the representative persons. Representative person, we had a technical name, that is, proxy. Representatives are excluded. Proxies are excluded while counting for quorum. Understood? Everyone. So this is all about, quorum provisions. Now, under all these sections, you can see, this provision is not applicable to specified IFSC companies and private companies if their articles of association prescribes otherwise. So that point is common for these provisions, ma. So you can check the limits, time limit, adjournment. Okay. Next one, representation of president, representation of governors. So this point I need to discuss with you. In case of state government companies, who is the member? Governor. In case of central government companies, government of India undertakings, president is the member. As per protocol, they had a privilege. So they can attend meetings personally or they can send their representatives to the meetings. So this representative looks like a proxy, but still this representative is counted for the purpose of quorum. For the purpose of quorum, this representative is considered. Generally, proxies are excluded while checking quorum. However, representative of president, representative of governor shall be considered for the purpose of quorum. Is it clear? All these points I covered. Next one, section 104 is not that much important, ma. Section 105, proxy. Tell me. Proxy benefit, is it available to all companies? No, ma. Proxy benefit is not available to companies without share capital if their AOA is silent. If their AOA is silent, proxy benefit is not there. First of all, proxy means what? Generally companies will conduct general meetings on working days, ma. Because only employees will employees will conduct meetings. Company will conduct meetings, but who will arrange all these proceedings, who will make arrangements? Obviously company employees, right? So generally on weekdays only general meeting will be conducted. Now I'm a member of a company, I'm occupied with some works during weekdays, I want to attend that general meeting, but I can't. Why? Because I'm occupied with personal works. However, I'm still having interest in that general meeting. I want to know what is happening in that general meeting, what kind of decisions they are making, and what is the what kind of opinion members are having. So I want to know the discussions happened at that meeting, but I can't attend the general meeting because of occupied works, because I'm occupied with my job or my practice works. I can't attend the general meeting. In such situations, member can send his representative to the general meeting, and that representative we call proxy. So proxy is having two meanings. One is instrument appointing proxy. So proxy means proxy instrument. The other one, person named in that instrument, person whose name is mentioned in that instrument, he is also a proxy. So proxy is having two meanings. One is instrument, the other one is person named in the proxy instrument. We call him also proxy. We call him as proxy. Coming to the disabilities of proxy, proxy shall not have right to speak at such meeting, and he is not considered for the purpose of quorum. He is not counted for the purpose of quorum. He is not entitled to vote at the general meeting under show of hands. However, under poll, he can cast his vote. Clear? So companies without share capital, generally proxy benefit is not there. However, articles of association, if company articles of association provides the benefit of proxy, then proxy benefit is available. And sir, who can appoint proxy? Member satisfying two conditions can appoint proxy. Two conditions. One is member entitled to vote at general meeting. member entitled to attend general meeting. Ma, two conditions ma. One is entitled to attend general meeting and entitled to vote at a general meeting. If these two conditions are satisfied, then that member can appoint proxy. In one attempt a question came for 2 marks ma. The question is, member already casted vote under electronic voting. Member already casted voting under remote electronic voting. Under remote electronic voting, he already casted vote. Now that member is entitled to attend general meeting. However, member is not entitled to vote at the general meeting. Why? Because day before yesterday, under remote voting, he exercised his voting power. Now voting power is not there. Now such member, can he appoint proxy to the general meeting? Answer is no. He is not entitled to appoint proxy. Why? Because he already exercised voting power. So who can appoint proxy? Member entitled to attend and entitled to vote at general meeting. Only that person can have proxy. Only that person can appoint proxy. And there are some limitations on the proxy. Limitations. One proxy can represent maximum 10 members. Maximum how many members he can represent in the meeting? 10 members. Or he can represent members holding not more than 10%. 10% of paid up share capital. I'm sorry, it's not 10 members, it's 50 members. Just wait. Proxy can represent max 50 members, or he can represent as that much number of members, but whose holding, cumulative holding shall not exceed 10% of company paid up share capital. Suppose each and every member is holding 1% capital. In that case, this proxy can represent only 10 members. So either of these two conditions, both of these two conditions should be satisfied. So each person holding 1% of paid up share capital, now he can represent only 10 members. Understood, sir? Each and every member is holding 5% paid up share capital, sir. In that case, he can represent only 2 members. Sir, each and every person is holding 20% paid up share capital, sir. In that case, he can act as a proxy to only 1 member. If a person is holding more than 10% of paid up share capital, he can have proxy, and that proxy can represent only this member, not any other members. Either 50 or, from holding point of view, 10% of paid up share capital, whichever is less, you have to consider. Next, so that point is important point. Next one, proxy instrument. Time limits for submission of proxy form. Here, time limits. For time limits, separate point. Time limit. One is deposit of proxy form. Deposit of proxy form. Second one is inspection. Inspection of proxy form. Remember 24, 48, 72 hours. Or with respect to days, 1 day, 2 days, 3 days. So deposit of proxy form, member who is appointing proxy has to give intimation to company at least 48 hours before commencement of meeting. Before meeting time, he has to deposit proxy form with company. That means, company should receive proxy form. Company should receive proxy form from the member at least 48 hours before meeting time. By articles of association, one can reduce this time limit, but one can't increase this time limit. Now, inspection of proxy form. Any member, if he is having intention to inspect proxy form, then he has to communicate his intention at least 3 days before general meeting. 3 days before general meeting, has to give notice to company regarding his intention to inspect proxy forms, and this inspection shall be carried out. Inspection period is 24 hours before commencement of meeting. 24 hours before commencement of meeting, and ends with start time. This is start time. Next one, end time. End time is meeting end time. So he can inspect proxy forms during the period starting from 24 hours before commencement of meeting and ends with meeting time. So the moment meeting gets concluded, inspection of proxy forms will also gets concluded. Understood? So 48 hours for deposit of proxy form, notice of intimation about inspection of proxy forms, notice for inspection of proxy forms at least 3 days before calling for meeting, sorry, 3 days before meeting, not calling for meeting, 3 days before general meeting. And inspection time period is 24 hours before commencement of the meeting, ends with a meeting. And such inspection shall be carried out only during business hours, not during night times. I told you 24 hours before commencement of meeting, right? So, sir, during night, can I inspect proxy forms? No, only during business hours you can inspect proxy forms. So, this is all about information about Proxima. One point I missed, that is who can act as a proxy. Who can act as a proxy? For Section 8 companies, only member can act as a proxima. That means in Section 8 companies, a member can appoint another member as a proxy. Outsider not permitted. And for all other companies, you can appoint an outsider as a proxy. You can appoint another person as a proxy. And me, faculty practicing chartered accountant, and you, the students of company law, that proxy benefit is there. How other people knows about the proxy benefit? How all other members know the benefit of proxy? It is possible only through intimation, yes or no? So in notice calling for general meeting, it is the duty of company to mention the benefit of proxy. Member, if you are unable to attend the general meeting, you can send your representative. So there should be a separate disclosure regarding appointment of proxy. Understood? If company failed to satisfy that condition, then company as well as officer in default is liable to a penalty of rupees 5,000. 5,000 penalty is applicable. Understood? And moreover, appointment of proxy is a complete 100% freedom to the member. Member can appoint any person as a proxy. So company can't circulate a document. Yes, member, if you want to appoint a proxy, you can choose only a person whose name is mentioned in the list. You can select a person, you can select any person, but the person details should be mentioned. Sorry. You can select any person as your proxy only from the list. So we are giving you 100 persons details. You can select any person out of 100 only. Like that, if company imposes any condition, in such cases, there is a penalty of 50,000 rupees. Penalty of 50,000 rupees. So while reading this point, many students get confused. Reading at this point. I'm telling you, the meaning of this point is company should not circulate a document containing the details of the persons who are willing to act as a proxy. It is completely, it is at the discretion of member. Member can appoint any person as his proxy. So you can't place restriction on a member. So you have to choose a person whose name is mentioned in the list. If you do like that, 50,000 rupees penalty is there. So next one, voting. All these are simple points only, types of voting. You can give one time reading. Just give one time reading. So next important topic is minutes, minutes. The last topic of management and administration. So very frequently you can observe questions from minutes. So minutes is nothing but a document containing summary of proceedings happened at that meeting. So meeting start time, presence of quorum, appointment of chairman, and discussions held, objections raised by the members, replies given by the management, everything. So minutes will contain a summary. It will contain a summary. So those who didn't attend the general meeting, if you go through the minutes, they will come to know what happened at the general meeting. So minutes is a summary document. So what happened in the general meeting, all that points will be incorporated in a separate record. We call it as minutes. So it is the duty of every company to prepare, sign and keep minutes regarding general meeting, regarding creditors meeting, regarding resolutions passed by the postal ballot, and regarding board of directors meetings, as well as committee meetings, audit committee meetings. Next one, allotment. allotment of securities committee, CSR, corporate social responsibility committee. Like that, separate committees will be there in the company. So committee meetings, board meetings, postal ballot resolutions, creditor meetings, general meetings. You have to maintain minutes for each and everything. Separate minutes for each and every meetings. Next one, contents. It should contain fair and correct summary of the proceedings that took place at the concerned meeting. Particularly, it must have all the appointments. That minutes shall contain the contents related to the appointments made at that meeting. In case of board meeting, so those who attended the board meeting, you have to mention the name of the directors attended the board meeting, name of the persons. With respect to general meeting, no need to mention the name of the members attended the general meeting. Why? Because members, there is no limit. In case of public company, you can have unlimited members. So now suppose 3,000 people 3,000 people attended general meeting. Now writing all those 3,000 people names, it will take time, and it require more and more records, more and more papers. I'm talking about minutes, right? So with respect to minutes, with respect to board meeting only, you have to mention the name of directors present at that meeting. And with respect to any resolution, if any director is not casting vote, or if any director is casting vote against to the resolution, I'm not talking about votes in favor, votes in favor, no problem. Votes against, or who is not at all casting any vote, those director details you have to mention in the minutes. Important, tricky point. See, any director, casting vote against to the proposal or not giving consent to the proposal, his details you have to incorporate in minutes. That means directors casting votes in favor of the proposal, no need to mention the details of such directors. Next one, chairman is having a absolute discretionary powers to exclude certain matters from minutes, but that matters, they should be either defamatory of any person, or they are irrelevant. The matters are irrelevant or immaterial to the meeting proceedings, or if you include that matters, it will have some negative impact on the company, detrimental to the interests of the company. So irrelevant matters, or matter which is defamatory of any person, or matter detrimental to the interests of the company, such matters, in the opinion of chairman, can be excluded from the minutes. Apart from these matters, apart from the matters other than this, chairman had no discretionary power to exclude. Each and every matter should be on record. Understood? And there is a practical question on this topic, certain members demanded chairman to exclude certain matters from the minutes. Now, is there any obligation on chairman to exclude such matters from the minutes? The answer is no. Chairman is having 100% absolute discretionary powers to whether to include or exclude matters from the minutes. Next one, important one, signing of minutes. And last point is, time limit for maintenance, signing of minutes. Just see minutes, time limit, and signing. So with respect to general meetings, extraordinary general meetings, minutes shall be kept ready. Minutes shall be kept ready within 30 days of meeting. Within 30 days of meeting, you have to complete the record of minutes. Coming to the signing, here meetings are of what? Two types. One is members meetings. Two types. Just wait. The other one is board meetings. Who can sign, general meetings or general meeting minutes? Option A, chairman of the meeting. Chairman of the meeting has to sign general meeting minutes. In case if chairman is not available, chairman got deceased or chairman left the country due to some emergency situations, in that case, any director authorized by board on this behalf, So only these two people can sign members meeting minutes. Coming to the board meeting minutes, chairman of the board shall sign the minutes. In case if this chairman is not available, no worry, no problem. Chairman of succeeding board meeting, succeeding chairman, or chairman of next board meeting. Suppose for Q2 company conducted one board meeting. Minutes was kept ready, but before signing, chairman died. No problem. For Q3, you are conducting board meeting, right? In that board meeting, you will appoint one person as chairman, right? So this chairperson will sign Q3 board meeting minutes, and he's also having a duty to sign Q2 board meeting minutes. That's what with respect to time limit of maintenance of minutes regarding board meetings, committee meetings, there is no specified time limit. With respect to member meeting minutes, it should be maintained, it should be completed within 30 days of meeting. Who can sign ma? Member meeting minutes shall be signed by chairman of the meeting. The chairman deceased, any director authorized by the board on this behalf. Coming to the board meeting minutes, chairman of the current board meeting or chairman of the upcoming board meeting. So inspection of minutes is also permitted, ma. Inspection of meetings is also permitted. If you want any copy, extract of the minutes, you can get it by paying sufficient money and by making a written request. So member is also entitled to get extract of the minutes. So for that he need to pay sufficient money, and he should submit request in writing. Then within 7 working days, company is having a duty to submit a copy of minutes to the members. Violation of this section, penal provisions as usual, ma. Penal provisions as usual. How to remember. So this is all about minutes. Next important topic is meetings, general meetings, section 96, section 100. So this is the last topic of management and administration. Sima, every company, whether it is private or public, except OPC, is required to conduct one general meeting once in a year. We call it as annual general meeting. Sir, is there any time limit for conducting annual general meeting? Yes. For first AGM, the time limit is within 9 months. 9 months from closure of first financial year. With respect to subsequent AGMs, with respect to subsequent annual general meetings, first time limit is within 6 months from closure of financial year. Second one, time gap between two AGMs, time gap between two annual general meetings shall not exceed 15 months. And every year one annual general meeting. So whichever is earliest, we need to consider. So every year, right? So year closure date, year means year calendar year. Year closure date would be 31st December. So out of these 3 dates, whichever is earliest will apply. For first AGM, 9 months from closure of first financial year. Sir, first financial year closure date. Is there any definition with respect to first financial year closure date? Yes, ma. If you are a company incorporated on or after 1st January, then financial year closure date will be 31st March of following year. Other cases, 31st March of relevant financial year, That means if a company is incorporated on 1st January 2023, then financial year closure date will be 31st December 2024. So here you can observe, 31st March, it's not December, 31st March 2024. So here in this case, you can observe financial year is of 15 months. Allowed. Why? Because company incorporated on 1st January. Just imagine, every company upon incorporation, within 30 days, they need to file registered office address with ROC. Within 30 days, they need to appoint auditor. Within 30 days, and then within 180 days, company has to file commencement of business form with ROC. So company has to comply various norms upon incorporation. So there is a very little time to do business. They will find only little time for doing business. Again, for that, you need to prepare financial statements. Those financial statements should get audited, and those financial statements should be placed in front of members in the general meeting. You need to take approval from members of the general meeting. Why unnecessary compliance? First, why unnecessarily, more complaints in the just first year of incorporation? The two, only 3 months, only for 3 months. Why this much hectic procedure? So that's the reason, government came up with the concept, financial year closure date will be not 31st March of that year, 31st March of next year. So if a company is incorporated on the 1st January 2023, then financial year closure date will be 31st March of 2024. From here onwards, 9 months time limit is given for conducting first AGM. So 31st December 2024 is the last date for conducting first AGM. Are you getting my point? In other cases, suppose company is incorporated on 1st December 2022. Suppose 1st December 2022. Then financial year closure date would be 31st March 2023. From here onwards, just add 9 months to get due date for AGM, first AGM. So 31st December 2023 is the due date for conducting first AGM. With respect to subsequent annual general meetings, the time limit is 6 months from the closure of financial year, and previous annual general meeting add 15 months. Previous annual general meeting date add 15 months. So out of these two limits, whichever is earliest, you have to consider. And there is a power to ROC to grant extension for AGM due date. ROC is having power to grant extension, and that extension benefit is applicable only for subsequent AGMs. So here ROC can grant extension up to 3 months. Up to 3 months ROC can grant extension. For first AGM, that privilege is not there. So in examination, definitely a question will come like this. Company filed an application with ROC for an extension of first AGM. For extension of first AGM. So can ROC grant extension? Is ROC having a power to grant extension? No. ROC is having no power to extend first AGM due date. However, he can extend subsequent AGMs up to 3 months. Up to 3 months. He can extend it by the 10 days, 20 days, 1 month, 1.5 month, 2 months. Up to 3 months he can extend. Next provisions. Day, time, place of general meeting. Day, time, place of annual general meeting. You can call for general meeting. You can conduct a general meeting on any day except national holiday. Any day except national holiday, you can conduct an annual general meeting. For the time being, we are having only 3 days were declared as national holidays. One is 26th January Republic Day, 15th August Independence Day, and 2nd October Gandhi Jayanti. These 3 days are declared as national holidays. So except on these 3 days, you can conduct general meeting on any day. Suppose, sir, we fixed 22nd August 2023 as a date of general meeting, sir. We issued notice calling for general meeting. Subsequently, central government announced 22nd August as national holiday. Then can we conduct meeting on 22nd August 2023? Can we conduct or not, sir? You can conduct for that year. For that year 2023, you are allowed to conduct general meeting on 22nd August. Why? Because already arrangements started. Already you issued notice calling for general meeting. So now how can you change the date? So for 2023, you can conduct meeting on national holiday. But next year onwards, 2024 onwards, you are not allowed to conduct general meeting on 22nd August. Next, time of meeting. Meeting commencement time should be between 9 a.m. and 6 p.m. Meeting, one can't start meeting before 9 a.m. One can't start meeting after 6 p.m. Meeting commencement time should be between 9 a.m. and 6 p.m. However, meeting can be continued even after 6 p.m. There is no problem. Commencement time should be during business hours, that too between 9 a.m. and 6 p.m. And coming to the place of general meeting, at the registered office of the company, first priority registered office, or any place in city, town, village where registered office is situated. Understood? Any place in city, town, village where registered office is situated. Only two options are there. Coming to unlisted companies, with 100% members approval, with all members approval, you can conduct general meeting at any place in India. Understood? So Section 8 companies are having privileges, some privileges. Unlisted companies are having some privileges. Government companies are also having privileges. At the end, Government of India, Ministry of Corporate Affairs is having a freedom to exempt some companies from complying these provisions. This is all about Section 96. First AGM within 9 months from closure of first financial year. Subsequent AGM held within 6 months from closure of financial year. Gap between two annual general meetings shall not exceed 15 months. Extension of first AGM not possible. Extension of subsequent AGM possible up to 3 months. Power vested with ROC. And time, place, everything we discussed. Unlisted company. If all the members give approval in advance, then unlisted company can conduct meeting at any place in India. Section 8 companies, day, time, place, this can be decided by members in a previous AGM itself. Next, government companies, certain privileges are there, and government is having a power to exempt certain class or classes of companies from complying above norms. For the time being, one example, OPC. OPC, you will have only one member. In OPC, you can have only one member. So for one member, how can you call for a meeting? Understood? Next one, EGM, extraordinary general meeting. Extraordinary general meeting is of three ways. One is, board of directors on their own motion. Board of directors on their own motion can call for EGM. The matters requires emergency approval. Suddenly company decided to change object clause. Suddenly company decided to change its name. Next AGM, it will be after 8 months. Right now we need to take a decision. Rectification of name. Right now we need to take approval. So in that case, no need to wait till AGM. You can conduct a general meeting other than AGM. We call it as EGM. So board of directors can call for EGM on their suo moto basis. In that case, coming to the day, time, place, relaxations is there. Relaxations are there. With respect to day, you can conduct EGM on any day, including national holiday. You can conduct general meeting on national holiday also. Coming to time, any time, need not be 9 to 6. Midnight, early in the morning, you can conduct meeting. Place, any place in India. Any place in India. Suppose if you are a company where 100% of share capital is held by a foreign company or company incorporated outside India. Foreign company is holding 100% of paid up share capital in our Indian company. In that case, this company EGM can be conducted even outside India. So any place in India or outside India. Outside India. Any place either in India or outside India. Understood? Next one, board of directors on a requisition. So this requisition means what? Certain members. How much, sir? How many, sir? If it is a company with share capital, members holding not less than 1/10 of paid up share capital, entitled to vote on date of receipt of requisition. When company is getting this requisition, when company is receiving this requisition, on that date, these members, whoever signed this requisition, should possess 1/10 of paid up share capital, and they are entitled to vote at the general meeting. So if these conditions are satisfied, then that requisition is valid. In case of company without share capital, same 1/10, but it is not paid up share capital, 1/10 of voting power, entitled to vote as on date of receipt of requisition by the company. So if these people sign the requisition, then that requisition is valid. That requisition will contain a matters to be discussed at the general meeting. An explanatory statement is not required with respect to requisition. No need to give explanatory statement. Just matters to be discussed at general meeting is sufficient. So the moment board of directors receive requisition, imagine, date of requisition equal to date of receipt of requisition. If it is in electronic form, if sending this requisition is in electronic mode, I mailed you, suppose, by mail, I'm requesting company to call for a general meeting. So today I sent the mail, company received mail today itself. That's what, date of requisition equal to date of receipt of requisition. Assumption, remember. So from here onwards, within 21 days, board of directors has to take all steps calling for general meeting. And within 45 days, general meeting shall be conducted. Within 21 days, board has to take all the steps in calling for general meeting, and within 45 days of date of receipt of requisition, general meeting shall be conducted. Suppose if board failed to call for general meeting within 21 days, board failed to conduct meeting within 45 days, in that case, the power to call for meeting will go to members. Requisitionist will get a power to call for general meeting, and they should conduct the general meeting within 3 months from the date of requisition. Within 3 months from the date of requisition, the meeting shall be conducted. Remaining provisions are same. In case, if requisitionists are calling for a general meeting, then, day of meeting, it can be any day except national holiday. It can be at any time during business hours. It can be at any place, either at registered office or city, town, village where registered office is situated. Simply, AGM related rules and regulations will apply if a meeting is called and conducted by requisitionist. Understood? So first, board of directors has to call for a meeting within 21 days. That meeting shall be conducted within 45 days. If board fails to satisfy any of this condition, then power will go to requisitionist. A requisitionist shall call for AGM, and that meeting shall be conducted within 3 months from the date of requisition. And if in this meeting, if there is no quorum, then there is no concept of adjournment. The meeting automatically stands cancelled. Understood, everyone? So with this, I'll conclude management and administration. Next topic, declaration and payment of dividends, section 123 to 127. Small chapter and scoring chapter. Examination point of view, you can expect 6 to 9 marks from this chapter. So don't ignore this chapter, ma. First of all, what is the meaning of dividend? What you know about dividend? So dividend means division of something. From company point of view, distribution of certain amount of profits among the owners of the company, nothing but members of the company. It is nothing but dividend. You all know company will not distribute all its profits in the form of dividends. It will reserve certain portion of profits. We call them as retained earnings. It will reinvest that retained earnings into the business. And the portion which is distributed among the members of the company, we call it as dividends. Understood? So if you look at the definition of dividends, dividend includes a interim dividend. So it is an inclusive definition. It is not defining the word dividend. In fact, it is giving a list, list of items covered under this definition. Dividend includes interim dividend. In the entire Companies Act 2013, wherever you see the word dividend, it includes interim dividend. That means provisions of Companies Act 2013 are applicable to final dividend as well as interim dividend, unless other intention appears. So first of all, sir, what is meant by interim dividend? What is meant by final dividend? I'll tell you, ma. The final dividend, it is a dividend recommended by board of directors. Final dividend. Who will recommend final dividend, ma? Who will recommend final dividend? Recommendation will be done by board of directors, and approval, approved by members in annual general meeting. In AGM, members will approve the final dividends. Who will make recommendation? Board of directors. Board of directors looking at financial position and financial performance of the company, they will recommend, for example, 8% dividends. Now members in annual general meeting, they will declare this dividend. They can reduce the rate of dividend. They can't increase the rate of dividend. If they increase it, if they want to increase it, suppose they are passing a resolution, they fixed 10% as a dividend. Now is that resolution valid, sir? No, invalid. Section 6 we discussed. Section 6, Act shall override MOA, AOA, any resolutions passed by the board or members and any agreement executed by the company. So if there is any inconsistency between Companies Act and these 5 things, Companies Act shall always prevail. So members can't increase the rate of dividend recommended by the board of directors. Members can reduce the rate of dividend. Understood? So final dividend, it is recommended by directors and approved by the members. Generally, final dividends are declared at AGM only. So now we are in the financial year 2023-24. So 1st April 2023 is the start date. 31st March 2024 is the end date. And you all know the due date of AGM. Just now we discussed the due date of AGM is within 6 months from the closure of financial year. And the time gap between two AGMs shall not exceed 15 months. Yes or no? Generally, the due date for AGM is 30th September 2024. Understood? So now, in AGM, if members declaring something as a dividend, we call it as final dividend. Clear? Final dividend with respect to which year, sir? Final dividend with respect to financial year 2023-24. Now coming to the interim dividend, it is a dividend recommended by the board of directors and declared by the board of directors. So with respect to interim dividend, who will recommend? Recommendation will be done by board of directors. Declaration will also be done by board of directors. At the end of the year, in the annual general meeting, members will ratify interim dividends too. You're getting my point? So if any dividend is declared by the directors, recommendation and declared by the directors, then we call it as interim dividend. Generally, interim dividend is declared between 2 annual general meetings. Is it clear? So any dividend declared between 2 annual general meetings, we call it as interim dividend. And who is having power to fix the rate of dividend? Board of directors. Who is having power to approve interim dividend? Board of directors. Clear? Next one. Important point is sources of dividends. Important point, sources of dividends. Sources. Sir, from where we get money in order to pay these dividends, sir? First one, current year profits. Second one, previous year's profits, accumulated profits. Simply accumulated profits, a surplus in profit and loss account, general reserves account. Understood? Next one, both combination of above. Sometimes, money provided by government. So out of these sources, you can declare dividends. And there is one small adjustment. The adjustment is you can declare dividend out of profits only after providing depreciation. That means from current year profits, you need to adjust depreciation. Depreciation is a non-cash expenditure. So you have to deduct depreciation. That depreciation you can't calculate according to your interest. You have to calculate depreciation according to Schedule 2 norms. After reduction of depreciation, whatever profit left over, from that profits only you can declare dividends. Sir, is there any obligation to transfer certain portion of profits to general reserves, sir? Is there any obligation on company to transfer certain portion of profits to general reserves? No, there is no such obligation to transfer profits to the general reserves. It is completely at the discretion of board of directors. If board of directors want to transfer some portion of profits to general reserves, they can. But there is no mandatory obligation under Companies Act 2013 in order to transfer portions to general reserves. Understood? Understood, everyone? Next one. Sir, within how many days? Time limit. Within how many days we have to pay these dividends, sir? We have to pay these dividends. For the time being, remember these 2 points. Remember these 2 time limits. One is within 5 days of declaration. Transfer dividends to a separate bank account. And within 30 days of declaration, the dividends should be distributed among the members. So payment should be completed. Payment should be completed within 30 days of declaration. Are you all getting my point? Everyone. So sources, it is very clear. Current year profits. Suppose I'm talking about, dividend. I'm talking about, dividend with respect to financial year 2023-24. Now, the first source is financial year 23-24 profits. Sir, not sufficient, sir. Or current year, losses, sir. Then you can use previous year's accumulated profits. Profit balance as on, 31st March 2023. So profit balance lying in the, general reserves or credit balance of profit and loss account. You can use that balance subject to some conditions. Those conditions I'll discuss with you later. Clear? So now let's look at the interim dividend. Interim dividend may be declared by the board of directors at any time during the period from closure of financial year till holding of annual general meeting. So what they are telling, just see financial year 2023, 1st April 23, 31st March 2024. This is the closure date. Now, board of directors can declare interim dividend during the period from closure of financial year. That means, 31st March 2024 till the date of annual general meeting. So annual general meeting date, 30th September 2024. So during this period, board of directors, if they want to pay interim dividend, they can pay interim dividend. Suppose, the recommended dividend on 31st July 2024. The recommended dividend on 31st July 2024. Can they pay this dividend, sir? Yes. Yes. Now coming to the sources for interim dividend, surplus in the profit and loss account, profits of the financial year in which such dividend is sought to be declared, or profits generated in the financial year till the quarter preceding the date of declaration of the interim dividend. So here you are having three sources. One is surplus in profit and loss account. That means opening balance of profit and loss account. Opening balance of profit and loss account. Next, profits for the financial year. Profits of the financial year in which such dividend is sought to be declared. Suppose, board of directors, if they decide that, this dividend, this interim dividend belongs to financial year 2023-24. The interim dividend belongs to 2023-24. Then they can use profits of 2023-24. They can use profits of 2023-24 in order to pay interim dividend. And we had third point, that is profits generated in the financial year till the quarter preceding the date of declaration of interim dividend. Now, if you look at the declaration date, it is covered in financial year 2024-25. Just observe carefully. 31st July 2024, it is in the financial year 24-25. So you can use current year profits, till the date of, quarter preceding the date of declaration. If you observe 31st July, exactly before 31st July, we had, quarter ending date, that is 30th June 2024. You can also use the sources, profits that were generated in quarter 1 of financial year 24-25. It's up to you. Opening balance of profit and loss account or profits of the financial year, dividends ought to be declared. And next, profits generated in the financial year till the quarter preceding the date of declaration of interim dividend. Here date of declaration is 31st July 2024. So this is declared and recommended and declared by board of directors. So this is an interim dividend. For this you can utilize profits earned during financial year 24-25 till the closure of quarter 1. Next one, ratification at AGM. So all interim dividends, declared and paid by the directors shall be ratified at the upcoming annual general meeting by members. So don't ask me questions, sir. What if members don't ratify? So they already accepted money, yes or no? Whenever company paying interim dividend, they already accepted that money. So deemed ratification already done. This is just a formality sake. In case of losses, if company has incurred loss during the current financial year up to the end of quarter immediately preceding the date of declaration of interim dividend, then such interim dividend shall not be declared at a rate higher than average of dividend declared by the company during the immediately preceding 3 financial years. So what this point meaning? See company completed 3 quarters quarter 1, quarter 2, quarter 3. Quarter 1 they got loss of 100 crores. For quarter 2, they got profit of 50 crores. For quarter 3, they got profit of 30 crores. And they want to declare interim dividend on 31st January 2024, looking at the market competition in order to attract more and more shareholders, more and more owners, they decided to declare interim dividend. Now, if you look at the position, performance of the company in that year, in the financial year to 2023-24, 2023 2024, if you look at that financial year, overall performance of the company is minus 20 crores. So quarter ending date, if you look at the point, end of the quarter immediately preceding the date of declaration of interim dividend. So 31st January, date of declaration of dividend. So preceding quarter ending date is 31st December 2023. So up to that date, during that year, the performance of the company is minus 20 crores. Can they declare dividend, sir? Yes, they can declare dividend, but there is a restriction. The restriction is rate of dividend shall not exceed. That means rate less than or equal to average of last 3 years dividends. Average of last 3 years dividends. Sir, last 3 years company paid dividend of 8%, 9%, 10%, sir. In that case, if you look at the average, 9%. 8 plus 9 plus 10 divided by 3, 9%. So company can pay interim dividend up to 9%. Next one, separate bank account. I told you the amount of dividend including the interim dividend shall be deposited in a separate bank account maintained with a scheduled bank. Within how many days? 5 days from the date of declaration. The same norm is applicable to final dividend as well as interim dividend. Same provisions for final dividend. The final dividend is declared at AGM of the company. It is also known as final dividend. And rate of dividend recommended by board cannot be increased by the members. Clearly, I told you. Next one, types of dividends, not important from examination point of view. Provisions regarding declaration and payment of dividends, very important. Profits of the current financial year after providing depreciation. Profits of any previous financial year or years which remain undistributed. Suppose our previous years we got profits, 100% of profits already distributed, sir. 100% of profits already distributed. Now undistributed profit is 0. Now you can't use previous year profits. Next one, combination of A and B. Next one, provision of money by the government. Sometimes government will promise public, you come and subscribe company shares, definitely company will pay dividends to you. If company fails to pay dividends, I'll contribute money to company and company will distribute that money among you in the form of dividends. Sometimes government will do that promise. If government make that promise, government will provide money. So the money provided by the government can be used for declaration and payment of dividends. Next one. So note point, I'll explain you later. Just wait. So meaning of free reserves. Free reserves, name itself is telling free from obligations. And these profits are available for distribution and payment of dividends. Now, while calculating, free reserves, certain reserves shall be excluded. One is revaluation reserve. Revaluation reserve, generally it is not a business profit. You purchased one asset, 10 years back, a decade back, you purchased one land. Now, indexation, etc., demand for land increased. Now the price of the land, the value of the land got increased. Now, can I increase my value of the asset? Yes, you can increase it. Corresponding credit balance, you can, you can credit to revaluation reserve. Now, this reserve is not in the form of cash. Yes or no? This reserve is not in the form of cash. You increased the value of asset. So this is an unrealized gain. This is just a notional gain. You can't use revaluation reserves for distribution and payment of dividends. Next one, fair value adjustments. Any change in carrying amount of an asset, liability recognized in equity, including surplus in profit and loss account on measurement of the asset or liability at fair value. For example, Infosys company is providing services to a US company. At the time of service, the contract value is $1 million, simply $10 lakh, into at the time of providing that service, dollar value is just 80 rupees. Now total contract value is 8 crores. So they recorded asset like this, debtor 8 crores, sales 8 crores, they recorded. After 1 month, 31st March came into the picture. On 31st March, current assets can be valued at fair values, can be valued at closing price of the dollar. So closing price of the dollar, it went up to 84 rupees, 84 rupees. Now, how much amount, you can realize from the debtor, sir? It's not 8 crores. So $1 million into 84. So you can realize 8.4 crores. So originally you recorded asset for 8 crores. Now the value of asset went up to 8.4 crore. Why? There is an inflation. Sorry, there is an increase in dollar value. increment in dollar value. So 40 lakhs is a gain, no sir. From this 40 lakhs, can I distribute dividends, sir? No. Any change in carrying amount of an asset, carrying amount of a liability, you can't utilize that amounts for payment of dividends. Understood? Next one. Need for providing depreciation out of profits before declaring dividend. Common point, not important from examination point of view. So I'm ignoring this point. Next step, before declaring dividend, company must transfer a certain portion of profits to reserves. Is it true? No. Under Companies Act 2013, there is no obligation on company to transfer certain portion of profits to the reserves. It is completely at the discretionary powers of directors. Understood? Old Companies Act, that provision is there. New Companies Act, the provision is not there. Next one, write about conditions for declaration of dividends in case of inadequacy or absence of profits. Suppose current year's profits are not there, losses, but still company want to declare dividends. Why? Members expect something. Members definitely expect something in annual general meeting, and moreover, it's a reputation matter. Competitors, they are declaring and they are paying dividends. If we want to declare dividends, definitely our members will sell our shares and they will go to competitor companies. So that is, that creates bad image in the market. Yes or no? So to satisfy members, company can declare dividends. Sir, but current year profits are not adequate. No, sir. Current year profits are inadequate. Current year profits, we are not having current year profits. We are having losses, sir. Still, you can declare dividend out of accumulated profits, subject to some conditions. Sir, what are those conditions, sir? Condition 1, the rate of dividend declared shall not exceed average of the rates at which dividend was declared by the company in the immediately preceding 3 years. 3 years. Suppose, company 1, last 3 years, it declared dividend, rate of dividend is 8, 9, 10. Now, average it, 8 plus 9 plus 10 divided by 3. So, average is 9%. Suppose company 2, sir, last 3 years, 1 year they didn't declare any dividend, sir. 1 year they declared dividend 10, another year they declared dividend 12. Now, average is 10 plus 12 divided by 2. It's not 3. Why? Because if any year, company didn't declare any dividend, don't consider that year. Don't consider that year. Suppose, sir, company 3, it didn't declare any dividend last 3 years, sir. Complete transfer of profits to the reserves only. In that case, condition 1 is not applicable. In that case, company can declare, unlimited dividends. Condition 1 will not apply. See, however, this condition shall not apply if company has not declared any dividend in each of the 3 preceding financial years. So, last 3 years, if company didn't declare any dividend, now there is no restriction on rate of dividend. They can declare unlimited dividends. But last 3 years, if they declare any dividend, now you have to average it. Next one, condition number 2. What is condition number 2? Total amount to be drawn from such accumulated profits shall not exceed 10% of paid up share capital and free reserves. So withdrawal shall not exceed 10% of paid up share capital plus free reserves. Condition 3. Amount so withdrawn shall be first utilized to set off current year losses. So first adjust current year losses. Next one, balance of reserves after such withdrawal shall not fall below 15% of paid up share capital. Simply reserves and surplus post withdrawal, after withdrawal shall be greater than or equal to 15% of paid up share capital. So now satisfying these 3 conditions, just one problem I will explain. Just one problem. Why? Because in examination there is an instance, a problem was tested for 4 marks. Just look at this question, paid up share capital of the company, 100 crores. Current accumulated reserves and surplus is 30 crores. Clear? Current year losses, current year losses 3 crores. Losses 3 crores. Now company want to declare a dividend for the current year. Last 3 years, average rate of dividend. Suppose last 3 years, year 1, year 2, year 3, they declare dividend 10%, 15%, 20%. Now, maximum 10 plus 15 plus 20 divided by 3. So it is 15%. So maximum rate of dividend a company can declare, that is 15%. Next, condition number 2. Maximum withdrawal, 1/10 of paid up share capital plus free reserves. So 1/10 of 100 plus 30, that is 13 crores they can withdraw. Third condition, out of 13, first I'll tell fourth condition, balance after withdrawal in the reserves and surplus should be minimum of 15% of paid up share capital. Minimum of 15% of paid up share capital. So reserves and surplus. Reserves and surplus. How much amount we can withdraw, sir? So paid up share capital into 15%. So maximum withdrawal. This is the equation. Current reserves and surplus, how much? 30 crores minus paid up share capital into 15% means 100 crores into 15 percentage. So maximum I can withdraw 15 crores. 30 minus 15, I can withdraw 15 crores. Above condition, it is 13 crores. Whichever is less, you have to satisfy two conditions. You have to satisfy two conditions. So whichever is less, that is 13 crores. 13 crores. Now I can withdraw 13 crores. Now don't distribute entire 13 crores in the form of dividends. First set of current year losses. Current year losses, how much? 3 crores. 13 minus 3 crores, 10 crores. You are having funds. Now this 10 crores means how much? 10 crores out of paid up share capital is how much, ma? 10 crores divided by 100 crores, that is 10 percentage. Now if you look at the first condition, company can declare dividend up to 15 percentage. With respect to rate, maximum 15%. But coming to the funds, it is having just 10 crores only. Now 10 crores or 15%. 10 crores is nothing but 10%. 10% or 15%, whichever is less, 10%. Simply, company can declare dividend and can pay dividend only rupees 10 crores. Understood? No confusion at all. You have to satisfy all conditions. As per condition 1, company can declare dividend up to 15%. Now coming to the sources, it is not having 15% funds. 15% means how much, ma? 100 crores into 15%, 15 crores, sir. But coming to the funds, it is having only 10 crores. It is having only 10 crores permission. How much permission they are having? 10 crores. They can distribute, they can pay only 10 crores. That's it. Next one. These rules are not applicable to 100% government company. 100% government company means 100% of control, 100% of capital held by governments, state government, central government, state governments, combination, any combination. So you are having problem also here. You can solve it, ma. You can solve it. For the time being, very simple problem only. See, average rate of dividend, 10.33% we got. Paid up share capital plus free reserves 440 lakhs. So maximum we can draw 10%, that is 44 crores. After withdrawal, balance in free reserves should be not less than 15% of paid up share capital. So if you look at free reserves, balance of free reserves, yes, free reserves how much, ma? Reserves is 240 lakhs. So 240 lakhs minus what is the capital of the company? 200 lakhs. 200 lakhs into 15 percentage. So 240 minus 30, 210 lakhs. 210 lakhs, up to 210 lakhs you can declare. Up to 210 lakhs you can declare. But according to condition 2, only 44 lakhs. Only 44 lakhs. So 44 or 210, whichever is less, 44 or 210 lakhs, whichever is less, 44. From 44, first you need to set off current year losses, that is, 30 lakhs. So you will get only 14 lakhs. Now 14 lakhs. 14 lakhs means how much? 14 lakhs divided by 200 lakhs, that means 7% only. Sir, if you look at the rate, 10.33% is permitted, no. But coming to the source, we are having only 14 lakhs. So you can declare dividend up to 7%. You can declare dividend up to 7% of the paid up share capital. That's it. Suppose, ma, if a company passed a resolution declaring dividend out of capital, they want to declare dividend out of capital or out of CRR, capital redemption reserve, or out of DRR, debenture redemption reserve, deposit repayment reserve, then such a declaration, is it valid? No, ultra virus, beyond the powers given by Companies Act, and it is illegal and punishable. Understood? Next, deposit and payment of dividend. I told you. So within 5 days from the date of declaration of dividend, yes, you have to deposit the amount in separate bank account. Why? Because it is no more your funds. You have no control over the funds. You have to transfer that amount. And within 30 days of declaration, that amount should be distributed among members of the company. Understood? Now coming to the 100% government company, this rule is not applicable. Why? 100% ownership, if 100% ownership, central government or state government is having. Why again transferring to separate bank account? Directly transfer to government. Next one, payment of dividend to the shareholder. So dividend shall be payable only to the registered shareholder or to his order or to his banker. So company is liable to pay dividends to registered shareholder or his order, suppose as per his instructions. Next one, to the banker. Shareholder but not a member. A purchaser of shares whose name is not entered in the register of members cannot claim payment of dividends to him through, though he might have made full payment to the seller of shares. In this regard, dividend may be kept in abeyance pending registration of transfer of shares unless the registered holder has authorized the company to pay dividend to the purchaser. Now this is section 126 ma. According to section 126, suppose situation, transferred shares to transferee. So transfer happened, transferee paid full consideration to transferor, and all these documents were sent to the company for registration of transfer. What company did? Company didn't register the transfer. The reason is closure of registers. We discussed in previous chapter, closure of registers. So company gave notice to all the members. Company gave advertisement also. So this 10 days, company will not register any transfers. After 10 days, company will register the transfers. So the transfer is pending for registration. Transfer is pending for registration. During the time period, company declared dividend. And in this situation, actually, to whom company should pay dividend? Actually, company should pay dividend to the member. Who is the member actually? Transferor is the member. Why? The transfer still not yet registered, right? Transfer still not yet registered. So as per register of members, transferor is the member. So legally, company should pay dividend to the transferor. However, transferee already paid consideration to transferor. Transferee already paid consideration to transferor. So transferee is entitled to those dividends, but transferee name is not yet updated in the register of members. So to whom we have to pay dividends? So there is the confusion. So don't pay any dividend to anyone. Just keep it in unpaid account directly. Unpaid dividend account, directly transfer that amount to unpaid dividend account. Generally, unclaimed dividends, unpaid dividends shall be transferred to unpaid dividend account within 7 days from the closure of 30 days from declaration. Understood? But coming to this particular situation, don't wait for 30 days. Immediately transfer this amount of dividend to unpaid dividend account. Once transfer is registered, transferee will file application with company. Then company can pay dividends to the transferee. Of course, if transferor give instruction to the company, pay dividends to transferee only. Don't pay dividends to me. Pay dividends to the transferee. In that case, company will transfer dividends to the transferee without transferring it to unpaid dividend account. And during the time period, any rights or any bonus shares were issued, all those shares, all those options will be kept in abeyance. Once transfer registration completed, then transfer is permitted. The transfer is eligible for all these benefits. Next one, payment of dividends payable in cash, check, warrant, or in any electronic mode, NEFT, RTGS, payable to the registered shareholder of the share and or to his order. So or to his order, that means as per instructions of the registered shareholder, or to his banker. Coming to the Nidhi company, if any member didn't claim any dividend, then no need of transferring dividends to unpaid dividend account. Just credit the amount to the account of a member. Credit the account of a member means simply, in balance sheet, write the name of a member who didn't claim dividend and write the amount. Suppose, one member didn't claim any dividend, 50 rupees. Now just credit that amount to member account in books of accounts, not member bank account, member account in books of accounts. So the moment he comes to the company, just pay that amount to the member. Until then, that amount, company will hold, and for that amount, member will be the creditor. Member will become creditor for that amount, and company is liable to pay as and when member comes to the company. Very simple topics, ma. Very, very simple topics. Next one, dividends on partly paid shares. Section 51, we already discussed in share capital. Next, dividends are payable in cash and not kind. Correct. So dividends in lieu of bonus shares is also prohibited. Whenever company declare dividends, 100% of dividends should be paid in cash only. Kind, bonus shares, company products not permitted. Always it should be paid in cash mode only. Cash. Next one. Applicability of section 2 Nidhi companies already discussed with you. For Nidhi companies, directly transfer that much amount to member account. Simply write an entry like this. Many students will get confusion here. you write entry like this: dividend payable account debit 50 rupees to member account. So recognize member as a creditor for this dividend. If member fails to claim any dividend, no need of transferring dividends to the unpaid dividend account, no need of transferring amounts to the IEPF account, Investor Education and Protection Fund, no need. Just transfer that amount to member account. Member account means not member bank account. Open member ledger in your books and credit that amount to the member ledger. Next one, write about circumstances for prohibition on declaration of dividends. Only two companies are prohibited from declaration of dividends. Very important. In past, a question came for 2 marks with respect to these points only. So two companies in entire companies act, two companies are prohibited from declaring and paying dividends. What are those two companies, sir? One is Section 8 company. In Section 8 company, I told you clearly, Section 8 companies are prohibited from declaration and payment of dividends. And the second one is company failed to comply deposit provisions. Company failed to comply deposit provisions. These two companies, can't declare, can't pay dividends to its members. Write about unpaid dividend account. Told you. So within 7 days, company declared a dividend but has not been paid or has not been claimed within 30 days from the date of declaration. The company shall within 7 days from the expiry of the set period of 30 days transfer total amount of unpaid or unclaimed dividend to a special account. So this account also belongs to the company, but this account will be kept aside. Company will not use money of this account, separate account. It's a reserve account. We call it as, technically we call it as escrow account. So deposit, you will have powers. Withdrawal, you will not have any powers. For withdrawal, you have to follow a specified procedure. Next one, sir, company made a default, sir. Within 7 days, they failed to, within 7 days, they didn't transfer dividend to separate bank account, sir. They failed to transfer dividend to unpaid dividend account, sir. In that case, for the delay period, company is liable to deposit also. Company is also liable to deposit 12% interest. See, what actually happens, suppose, company is there, Infosys company, Infi Limited, Infosys company is there. On 30th September 2023, they declared a dividend, 10 rupees per share they declared. One member holding 10 shares. So he will get dividend of how much rupees? 100 rupees. So the moment you declare dividend, within 5 days, I repeat, within 5 days, transfer to separate bank account. Separate bank account. That means, open one bank account for the purpose of payment of dividends. And you have to deposit amount in this bank account. Now, within 30 days from the date of declaration, so including 5 days once again get included. So within 30 days of declaration, you have to deposit it in members accounts, deposit or transfer to members accounts, member accounts. Suppose if any member didn't claim dividend, for example, this person, one person, rupees 100, he didn't claim at all. Now from here onwards, within 7 days, transfer amount to unpaid dividend account. This is also one bank account. This is also a bank account opened by the company in any bank, in any scheduled bank. So this is one bank account and this is second bank account, unpaid dividend account. This is second account, unpaid dividend account. These two accounts, company will open with banks. First, you deposit a dividend amount within 5 days from the date of declaration in a separate bank account. So within 30 days, transfer to the members any unclaimed or unpaid dividends from this bank account. Transfer to second bank account named unpaid dividend account. So both accounts belong to the company, and company is not permitted to use this money for business. Suppose if a company makes delay in transferring this amount to unpaid dividend account, now along with unpaid or unclaimed dividend, it has to deposit 12% extra interest at the rate of 12% per annum. 12% per annum. Understood? See, I'm not revising it in a fast manner. I'm stressing some points which will confuse you. As you all know, this is not a complete class. This is a marathon class. In actual class, I teach dividends for 7 hours, 6 to 7 hours. Understood? So this is a marathon. Roughly, I'll take, 40 or 50 minutes to complete this topic. So don't think that, I'm teaching in fast manner. So this is a marathon, you all know, right? Okay, not rushing you. Disclaimer. Next one, preparing of a statement of unpaid dividend. Within 90 days of transferring any amount to the unpaid dividend account, the company shall prepare a statement containing the names, last known address, and amount of unpaid dividend to be paid to each person and place such statement on its website. So within 90 days of transferring the amount to unpaid dividend account, 90 days. So total, if you look at the time limits, this is date of declaration. From here onwards, 5 days one condition. Again from here onwards, 30 days another condition. Now second one, from here onwards 7 days one time limit, and from here onwards 90 days another time limit. And again from here onwards there is one more time limit, that is 7 years. Within 7 years, if this dividend remains unclaimed, then along with these unclaimed dividends, consecutively 7 years, if any person is not claiming dividends, now all these 7 years dividends and shares shall be transferred to investor education and protection fund. Understood? So that is what, question number 11, consecutive 7 years. If any person fails to claim for dividends for a period of 7 consecutive years, now along with the dividend, shares shall also be transferred to the IEPF. Suppose, sir, 1, 2, 3 years he didn't claim dividends, sir. 4th year he claimed dividends, sir. Again 5th, 6th, 7th years he didn't claim dividend. Now can he transfer shares to unpaid dividend account? No. Why? Fourth year he claimed dividend, right? So this is not 5, 6, 7. This is 1, 2, 3 consecutive 7 years. In between, if he claim any dividend, then 7 consecutive years condition gets failed. You have to count 1 from the next year onwards. Next one. There is a logic behind this section. No one should become rich at the cost of others, right? If a person is not claiming dividends, that means he is no more in existence. He may be no more in existence. So if there is no provision like this, what company will do? It will check the status of the member. If member is no more, then any of the directors may manipulate books and they may get those shares. So they are becoming rich at the cost of members. Yes or no? This should not happen. So you have to transfer all these monies to the government. Why? Government is there for public, by public, for the public, of the public, etc., etc. So no one should become rich at the cost of others except government. Why? Because government is meant for the public. Next one. So along with the transfer, you have to file a statement with the IEPF. Next one. Right of owner of transfer shares to reclaim. So if any person came to know that yes, last 3 years or 4 years or last 10 years, I'm not claiming dividend. So if any person who get this matter, suppose his shares got transferred to IEPF, his dividends got transferred to IEPF. Now if you want to claim them, he can claim them. So by filing an application with IEPF, he can claim all his dividends as well as shares. So punishment for contravention. Very simple punishment, ma. Remember that punishment. And this is a small chart. Just go through this chart, ma. Next one, IEPF. Credits, debits. Credits means deposits of amounts with IEPF. Debits means expenses of IEPF, payments of IEPF. Simply, point A is all about receipts of IEPF, and next one, it is all about B point is all about payments from IEPF. So if you look at the receipts, very simple amounts, central government grants, central government donations, in budget, suppose in a budget, in a parliament session, finance minister announced 50 crores amount to the IEPF. So grant. Next, donations by the central government, amount lying in unpaid dividend account, amount in the general revenue account of central government, under 1956 Act, under Companies Act 1956. So government have maintained general revenue account, or government have maintained old IEPF account. Now balances lying in these accounts shall be transferred to new IEPF account. And income from investments. So whatever shares held by IEPF, whatever dividends generated on those shares, whatever income generated on those shares, all those amounts again transfer to IEPF. Amount received through disgorgement or disposal of securities. Under section 38, if you make personation of securities, that means by filing a duplicate applications, if you obtain 2 or more securities, if you obtain securities illegally, all those securities shall be surrendered to IEPF. So surrender to IEPF is nothing but receipt for IEPF. Next one, application money. which remains unpaid for a period of 7 years or more. Mature deposits which remain unpaid for a period of 7 years or more. If you look at this point, other than banking companies, why? Because for banking companies, time period is completed, automatic renewal is there, automatic renewal concept is there. But with respect to other than banking companies, Reliance, automatic renewal concept is not there. For renewal also, deposit holder should come to the company and he has to file renewal application with company, or else company should not renew those deposits. So those deposits shall be transferred to IEPF if they remain unclaimed for a period of 7 years from the date of its maturity. Same for mature debentures, interest thereon, and even preference shares also. The amount remain unpaid. So for a period of 7 years or more shall be transferred to IEPF. So amount received from sale proceeds of fractional shares. So any fractional shares, suppose company transferred some 890 shares to IEPF. Next year, company declared bonus in the ratio of 1:100. 1:100. Now 890 shares held by IEPF. So accordingly, 1:100 means 8.9 shares, bonus shares, company has to declare in the name of IEPF. So 0.9, I told you, shares will not be available in fractions. Stock is available in fractions. Shares, always natural numbers. Now 0.9 is a fractional share. So these fractional shares, IEPF will authorize company to sell to someone else. Now sale proceeds from fractional shares should be transferred to IEPF. Similarly, preference shares redemption. And next one, any other amounts as may be prescribed. So this list has been prescribed. All these amounts shall be transferred to IEPF. Next one, utilization of fund. Refund of unclaimed, matured debentures, deposits. If application is filed for refund of these monies, IEPF shall transfer these amounts to the respective owners. Next one, for conducting awareness programs, educating investors, they may conduct some workshops. For conducting those workshops, expenditure, they will incur expenses from this account only. Next one, distribution of discharged amount among eligible and identifiable applicants. Suppose one person, he got profits illegally. He got profits not in a legal manner. For example, Harshad Mehta, he projected some companies, those companies' share price will increase in coming days. So he showed some greediness to the investors. Investors, they bought these shares at higher prices. Understood. So all the profits were held by Harshad Mehta sir. Now whatever profits held by Harshad Mehta sir, whatever profits transferred to IEPF, that amount shall be distributed among the eligible applicants. Next one, reimbursement of legal expenses incurred in pursuing class action. Suppose cheating happened to the members, company cheated members. So members, definitely they can file a case on company for meeting legal expenses. Yes, IEPF will help them. IEPF will pay some amount in order to meet legal obligations or any other purpose incidental thereto. Understood, ma? See, central government is having a power to constitute authority to monitor, to administer this fund. That authority name is Investor Education and Protection Fund Authority. And with respect to authority, how many members are required, who will take the position of chairman, everything, government of India will look into those matters. So as of now, chairman, who is the chairperson, sir, secretary of MCA is the ex officio chairperson of the authority. In addition, there shall be 6 members, maximum 7, and a CEO who shall be the conveyor of the authority. So these people will look after the fund. And procedure for administration of the fund and consultation, next one, maintenance of books of accounts, filing of annual returns, audit of books of accounts of the fund, everything, government will prescribe after consulting C&AG, Comptroller and Auditor General of India. Next one, utilization of money in IEPF account, audit of the fund, preparation of annual report by the authority. So everything, government of India will prescribe. Next one, write about right of dividend, right shares and bonus shares to be held in abeyance pending registration of transfer of shares. Just now I told you section 126. Same amount, same provision. Transfer of shares has not been registered by the company. It is in pending. It is pending. So in that case, don't pay dividends to either of the parties. Straight away transfer that amount to unpaid dividend account. If there is any representation from transferor, so please pay amounts to transferee. Then pay amounts to the transferee. And during that time period, if company declares any rights, bonus shares, or have given rights option, all these options will be in hold. Abeyance is nothing but hold. Next, last provision of dividends. So time limit for distribution of dividends. I told you 30 days from the date of declaration. In case of delay, suppose company committed delay, company didn't pay dividends within 30 days, then company has to pay dividend plus 18% interest on dividend. Interest on dividend. Suppose total dividends declared 100 crores. It is the duty of company to pay these dividends within 30 days. Now it is 45th day. Now company is paying dividend on 45th day. Now don't pay 100 crores. Along with 100 crores, pay interest also 18% into 45 days divided by 365 days. So just calculate how much amount comes, that much amount interest, company will pay. Company will pay to the members. Now officer in default, he will get punishment, imprisonment up to 2 years. And officer in default, it's not officer in default. Here in this one case, we will call director. Only director is liable, not officer in default. Director who is in default. So director who knows about the defaults but still not doing anything, simply all directors of this company shall be punishable with imprisonment up to 2 years if he is a knowingly party to the default. That's what I told you. Director in default, imprisonment up to 2 years, minimum 0 days, maximum 2 years, and fine how much? 1000 for every day during such default continues. Suppose 15 days delay happened, no? Come on, pay 15,000 rupees. The company shall be liable to pay simple interest at the rate of 18% per annum. That's why, I multiplied that amount with 45 by 365. Exemption from punishment. Sir, delay is there, sir, but if the delay falls in these 5 categories, if delay falls under these 5 categories, then there will be no punishment. There will be no punishment. Sir, what are those cases, sir? First one, operation of law. Operation of law. Suppose if you look at section 126, just now we discussed. If you look at section 126, under section 126, if transfer registration is pending, sir. Registration of transfer is pending, sir. So don't pay dividend to either of the parties. Keep it pending. Keep it transferred to unpaid dividend account. Law is telling you don't pay any party. Don't pay amounts to any party. So in that case, 50 days or 60 days, companies are not liable to pay any interest on it. Next one, specific directions could not be complied. Suppose, member told, don't issue checks in my name. You just directly transfer amount to my account, NEFT, net electronic funds transfer. You just transfer amounts to me directly. And, he mentioned one account number, So company took that account number, and that account number is not, while entering that account number, so pop-up message came, account number wrong. So company unable to comply those directions, and company has already communicated the same with the member. The 2 conditions should be satisfied. There should be a specific direction, non-compliance, and next one, not compelled, and same shall be communicated to the member. Now, delay is not from company side, delay is from member side. So delay is from member side. So how can you expect company to pay 18% interest? Disputed ownership. Member got deceased and he is having 2 sons, son 1, son 2. Now there is a dispute between son 1 and son 2. Son 1 is telling that I am a nominee. I am the nominee. Son 2 is telling that no. Son 1 is telling I am the legal representative. I am the elder son. Son 2 is telling I am the nominee. I am eligible for dividends. So there is a dispute with respect to ownership. Now don't pay dividend to either of the parties. Keep it pending. No need to pay any interest. Adjusted against dues. Adjusted against dues. Suppose, company issued shares, partly paid up. And, company made calls on shares. One member, particularly one member, he is holding 1000 shares. And, 2 rupees didn't pay it. He didn't pay 2 rupees to the company. 2 rupees, total 2000 rupees calls in arrears is there from this member. And now company declared a dividend of 2 rupees. Company declared dividend how much? 2 rupees. Now he is holding 1000 shares, right? 1000 into 2, total 2000 rupees. So company didn't pay single rupee. Company adjusted these 2000 against calls in arrears. Now is this a legal adjustment? Is this a valid adjustment? Yes. So if you adjust against legal dues, then also company is not liable to pay any interest. Next one, default in process by others. Mistake is not on company. Company transferred pay amount is debited in company bank account, but the same amount is not credited to the members account due to bank system failure. Or company issued dividend warrants because of postal strike or COVID lockdown. The warrants didn't receive members didn't receive those warrants within the time. So this is a delay not from company side. Delay happened due to some other reasons, not from company end. The delay is not within the control of the company. So in that case also, no need of payment of dividends. No need of payment of interest on the dividends. No need to pay any interest on those dividends. Understood? So very frequently, this point, specific directions could not be compelled. So this point was tested, I think, 2 times in previous examinations. Clear? So with this, dividends completed, ma. With this, dividends completed. Just give one time reading, ma. So don't ignore this chapter. Very small chapter, scoring chapter. Understood? Everyone. Next topic, accounts of companies. Section 128 to 138. Examination point of view, minimum 6 marks. You can expect 6 marks from this chapter. Lengthy and moderate chapter, ma. So I'll cover all the provisions that are important for examination. So I'll start with section 128, provisions related to books of accounts. First of all, applicability of section 128, ma. Applicability, it is applicable to every company, whether it is a private company, one person company, public company, small company, government company, all companies, all companies has to follow section 128. As per section 128, every company shall prepare books of accounts and other relevant books and records and financial statement for every financial year. Every company, every financial year. And books of accounts should give true and fair view. Yes, books of accounts will express true and fair view only if you maintain them under double entry system. Both credit and debit aspect you have to record, and you have to follow accrual basis, not cash basis. Remember these 2 points, double entry system and accrual basis. Automatically books of accounts will express true and fair view. So state of affairs of the company including branch offices and books shall also explain the transactions affected both at register office and its branches. Simply writing entries is not sufficient. Supporting evidences should also be there. Accrual and double entry system, accrual basis. So income generated, expenses incurred, sufficient. No need of cash receipts, no need of cash payments. You need to record all those entries in the books of accounts. Income incurred, when risk and reward is transferred, is a correct point to record sale entry. Next, double entry system, dual aspect of debit and credit, you need to record. Next, coming to the definition of books of accounts, books of accounts covers only 4 things. Books of account means don't write, journal, ledger, subsidiary books, trial balance. This will not comes under books of accounts. Books of accounts cover 4 items. One is receipts and payments. Next one, sales and purchases, assets and liabilities. Next, items of the cost as may be prescribed under section 148. So this point is applicable only to the companies to which section 148 is applicable. Section 148 companies is required to maintain cost records. Remaining entities, ABC common, receipts and payments, sales and purchases, and then assets and liabilities. So books and paper is a broader definition. Books and paper includes books of accounts. Extra items, MOA, AOA, agreements, vouchers, deeds, documents, minutes, registers, all these put together we call books and paper, and book or paper. So book and paper includes books of accounts. Sir, maintenance, place of keeping these books of accounts, sir. First priority, registered office, ma. Registered office. Second option, after getting board approval and filing of this information with ROC within 7 days of board approval, you can maintain these books of accounts at any place in India. My registered office, my company registered office is situated at Hyderabad. First, I need to maintain books of accounts at Hyderabad registered office. Second option, after getting board approval, board resolution, you can maintain these books even in Delhi, Kolkata, Bangalore, Chennai, subject to two conditions. One is board approval. Second one, filing of information with ROC. What is the time limit? 7 days. Next, branch office. So branches, yes, today, expansion activities are happening through branches only. So company main office, head office at one location, branches other locations. Now, there is obligation on branch office also. Branch offices are required to maintain books of accounts, and periodically they need to submit summarized returns. They need to submit periodically, quarterly they need to provide summary form of returns to registered office. So at registered office we need to maintain books of accounts related to head office as well as branch offices. Understood? So company shall prepare books and paper, financial statements. So it should be placed at registered office of the company. or any other place in India, as the board of directors may decide. And they are open for inspection for directors. So coming to our company, the director or director can inspect our company books of accounts. With respect to subsidiary company books, a director authorized by the board can inspect books of accounts of the subsidiary. See, inspection of books of accounts of subsidiary by a person only on authorization by board directors. And these books of accounts shall be preserved for a period of 8 years. Failure in compliance, then fine 50,000 rupees. So this is the case, where members approval is not required. Books of accounts, in order to shift from register office to other location in India, no need of members approval, only board approval is sufficient. And remember, my dear students, one point, members are not allowed to inspect books of accounts. Members can inspect financial statements and related documents. Members had no power to inspect books of accounts. That's the reason members approval is not required. Board approval is sufficient. And within 7 days, you have to file that information with ROC. Filing information with ROC is sufficient. Next one, the inspection by the directors. I told you, any director with respect to our company C Limited, any director during business hours can carry inspection activities. But coming to the subsidiary company, not every director, not any director, only director who is authorized by the board. First of all, why we inspect subsidiary company books of accounts? So we want to know whether company is following LIFO or FIFO method for valuing closing stock, depreciation, straight line method or WDV. Why? Because our company, if it is a holding to another company, suppose we are having subsidiary company, the holding company is required to prepare consolidated financial statements. In consolidated financial statements, we will consider the figures of S Limited. So now S Limited, what methods they are following in valuing closing stock, in valuing fixed assets, what method of depreciation they are following. So to get knowledge of these things, inspection is required. Now with respect to subsidiary company, only a director who got authorization from board will carry inspection activities. So while director, while doing inspection, officers of the company, employees of the company should provide 100% assistance to the director. So whatever director asks, employee or officer should provide that information. Next, coming to the branches located outside India, with respect to branches located outside India and financial information of those such branches, director is having power to get that information. So company branch should produce that information to the director within 15 days of date of receipt of a written request. And director can seek information only individually, not by or through his agent, attorney holder or representative. So director representative is not permitted to inspect books of accounts. Only director in his individual capacity is permitted to inspect books of accounts. So total, if you look at this question, if you look into this question, 3 aspects: head office books of accounts, subsidiary, and branches located outside India. So with respect to company books, any director can carry inspection activities. With respect to subsidiary company, only director who got permission from the board, who got authority from board, can carry inspection activities. Now with respect to outside India, financial information, with respect to branches outside India, director can request financial information, and officers and employees are located at that officers and employees of that branch should provide that information within 15 days of written request. Next, sir, how long I should preserve these books, 8 years. 8 years. Last 8 years books of accounts I need to maintain, or current year books of accounts I need to maintain next 8 years. Both are same. Last 8 years you have to maintain books of accounts. You have to maintain books of accounts with respect to last 8 years. If company is incorporated less than 8 years, suppose incorporation happened in the year 2020, right now we are in the year 2023. Now how can you expect company to maintain last 8 years books of accounts? So its period of existence is less than 8 years. In that case, no need to maintain 8 years books of accounts. It is sufficient if you maintain books of accounts from date of incorporation onwards. Once again, I repeat, last 8 years books of accounts you have to maintain, or current year books of accounts you have to maintain for next 8 years. Both are same. Effect is same only. But you have to write a first point. So company is required to maintain books of accounts with respect to last 8 years immediately preceding the relevant financial year. Right now we are in the financial year 2023-24, right? So last 8 years. So 22-23, 21-22, 20-21, 1, 2, 3. Next one, 19-20, 18 19, 17 18, 16 17, 15 16. So 3 4 5 6 7 8. So from 2015-16 financial year onwards, you have to maintain these books with respect to current year. Suppose next year 24-25, then no need to maintain 15-16 books of accounts. It is sufficient if you maintain books of accounts from 16-17 onwards. That's it. Next one, suppose if government ordered company, so you have to maintain books not for 8 years, you have to maintain books for 12 years. In that case, that company, particularly that company, has to maintain books of accounts related to last 12 years. So government, central government of India is having power to increase the time limit with respect to particular companies, not all companies. Government, by issuing an order, it will order the company to maintain books of accounts for a longer period, longer than 8 years. And persons responsible under section 128, they are managing director, full-time director in charge of finance, CFO, any other person of a company charged by board with the duty of complying provisions of section 128. Sir, what is the reason of reading these persons' names? Very simple. Violation of section 128, these 4 people will get punishment, will get reward. Reward is not less than 50,000 rupees fine, but which may extend to 5 lakh rupees. Next one, sir, can I maintain books of accounts in electronic form? In a SAP form, in Tally ERP9, Oracle, Java, etc. Can I maintain books of accounts in electronic form? You can maintain books of accounts in electronic form, provided you have to satisfy all the following conditions. Conditions are, those books of accounts which are maintained in electronic mode should remain accessible in India. In one attempt, there is a question for 2 marks. Companies maintaining books of accounts in electronic mode shall remain accessible in a country outside India. Remain accessible in a place outside India. Permitted or not permitted? Not permitted. They shall remain accessible in India. Understood. Next one, audit trail compulsory. So this is a particular feature. Audit trail, it gives you information regarding when the transaction was recorded, when the transaction got modified, who recorded the transaction, who deleted the transaction. That complete information system will provide you. That feature we name it as, or we call it as audit trail. It is a compulsory with effect from 1st day of April 2023. So from 1st April of 2023 onwards, it is a mandatory obligation on every company to maintain audit trail if they maintain books of accounts in electronic mode. Next one, retention in original format. In which format you recorded entries in electronic mode, in that format only the books of accounts should be retained. And information received from branch office shall not be altered. So no modifications permitted. Next, legible form. Legible form. So I entered figures, in numbers, Indian numbers. Later when I opened system, Chinese numbers, Japan numbers are getting appeared. Is it in a legible form? No. Understandable form. Next one, storage and retrieval. So storage capacity and as well as retrieval backups should be there. So periodically you have to take up backups. So periodically it is daily basis. So like these points very important from MCQ point of view. So daily backup is compulsory. And if you are maintaining books of accounts in a cloud server, in an electronic mode only, but the cloud server is not with you. Some service provider is providing that services. Then you have to furnish the details of service provider. Next one, write about definition and concept of financial statements. Definition. Financial statements cover 5 aspects. Balance sheet, profit and loss account, cash flow statement, statement of changes in equity. So it helps you to look into the matters of promoters contribution, promoters shareholding, and shareholding by persons other than promoters. If there is any change, you can observe by looking at this statement. Next one, explanatory statements, explanatory notes. Shortcut we call it as notes to accounts. However, OPC, small company, dormant companies, inactive companies, private company being a startup may not include cash flow statement. beginning of this marathon lecture, small company benefits, I told you, no need to maintain cash flow statement. Sorry, no need to prepare cash flow statement. One of the reporting responsibility eliminated. Next one. So these exemptions are possible only if company is regular in filing annual returns with ROC as well as copy of financial statements with ROC. And financial statements should be presented in Schedule 3 format. And financial statements should be prepared in accordance with accounting standards. So for preparation of financial statements, you need to comply accounting standards. For presentation of financial statements, you need to comply Schedule 3. Understood? Next one. Write about concept of financial year. This concept I already told you in management and administration chapter. The company is incorporated on or after first day of the January of year, then period ending on 31st day of March of following year, next calendar year, 31st March of next year will be the financial year closure date. In other cases, 31st March of every year is the closure of financial year. Accordingly, we calculated due dates for first AGM. Next one. Suppose your company is an holding company or your company is a subsidiary company, and your holding or subsidiary companies are located outside India. You're a subsidiary, your holding company is located in Canada, and this holding company is preparing financial statements for a period, Jan to December. They're following Jan to December as a financial year. Now you're asking me to follow April to March. So for the purpose of consolidation, again, I need to prepare financial statements related to Jan to December. So once again, a burden on me. So in such cases, subsidiary company can request, government, central government, sir, my holding company is following different year, sir. So permit me to follow different year. So if government gives permission, then you can follow Jan to December. Suppose, sir, myself holding company, I'm having 10 subsidiaries, sir. I'm having 10 subsidiaries in Canada. All these 10 subsidiaries are following Jan to December calendar year as a financial year, sir. So if I follow April to March, again for preparing consolidation of financial statements, for the purpose of consolidation only, this concept is all about consolidation. My holding company, in order to prepare consolidation, again, I need to prepare Jan to December. My subsidiary companies has to prepare financial statements for April to March in order to prepare consolidation financial statements of my entity. So instead of asking all these 10 companies to follow April to March, so permit me to follow Jan to December year, sir. So I'll follow Jan to December year as a financial year. So if government gives permission, holding company in India is permitted to follow Jan to December as a financial year. Understood? Next one. Write about preparation and presentation of financial statements. I told you preparation should be according to accounting standards. Presentation should be according to Schedule 3. So if you comply these two norms, automatically financial statements express true and fair view. But this accounting standards, Schedule 3, these conditions are not applicable to big companies. Sir, big companies, you didn't give any definition, no sir. Big companies means banking, I means insurance, G means generation or supply of electricity, generation or distribution of electricity. Under section 133 and shall be in the form or forms as may be provided for different class of companies in Schedule 3. So non-applicability, insurance, banking, electricity. I told you, right? Generation or supply of electricity. So to any other class of companies for which a form of financial statement has been specified in or under the act governing such class of companies. But still, following the respective schedules, following the respective acts, still, those financial statements will express true and fair view only. And there is a condition. If you want to, if you don't want to follow any particular accounting standard, or if you want to come out of Schedule 3, suppose, not able to follow accounting standards. Best example, valuation of inventory. Inventory should be valued at cost or NRV, whichever is lower. Your closing stock NRV is very less, but still you are following cost. As per accounting standard 2, you need to follow NRV. Whichever is less, you have to show the figure NRV, but you are showing cost. So why? What is the reason for such a deviation? First, you need to mention the deviation, and you have to tell what is the purpose of not following accounting standard 2, and impact, because of non-compliance of accounting standard 2. So my actual cost is 1 lakh. NRV is 60,000, still I am showing 1 lakh. So the actual impact is 40,000. I'm overvaluing the inventory. I'm making overvaluation of inventory. Amount how much? 40,000 rupees. So like that, you have to disclose that matter. Next one, laying of financial statements at every annual general meeting. Yes, I told you under ordinary business members, you have to present financial statements in the annual general meeting and members will approve those financial statements. Consolidated financial statements, every company having subsidiary or subsidiaries and associate, then this company is required to prepare consolidated financial statements. Consolidated financial statements is nothing but individual standalone financial statements plus subsidiary financial statements addition. Consolidation of accounts, consolidated financial statements, we are having problems, right? To solve problems also. Next one. So there is one exception, tricky point. I need to discuss that point. Exemptions from preparation of CFS. Exemption from preparation of CFS. CFS means not cash flow statement, consolidated financial statements. So if all these three conditions are satisfied, then no need to prepare consolidated financial statements. One is, it is a wholly owned subsidiary, our company C Limited, it is a wholly owned subsidiary or is a partially owned subsidiary of another company and all its other members, including those not otherwise entitled to vote, having been intimated in writing and for which the proof of delivery of such intimation is available with the company, do not object to the company not presenting consolidated financial statements. Condition 1. What is this condition? See, our entity is already a subsidiary to another entity, H Limited. First of all, we is having subsidiary company, or C Limited is having subsidiary. Then carefully, C Limited is having a subsidiary company. Now C Limited, actually it is required to prepare consolidated financial statements. In one situation, no need to prepare consolidated financial statements. What is that situation? First thing, it is a subsidiary, either wholly owned subsidiary of another company or normal subsidiary to another company. In that case, C Limited has to communicate that intention with the remaining members also. See, this time we are not preparing CFS. And all the members of the C Limited should approve it. Okay, we have no objection. No need of preparation of consolidated financial statements. Second one, this C Limited must be an unlisted company. The C Limited must be an unlisted company. Suppose C Limited, if it is a listed company, then exception will not apply. Compulsorily, C Limited is required to prepare consolidated financial statements. Next one, ultimate holding company, H Limited. Ultimate holding company prepares and files CFS. Its ultimate or any intermediate holding company files consolidated financial statements with the registrar which are in compliance with applicable accounting standards. Suppose H Limited, sir, it is preparing consolidated financial statements covering the figures of C Limited, covering the figures of S Limited, sir. Then C Limited is exempted. See, three conditions C Limited has to fulfill. One is, C Limited should get approval from its members. C Limited must be an unlisted company, and a company which is holding the C Limited is required to prepare consolidated financial statements, is required to file consolidated financial statements with ROC. In that particular situation, our company is exempted from preparing consolidated financial statements. Next, non-compliance of accounting standard NDAs. I told you. So deviations should be reported, reason for such deviation and financial effects. And government is having a power to exempt certain class or class of companies from following accounting standards and Schedule 3. So far you can see banking company, insurance company, electricity companies are not required to follow them. And moreover, certain exceptions, if you look at defense companies are not required to comply segment reporting accounting standard is not required. Common sense, segment reporting, you have to disclose value of stock lying at each and every segment. Now if a defense equipment company, if it disclose, like in Mumbai we are having 20 equipments, in Visakhapatnam we are having 10 equipments, in Chennai we are having some 20 vehicles, 20 military vehicles. If they disclose that information, if they file that information with ROC, it becomes public information. Even terrorists can download that information and terrorists will attack our military bases. So companies engaged, government companies which are engaged in production of defense equipment, no need to follow accounting standard regarding segment reporting. And this benefit is available only if that government company is regular in filing financial statements with ROC and annual returns with ROC. So these two conditions they need to fulfill. Next, penal provisions, same under 128 we discussed. Penal provisions. same privilege, same penalty under 129 too. Managing director, whole-time director in charge of finance, CFO, person charged by the board with the duty of complying with the requirements of this section. In the absence of any of these officers, then all the directors shall be punishable with respect to violation of section 129. Imprisonment up to 1 year or fine 50,000 to 5 lakhs or both. Next, periodical financial results. This is a latest amendment. This section is not part of original Companies Act 2013. Very recently, this section was incorporated. According to this section 129A, apart from preparing financial statements, annually, you are required to prepare periodical financial statements, say for suppose quarterly. And this is not a new section. This is not a new provision. Every listed company, according to SEBI norms, is required to prepare quarterly financial statements and required to file this information with stock exchanges. Now, this concept was made, this concept was introduced for other companies also. Unlisted companies also required to follow this concept. So they're required to prepare periodical financial statements. So periodical results, limited review, not complete audit, only limited review, and that information you need to file with ROC within a period of 30 days of completion of relevant period. Understood? So Q1 quarter 1 completed, right? So by 30th July, file the information with ROC. Next, reopening of accounts on court order or tribunal order under section 130. The next one, 131 is all about, revision of financial statements, revision of board of directors report. So you can look at this chart, section 130. See, 4 parties, any of these 4 parties. Repeat, any of these 4 parties. Central government, income tax authorities, SEBI, any other person concerned. Statutory regulatory body. So 4 persons are there. 5th person, any other person having interest. So if they are of opinion that, if they are having an opinion that financial statements are prepared fraudulently, sir. So actually, the profit will be 200 crores, but company reported only 20 crores, sir, in order to avoid taxes. Or actually, company is a loss-making company, sir, but in order to attract investors, they disclosed a profit of 20 crores, sir. So financial statements are prepared fraudulently, sir. So if they are having that opinion, they had power to file an application with either court or tribunal. So please reopen the financial statements, sir. So we'll look into the sales, we'll look into all the expenses. So we'll arrive at correct figures. So based on correct financial statements will be prepared. This happened in Satyam Computers scam. Satyam Computers scam, this section was implemented. Now court or tribunal will pass an order to the effect that yes, you can reopen books of accounts. So this is possible only under 2 cases. One is earlier accounts prepared in fraudulent manner, or affairs of the company were mismanaged. Board of directors diverted certain funds to other related entities or to other countries, and they're claiming those amounts as expenses. So we had a doubt with respect to company financial statements. So please permit us to reopen books of accounts. So court or tribunal is having a power to order for reopening of books of accounts. Then notice will be served to the applicants. Okay, so we'll take representation. Into the consideration of, if any, and will pass order to reopen books of accounts, and the revised account shall be final. So for reopening, maximum period is 8 years. 8 years immediately preceding the current financial year. Why? Because under section 128 we discussed, company is required to maintain last 8 years books of accounts, right? So reopening is also permitted for 8 years. Beyond 8 years, not possible. However, if government already gave an order, ordered company to maintain books of accounts for 12 years. In that case, revision or reopening of books of accounts is permitted up to 12 years. A question came on this section, I think 2022. In 2022, a question came on this concept. SEBI or income tax authority filed an application with court or tribunal in order to reopen particular company books of accounts, and they are requested court to order company to reopen its books for the last 11 years. For the last 11 years. So is it permissible or not permissible? The answer is not permissible. Why? Up to 8 years reopening is permitted. Logic is simple. Company is required to maintain books of accounts only with respect to last 8 years. Next one, voluntary revision of financial statements. Voluntary revision of financial statements. For this also we are having a chart. We'll look into the chart. See, section 130, a revision, reopen of books of accounts. Who can file application? Whether income tax, SEBI, government, or statutory body, or any other person. But coming to section 131, revision of accounts. Here, who will file applications, sir? Only directors will file application. Directors will file an application with the tribunal. Sir, a particular year financial statements, particular year board report are not in compliance with section 129 and 134, sir. So please give us approval in order to revise the financial statements, in order to revise board reports, sir. Now, tribunal, before giving approval, tribunal will give notices to Government of India, Income Tax Department, everyone, Government of India, Income Tax Department. See, particular company is asking for revision of financial statements. Particular company is asking for revision of financial statements. So if you have any objection, please come and file your objections. If you want to verify company books of accounts, you can come and you can look into the financial statements. You can look into the board report. It's up to you. So board, if they are of opinion that financial statements or board report doesn't complied or didn't prepared in accordance with section 129 or section 134, then they can file application with tribunal. So tribunal, before giving approval, it will consider the recommendations of Government of India as well as Income Tax Authority. And revision is possible only once in a year. Only one time revision is permitted. Second time, third time revision not permitted. And that revision is subject to last 3 financial years only. Beyond 3 years, you can't go. So if you ask me, sir, differences between section 130 and section 131. Section 130 and 131. 130, 4 people can be applicants. There is, central government, Income Tax Authority, SEBI, statutory body, any other person. Coming to 131, who can file applications are only board of directors. Section 130 is applicable, if financial statements are prepared fraudulently. Board repair, and then affairs of the company are mismanaged. So let me write here, why unnecessary confusion, ma? So section 130, reopening of books of accounts. Section 131, a revision of financial statements. So applicant. So here you can see central government. Next one, SEBI. Next, Income Tax Authority. Next, any statutory body. But coming to revision of financial statements, board of directors will file application. Sir, with whom? Application with whom? Under 130, application can be filed with either court or national company law tribunal. Whereas under 131, application can be filed with only tribunal, ma. And when, sir, when section 130, when it will be applied, sir? Financial statements are prepared fraudulently. And next one, affairs of the company have been mismanaged. Affairs of the company are not managed properly, sir, mismanaged. These 2 circumstances. Coming to the section 131, financial statements, board report. Financial statements are not prepared according to section 129. Board report, we didn't complete section 134. Next one, coming to the time period, ma. So reopening of books of accounts is possible for 8 years. Revision of financial statements is possible only for 3 preceding financial years. Are you all getting my point, students? So these are somewhat differences between 130 and 131. Remaining points, just give one time reading, ma. So crux of the section, I explained you. Next one, NFRA. Not that much important. Of course, there is a question, one time there is a question from this section, but not that much important. Why? Because this is not a practical concept. This is a theoretical concept. You have to by heart. You have to remember and you have to reproduce in examination. So constitution of NFRA, National Financial Reporting Authority of India. So statutory body, right? Statutory authority. Statutory authority. I told you, right? Under deposits chapter, I told you funds received, from government, state government, local authority, statutory authority. Okay, so NFRA shall perform its functions through such divisions as may be prescribed. So if you look at functions of NFRA, maintain details of particulars of the auditors. So details of the auditors. Next one, recommendations to the central government with respect to accounting policies, accounting standards, auditing policies, auditing standards. Next one, monitor and enforce compliance with accounting standards and auditing standards in such manner as may be prescribed. The first one, it will maintain details of the auditors. It will give recommendations to the government with respect to formulation of accounting policies, auditing standards, accounting standards. The next one, monitoring whether all the companies and all the auditors complying these norms. Next one, italic content just give one time reading, not relevant, not important for examination. Italic content just give one time reading. Oversee the quality of services of the professionals associated. So, auditor has to express an opinion on the financial statements, whether they are free from material misstatements or not. So, whether auditor is negligent or other auditor is providing, qualitative services or not, monitoring. Next one, promote awareness in relation to the compliance of accounting standards and auditing standards. So, whenever new standard comes into the picture, impact of the standard, how to follow it, how to complete, just promote awareness programs. Next, cooperate with the national and international organizations of independent audit regulators in establishing and overseeing adherence to accounting standards and auditing standards. Next, finally, perform such other functions which are necessary and incidental to the aforesaid functions. For following above functions, we need staff, sir. Okay, recruit staff. We need branch officers, sir. We need branches in each and every state. Okay, establish your branches in each and every state, like that. Next one, who is having power to constitute NFRA, sir? Government, central government is having power to constitute NFRA and to delegate powers to the NFRA. Next, powers of NFRA. So, power to investigate. Next one, it will have same powers that are vested in the civil court, conducting investigation proceedings. Next one, discovery and production of books of accounts, summoning and enforcing the attendance, issuing summons to people. So you need to come to office by so and so time, so and so place. You need to produce documents and information. So inspection of any books, registers and other documents. Issuing commissions. Commissions is not money, it's a notice, intimations. Okay, notices. So issuing commissions for examination of witness or other documents. In case of any professional misconduct or any other misconduct, NFRA is having a power to levy penalty. If any auditor commits default with respect to his duties, so auditor is subject to the punishment, not less than 1 lakh, which may extend to 5 times of fees received in case of individuals, not less than 5 lakh rupee, but which may extend to 10 times of fees received in case of firms. So if auditor, if a partnership firm is acting as an auditor, firm of auditors, or individual auditor, punishment maximum 1 lakh rupee. 1 lakh rupee, not less than 1 lakh rupee, right? Okay. So minimum 1 lakh rupee and maximum 5 times of the fees. The next one, with respect to firm of auditors, it is 10 times of the fees received or 5 lakhs. At the same time, NFRA is also having power to debar the member, ban period. So for example, 5 years, you are not permitted to do practice related activities. 5 years, you can't audit any entity. 5 years, you can't provide any consultancy services to any entity, like that, debarring member from institute. And still, if you had any objection, you can file appeal with National Company Law Appellate Tribunal against orders of the NFRA. Understood? Next one, so debarring the member of firm from being appointed as an auditor, external auditor as well as internal auditor for any undertaking, for any entities. Next one, performing any valuation as provided under section 247. So from these two activities, you will be debarred for a period minimum how much? Minimum 6 months, maximum 10 years. If you are opposing NFRA order, if you want to oppose NFRA order, then you can file appeal in National Company Law Appellate Tribunal. Understood? So next one, administrative aspects of NFRA, not important for exams. So I'm not revising this topic. Just give one time reading. That's it, sufficient. Who will be the members of the NFRA and what are the powers of members of NFRA. Everything is there. Meetings of NFRA. So maintenance of books of accounts. Who will audit NFRA books? Annual reports, etc., etc. Not at all important, ma. If you had time, just give one time reading. Next one. Write about class or class of companies covered under NFRA. So NFRA will regulate some companies. What companies are? All listed companies. All listed companies. No exception. And coming to the unlisted company, paid up share capital minimum 500 crores, or unlisted companies having turnover 1000 crores or more, or unlisted public companies in aggregate, outstanding loans, debentures, deposits of not less than 500 crores as on 31st March of immediately preceding financial year. Either of these condition is satisfied, then unlisted public companies will come under the purview of NFRA. NFRA is having complete powers to monitor, to recommend, and to issue any order against these companies. So special entities, insurance, banking, electricity, and companies regulated by special act for the time being enforced, body, corporate. All these entities are also under the scope of NFRA only. NFRA will closely monitor these entities. And entities referred by central government. Any other entity, which is not covered above, but if government notifies it, then NFRA will also monitor such entities. So material SC or AC of the above. So subsidiary companies or associate companies of the above, simply related companies. So already we saw 4 companies, right? Listed company, unlisted company satisfying any of the criteria, and special entities and entities referred by central government. Now subsidiary companies to these entities, associate companies to these entities will also be monitored by NFRA. Understood? Now with respect to auditors of all these entities, definitely NFRA will monitor them. Next, section 133. Section 133. So write about prescribing of accounting standards by central government under section 133 of Companies Act 2013. Actually, one committee in ICI, Accounting Standards, National Advisory Committee on Accounting Standards, I think NACAS, will formulate accounting standards, auditing standards, and will recommend to ICI. ICI will recommend to NFRA. NFRA will make further recommendation to central government, and central government will prescribe the standards of accounting, standards of auditing. And every company is required to prepare financial statements according to accounting standards, except, I told you this one only, NACAS, except, banking company, insurance company, electricity companies. Is it clear, ma? Everyone. Okay, fine. Next one, section 134. Section 134 covers 2 aspects. One is contents of board report. Second one is approval of financial statements and board report. The first one, authentication of financial statements, simply approval of financial statements. So who is having authority to approve financial statements initially? Board of directors. The board of directors, by passing board resolution, they will approve company standalone financial statements as well as consolidated financial statements. After that, it shall be signed by the following people. First one, in case company is having a chairperson, and if the chairperson is authorized by the board, so he will sign the financial statements. If chairperson is not authorized, then 2 directors, out of which one shall be the managing director. And next, CEO of a company, if appointed, CFO of a company, if appointed, CS of a company, if appointed. Suppose, sir, myself, private company, I'm not having company secretary, CFO, and then CEO, sir. Then who will sign my company financial statements? 2 directors. One shall be managing director. Understood? Next one, coming to 1-person company. So in 1-person company, minimum 1 director is required. So board resolution, board approval not required, ma. Just signing by 1 director is sufficient. And submit these documents to the auditor for Audit. The auditor report shall be attached to every financial statements. Compulsory. Wherever you read the word financial statements, are they audited financial statements or unaudited financial statements? The answer is audited financial statements. Why? Because we need to attach audit report to the financial statements. Once you are attaching audit report to the financial statements, means the financial statements are audited ones. So company had no authority to circulate unaudited financial statements. Company have to circulate audited financial statements. See, something we call it as an attachment. That means it is not detachable. You can't separate it. Understood? A signed copy of every financial statement, including consolidated financial statements, if any, shall be issued, circulated, published along with a copy of notes to accounts, audit report, and board report. Next one, contents of the board report. So contents of the board report. Board report shall be prepared based on the standalone financial statements, but not consolidated financial statements. If you look at company, TCS, Tata Consultancy Services, it is having more than 46 subsidiary companies. If I'm not wrong, more than 50 subsidiaries it is having. So TCS is required to prepare individual financial statements. We call it as standalone financial statements. Next, consolidated financial statements, including the figures of subsidiary companies. Now, board report shall always cover the matters related to standalone financial statements. Board report will include the figures of standalone financial statements, but not consolidated financial statements. Board report is nothing but a report prepared by the board of directors. It is a communication by the directors to the members. So whatever directors want to tell to the members, so they will communicate all that matter through one report called board report. And that board report always prepared based on standalone financial statements, but not consolidated financial statements. However, it shall cover, it shall report on the highlights of the performance of subsidiaries, associate and joint venture companies. So simply highlights means, what is the total turnover of the subsidiary company and what is the net profit of the subsidiary company. And next one, what is the paid up share capital of the company, net worth of the company. So simply provide highlights in the board report. Next one, contents of the board report. Not important for exams, so just I'll give a summary. Contents, web address where annual return has been placed, and how many meetings of how many board meetings were conducted, and who attended the meeting. Next one, director responsibility statement. So this one is important. So contents of director's responsibility statement I'll discuss with you in the next question. So details in respect of frauds reported by the auditors under subsection 12 of section 143. You all know section 143 subsection 12. Auditor, while performing his duties, if he suspect or if he came to know that a fraud happened, if the fraud amount is 1 crore or more, then auditor has to report to the government of India. So he should write a letter, addressed to Secretary, Ministry of Corporate Affairs. If the amount of fraud is just less than 1 crore, no need to report to government of India, just report it to the company. Now directors have to express their opinions on such matters. So details in respect of frauds other than which are reportable to the central government. Next one, statement on declaration given by the independent directors. If company is having independent directors, then you have to get a declaration from independent director regarding his independence, and the same shall be included in the board report. Next, in case of a company covered under subsection 1 of section 178, nomination and remuneration committee, stakeholder relationship committee, company policy on directors appointment and remuneration, including criteria for determining qualifications, positive attributes, independence of a director and other matters provided under subsection 3 of section 178. So you have to cover these matters too. Next one, with respect to auditor qualifications, any reservation or adverse remarks made by the company auditor or company auditor or cost auditor or secretarial auditor, company secretary. So for all these negative remarks, so what board of directors are giving answers. So what are the explanations given by the board with respect to these qualifications, reservation or adverse remarks done by the auditors in their audit report. Next one, particulars of loans, guarantees, investments under section 186. So next one, particulars of contracts or arrangements with related parties. So whatever loans, guarantees, investments happen under 186. And next, contracts or agreements entered with related parties. So all those documents, information, particulars you have to furnish in board report. And then state of company affairs, position of the company, financial position of the company, amount if any which it proposes to carry to any reserves. Under dividends, I told you, in dividends topic, I told you, there is no compulsion on company to transfer portion of profits to reserves. It is a completely left to the directors, board of directors. So if any word is used, if they want to transfer to reserves, so what is the amount? The amount, if any, which it recommends should be paid by way of dividends. So one is, retained earnings, the other one is distribution of profits. Material changes and commitments, that occurred between the end of financial year and to which the financial statements relate to and the date of report. Generally, board reports were prepared after closure of the year, some 3 to 4 months after 31st March. If you look at board report, you'll get dates like this. 31st March 2023 is the closure of financial year. And if you look at the board reports, board reports will have date like this, 30th July 2023. Now the point is, during this time period, any material changes happened in the company. Material changes, important, significant. Any changes in the company. Suppose managing director of the company resigned from his post on 1st May 2023. So up to 31st March, he is the managing director. Subsequently, he resigned. So like that, you have to report in board report. Next one, conservation of energy, technology absorption, foreign exchange earnings and outgo. So this is all about, future related points. So how, what kind of equipments you are using in order to save energy for future generations, technology absorptions and foreign exchange earnings, exports revenue, imports revenue, outgo simply imports, in exports, such manner as may be prescribed. Next one, statement indicating development and implementation of a risk management policy for the company, including identification therein of elements of the risk. It's like an antivirus in our computer system. So what antivirus will do? It will detect virus and it will remove virus from our system. So risk management policy, it's a policy prepared and implemented by the directors in order to identify the possibilities of risk and eliminate the risk at root level itself. The details about policy developed and implemented by the company on corporate social responsibility initiatives taken during the year. So this is all about CSR. We'll discuss it under section 135. In case of listed company and every other public company having paid up share capital as may be prescribed, how much amount it is? 25 crores or more. See, listed company without any limit, listed company without any limit, unlisted public company, unlisted public company, if it's a paid up share capital is 25 crores or more, then a statement indicating the manner in which formal annual evaluation of performance of the board, its committees of individual directors has been made. So annual evaluation, it's like, self evaluation. So to what extent company is achieving success in fulfilling its objectives, to what extent, they are able to fulfill the promises made to the members of the company. So during the year, what kind of activities we initiated, up to what extent we completed the works. It's all about self-evaluation. And this self-annual evaluation is applicable only to two companies. One is listed company. Second one is unlisted public companies having paid up share capital 25 crores or more. Next one, such other matters as may be prescribed. Next one, with respect to such other matters as may be prescribed, some matters were prescribed under rules, rule 8 of company account rules 2014. If you look into it, financial summary or highlights. So simply I told you, right, paid up share capital. Next one, turnover. Next one, net profit, net worth, highlights. Next, change in nature of business, if any. So during the year, if company changed the nature of business, punish the details. Details of the directors or KMP who were appointed or have resigned during the year. So composition of board of directors. Statement regarding opinion of the board with respect to integrity, expertise and experience of independent directors appointed during the year. So simply it's opinion from the directors with respect to independent directors, integrity, expertise and experience. And name of companies which have become or ceased to be its subsidiaries. So during the year, it got 2 subsidiaries, or it sold shares of subsidiary companies, thereby a cessation of subsidiary relationship happened. So those details you have to provide. And deposits details. So details of deposits which are not in compliance with requirements of chapter 5, you have to include all this information. Details of significant and material orders passed by the regulators or courts or tribunals impacting the going concern status and company operations in future. Suppose company didn't pay GST amounts. Recently, I saw one notice. Revenue Department of Government of India issued notices to Dream 11, so to pay taxes. Understood. Now company challenged the notice in High Court. Suppose if they win the case, they are not required to pay any amount to the government of India. If they lose the case, then they are required to pay the amount to the government of India. Now, if they are having sufficient funds to pay that much amount, no problem. Sir, they are not in a position to pay that much amount, sir. Next, what happens? Binding up proceedings will be initiated. Yes or no? So, material cases, how it is impacting going concern status. Next one, details in respect of adequacy of internal financial controls with respect to financial statements. So, internal financial controls, one kind of risk management policy. So are they working, accurately, adequately, sufficient or not, like that. And next one, disclosure with respect to maintenance of cost records as specified by central government under section 148. So disclosures with respect to cost records. And next one, a statement that company has complied provisions regarding constitution of internal complaints committee under sexual harassment of women at workplace. Protection of women. Protection of women. And next, details of application made or any proceeding pending under insolvency and bankruptcy code. Next, details of differences between amount of valuation done at the time of one-time settlement and valuation done while taking loan from banks or financial institutions along with reasons thereof. So simply at the time of getting loan, so you valued your property, and at the different time, after some time you valued the same property. If any differences you found, you have to report them in board report. So don't worry, ma. This much lengthy question they won't ask you. They won't ask this much lengthy questions. This much lengthy questions for 2 to 3 marks. Okay. So practically, this chapter is important from practical questions point of view. Next one, abridged board report, ma. So if you look at the points we covered so far, so generally, formal assessment, formal annual evaluation, subsidiary companies' financial performance, financial positions, highlights of the subsidiary companies, joint venture companies, everything we saw. But these points are not relevant for small companies, one-person company. Why? Because one-person company can't become a member of another company. One-person company can't invest securities in body corporates, can't invest securities of a body corporate. Yes or no? Small company, it should not have holding company, it should not have subsidiary company. Are you getting my point? So OPC, small companies, they won't have holding companies, they won't have subsidiary companies. So why that information? Why we need to ask that information? OPC provide information of your subsidiary, small company provide information of your holding company, subsidiary company. What is the need of asking them? Actually, these points are not applicable to them. Yes or no? So the points we discussed so far, which are not applicable to these entities, no need to report them. Accordingly, after removal of those points, we get another board report, and it is a abridged board report. The abridged board report will have only few points compared to normal other companies, like web address, number of meetings, director responsibility statement, and 143.12, fraud less than 1 crore. Next one, every qualification, reservation, adverse mark made by the auditor with respect to these qualifications. So explanations given by the board, state of company affairs, financial summary or highlights, material changes, details of the directors who have been appointed or resigned, details of significant and material orders passed by the regulators during the time period, after closure of financial year till the date of preparation of board report. So that's it, ma. Other than that, not required. Other information is not required. So it will contain only 12 points. That's it. Next one, board report in case of OPC. So who will sign board report in case of OPC? Single director signing a board report is sufficient. So in case of OPC, the report of the board of directors to be attached to the financial statements under this section shall mean a report containing explanations or comments by the board on every qualification, reservation, adverse remark or disclaimer made by auditor in his report. Coming to the signing, one director signing board report is sufficient in case of OPC. With respect to other companies, it should be signed by at least 2 directors, and one should be the managing director. Understood? Or by the director where there is only one director. Example, OPC. Coming to the financial statements, you can see, chairperson if authorized by board, or 2 directors, one must be managing director. Next, CEO, CFO, CS if appointed. But coming to board report, these many options, these many people are not required. Only 2 directors signing board report is sufficient. One should be managing director. In case of OPC, single director signing board report is sufficient. Next, punishment for contravention. As usual, company penalty 3 lakhs. Officer in default, penalty 50,000. Every year, company is required to file financial statements with ROC. Financial statements includes, financial statements also includes audit report as well as board report. Now you need to file audit report and board report with ROC. So central government, it will verify few documents on sample basis. If it come to know that company violated the provisions of section 134, it didn't provide information related to subsidiaries, it didn't provide information related to holding companies, etc., etc. In that case, government is having a power, MCA is having a power to levy penalty on the company. Penalty is 3 lakhs. Officer in default, penalty 50,000 rupees. Next one, contents of a director's responsibility statement. Being a director, some additional, some duties are attached. Some duties were placed on you. Being a director, you need to fulfill some responsibilities. In that first responsibility, while preparing financial statements, you have to comply accounting standards. Sir, I have complied accounting standards in preparation of financial statements. Next one, accounting policies, like with respect to depreciation, straight line method, written down value. Next, coming to the valuation of closing stock, FIFO, first in first out, LIFO, last in first out, weighted average, simple average. Do you remember these methods of valuing closing stock and methods of depreciation, right? So first year, whatever policies you implemented, next year also apply the same policies. Then only users of financial statements will feel better in comparing the results. In comparing the results, they will feel better. So compared to last year, this time profit went up. Compared to last year, this time sales went up. Apply accounting policies consistently. In case if you are if you don't want to apply previous year accounting policies, then just report it in the following areas. So we didn't apply the previous year financials, previous year accounting policies due to these reasons. And what would be the impact, what would be the effect on the financial statements? You clearly explain them. Next, directors had taken proper and sufficient care for maintenance of adequate accounting records. So whose responsibility maintaining accounting records? Directors. So safeguarding the assets is also the responsibility of director. Today member is coming to the company and he is just investing money in the company. He is not eligible to participate in day-to-day affairs of the company. Why? Because separate legal entity, company is separated, members are separated, company is separated, owners are separated. So it is the responsibility of the directors to take care of assets of the company. Next one, directors has prepared annual accounts on going concern basis. As I told you previously, if company's going concern assumption is appropriate, then financial statements are prepared based on cost historical value basis. If going concern assumption is not proper, then all the assets shall be valued at realizable values. So directors have to prepare annual accounts on going concern basis if going concern assumption is appropriate. The directors in case of listed company had laid on internal financial controls to be followed by the company, and that such internal financial controls are adequate and were operating effectively. Next, all these points already covered. Safeguarding of assets, company policies, prevention and detection of frauds, accuracy, timely preparation of reliable financial statements. Next one, the directors has devised proper systems to ensure compliance with provisions of all applicable laws. For doing business in India, you have to comply various laws and regulations. Example, I'll tell you, if you are a manufacturing entity, you need to comply Factories Act. Next, protection of environment related provisions. Next, with respect to employees, you need to follow EPF Act, Employee State Insurance Act, provision of gratuity act, payment of gratuity act, payment of bonus act, minimum wages act. Understood? Next, payment of wages act. Next one, being a company, you need to follow Companies Act, and you are earning a revenue, so you need to pay income tax. So Income Tax Act. Next one, indirect taxes. Next, if you are making any exports, then custom duties. So yes, every time you have to comply all the applicable laws and regulations. So now director has to tell, yes, we devise proper systems. So periodically we are verifying ourselves whether we are in compliance with all the applicable laws or not. So if any deviation, we are rectifying it. Like that, director has to specify in his director's responsibility statement. So this is all about section 134. Next one, section 135, corporate social responsibility. Corporate social responsibility. Today company is doing business with various natural resources, various natural resources. If you take any oil companies, oil petroleum diesel companies, so they are doing business from the raw material which they are getting from nature, crude oil, non-renewable resources, or no. So company is carrying some manufacturing operations, definitely it require labor, so labor comes from society only. And once production is completed, once product is finished, now for selling the product, company needs customers come from society only. So today company is surviving only because of society. Yes or no? Now it's your responsibility to contribute something for the benefit of society. Every companies are no, only companies covered under section 135. So what is the criteria to cover under section 135? One is, net worth 500 crores or more. Every company, whether it is a private or public, whether it is a OPC or, small company or government company, listed company, every company, it is immaterial. Every company having net worth of 500 crores or more. Sir, my net worth is 100 crores only, sir. Next, second condition. Turnover 1000 crores or more. Sir, my turnover is 600 crores only, sir. And or net profit 5 crores or more. Sir, my net profit is 5.1 crores, sir. That's it. CSR provisions will apply to you. You have to comply section 135. The moment section 135 is applicable, the next minute you have to constitute CSR committee. Every company can have maximum 15 directors. Suppose in our company also there are 15 directors. Out of 15, call 3 people, call 3 directors to form a committee called CSR committee. If your company is having independent director, then out of 3 directors, one shall be independent director. So during the preceding financial year, any of these conditions satisfied, net worth 500 crores or more, turnover 1000 crores or more, net profit 5 crores or more, then CSR provisions shall apply to you. Accordingly, you have to constitute CSR committee. So now the strength of CSR committee should be 3 or more directors, general rule. Coming to private companies, you will find only minimum 2 directors, right? So for private company, CSR committee can have 2 directors and no need of independent director. If independent director is there, then one independent director should participate in the CSR committee. Next one, holding subsidiary company, foreign companies. Every company, including its holding subsidiary foreign company, defined under section 2 clause 42, having its branch office or project office in India. Foreign companies having project offices in India, which fulfills the criteria provided in this section, and these rules shall comply with the provisions of section 135 and these rules. Suppose PUBG is there. Initially it is a foreign company, it is having a business in India. So we people, for playing those games, we are depositing our money, we are paying some money. Now, from India, if they're doing a business of, turnover of 1000 crores or more, and in India, if their net worth is 500 crores or more, in India, if they're getting profit of 5 crores or more, then CSR is applicable to them also. So whatever revenue, whatever incomes they are generating from India, out of that revenue, out of that profit, they need to spend certain portion on welfare of the society, on the development of this society. So meaning of net worth already told you under deposits chapter. Paid up share capital plus reserves plus securities premium minus accumulated losses not written off minus miscellaneous assets. I told you, right? But it's not include revaluation reserves. The revaluation reserves are not covered while calculating net worth. So once CSR is applicable to you, the very next minute you have to constitute CSR committee. Next one, cessation of CSR applicability. Sima, for the current year, financial year 2023-24, whether CSR applicable or not, you have to look into the preceding financial year, that is 2022-23 balance sheet and profit and loss account for net worth, turnover and net profit. So you have to check on yearly basis. Previously, for the last 3 years, if you are not complying, if you are not covered under criteria, then you will be given freedom. No need of following this section. Right now, that provision is omitted. So every year you have to check preceding financial year figures. Suppose in preceding financial figures, your net profit is 6 crores. Assume remaining 2 are within the limits only. Net profit 6 crores. Now for financial year 23-24, you have to spend money on CSR. Suppose for financial year 23-24, net profit came to 3 crores only, sir. then 2024-25, no need of CSR, no need to comply CSR provisions, no need of CSR committee, no need of incurring CSR expenditures. Next one, composition of CSR committee. I told you minimum 3 directors that committee should have. Minimum how many directors? 3 directors. In case of private company, 2 directors are sufficient. In case of listed companies or unlisted companies having a the independent director, then that independent director shall also participate in CSR committee. Just look these points, ma. You will only have clarity. You will only get clarity. The private company having only 2 directors, then board shall constitute its CSR committee with 2 of such directors. Next one. With respect to foreign company covered under these rules, the CSR committee shall comprise at least 2 persons, of which 1 person shall be specified under clause D of subsection 1 of section 380 of the Act, and other person shall be nominated by the foreign company. So just look at this summary box, you'll get clarity. Next one, disclosure of CSR committee. So you need to disclose the details of CSR committee. So who are the members of CSR committee? You have to disclose those details in annual return. Next one, duties of CSR committee, ma. Very simple. FRM, fraud risk management. No. F stands for formulate policies, recommend CSR policies to board of directors and ask them to contribute this much amount for fulfilling these activities. M stands for monitor the performance of the CSR committee, monitor the progress of this project. So recommend, next formulate, recommend, and formulate and recommend it to the board CSR policy, recommend the amount of expenditure needed for fulfilling these activities, and monitor CSR policy of companies from time to time. And their annual action plan, the list of CSR projects or programs that are approved to be undertaken in the areas are subject to specified in Schedule 7. So Schedule 7 will contain, activities related to CSR. You need to spend money on any activity which is specified in Schedule 7. The manner and execution of such projects or programs, modalities of utilization of funds and implementation, monitoring and reporting mechanism, impact assessment. Sir, impact assessment means what? You created CSR committee for the purpose of education, and you diverted some 60 crore funds for providing education. Now under impact assessment, we will assess to what extent this object we are achieving completely. So out of 6 crores, how much money is reaching to the public for the benefit of the public? So you divert, you simply separate, you kept 6 crores money separately for the welfare of people by providing education. Now out of 6 crores, how much money spent and how many people got benefited? So that assessment is nothing but impact assessment. Next one, duties of the board. CSR committee will recommend the expenditure, will recommend the CSR policy. Now it is the duty of board of directors to approve the CSR policy and allot the required funds for meeting the project needs. So activities, ensure that activities are included in CSR policy of the company and are undertaken by the company. So display CSR activities on its website. Sir, how much amount I should spend under CSR, sir? 2% of last 3 years profits. Suppose last 3 years profits, 3 crores, 5 crores, 15 crores. Now with respect to current financial year, you just average it, 15 plus 5 plus 3 divided by 3, 2023 by 3. Okay, I'll make it as 4, why unnecessary confusion. 24 by 3, 8 crores. Now on 8 crores, you need to apply 2%. No need to spend 8 crores, Your profit, your average profit is 2 crores. Sorry, your average profit is 8 crores. Then how can you spend entire 8 crores on CSR? So out of 8 crores, spend not less than 2%. At least 2% of average net profits made during 3 immediately preceding financial years on CSR. In case of new company, sir, first year of incorporation, sir. In the first year of incorporation only, we got a net profit of 10 crores, sir. Now last 2 years company is not in existence, right? So 10 crores directly you take. 10 divided by 1, so average 10 crores. 10 crores into 2%. So it might be 20 lakhs, right? Yeah. Failure to spend the required minimum amount. So company failed to spend such amount, sir. Then disclose the same in board report. Whatever amount unspent, just transfer that amount to unspent CSR account, like unpaid dividend accounts. You have to open separate account called unspent CSR account. Unspent amount to the fund specified in Schedule 7. within a period of 6 months from the expiry of financial year. So right now we are in the financial year 2023-24, right? So last 3 years average profit is 20 crores. 20 crores into 2%, 40 lakhs you need to spend. Sir, so far I spent only 30 lakhs in this financial year, sir. Then remaining 10 lakhs you need to transfer to unspent CSR account. Sorry, it's not unspent CSR account. Unspent CSR account is applicable for ongoing projects. So this is the case, other than ongoing projects, right? Ongoing projects means, projects having longer duration, multi-year projects, simply more than 1 year. If a project requires time of more than 1 year, we call it as ongoing projects. So other than ongoing projects, you have to spend money completely within the year, or else within 6 months from the closure of financial year, transfer that amount to the fund specified in Schedule 7. Next one, unspent amount for ongoing project. Unspent amount for ongoing projects. In case of ongoing projects, you need to transfer that amount to unspent CSR responsibility, CSR account, and such amount shall be spent by company in pursuance of obligation towards CSR policy within a period of 3 years from the date of transfer. No, sir, we didn't utilize within the 3 years. Then within 30 days from the closure of third financial year, transfer amount to the fund account. See, very simple, ma. You need to decide whether the project is ongoing or not. Suppose if it is ongoing, you didn't spend complete amount. Remaining amount is transferred to unspent CSR account. Unspent CSR account. So you will be given 3 years time to use that fund. 3 years completed, but still you're not using that funds. Then within 30 days, within 30 days from expiry of that 3 years, transfer to fund specified under Schedule 7. Sir, not ongoing project, sir, not ongoing project. Now, any amount remained with the company within 6 months of closure of financial year, transfer the amount to fund directly. So, no need of unspent CSR account. Clarifications not that much important, ma. Just clarifications, just give one time reading. So, in that, one important clarification is, suppose if a company spent 10% of average profits on CSR, 10% profits it's spent on CSR, ma. In that case, 8% they can carry forward to next years. So next years, even though they didn't incur CSR expenditure, no problem. Out of 10%, already you incurred 10% in the last year, right? So excess will be carried forward to next year. Excess amounts you spent will be carried to the next year. Next one, administrative overheads, ma. See, ma, for spending money on CSR related activities, definitely I need staff. Yes or no? I need staff. So I need to pay salaries to them. And those people will visit projects regularly. Traveling expenses, salary expenses, nothing but indirect expenses, overheads. So for meeting these expenses, in order to fulfill CSR provisions, we call them as administrative overheads. You can incur administrative overheads up to 5% of total CSR expenditure. Suppose 40 lakhs is the amount kept aside for meeting CSR expenses. Out of this 5%, that means only 2 lakhs. Up to 2 lakhs you can incur administrative overheads. Beyond this, if you incur, we won't consider them under CSR expenditure. You need to spend additional amounts. Next one, any surplus arising out of CSR activities shall not form a part of business profits, ma. Shall not form part of business profits. Suppose providing education, you constructed buildings, school buildings, and you appointed teachers, and you are collecting some nominal fees for providing education. Now at the end of the year, incomes you received is more than expenditures you spent on that education. So there arises a surplus. Now you should not add this surplus to the business profit. This surplus you have to invest on promoting the similar objects. So those amounts are disqualified from declaration and payment of dividends. So treatment of excess expenditure spent, I told you. So immediate succeeding 3 financial years carry forward option is there. Simple, like income tax act, if you have any business losses, unspeculative business losses, those losses shall be carried forward for next 8 years. So next 8 years, if you get profit, you can set up the losses with the profits. So capital assets for CSR activities. So for CSR activities, if you purchase any capital asset, sir, can I purchase any capital asset? Yes, you can purchase capital asset, and that capital asset shall be held by, the registration of capital asset shall be in the name of, Section 8 company or registered public trust or registered society having charitable objects. And CSR registration number under sub rule 2, rule 4 is compulsory. So beneficiaries of said CSR project in the form of self-help groups, collectives, entities, or any public authority. Now, Ma, you can choose any activity specified under Schedule 7. You can spend money on it. That amount will qualify as CSR expenditure. That amount will qualify as CSR expenditure. But certain expenditures are excluded from CSR expenditure, Ma. That means even if you spend this much amount, even if you spend this amount will not be qualified as CSR. Sir, what are those activities, sir? Normal course of business. Normal course of business. Activities undertaken in pursuance of normal course of business of the company. Just wait. Suppose ma you started a dairy company, a milk company. And what you are doing, for promotion of that business activities, you are providing some goods on sample basis at free of cost. Free samples you are distributing. Free samples you are distributing. Now the point is, sir, can we take that expenditure under CSR expenditure? No, not permitted. And next one, myself, educational institute company providing educational services, and my net profit during the year was 10 crores. Now I need to spend some portion of amounts, certain portion of profits on welfare of the society. So now what I did, I selected some 10 students, from poor families. The track record is very poor. Their family record is very poor. Now I selected 10 students. I told them free education to you, free education services to you. See, my primary business is education. Now, if you select any students and giving scholarships to them who join in your institute, so those activities will not qualify as CSR expenditure. Those expenses will not qualify as CSR expenditure. But there is an exception, with respect to COVID pandemic. Dr. Reddy Laboratories, Sun Pharma companies, Cipla, all these companies, are already in drug business, right? Or are already in medical businesses. So now for development of a vaccine or a medicine in order to cure COVID, so if they spend any amount on experiments, research and development, so all these expenses shall form part of CSR expenditure only. Actually, this is also a normal course of business only. This also looks like normal course of business, but this is permitted. So medical companies spending money on research and development related to development of vaccines, drugs and medical devices, particularly with respect to COVID pandemic. During the financial years 2021, 21, 22, 22, 23. So all those expenditures are eligible or qualified, are qualified under CSR. Subsequent years not qualified. Next, any amount is spent on activities outside India. Outside India, right? You have to give priority to India. You are earning profits from India, you have to give priority to India. So any activity undertaken outside India is not eligible CSR activity. Next, donation to the political parties. Next one, giving benefits to the employees, sponsorship services, all these are disqualified expenditures. Accordingly, you should not consider them. Sponsorship activities, supported, example, Baiju sponsorship to Indian cricket team. Yes or no? India cricket team jersey, if you observe, Baiju, they will, sorry. So the dress code, the shirts of Indian cricket team, sorry, jersey will have a Baiju symbol. Yes or no? Jersey will have Baiju symbol. For that, Baiju will pay some 4,000 or 5,000 crores to BCCI every year. Now, sir, this 4,000 or 5,000 crores we are spending on sponsorship related activities. Can we account them under CSR expenditure? No. Next one, statutory obligations. Activities carried out for fulfillment of any other statutory obligations under any law in force in India. Suppose if you look at Section 8 companies, they're having a statutory obligation. They need to spend money compulsorily on the welfare of the society. So like that, if any company is having a statutory obligation like that, so expenditure incurred on that statutory obligations will not be accounted as CSR expenditure. For example, if I want to start a hotel business, first and primary requirement is FSSAI license, food license. For getting food license, I need to pay fees to the government of India. central food license, I need to pay fees to the government of India. Now, payment of these, statutory fees, taxes, will they come under CSR expenditure? The answer is no. So you have to remember these points. Points excluded from CSR expenditure, very very important. So with these provisions related to CSR, we completed. First important point, applicability. Next, composition of CSR committee. Next one, quantum of CSR expenditure, 2% of last 3 years average profits. Next one, unspent CSR money. If it is related to ongoing project, just transfer to separate bank account, utilize it in the next 3 years. Failed to utilize in the next 3 years. Now within 30 days, you have to transfer to the fund specified under Schedule 7. If it is not ongoing project, then within 6 months from the closure of financial year, transfer unspent CSR amount to fund specified under Schedule 7. Next one, if company want to spend CSR expenditure directly, they can spend directly. Board shall ensure that CSR activities are undertaken by company itself directly or indirectly through any Section 8 company or through registered public trust or through society which is registered under Section 12A and 80G of Income Tax Act 1961, exempted under Section 10 subsection 23C clause 4, 5, 6, 7A. So you can incur CSR expenditure through these entities also. Simply, transfer amounts to these entities. Now these entities spending money on the public sufficient. You only directly spending on you only spending amount directly on the public. We assume that you are spending that money on the public directly. Next one, a company established under Section 8 of the Act or registered trust or registered society established by the central government or state government or any entity established under Act of a parliament or state legislature, statutory authorities. Next, a company established under Section 8 of the Act or registered public trust or a registered society exempted, under these sections, having an established track record of at least 3 years in undertaking similar activities. So you can select these entities and you can transfer money directly to these entities. And these entities will spend money on the welfare of the society. So we assume that you have complied the provisions of Section 135. Or you can collaborate with other companies also. Suppose Reliance Foundation is there, Tata Foundation is there. So collaborate with these companies and spend amount related to corporate social responsibility. That's fine to us. So next, remaining points, just give one time reading. Remaining points are not that much important. So applicability, all these points are very very important. And one more point with respect to multiple choice question, impact assessment. Just I told you, impact assessment. So to what extent a company is fulfilling the objectives, specified under CSR. So, how many people are getting benefited through these CSR activities. So for doing that, impact assessment is required. But impact assessment is not compulsory for all the companies. Is it clear? So every company having average CSR obligation of 10 crore rupees or more. CSR obligation how much more? 10 crore rupees or more. In the 3 immediately preceding financial years shall undertake impact assessment through an independent agency of their CSR projects having outlays of 1 crore rupees or more and which have been completed not less than 1 year before undertaking the impact study. So companies having CSR obligation 10 crores or more in the last 3 preceding financial years are required to undertake impact assessment. And with respect to impact assessment, yes, you can incur expenditure maximum 2% of total CSR expenditure or 50 lakhs, whichever is less. Now people who carry impact assessment, you have to pay a remuneration to them, right? That remuneration amount shall not exceed 2% of CSR expenditure or rupees 50 lakhs, whichever is less. Next one, Schedule 7 related activities. Just give one time reading. That's it. Next one, Section 136. So do you remember Section 101, notice calling for meeting? Company has to give notice to all the members of the company. If any member is deceased, then legal representative of the member. If any member become insolvent, then official SNE of the member. Next, every trustee of the debenture holder as well as deposit holder and all the persons other than such members or trustee being a person so entitled to, simply auditor of the company, directors of the company. So it is the duty of company to circulate audited financial statements along with audit report and board report at least 21 days before the date of annual general meeting. So simply notice related provisions 136 is similar to section 101. So conditions for a period less than 21 days. That means we call it as shorter notice. So for shorter notice, you need to get approval from the members. Sir, what kind of approval, sir? See, majority number of members entitled to vote, and they should represent not less than 95% of paid up share capital entitled to vote at the meeting. So if it is a company having SC means what? Company having share capital. If a company is having share capital and if that company wants to circulate financial statements for a period less than 21 days, so then prior approval from members is required. And what kind of approval? Majority of members, and they should possess at least 95% of paid up share capital at the time of giving approval. And if it is a company not having share capital, then members having not less than 95% of total voting power shall give approval to the shorter notice. So additional conditions for listed companies. Listed companies will have unlimited members, lakhs of members. They may have lakhs of members. So circulation, they have to circulate. But complete set of financial statements, standalone financial statements, consolidated financial statements. Now, submitting all these reports to all the members, definitely it's a cost making thing and time taking thing. Cost making as well as time taking thing. So it is sufficient, if they post all these statements and reports on company website and summarized form of financial statements, summarized form of statements. It is sufficient to circulate summarized form of statements. That's it. The listed company publish on website. A listed company shall also place its financial statements, including consolidated financial statements, if any, all other documents required to be attached thereto on its website, which is maintained by or on behalf of the company. So if you look here, statement containing salient features of the documents in the prescribed form or copies of the documents as the company may deem fit is sent to every member of the company and trustee of the holders or any debentures issued by the company not less than 21 days before the date of meeting, unless shareholder asks for full information, full financial statements. So initially we will send them abridged financial statements. Later, if any member requests for full financial statements, then company has to submit full financial statements to the requested member. Logic is very simple. Listed company will have unlimited members. So if you look at ITC, it may have 3 million members, 30 lakh members. Now 30 lakh copies you need to print it out and 30 lakh copies you need to circulate. So costly thing. Next one, time taking thing. So to save money and to save time, this provision came into picture. Next one, every listed company having a subsidiary or subsidiaries shall place separate audited accounts in respect of each of the subsidiary on its website, if any, and provide a separate audited or unaudited financial statements as prepared in respect of its each of its subsidiary to any member of the company who asks for it. The subsidiary information you have to provide to the members of the company. Foreign subsidiary, same norms, foreign subsidiary. So if foreign subsidiary financial statements are not available in English language, then prepare financial statements in English language. If audit is mandatory in foreign countries, then you have to provide audited financial statements. If audit is not mandatory, then you have to provide unaudited financial statements. That's it. Audit is not mandatory in that country, then how? So there is no need of getting audited. Understood. Next, Nidhi company exempted. Nidhi company is exempted from provisions of section 136. No need of circulation of financial statements. Just place it on company notice board. So at the registered office, definitely you'll have notice boards. So in that notice board, you just place the financial statements. So the people who is having interest in it, or people who had adequate knowledge with respect to accounting standards and schedule 3, they will come and they will look into the matters. That's it. So just go through this chart once. So this chart is providing information with respect to section 136. Complete information, ma. Every, copies of audited financial statements, including consolidated financial statements, if any, audit report, other documents sent to every member of the company, debenture holder, trustee, and other entitled persons. What is the time limit, sir? At least 21 days before general meeting. The circulation of financial statements for listed companies, they can choose electronic mode. Public company where net worth is more than 1 crore and turnover more than 10 crores. So dispatch of physical copies. Two options are available to them: electronic mode or dispatch of physical policies. Understood? So with respect to electronic mode, shareholders holding shares in demat form and shareholders not holding shares in demat form, and where consent is given for electronic mode of documents, then submit those documents in electronic mode. In other cases, deliver documents in physical copies only. So the chart information is there under this question. Next one, section 137, filing of financial statements with ROC under section 137. So filing of annual returns under section 92 we discussed already. So what is the time limit, ma? Within 60 days of AGM. If AGM is conducted. If AGM is not conducted, then within 60 days of due date of AGM, right? Due date of AGM, you have to file information with, you have to file annual returns with ROC. That is with respect to section 92. Section 137 is all about filing of financial statements with ROC. Sir, what kind of financial statements are? Adopted financial statements. Sir, when we call financial statements as adopted financial statements, the answer is when members pass ordinary resolution approving the financial statements, we call it as adopted financial statements. So what is the time limit for filing adopted financial statements with ROC, sir? 30 days of date of AGM. Within 30 days of date of AGM, you have to file adopted financial statements with ROC. If AGM is not conducted, then you have to file unadopted financial statements with ROC within the same time period, 30 days of due date of AGM. 30 days of due date of AGM. Sir, AGM conducted, sir, but in that AGM, financial statements were not approved because of so and so reasons, sir. Then, file unadopted financial statements with ROC within 30 days of AGM. And, conduct adjourned annual general meeting with respect to adoption of financial statements. So in adjourned annual general meeting, if financial statements got adopted, then again file adopted financial statements. This time adopted, last time unadopted. Last time unadopted financial statements you filed. Now you file adopted financial statements with ROC within 30 days of approval. So XBRL, Extensible Business Reporting Language, this is applicable to a few companies. And remember the criteria, remember the criteria. So AOC 4 is available in two ways. One is, XBRL format. So if you want to open file which is there in XBRL format, you must have relevant softwares. Then only you can open this AOC 4. Other companies, normal filing is sufficient. XBRL is not required. So XBRL is applicable to all listed companies and their subsidiaries. Next one, unlisted company. If that company is having paid up share capital 5 crores or more, and if that company or if that company is having turnover 100 crores or more, or all companies which are required to prepare financial statements in accordance with Ind AS. So if your company is falling within this category, then you have to file AOC 4 under XBRL mode. Other companies, other mode. Next one, XBRL is not applicable to these entities, even though they are listed. Suppose SBI is their listed company, XBRL is not applicable to them. Understood? Next one, non-banking financial companies, housing finance companies, companies engaged in the business of banking and insurance sector. So even though your paid up share capital is 5 crores or more, 5 crores or more, still no need to follow XBRL reporting method. Next one, once applicable, always applicable, so applicability is forever. Once you start filing under XBRL, so subsequent years, even though you are not fulfilling the criteria, but still you have to follow XBRL method of filing only. Next one, if the financial statements are not adopted, I told you AGM conducted but financial statements are not adopted, so file them as unadopted financial statements as provisional, temporarily take these financial statements. And if the financial statements are adopted in adjourned AGM, then they shall be filed with registrar within 30 days of date of such a adjourned AGM with relevant fees. Now, coming to the one-person company, general meeting is not required, right? So 30 days of AGM, what is the general time limit? 30 days of AGM. For one-person company, AGM rules and regulations will not apply. So for one-person company, the filing of these forms, the time period is 180 days from the closure of financial year. What is the time period, ma? 180 days from the closure of financial year. So generally, 27th September, recently, very recently, I filed two one-person company annual returns, two one-person company financial statements. So that's what, I remember this date. So by 27th September, they need to file these forms with ROC. Next one, in case company is having subsidiaries, then subsidiary information is also, then company is also required to file subsidiary information. If subsidiary or subsidiary companies have been incorporated outside India and which have not established their place of business in India, then that financial statements, our company is required to file it with ROC. Sir, with respect to subsidiaries in India, this provision is not applicable. Why? Why? Because they will file copy of financial statements with ROC under section 137. SEMA, TCS is having two subsidiaries. One is A Limited in India. The other one is F Limited in foreign. So for F Limited, which is incorporated outside India and which is doing business outside India, our Companies Act provisions will not apply. So accordingly, F Limited is not required to file any annual returns with ROC, any financial statements with ROC. A Limited Indian subsidiary, definitely it will file financial statements under section 137. Understood? So Indian subsidiaries not required, whereas foreign subsidiaries, which is not having place of business in India, with respect to that entity, holding company, Indian holding company has to prepare financial statements and subsidiary financial statements shall be filed with ROC. AGM not held, sir. AGM not held. Then, file unadopted financial statements as, provisional and disclose the details why AGM was not conducted. What is the reason, why AGM was not conducted? Disclose the reasons. So the moment you conduct annual general meeting, adopt the financial statements. Now from the date of annual general meeting, file adopted financial statements with ROC. This time, permanent financial statements. Previously provisional, right now permanent. Penalty, violation of section 136, these penalty, violation of section 137, these penalty provisions shall apply. And last section of accounts of companies, internal audit. Internal audit. In this entire internal audit section, this is the important topic, important. Criteria of applicability of internal audit. Internal audit is applicable for all listed companies, irrespective of paid up share capital, irrespective of turnover, irrespective of outstanding loans and borrowings. So I don't check the limits. If you are a listed company, internal audit is mandatory. Coming to the unlisted public companies, not private companies, unlisted public companies, paid up share capital 50 crores or more during the preceding financial year. Or, sir, my paid up share capital is just 5 crores, sir. Acha? So what is your turnover? Sir, my turnover is 250 crores, sir. Okay, internal audit is applicable to you. So turnover 2 crores or more during the preceding financial year. Sir, my turnover is just 100 crores, sir. Okay. So what is your outstanding loans or borrowings? Sir, my outstanding loans and borrowings is just 110 crores, sir. Okay, internal audit is applicable to you. So 100 crores or more at any point of time. Just observe my AB points. You need to check financial year ending date as on 31st March. But coming to C point, at any point of time. CD points at any time during the financial year. Say for suppose on 1st April 2023, my total borrowings is just 50 crores. On 31st December 23, total borrowings increased to 101 crore. And 31st March 2024, total borrowings fallen to 40 crores. Now, internal audit, applicable or not applicable? The answer is applicable. Why? Because at one point of time, as on 31st December 2023, your total borrowings exceeds 100 crores. That's it. Internal audit is applicable for the current year. So with respect to point C and point D, we are not checking as on 31st March of the financial year. We will check at any point of time during the financial year. Now coming to the private company, BC points are applicable. BC. One is, turnover. The other one is outstanding loans or borrowings from banks or public financial institutions exceeding 100 crore rupees or more at any point of time during the preceding financial year. Next one, generally for external auditors, statutory auditors, Companies Act will determine the scope of audit. Coming to the internal audit, if company is having audit committee will decide the scope of internal audit. If there is no audit committee, then board of directors will decide the scope of internal audit. Next, who can be an internal auditor? With respect to company auditor, statutory auditor, independent person, chartered accountant holding certificate of practice. But coming to the internal auditor, any person can act as an internal auditor. He may be a CA or CMA or CS, whether in practice or whether in employment, it is immaterial. Even company can appoint an employee. Company can appoint its employee as an internal auditor. There is no problem. First of all, internal audit function should be there. Understood? So with this, provisions related to accounts of companies we completed.